Hello CMA final aspirants. Hope you are seriously preparing for your December 24 attempt. In this last few days of preparation, it's really good if you are able to watch a marathon session on corporate and economic class so that you can quickly brush up all the important concepts. Don't worry, our top rated faculty CA and CMA signers sir, having 6+ years of rich teaching experience, has recorded a detailed marathon in 12 hours. This marathon is best suited for either December 2024 or further attempts. Let's take a closer look at the topics included in this marathon. In this 12 hours of detailed marathon, faculty has covered 80+ marks. The conceptual clarity that you can gain by watching this marathon will surely help you to score 60+ marks in the exams. Check the description of this video for chapter-wise timestamps. You will surely get benefited if you watch this marathon in the given sequence and maintain normal playback speed. So these are live classroom recordings but not pre-recorded or studio recorded. More than 60 students have participated in the face-to-face marathon classes. Classes are taught in 100% English so that students of all the states can watch these videos. Exclusive marathon material in which the faculty has taught is available for free download in our app. If you like this video, then hit like so that YouTube can recommend this video for more number of students. If you feel this video to be helpful, do share it with your friends so that they will also get benefited. Share your feedback on this video in the comment section, which will inspire us in creating more content like this for the benefit of the students. Here is the procedure to download the marathon material. First, you need to install our Android app, Mastermind's online classes, which is available in the Google Play Store, either in an Android mobile or an Android tab. So as on today, there is no support for Apple devices. So you need to enter your mobile number and other details and sign up. In the home screen, click the 3 horizontal lines icon in the top left corner and select the free material option. Now click the Documents tab. Open the folder CMA Final Marathon Classes for December 24 and navigate to the corporate and economic class. So open the file through Acrobat Reader or some other PDF reader app. You can download or share it and can take a printout of the same. Stay tuned as we will be soon uploading the marathon videos of all the remaining subjects of CMA Final. If you would like to receive a notification as and when we upload a video, then press the subscribe button and enable notifications with the bell icon. Now you can start enjoying the marathon video. All the best, my dear students.
Hello everyone, I'm Sainath, your law faculty, and today we are going to discuss about marathon for corporate and economic class. So in this marathon, we are going to cover all the chapters except Competition Act, FEMA, banking sector laws, insurance laws, and MSME laws, and finally cyber security laws also. So apart from these chapters, we are covering each and every chapter. Then what is the advantage of listening this marathon? So from first 4 chapters, you will get around 15 marks. This is minimum number of marks. Next one. From next 2 chapters, you can easily get another 15 marks. From last 3 chapters of Companies Act, you can get 10 marks. That means you can get 40 marks only in descriptive questions from Companies Act. Next one. IBC, corporate governance, SEBI regulations. So from these chapters, we will get 15 marks. And finally, from PMLA, we can get 5 marks. So in total, we are going to cover 60 marks descriptive questions. So the entire marathon is divided into 2 categories. One is marathon for descriptive questions. Other one is marathon for MCQ questions. So in descriptive questions, we are going to cover 60 marks. In MCQ questions, we are going to cover 20 marks. So around we are going to cover 80 marks in the entire paper. So that is the purpose of this marathon. So in this marathon, I am going to first explain Board of Directors chapter, which is very important. So first one, Board of Directors and key managerial personnel. So question number 1. Meaning of executive directors and non-executive directors. So basically executive directors are working directors and non-executive directors are non-working directors. So executive directors will be in employment. And what about non-executive directors? They will not be in employment. Executive directors will have in-depth knowledge about the affairs of the company, whereas non-executive directors will have diverse experience and independent perspective and knowledge. In case of executive directors, they will be in whole-time employment of the company. But in case of non-executive directors, they will not appointed for whole-time basis. And in case of executive directors, they are connected with policy formulation and taking active part in day-to-day affairs. But in case of non-executive directors, they are available just to contribute something towards unbiased decisions. Now, examples for executive directors are managing directors and whole-time directors, and in case of non-executive directors, independent directors. In simple words, executive directors are just like active partners. So they will participate in the day-to-day affairs of the company. Whereas non-executive directors are sleeping partners. They will not participate in the day-to-day affairs. Next one. Then what about number of directors? So for this purpose, we need to classify the companies into three categories: OPC, private company, public company. In case of OPC, minimum number of directors must be 1. In case of private company, 2. In case of public company, 3. And maximum number of directors in each category will be 15. So that means in case of OPC, number of directors can be from 1 to 15. In case of private company, from 2 to 15. In case of public company, from 3 to 15. Is it possible to have less number of directors below this limit? No. Is it possible to have more number of directors above 15? Yes. For that purpose, special resolution need to be passed in the shareholders meeting. But this requirement is not applicable for two companies. One is government company and other one is Section 8 company. So for both these companies, SR is not required. They can have more number of directors. Next one. This kind of exemption will be given to government company and Section 8 company only when there is no filing default. So what is meant by filing default? Every year, every company need to file financials as well as annual returns with the ROC. If company files the financials and annual returns, then there will be no filing default. If company fails to file either financials or annual returns with the ROC, then there will be filing default. That means if government company and Section 8 company are filing every document on timely basis, then they can get this exemption. Otherwise, they are also treated at par with remaining companies. Next one. Woman director, resident director. Let's see first resident director. So who is resident director? Resident director means he is a director who need to stay in India for at least 182 days. Okay, in which year he need to stay 182 days? Previously, the provision will be like this: minimum 182 days in the previous year, and that previous year must be calendar year. But now the provision got updated. So now the updated provision is at least 182 days in the current financial year. So this is outdated provision, this is updated provision. Now out of all the directors, at least one director need to stay in India for at least 182 days during the current financial year. Now that is the requirement. So this requirement need to be complied by all the companies. No company is exempted from this requirement. Each and every company is required to follow this rule. What is that rule? Out of all directors, at least one director need to stay in India for at least 182 days in the current financial year. Next one. Now, so I created a company exactly on October 1st. So this is exactly half of the financial year. Now, how is it possible for the director to stay for at least 182 days within 6 months? So when company is created for the first time, then for the first year, we need to take proportionate 182 days. That means For entire complete year, it will be 182 days. But this is a newly incorporated company which is incorporated in the middle of the year. So that's why. So for a half year, the requirement will be 91 days. So we need to take proportionately. So this is applicable only for the year of incorporation. And thereafter for every year 182 days will become mandatory. Independent director. So first of all, which companies are required to appoint independent director? So listed companies, listed public companies, unlisted public companies, and private companies. Total 3 categories. For listed public companies, irrespective of turnover, irrespective of paid up capital, irrespective of borrowings, so every listed public company need to appoint 1/3 of total directors as independent directors. That means if total number of directors in that listed company is 9, out of 9, how many directors need to be independent? 3 directors need to be independent. If total number of directors is 12, how many directors need to be independent? 12. 12 into 1 by 3, 4. What happens if it is 10? Total number of directors are 10. How many directors need to be independent? 3.33. How is it possible 3.33? It is not possible. That means we need to round it off. So how to round it off? To the nearest number or to the next number? It is next number. That means 4. Even though it is less than 0.5, we need to take it as complete number. So even though it is 3.33, we need to count it as 4. So how many independent directors are required? 4. So this is in case of listed public company. What about unlisted public company? They must have at least 2 independent directors. That's it. Now the point is, all unlisted public companies are not required to appoint minimum 2 independent directors. Only few unlisted public companies are required to appoint minimum 2 independent directors. Then what are those companies? For that purpose, we need to check paid up share capital, turnover, and loans plus debentures plus deposits. So if paid up capital is greater than or equal to 10 crores, if turnover is greater than or equal to 100 crores, if loans plus debentures plus deposits, we need to take all the 3 amounts. If the aggregate of loans plus debentures plus deposit, if it exceeds 50 crores, so greater than 50 crores. So if any one of these conditions got satisfied, no need to satisfy all the conditions. Even if one condition is satisfied, then that unlisted public company must appoint at least 2 independent directors. Now the point is, even though these conditions are satisfied, certain companies are exempted from appointing independent directors. That means this provision is not applicable for certain companies. Which companies? Joint venture company, wholly owned subsidiary, dormant company. So what is meant by joint venture company? Say for example, there is a company A Limited as well as B Limited. A Limited, B Limited started a venture in the name of AB Limited. So A Limited is continuing its existence. B Limited is in existence. AB Limited is also in existence. So all the 3 companies are in existence and they are doing their respective businesses. This kind of arrangement is called as joint venture. This is not merger. In case of merger, A Limited will be closed. B Limited will be closed. Only AB Limited will be in existence. So that is merger. In case of joint venture, all the 3 parties will continue their respective businesses. Now the point is, A Limited will be called as co-venturer, B Limited will be called as co-venturer, and AB Limited will be called as joint venture. So for joint venture, this requirement is not applicable. Even though it is satisfying either paid up share capital or turnover or loans or debentures or deposit requirement, it is not required to appoint minimum 2 independent directors. Next one. Then what is meant by wholly owned subsidiary? Say for example, there is a company AB Limited. So AB Limited is holding entire shares, that is 100% shares in A Limited. Now A Limited is subsidiary. So it is not a normal subsidiary, it is wholly owned subsidiary. Why it is wholly owned subsidiary? Because entire its capital is held by another company, that is AB Limited. AB Limited is holding and it is holding entire capital of A Limited. That's why A Limited will be called its wholly owned subsidiary. That means this provision is applicable for normal subsidiary. This provision is applicable for normal subsidiary, but this provision is not applicable for wholly owned subsidiary. Next one, dormant company, which means inactive company, which is not doing business currently. So what is the requirement now? For listed companies, for all listed companies, mandatory. In case of unlisted public companies, so if it is wholly owned subsidiary, if it is dormant company, if it is joint venture, then this requirement is not at all applicable. If it is any other company, we need to check paid up share capital limit, turnover limit, loans, debentures, deposit limit. If any one condition got satisfied, they are required to appoint independent directors. And what about private company? Completely it is not applicable. For private companies, it is not applicable. So how many directors need to be independent in case of listed companies? In total directors, at least 1/3 directors. In case of fractions, we need to round it off to next number. Next one. What about unlisted public companies which are satisfying any of the three conditions? So they need to have at least 2 independent directors. Next one. Then what about vacancy in case of independent director? If the minimum requirement is complying, then no need to appoint independent director. If minimum requirement is not complying, then the vacancy need to be filled by the board of directors and the time limit is same, just like women director. That is 3 months from the date of vacancy or next board meeting date, whichever is later. Now the main point is, who is eligible to become independent director? Because any person can become woman director provided if that person is woman. Any person can become resident director provided if that person is residing in India. But what about independent director? All people are not eligible to become independent director. Then who is eligible? Any person is eligible except the following persons. Then who are those people who are not eligible to become independent director? First one, if he is already having a position of whole-time director, then he cannot become independent director, because whole-time director means executive director. Independent director means non-executive director. How is it possible for a person to act like both executive directors and non-executive directors? So it is not possible. So that's why whole-time director cannot become independent director. Next one, nominee director. Nominee director means, say for example, there is a company. In that company, CG is holding certain number of shares, or state government is holding certain number of shares. Now because of that shareholding, the government is appointing a person as a director in this company. Now this person will be called as nominee director. So he is acting like nominee for the government. So how government got power to appoint director in a company? By virtue of shareholding. Next one. Now there is a bank or financial institution. This bank or financial institution gave a huge loan to the company. Now in order to know about the efforts of the company, this bank or financial institution want to nominate a person as a director in that company. Now this person is also called as nominee director because he is nominated by bank or financial institution. Then how this power is obtained by the bank or financial institution? By virtue of loan. That means by virtue of shareholding, government can appoint nominee director. By virtue of loan, banks or financial institutions can appoint nominee director. The person who is appointed as nominee director will represent government or bank in the company. So nominee director is already having interest with the company. So in this case, some shareholding is there. In this case, some amount is given to the company as loan. Already he is connected with the company. As he was already connected with the company, how that person can become independent director? Because independent director need to maintain independence. He must not be related to the company. So that's why even nominee director is also not allowed. He is also disqualified. Next one. Next one, cash companies. So what is meant by cash company? C stands for main company. A stands for associate of the main company. S stands for subsidiary of the main company. H stands for holding of the main company. So nothing but this is a group of companies. So main company, my associate, my subsidiary, my holding. So total 4 companies, cash companies. Now, if a person is promoter, in main company or in subsidiary company or in holding company, that person is not eligible to become independent director in the main company. But here associate is not covered. Only 3 companies got covered. What are those 3 companies? Main company, subsidiary company, its holding company. If any person is acting like promoter in main company or its subsidiary or its holding, then that person cannot become independent director in the main company. So that is the rule. Now, any person who is a relative of this promoter is also disqualified. Next one. Now, if any person is having pecuniary interest, what is meant by pecuniary interest? Nothing but business relationship. So, I'm the client of company. Now, company is getting turnover only because of me, or company is client of me. I'm getting turnover only because of the company. That means there is a business relationship between company and me. So this kind of business relationship is called as pecuniary interest. Then the person who is having business relationship is disqualified. He cannot be appointed as independent director. So business relation with whom? With main company, with associate company, with subsidiary company, with holding company. Now all the 4 companies got covered here. So if any person is having any business relationship, that is pecuniary interest, with a main company or its associate or its subsidiary or its holding, then that person is not eligible to become independent director in main company. Next one. So KMP. KMP stands for Key Managerial Personnel. So if any person is acting like KMP, in which companies? In main company, in subsidiary company, in holding company, but not in associate company. So that person is not eligible to become independent director in the main company. So these are the disqualifications. What is the first one? If he is whole time director, he cannot become independent director. Next one. If he is nominee director, he cannot become independent director. Next one. If he is promoter in main company, subsidiary, holding, not eligible. If he is relative of such a promoter, not eligible. Next one. If he is having pecuniary interest in main company or its associate or its subsidiary or its holding, not eligible. Next one. If he is KMP in main company or subsidiary or holding, not eligible. If he is relative to such a KMP, not eligible. So these are the people who are not eligible to become independent director. Except these people, remaining people are eligible. But those remaining people need to have a qualification. So for becoming women director, no qualification is required. For becoming resident director, no qualification is required. But for becoming independent director, qualification is required. Then where to get that qualification? So, did you remember MCA? MCA stands for Ministry of Corporate Affairs. Now it is IICA, Indian Institute of Corporate Affairs. So just like ICAI, ICMAI, ICSI, there is an institute named as Indian Institute of Corporate Affairs. So you need to get qualification from this institute. Then only you are eligible to become independent director. But certain people got exemption here. Who are those people? Any person who worked as KMP for 10 years, no need to pass this examination. Any person who is a practicing CA, practicing CMA, practicing CS with 10 years practice experience, even advocate with 10 years practice experience, those people are not required to clear this exam. Next one. Any person who is acting like a director in any government sector, then he is also not required to pass this examination. They are directly eligible. So, in order to become independent director, what is the qualification? They need to pass the exam that is conducted by IICA. But that kind of exam is not applicable for KMP with 10 years experience, CA, CMA, CS advocate who are in practice with 10 years experience, and any person who is in director position in any government entity. So even that person is also not required to appear for exams. Those people can directly become independent directors. Next one. Rules regarding appointment of director. So first of all, in case of company, we need to appoint first directors. So later we need to appoint normal director. Who is first director and who is normal director? First director means The director who will act like a director from the date of incorporation of the company till first AGM. Then what about director? Any person who is appointed as director after first director will be called as normal director. Now, how to appoint first directors? In articles of association, we need to provide the names of those people who will act like first directors. The person who is named as first directors in articles will become first directors after incorporation of the company. And what about the tenure? They will stay in the company as a director till first AGM. Next one. And what about normal director? Normal director will be appointed based on AOA only. So we need to appoint normal director according to the procedure which was given in AOA. So in case of first director, directly the names will be given. In case of subsequent directors, procedure of appointment will be given. Next one. So what happens if AOA does not contain the names of first directors? Then the subscribers who will become members after incorporation. So out of all subscribers, only individual subscribers, because subscribers may be individuals or body corporates. Individual means natural person. Body corporate means artificial person. So who can become member of the company? Either natural person or artificial person. That means either individual or body corporate. Now the point is, before incorporation, members are called as subscribers. Because before incorporation, there is no shares. As there is no share, they cannot become shareholder. As they are not shareholder, they cannot be called as member. So that's why we need to call them as subscribers. But after incorporation, company will be created, shares will be created, they will be allotted to the subscribers. Now subscribers will become shareholders, shareholders will become members. So just timing difference, that's it. So the subscribers who are individuals will become deemed first directors. That means if they provided the names of first directors in articles, those people will act like first directors until first AGM. If nothing is provided in articles about first directors, all the subscribers who are individuals will automatically become first directors. Sir, what about body corporate? Body corporates are not allowed to become director. Only natural persons are allowed to become director. Artificial persons are not allowed to become director. So that is the reason why body corporates are not allowed here. Next one. Then what about subsequent director case? In subsequent director case, so if AOA provides for any procedure, just follow that procedure for the appointment. If AOA is silent about the procedure of appointment, then how to appoint subsequent directors? By passing ordinary resolution in general meeting, you can appoint the directors. That means who will appoint the directors? Shareholders will appoint the directors. Now say, what are the rules regarding appointment of director? First directors, subsequent director, that is normal director. First director will be appointed based on articles of association. If articles are silent, all subscribers who are individuals will be deemed to be first directors. And subsequent directors will be appointed according to the procedure mentioned in AOA. If AOA is silent about it, then they will be appointed by passing ordinary resolution in general meeting. Now, whatever the director he may be, he need to provide three particulars to the company. So what are those three particulars? First one, he need to provide director identification number, which is allotted by MCA, Minister of Corporate Affairs. If you don't have director identification number, then acquire director identification number by making an application to MCA. Next one, he must provide particulars of interest in other business entities. Next one, and he need to provide consent letter also. So every director, whether he is first director or subsequent director, he need to provide these three particulars. What are those three particulars? Director identification number, particulars of interest in other business entities. Say for example, this director is having 10% stake in a partnership firm. He need to provide such particulars. He is having 1000 shares in a X and Y company. He need to provide such details. And finally, he need to give his consent letter. Next one, the consent letter which is given by the director will be forwarded to ROC within 30 days of appointment. That's it. So these are the rules of appointment of director. Next one, retirement and rotation of directors. So this concept is applicable only to the public companies. This concept is not applicable for private companies. Public company means it may be listed public company or unlisted public company. So all the public companies are required to follow rotation concept. Okay, then how to know about this concept now? So total directors, you need to take total directors, and out of total directors, at least 2/3 of the directors must be rotational directors. And what about balanced directors? They are non-rotational directors. So who is rotational director and who is non-rotational director? So rotational director need to vacate his office at every AGM. If he is reappointed by the company, he can continue for further term. If he is not reappointed by the company and someone else is appointed in his place, he need to vacate the office of company completely. So rotational director means who is liable for retirement at every AGM. Then what about non-rotational directors? They are not required to retire in the AGM. That means they are permanent directors. They will stay in the company for forever. So those kind of directors will be called as non-rotational directors. In case of private company, these rules are not applicable. In case of public company, these rules are applicable. What is the rule? Out of total number of directors, at least 2/3 directors need to be rotational and balance non-rotational. Okay, let's take 9 as example. How many rotational directors must be there for that company? First, you need to ask what kind of company it was. If it is a private company, not applicable. If it is a public company, applicable. Then say how many rotational directors need to have for this company. So 2/3 means 6 directors. Now number of directors are 12. Total number of directors are 12. Now say how many directors need to be rotational here? 8. Okay, now number of directors are 10. Now say how many directors need to be rotational? So 10 into 2/3, which means 6.66666 and so on. Okay, now here we need to take it as 7. So why we need to take it as 7? Is it nearest number or next number? It is next number only. If it is 6.1 or 6.2, 6.3, then also we need to take it as 7 only. So here also we need to take next number but not nearest number. Next one. Now, so we find some directors who are rotational directors. Now out of these rotational directors, certain number of directors need to vacate the office by retirement in AGM. Then how many directors are liable for retirement? So out of total rotational directors, I am taking only rotational directors, not total directors. So out of rotational directors, at least 1/3 of the people need to retire at the AGM. Now in first case, how many rotational directors are there? 6. In 6, 1/3 means 2. So 2 directors need to retire at AGM. In second case, 8. So in 8, what is 1/3? Take calculator. 8/3. 2 point. Say exact figure. 2.9. 2.1, 2.2, 2.3, 2.4, 2.5. Say accurate answer. 2.67. Now how to round it off? Is it for nearest number or for next number? So here we need to take nearest number. So in this case we need to take nearest number. So in case of 2.67, what is the nearest number? 3. If it is 2.4, nearest number 2. So at the time of counting total number of rotational directors, we need to take at least 2/3. If there is any fraction, we need to round it off to next number. In case of, so number of directors who need to retire at AGM, at least we need to take 1/3 of total rotational directors. Here we need to round it off to nearest number, not to next number. Next one. Now the point is, sir, what happens? There are rotational directors of 6 and 2 directors need to retire at AGM. Now there is a dispute between all the 6 directors regarding who need to retire in the AGM. Now how to decide? So based on term. So since their last appointment, we need to count that term. And the person who is having highest term, longest term, that person need to retire first. What happens if all the people joined at same time? There is no option. We need to conduct lottery. So based on lottery, we need to select 2 out of 6. So this is how we need to follow rotation concept. Once again, I'm saying So first one, you need to take total directors. Out of total directors, minimum 2/3 directors must be rotational directors. Now out of rotational directors, 1/3 directors need to be retired. So here we need to take next number in case of fractions. Here we need to take nearest number in case of fractions. Now while selecting who need to retire, we need to give highest priority to the persons who are having longest term. If all the people are having same term, then we need to decide based on lottery system. Now the point is, there are certain directors who cannot be retired by way of rotation concept. Who are those directors? Independent directors. Next one, small shareholders directors. Next one, nominee director. Because independent director will work for only 2 terms of 5 years. That means total 10 years. After 10 years, he need to vacate the position. So then, why it is required to retire at AGM? When his term is limited, what is the necessity for rotation concept here? So that's why rotation concept is not applicable for independent directors. And what about small shareholder director? He will there in the company for only 3 consecutive years. That's it. And thereafter he need to vacate the office. When the term is already prescribed, what is the necessity of rotation concept? So that's why it is not applicable. Next one, last one, nominee director. So nominee director is appointed because of shareholding, because of loan. Until that shares are paid, until such loan is paid, he will continue in the company as a nominee director. So here also rotation concept is not applicable. So that's why while taking total number of directors, exclude these 3 directors. That means first what I need to do, I need to take total number of directors and I need to exclude independent director, small shareholder director and nominee director. Now I will get one value. So out of this value, I need to take 2/3 value in order to know about total number of rotational directors. Out of total number of rotational directors, I need to take 1/3 so that I will know about how many directors need to retire at the AGM. Next one. Additional director, alternate director, nominee director. So first of all, who will appoint the director? Shareholders will appoint the director by passing ordinary resolution. But in these 3 cases, the directors will be appointed by board of directors. So generally, who is appointing authority? Shareholders. By passing over, they need to appoint the director. But in these 3 cases, that is alternate director, additional director and nominee director cases, who need to appoint the director? Board of directors. Now the appointing authority will be board of directors. Okay, then who gave that power to board of directors? So in case of alternate director, the power is given either by articles of association or by ordinary resolution in general meeting. So AOA may authorize board of directors to appoint alternate director, or shareholders may authorize board of directors to appoint alternate director. Then what about additional director? Only AOA. What about nominee director? Only AOA. So in 3 cases, the director will be appointed by board of directors only. But how that board of directors team got the power? In case of additional director, by AOA. In case of alternate director, either by AOA or by shareholders. In case of nominee director, by AOA, board of directors got that power. Now, what is the difference between additional director, alternate director and nominee director? First one, additional director. Additional director means actually he was not the director, but he's having lots of expertise and company want to recruit that person at any cost. But such kind of people will not work as employee. So for example, you are a qualified cost accountant and you are practicing for 20 to 30 years and you got enough experience in all the fields and you are the leading cost accountant in India. Now you are having enormous experience. Now I created a small company. I want to utilize the services of you. Is it possible to recruit you as an employee? Definitely you will say no. Why? You are having enough experience. You are having enough experience, enough expertise, but You are not willing to work as employee. Then how to utilize your services now? I need to offer director position to you. If it is a director position, then definitely you will provide your valuable assistant to the company. So that is the reason why for this kind of people, instead of offering them employment, you will offer directorship in the company. And these people will be called as additional directors. Now the point is, what about the term of additional director? So he will stay in the company for next AGM only. That's it. After next AGM, he need to vacate the office because he is not the director who got appointed by the shareholders to remain as director for longer terms. So he is appointed by board of directors. That's why his term will end by next AGM. Next one. Then what about alternate director? Now one of the director went outside India for minimum 3 months. So he went Bangkok and he is enjoying in Bangkok for at least 3 months. He is not returning to India. But the board of directors require one more person as a director. But the one of the director went outside India for at least 3 months. Now what to do? In the place of that director, the board of directors can appoint some other person as a director. And that some other person will become alternate director. So why he is called as alternate director? Because he is alternative to the main director who went outside India for minimum 3 months. Okay, now the point is, what about the term of this director? So he will continue for the balance term of the original auditor or the return of original director, whichever is earlier. Say for example, the balance term is 2 years and he returned within 3 months. Then when he need to vacate the office? After 3 months only, because original director came back to India. That's why he need to vacate the office as alternate director. Now, what happens if he returns to India after 4 years? Then after 2 years, he need to vacate the office. That means we need to take balance term of the original director as well as his return term, whichever is earlier. Next one. Then what about nominee director? So we already discussed about nominee director. Who will appoint nominee director? Government, because of shareholding. Banks, because of loans. So government will nominate a person. Banks will nominate a person. So they will just make nomination. Nomination is not appointment. They will make nomination. That's it. That means they are required to be appointed in the company just like normal directors. So nomination will be done by these people. But appointment will be done by company by following the regular procedures. Next, some important points. Now, in general meeting, there is a proposal regarding appointment of a person as director. But shareholders rejected that person as a director. Now he failed to appoint it as a director because of shareholders' resolution. Now directors want to make this person as additional director. Is it possible or not possible? Not possible. You may get a practical question on this. So the person who got rejected by the shareholders for the appointment of director position, that person cannot be eligible to become additional directors by board of directors. That means board of directors cannot bring rejected candidates indirectly into the company by using those powers. Next one. In case of alternate director, who can be appointed as alternate director? So if he is already an alternate director for any other person, the same person cannot act like alternate director for some other person. That means at a time, a person can act like alternate director for how many directors? Only one. So on this point also you may get a practical question. Next one. Small shareholders director. So this concept is applicable for listed companies only. What about unlisted public companies? Not applicable. And what about private companies? Not applicable. Because in case of unlisted public companies, in case of private companies, number of shareholders are very less. So that's why small shareholder director concept is not applicable for them. So small shareholders concept is applicable only for listed company. And this is not mandatory provision. This is optional provision. That means listed company may appoint small shareholder director. It is not mandatory. Then when listed company may appoint small shareholder director? So on suo motu basis means without any request. Company on voluntary basis can appoint small shareholder director or upon the request. Then who need to request? small shareholders need to request. Then among shareholders, which shareholder will be classified as small shareholder? Any shareholder who is having shares whose face value, not market value. We need to take face value, not market value. So whose face value does not exceed 20,000. That means if any person is having shares with a face value of less than or equal to 20,000 rupees, then that shareholder will be called as small shareholder. Now, in order to represent such kind of small shareholders, the company need to appoint small shareholder director. But it is not mandatory, it is optional. And this provision is only applicable for listed company, not for any other company. Listed company on suo motu basis, that is on voluntary basis, can appoint small shareholder director, or upon the request also they can appoint small shareholder director. Then how many persons need to request the company to appoint small shareholder director? So 1000 small shareholders, or out of total number of small shareholders 110, whichever is lower. So for example, number of small shareholders in the company is 10,000. Then how many persons need to request the company in order to appoint a director in order to represent small shareholders? 1000, or 1/10 of 10,000, that is 1000, whichever is lower, that is 1000. What happens if small shareholders are 50,000? Then 1000 or 1/10 of 50,000, that is 5,000, whichever is lower, which means 1000. So the many number of shareholders need to ask the company to appoint small shareholder director. So here I am taking only small shareholders, not all shareholders. Only small shareholders count will be considered here. Next one. So generally, company will conduct general meeting by giving how many days prior notice? 21 days prior notice. So don't just look at the values given there. So at least 21 days before, they need to give notice to all the shareholders about the general meeting. Whether it is AGM or EGM, 21 prior days notice is required. That means 3 weeks prior notice is required. So now in this notice, company will communicates its own agenda to the shareholders. Later shareholders can also make their own agenda, and shareholders can communicate that agenda to the company. Then what is the time limit for the shareholders to communicate their own agenda? It is 14 days before the date of meeting. That is 2 weeks before the date of meeting. Now what company will do? Company will forward the agenda which is given by the certain class of shareholders to all the shareholders. It will be done at least 7 days before the meeting. That is 1 week before the meeting. So 3 weeks, 2 weeks, 1 week. That is 21 days, 14 days, 7 days. So first company will communicate its agenda to all the shareholders at least 21 days before meeting. Now if shareholders want to communicate their own agenda, they can communicate at least 14 days before. Now this agenda which is communicated by the shareholders will be forwarded to all the shareholders at least 7 days before the meeting. So 3 weeks before, company will communicate its own agenda. 2 weeks before, shareholders need to communicate their agenda, and 1 week before, company will forward this agenda to all the shareholders. Now the point is, if these number of shareholders want to propose a small shareholder director, they need to propose through own agenda before 14 days. So at least 14 days before the date of meeting, they need to communicate their own agenda. In that agenda, they can propose the appointment of small shareholder director. So 21 days prior notice will be called as general notice, and 14 days prior notice is called as special notice. That means general notice will be given by company to shareholders. Special notice will be given by shareholders to company. General notice will contain the agenda given by company. Special notice will contain about the agenda which is given by the shareholders. Now the appointment proposal will be contained in special notice, which will be issued at least 14 days prior to the date of meeting. Now in that notice, they need to give some particulars about themselves, some particulars about the proposed candidate as a small shareholder director. Okay, about small shareholders, they need to sign, they need to provide their address, and they need to provide the identification number of those shares, and they need to provide all these three particulars. What are the particulars? One is signature, other one is address, other one is shares identification number. In case of physical shares, the identification number is ledger folio number. In case of demat shares, the identification number is DPID, depository participant identification number. Okay, now about the proposed candidate. So DIN is mandatory. He need to give a declaration that he is not disqualified to become a director, and consent letter is also mandatory. If he is independent director, if he want to become independent director, he need to fulfill the eligibility criteria also. We already discussed about the eligibility criteria of independent director. The same need to be complied by the person who want to become both small shareholder director as well as independent director. Next one. Then what about the tenure of independent small shareholder director? 3 years. After 3 years, he is not eligible for reappointment. Can he counted for rotation purpose? No. At the time of knowing about number of rotational directors, you need to exclude small shareholder director from total number of directors along with independent directors and nominee directors. Next one. And what happens if he is having disqualifications? Not eligible. What happens after appointment? He was disqualified. He need to vacate the office. What happens if he attracted with section 167 provisions? What is meant by section 167 provisions? So it will contain the cases of vacancy. So here there will be some cases. If any director is covered in those cases, any of those cases, the director need to vacate the office. One of the point is, if a director fails to attend board meetings for 12 consecutive months, that person will be disqualified. That person need to vacate the office immediately. So that kind of points are provided in 167. Even that 167 section is also applicable. And if he want to become independent director, he need to meet independence director criteria. What happens if he fail to meet independent director criteria after becoming both independent director and small shareholder director? Then he need to vacate the office as independent director. Then in how many companies he can act like small shareholder director at a time? Maximum 2 companies, and those 2 companies must not be competing with each other. So he can't join in 2 competing companies. Next one. So what is the concept now? So for listed companies only this is applicable. For unlisted companies and private companies this is not applicable. So in case of listed companies also it is not mandatory, it is optional. Then so how this person will be appointed? Company can appoint this person without any request from the small shareholders, that is suo motu basis, voluntary basis, or it can appoint this person with the recommendation of certain number of people. Then how these people need to give representation to the company? So when company give general notice 21 days prior to the general meeting, then these people need to communicate their own agenda to appoint this person as small shareholder director at least 14 days before the date of meeting, which is called a special notice. And that special notice need to contain the details of small shareholders and the details of proposed director. And if he want to become independent director also, he need to meet the independent director criteria. Next one. And he is not liable for rotation, and his term will be maximum 3 continuous years, and after 3 continuous years cooling period will be applicable. He is not eligible to be reappointed as small shareholder director or in any other position also. Next one. You may get a practical question here. So after 3 years, so you want to become employee of the company. Is it possible? No, it is not possible. So he shall not associate with company in any manner after the expiry of those 3 years term. Next one. So what about the applicability of disqualifications? Applicable. After appointment, what happens if he is disqualified? Need to vacate the office. What happens if he fails to attend the board meetings for 12 consecutive months? Vacate the office. What happens if he failed to meet independence criteria? If he is acting like independent director, he need to vacate the office. And in how many companies he can act like small shareholder director? Maximum 2, but both companies must be not in competing nature. Next one. Disqualifications for appointment of director. So here there are 2 categories of disqualifications. One is individual disqualifications, other one is company level disqualifications. Individual disqualifications means, so these are applicable only to the single director. only that single director will be disqualified. Company level disqualification means, if it is company level disqualification, all the directors in that company will be disqualified at once. So that's why the disqualifications are classified into two categories: individual, company level. In case of individual level, only that director will be disqualified. In case of company level, all the directors in that company will be disqualified. Okay, then what about individual level disqualifications? First one, if he is unsound mind, disqualified. If he is insolvent, disqualified. If he made insolvency petition but application is still pending, then also he is disqualified. So if he is unsound mind, disqualified. Applied for insolvency, disqualified. Declared as insolvent, disqualified. Next one, he went to the jail. He went to the jail either for criminal reason or for civil reason. He went to the jail. Next one, if the period of imprisonment is at least 6 months, then he will be disqualified for 5 years. So this 5 years term will be counted after the expiry of imprisonment. Next one, if he is convicted for at least 7 years, then he will be permanently disqualified. Next one. So this is about point E and point F. Now a court or tribunal passes an order against the director, and that court or tribunal disqualified the director to act like director in any company, including the main company, then he will be disqualified. So what is the time? If court said 3 years, he will be disqualified for 3 years. If court said 2 years, he will be disqualified for 2 years. It all depends upon the court's intention. Next one. Now the director is also a shareholder of the company, and he is holding unpaid shares, and company made a final call or some call. Now this director is also required to pay the call money, but he fails to pay the call money and it is outstanding for 6 months. Now he will be disqualified until he made the payment of calls. Next one, he made related party transaction without disclosing that point to the authority, and he was convicted because of that related party transaction. When in any of the last 5 years, if any person in any of the last 5 years convicted in any related party transaction, that person is disqualified. That means once he got disqualified under this section, he need to wait for 5 years. Next one, every director need to have a valid DIN. If any person is not having a valid DIN, that person is disqualified. Next one. Now, what about the limit on number of directorships? So in case of all companies, the limit is 20. That means a person can act like director in 20 companies simultaneously. So here companies means it may be private company, public company. It includes all the companies. But there is a sublimit here. What is the sublimit? In case of public company, the limit will be only 10. So in case of public company, the limit is 10. All companies together, the limit is 20. And the both conditions need to be satisfied. Not single condition, he need to satisfy both the condition. What happens if he is director in 10 public companies, he want to become director in another public company? He is disqualified. What happens? He is director in 10 public companies, 10 private companies, and he want to become director in another private or public company? Disqualified. That means a person cannot act like director more than this limit. Next one. So these are all individual level disqualifications. So once again I am repeating, very important question. First one, if he is unsound mind, disqualified. Second one, if he applied for insolvency, disqualified. If he is declared as insolvent by the court, disqualified. Next one, if he went to the jail either for criminal case or for non-criminal case also, if he went for the jail, then if the imprisonment period is minimum 6 months, so after the expiry of imprisonment, he need to wait for 5 years to become director. Next one, if the imprisonment period is minimum 7 years, permanently he will be disqualified. Next one, if any court or tribunal passes any order against the director, and because of that order, the director may get disqualification. Next one, and if any director is having shares and company asks to pay some amount, call money, but this director fails to pay that money and 6 months time is expired. So until the payment of such money, he will be disqualified. And if he does not hold valid DIN, disqualified. If he is having directorship in more than 10 companies in case of public, in more than 20 companies in case of all, then also he is disqualified. So all these disqualifications are individual disqualifications. Only that person will be disqualified, but not all the directors. Now, in this case, one important point is there. So in case of point D, in case of point D, in case of point E, in case of point F, in case of point G, total 4 points. In all these 4 cases, so an order was passed against you by court or tribunal. That means there is a chance to go for appeal. So what the time limit to go for appeal? For first appeal, the time limit is 30 days. So once this order is passed, immediately you will not be disqualified. There will be a time period of 30 days. During the 30 days, you can still eligible to act like director. So if you prefer not to appeal the case, then after the expiry of 30 days, you will be disqualified. What happens if you appeal to higher court? Then you will not be disqualified until a decision is made in your case. Next one. Now that a higher court gave decision. So now for second appeal, there is a time limit of 7 days. So for those 7 days, there will be no disqualification. What happens if you prefer not to appeal once more? After expiry of 7 days, you will be disqualified. What happens if you prefer appeal in second case also? Then you will not be disqualified until a final order is passed. That means for first appeal, what is the time limit? 30 days. For second appeal, what is the time limit? 7 days. So if you go for appeal, then you will be disqualified only after the final judgment. So this is applicable in case of point D, E, F and G. That's it. Now let's go to company level disqualification. In case of company level disqualification, all the directors in that company will be disqualified at once. Then what is company level disqualification? First one, every year, every company must file financial statements as well as annual returns with the ROC. What happens if a company fails to file these documents for 3 continuous years? A company fails to file these documents for 3 continuous years. Then all the directors in that company will be disqualified. The company need to appoint some other people as directors. Next one. Now, there are 3 amounts: deposits, debentures, preference shares. In case of deposits, interest or repayment. In case of debentures, interest or repayment. In case of preference shares, dividend amount only, not repayment, only dividend amount. So, if company fails to pay either interest or repayment of deposits, company fails to pay either interest or repayment of debentures, company fails to pay dividend on preference shares, then if this amount is outstanding for at least 1 year, then all the directors in that company will be disqualified. So this is company level disqualification, which will disqualify all the directors in that company. So what are the cases? If company fails to file financials and annual returns for 3 continuous years, all directors disqualified. And if there is any payment default and the amount is outstanding for at least 1 year, then also all the directors disqualified. Next one. Then how many years they will be disqualified? They will be disqualified for 5 years. After 5 years, they're eligible to be appointed as director once again. That means this disqualification is for only 5 years. Next one. So, individual level disqualification is applicable to government companies, but company level disqualification is not applicable to government companies, because in case of government companies, everything will be filed lately. So that is the reason why in case of late filing, in case of non-payment also, all the directors can still continue as directors. That means company level disqualification is not applicable in case of government company, but individual level disqualification is applicable. So 164.2 means company level disqualification. 164.1 means individual disqualification. So 1 is applicable, but 2 is not applicable for government company. Next one. In case of private company, they can add some more points as disqualifications. So this kind of facility is available only for private companies. Next one. Resignation of director. Is it possible for a director to resign from his position? Yes. Then what he need to do? The director need to communicate that matter to company as well as ROC. That means he need to give resignation notice. He need to give resignation notice to the company, resignation notice to the ROC. So for giving information to the company, there is no time limit in the act. But for giving information to the ROC, the time limit will be 30 days from the date of his resignation. He need to communicate to ROC. Now, the company will make further communication. So it will make further communication to ROC within 30 days of receipt of information. Within 30 days of receipt of information by the company, it will forward that information to the ROC. And thereafter, company will post that matter in website of the company if company is having website. And thereafter, so every year, board of directors will issue board report. In that board report, they will disclose this fact. So now say what is the communication manner here? First one, the director who want to resign, he need to give the notice along with reasons. To whom? Company, ROC. And company need to forward this notice to ROC. It need to place this notice in website. It need to discuss about the resignation of director in board report. So in all the cases, the time limit in case of ROC case is 30 days. Next one, removal of director. Is it possible to remove a director? Yes. So for this purpose, we need to classify the directors first. First one, director appointed by shareholders. Director appointed by NCLT. So first one, director appointed by shareholders. Second one, director appointed by NCLT. If director is appointed by NCLT, only NCLT can remove the director. Shareholders cannot remove the director who was appointed by NCLT. If director is appointed by the shareholder, then shareholder can remove the director or NCLT can remove the director. That means the directors who got appointed by the shareholders can be removed either by appointing authority, that is shareholders, or by NCLT. But if the director is appointed by NCLT, only NCLT can remove the director. Now the point is, which kind of resolution is required? If shareholders appointed that person by passing ordinary resolution, then minimum ordinary resolution is required to remove that person. That means even SR is also sufficient. Even unanimous resolution is also okay. If shareholders appointed that person by passing SR, then for his removal, they need to pass minimum SR. So when it is possible to appoint a director with SR, independent director. So what about the term of independent director? 2 terms. Each term will have 5 years. So for the appointment for first 5 years, OR is sufficient. For reappointment for the second term of 5 years, SR is required. Why SR is required for second term? Very simple. When he is associated with 5 years with the company, he may lose his independence. So again, if you want to appoint the same person as independent director, it is very risky. So that's why OR is not sufficient here. For reappointment, what is required? SR. Now the point is, you want to remove the independent director during the first term. So how he was appointed? By passing OR. So how he can be removed? Again by passing OR or more than OR. Next one, during second term, if you want to remove independent director, so you need to pass SR. Why SR? Because he is appointed by SR. He can be removed only by SR. So once again I am repeating. If director is appointed by NCLT, who can remove? NCLT. If director is appointed by shareholders, shareholders are NCLT. So what kind of resolution is required? If appointment is made by OR, minimum OR. If appointment is made by SR, minimum SR. Then what may be the possible reason to remove the director from his position before the expiry of his term? So in case of NCLT, in case of any proven misconduct only, NCLT will remove the director. If director did anything wrong, then only NCLT will remove such director from his position. But what about shareholders? When they can remove a person as a director, so in case of proven misconduct or any other reason. Say for example, shareholders are not liking the face of independent director. So they can remove. They can remove by passing OR or SR as the case may be. So there is no fixed reason for removal of director by the shareholders. They can remove the director for any reason whatsoever they like. But the point is, so you are terminating a person from his position. that too before the expiry of term. That means you made breach of contract now. Company is committing breach of contract. So that is the contract which was made with the director. So company appointed a director for 5 years. And now company want to terminate his position after 3 years only. That means there is a breach of contract on part of company. Now company is required to pay damages to the director. So that damages is called as loss of salary. It will be called as loss of salary, because if you remove that person 2 years before the expiry, then what about the salary of 2 years? It is loss of pay. It is a loss to the director. That's why company need to pay damages. Now the point is where this concept is applicable. So this concept is not applicable in case of removal by NCLT. Reason? Because of his own misconduct only he got removed by the NCLT. That's why company is not required to pay any compensation. Next one. In case if the shareholder is if shareholder want to remove the director for misconduct reason, then this compensation rule is not applicable. If shareholder want to remove the director for any other reason, then they need to pay loss of salary. That is compensation for loss of salary. Then what about filling of casual vacancy here? Because you are terminating a person before the expiry of his term, that means there will be a casual vacancy. Then who need to fill the casual vacancy? In case if it is shareholder case, shareholders will fill the casual vacancy. But it is not mandatory to fill casual vacancy when there is minimum number of directors in that company. When that minimum number is reducing because of that casual vacancy, then it will become mandatory for the company to appoint some other person in his place. Next one, managing director. So now we are going to discuss about managing director, whole-time director, manager. So all these three people will be called as MP. MP means managerial personnel. They are not KMP. KMP definition is different. MP means managerial personnel. So who will be covered here? Managing director, whole-time director, manager. Now the point is, who is whole-time director? The director who is working for the company on full-time basis will be called as whole-time director. Then what about managing director and manager? If any person is having substantial power over the company, then if that person is a director, he will be called as managing director. If he is not a director, he will be called as manager. So managing director will have substantial power over the company. Manager will have substantial power over the company. Then when a person with substantial power will be called as managing director when he is director. When he is called as normal manager when he is not a director. Now say, is it possible to have MD plus manager? No, substantial power will rest in the hands of only one person, either director or other than director. If he is director, managing director. If he is other person, manager. That's it. That means having managing director and manager at a time is not possible. Then what about MD plus WTD? Possible. Manager plus WTD? Possible. What about MD plus manager plus WTD? Not possible. Very simple rule. These two people cannot be appointed at same point of time. Next one. Now, I'm going to discuss about managing director. So when a director can become managing director? So a director can become managing director because of articles of association. So by using the powers of AOA, a director can become managing director. Next one, because of any agreement with the company, a director may become managing director. And because of resolution passed in general meeting, a director can become managing director. So that means who will appoint managing director? Managing director can be appointed either by articles or by using agreement with the company or by using shareholders resolution. So by using any of the three authorities, a person can become managing director. Now the point is, managing director will have substantial power over the company. What is meant by having substantial power? So substantial power means having power to do many things except following things. That means if any person is having the power to do following things, that person cannot be called as managing director. Then what are those things? First one, affixing common seal. First of all, what is meant by common seal? Common seal is nothing but official stamp of the company. Is it mandatory to the company to use common seal? No, it is not mandatory. But if company wants to use common seal, it can use the common seal. So if company want to enter into a contract, then how company will sign on that contract paper? Just by affixing common seal. Then who will affix common seal? Even a peon can affix the common seal. So I can't take this power as substantial power over the company. So affixing common seal is not a substantial power. That is the first point. Next one. Negotiable instruments. Negotiable instrument means it may be a promissory note or bills of exchange or check. Okay. Now I appointed a person to draw bill of exchange, to endorse bill of exchange. Now, can I call it as a substantial power? No, it is not a substantial power. So it is a clerical work. So it is not a substantial power. So a person who is having this power cannot claim himself as a managing director, because this is an ordinary power which is not a substantial power. Next one. So in second point, check is covered. In third point, negotiable instrument is covered, but negotiable instrument includes check. Next one, share certificate. So shares can be of two types: physical shares, demat shares. In case of demat shares, share certificate is not necessary. In case of physical shares, share certificate is necessary, and a person from the company need to sign on that share certificate. Now I appointed a person just to sign the share certificate which need to be issued to the shareholders. So can I call it as a substantial power? No, it is not a substantial power. It is also a clerical work. Next one, transfer of shares. What is meant by transfer of shares? Say for example, in case of demat shares. So if I sell the shares, then immediately other person will become buyer of the shares. So it will be done through online process. So I need to just click on sell. Then my shares will be sold to some other person. So no need to communicate the details of other person to the company. But in case if the shares are physical shares, seller need to sell the shares to buyer. Later they need to send the details to the company. What company will do? Company will register this transfer. So company will remove this person name as shareholder. Now company will enter the buyer name as shareholder. This process is called as registration of transfer. Now I appointed a person in order to make registration of these transfers. So can I call it as a substantial power? No. So now say, so substantial power means any power except following powers. What are those powers? Affixing common seals, drawing or endorsing negotiable instruments including checks, signing on share certificates, registering transfer instruments. Next one, appointment conditions for MD, WTD, manager. So all three people will be called as managerial personnel. So MD, WTD and manager. So what are the conditions for the appointment of those people? First one. So there are four conditions here. If all the conditions are satisfied, then he is eligible to become MD or manager or whole-time director. If any of these conditions got failed, then that person is not eligible. That person is not eligible to become either manager or managing director or whole-time director. And in point number 4, some other conditions are given. So in this case, if all the conditions are satisfied, that person can become MD, WTD, manager. If any condition got failed, then also that person can become MD, WTD or manager, but with the prior approval of central government. Now what is the difference between the conditions which are given in point number 3 and conditions which are given in point number 4? If you fail to satisfy the conditions which are mentioned in point number 3, then you are not eligible to be appointed as managerial personnel. So if you fail to satisfy any of the conditions which are mentioned in point number 4, then also appointment is possible, but you need to take the prior approval of central government. Next one. Then what are those conditions? First one, age. So what should be the age of the person to eligible for MD or WTD or manager position? Minimum means 21 years, maximum 70 years. So the age must be at least 21 years and less than 70 years. Then only that person is eligible. Then who is not eligible here? Any person with less than 21 years of age. So that person is not eligible. Any person having 70 years of age, 70 or more than 70, even that person is also not eligible. But this point got shifted to point number 4 conditions. Now, even though if you attained 70 years of age, still your appointment is possible, but for that purpose you are required to take the permission of central government. That's it. Next one. If he is declared as insolvent, then he is ineligible. Even with the approval of CG also ineligible. Next one. If he made any suspension or any composition with the creditors, that means the person need to pay 10 lakhs to a person. Now he made default. So now this person is not eligible. Now he paid money, but by making composition, that is compromise. So instead of 10 lakhs, he settled the entire amount by paying just 2 lakhs. Even then also he is not eligible. So when he is eligible, when he is having dues and he cleared all the dues, then he is eligible. When he made any suspension of payment, not eligible. When he made any composition of payment, compromise of payment, not eligible. Even with the approval of CG, not eligible. Next one. Now, any person who was imprisoned by the court for period exceeding 6 months, then also not eligible. Now say, in which cases he is completely not eligible? When age is less than 21 years. Next, when he is insolvent. When he made suspension of payment or compromise of payment. When he is imprisonment for more than 6 months. If any condition is satisfied, then he is not eligible to become MD, WTD manager. Next one. In point number 4. So you can remove point C. So previously this point is there, but due to amendment, this point was omitted now. Instead of this point, you can write age having greater than or equal to 70 years. So total 4 points. First point. Now, in Companies Act, there are 7 schedules. First schedule deals about preparation of MOA and AOA. Second schedule deals about calculation of depreciation. Third schedule deals about formats for financial statements. Fourth schedule deals about independent director. Fifth schedule deals about appointment of MD, WTD manager. So the fifth schedule conditions are provided here. Next one. Sixth schedule contains about infrastructure projects. Seventh schedule contains about CSR activities. Okay. Now, under fifth schedule, there are 16 acts. Now it got amended to 19 acts. So previously it is 16 acts only. Now IBC, GST, some other acts also included. Now it is total 19. So in exam you can write either 16 or 19 because it is a descriptive question paper. So you can write whatever you like. But in case of objective questions, it is not possible. We need to select only one option. But in case of descriptive, you can write either 16 or 19, or for perfection, you can write both the points. So previously it is 16 acts. Now because of amendment, it is 19 acts. Okay. Now, there are 19 acts in schedule number 5. In those 19 acts, if you imprisonment for any period, even for 1 day also, you are ineligible. But with the prior approval of CG, you will become eligible. And you are fined exceeding 1000 rupees, you are ineligible. But with the prior permission of CG, you are eligible. So no need to mention all those 19 acts in the exam. So just provide the number, it will be sufficient. So these 19 acts are provided in which schedule? Schedule number 5. So if you are imprisonment for any term, or if you are fined for amount exceeding 1000, then you will be ineligible. But with the prior approval of CG, you will become eligible. Next one. Next act. So next act name is COFEPOSA. So COFEPOSA stands for conservation, that is protection of foreign exchange, that is foreign currency reserves, and prevention of smuggling activities act. So the act name is COFEPOSA Act. Now, if any person is detained for any period under COFEPOSA Act, then that person is ineligible. But with the prior approval of CG, eligible. Next one. So we deleted point C. Instead of point C, we can write about age point. If age is 70 years or more than 70 years, that person can be appointed as MD or WTD or manager with the consent of CG. Next one. And he must be resident of India. But here resident means not 182 days. Here resident means you need to stay for last 12 months. That is complete year. So you need to come to India either for employment purpose or for business purpose. And you need to stay in India for at least 12 months, continuous 12 months without any break. So after 12 months, now you will be eligible to be appointed as MD WTD manager. But you can violate this condition by taking the prior permission of central government. Now say, what are the appointment conditions for these people? 4 conditions. Mandatory conditions, 4 conditions, optional conditions. So what are 4 mandatory conditions? Age. If it is less than 21 years, completely not eligible. Next, if he is insolvent, completely not eligible. Next, he suspends payment to the creditor or he made compromise with the creditors, completely not eligible. Next one, he imprisoned for more than 6 months, completely not eligible. So even CG can't help in this situation. Then what about other 4 conditions? If the age is 70 years or more than 70 years, CG approval is required for appointment. Next one, if you are imprisonment for any period or you are fined of an amount which is more than 1000 rupees under any of the 19 acts, then CG's approval is required. Then if you detained for any period in COFEPOSA Act, CG's approval is required. And if you are not a resident in India, CG approval is required. But here resident definition is different. You need to stay for continuous 12 months before the date of appointment. And you need to come to India for either business purpose or employment purpose. Next one, appointment of KMP. So till now we discussed about MP. MP means manager, managing director, whole-time director. Now we are going to discuss about KMP. KMP means it includes 3 people. So KMP means not single person. KMP means combination of 3 persons. Then who are those 3 persons? So there must be CFO, Chief Financial Officer. There must be Company Secretary, CS. There must be one more person. That one more person may be either MD or CEO or manager or whole-time director. So out of 4 people, that is MD, CEO, manager, whole-time director, there must be at least one person. That one person along with CS, along with CFO will be called as KMP. So KMP means it is a team of 3 members. So 2 positions are fixed. One position is not fixed, it is available to 4 different people. Now the point is, every listed company must have one team of KMP. Next one, every unlisted public company having a paid up share capital of minimum 10 crores must have one KMP team. And that KMP team must be in whole time employment. That means they must have whole time KMP. So for all listed companies, having whole time KMP is mandatory. For unlisted public companies with a paid up share capital of minimum 10 crores, having whole time KMP is mandatory. Then what about private companies? In case of private companies with a paid up share capital of at least 5 crores, having whole time CS is mandatory, not whole time KMP. Whole time KMP means combination of 3 persons. Whole time CS means only one person, that is company secretary. Now say, in case of listed public companies, whole time KMP. In case of unlisted public companies, that too where paid up capital is at least 10 crores, one whole time KMP. In case of private companies with at least 5 crores minimum paid up capital, whole time CS is required, not entire team of KMP. Next one. Now there is a chairperson for the company. This chairperson want to act like managing director. Is it possible? No. A person cannot act like chairperson as well as managing director at a time. Next one. There is a chairperson of the company. Now he want to become CEO of the company, chief executive officer of the company. Is it possible? No. At a time, a single person cannot act like both chairman as well as CEO. But there is exception to this rule. What is this exception? If AOA allows such kind of appointment, then it is okay. That means in AOA, you wrote like this. A single person can act like both chairperson as well as MD. Then allowed. In AOA, you wrote like this. A single person can act like both chairperson as well as CEO at a time. Then it is allowed. If AOA permits, it is allowed. Otherwise, it is not allowed. This is exception number 1. Exception number 2. If company is carrying only single business, not multiple business. If it is only single business but not multiple business, then also this combination is allowed. Even though articles doesn't contain anything about it, it is allowed provided the company must carry only single business. Then what about multiple business? In multiple business, we need to check whether it is notified or not. If it is notified, then allowed. If it is other company, then not allowed. So that means, what is the general rule? A person cannot act like chairperson and MD at a time. A person cannot act like chairperson and CEO at a time. But if article permits, no problem. If it is having only single business, no problem. If it is having multiple business but it is notified by the CG, then also no problem. Next one. Now, a person want to become whole-time KMP in one company. Okay. Can he become whole-time KMP in any other company? No. At a time, a person can act like whole-time KMP in maximum one company only. But this rule is having exception. He can become a whole-time KMP for its subsidiary, but not for any other company. In case of small shareholder director, the limit is 2. In case of whole-time KMP, the limit is 1. Exception is subsidiaries. Then what about managing director? So managing director can act like managing director in 2 companies, maximum 2 companies. But the prior approval of board of directors is required. All the board of directors need to agree for this. Then only a person can act like managing director in 2 different companies. Next one. What happens if there is any casual vacancy? If there is any casual vacancy in whole-time KMP, then it need to be filled by board of directors within 6 months. Next one, maximum remuneration. So how much remuneration can be paid to directors? So for this purpose, we need to classify the directors first. First one, managing director, manager, whole-time director. So for single person, for all the persons, what is the limit? For single person, the limit is maximum 5% of net profit. For all the persons, the limit is maximum 10% of the net profit. I am talking about only managerial personnel, that is MD, manager, WTD. For single person, the remuneration shall not exceed 5% of net profit. For all the persons together, the remuneration shall not exceed 11% of net profit. Now, what about other directors who are not MD, manager or WTD? What about those directors? So for those directors, we need to check whether the company is having MD, manager or whole-time director. If those people are available, those people are present, then others will get a maximum remuneration of 1%. If those people are not present, that means MD, manager, whole-time director is not available for that company. The company contains only other directors, then they can take maximum of 3%. Now the point is, the overall remuneration to all the directors, overall remuneration, it shall not exceed 11%. So once again I am repeating. So in case of MD, manager, WTD, individual limit 5, overall limit 10. In case of others, we need to check the presence of these people. If these people are present, they are allowed to take only 1%. If these people are not present, they can take up to 3%. And what about the overall remuneration? It shall not exceed 11%. Now the question is it possible to give remuneration to the director exceeding any of these limits? Yes. For that purpose, you need to get special resolution. With the help of special resolution, you can pay more remuneration. So this is maximum limit, I too agree. But this can be crossed by using special resolution. Now the point is, if there is any payment default by the company, like from bank company has taken loan, from creditors company has taken loan. Now if company fails to pay the loan amount on due date, then before special resolution, the bank or financial institution or creditors approval is also required, because by making default in the payment of those dues, You cannot pay higher remuneration to your own directors. So that's why, in case if there is any payment default with respect to any creditor or bank, then first you need to get their approval, and thereafter you need to pass SR, and thereafter you need to pay remuneration exceeding these limits. Now say, what is the rule? First one, maximum remuneration is 11% overall. For MD, WTD manager, individual, 5. Overall, what about other directors? If MD, WTD manager is available, 1. If those people are not available, 3. Is it possible to exceed the limit? Yes, 2 approvals are required. First approval, in case of banks, financial institutions and creditors, if there is any payment default. If there is no payment default, approval is not required. And SR is mandatory. Next one. And what about sitting fee? So sitting fee is separate amount. It is separate amount. And what about the limit of sitting fee? For each meeting, the maximum fee is 1 lakh. Next one. And while giving sitting fees to independent directors and women directors, so don't show any discrimination. That means they shall be treated at par with others. If you offered 60,000 as sitting fee for other directors, you must offer at least 60,000 to independent directors as well as women directors. Next one. And what about the duties of director? So, what functions a director can do? It depends upon articles of association. That means a director is supposed to act in accordance with AOA. Next one. The director need to act in good faith. For what? For promoting the objects of the company. For promoting the objects of the company, the director need to act in good faith. So, it should benefit all the members. It should benefit company. It should benefit employees. It should benefit shareholders. It should benefit the entire community as well as environment. So, what is the first point? Director need to act in accordance with AOA. What about the second point? He need to act in good faith. For what? For promoting company's objective. And what is the main purpose? To benefit all the members, company, all the employees, all the shareholders, entire community, entire environment. Next one. While exercising his duties, he need to exercise care. He need to apply his skill. He need to be diligent. And he need to express independent judgment. Next one. Now, interest of company, interest of director. So, director cannot go against to the interest of company for his personal benefit. So, if he go against to the interest of the company for personal benefit, it will be called as conflict of interest. That means there is a gap between company's interest and director's interest, which is called as conflict of interest. So now, director is thinking about his personal interest, but not about company's interest. So it is called as conflict of interest. So there is a duty to avoid conflict of interest. And finally, he cannot get any unfair advantage from the company, either for himself or for his relatives or partners or associates. Next one. Sir, what happens if he got any unfair advantage? He need to return that amount to the company. Simple. Next one. Can he assign his office to somebody else? No. So assignment is not possible. So these are the duties of director. So first one, act as per AOA. Second one, act in good faith to promote company's objectives in order to benefit all shareholders, employees, company, environment, society. Next one, and while exercising his duties, he need to apply skill, care, diligence, independent judgments. And what about conflict of interest? He need to avoid it. And what about unfair advantage? He or his relatives or partners or associates cannot get unfair advantage. If they got unfair advantage, it must be returned to the company. And finally, assignment of his office to any other person, not possible. And what about the punishment for contravention? If director fails to obey any of these duties, the minimum fine is 1 lakh, maximum 5 lakhs. Next one, powers of board of director. So first of all, directors are of two types, individual directors, board of directors. So individual director means single director. Board of directors means all directors together. So which one will have powers? Board of directors will have powers because they will represent each and every director. But individual director, If they are appointed as executive director, they will have power. If they are non-executive directors, there will be no power at all. Because executive directors need to participate in day-to-day affairs of the company. Without having powers, how they can manage the company? So that's why, even though executive directors are individual directors, they can have certain powers. But what about board of directors? Board of directors will have all the powers. Next one. Then, is it possible to restrict the powers of board of director? Yes. Is it possible to invalidate the actions committed by the board of directors? No. So what is the meaning of this point? Say for example, board of directors did a decision and they implemented the decision also. Later shareholder conducted a meeting and they want to invalidate the action which was taken by the board of directors. No, it is not possible. Once it is exercised by the board of directors, you can't make those actions as invalid actions. But before committing that act, if you want to restrict board of directors, you can restrict. Then board of directors can't take that kind of decisions and they can't do such kind of acts. But after act is committed, shareholders cannot make that act as invalid act. Next one, powers of board of directors. First one, who can ask for call money? Board of directors. Who can authorize buyback? Board of directors. Who can issue securities? Board of directors. Who can borrow money on the name of company? Board of directors. Who can invest the funds of the company? Board of directors. Now company want to give a loan, or it want to give a property as security, or it want to give a guarantee, LSD transactions. So in this case also, who is having authority to approve such transactions? Board of directors. And who will approve financial statements initially? Board of directors. Because first company will prepare financial statements, later it will be approved by board of directors, later auditor will audit the financials and he will issue audit report, later board of directors will issue board report, later they will conduct AGM, in that AGM they will place financials, audit report, board report. Now in the AGM, shareholders will finalize the financials. Now that approved financials need to be filed with ROC and thereafter they need to file annual return with ROC. So this is the regular process. Now in order to approve financials, board of directors need to give their approval. So this will be done before audit. So this will be a power of board of directors. And to make diversification decision. What is meant by diversification? So splitting the single business into multiple businesses. So even that decision can be taken by board of directors, and they can approve amalgamations, mergers and reconstructions, and they can approve takeovers or acquiring substantial stake, that is at least 20% stake, and they can do any other matter which is prescribed. So these are all the powers of board of directors. Now the point is, in order to exercise these powers, they need to conduct board meeting, they need to pass board resolution. So they must conduct board meeting, they must pass board resolution. Board meeting means meeting of directors. Board resolution means the decision which is made by the directors. Then how many directors need to agree for the decision? More than 50%. Then it will be called as board resolution. So by conducting board meeting and by passing board resolution in that meeting, they can do all these things. In addition to these things, they can even do political contributions. They can make contribution to any political party. Next one, they can appoint or remove KMPs. Next one, they can appoint or remove internal auditors, secretarial auditors. What about cost auditor? No, shareholders will have that authority. What about statutory auditor? No, shareholders will have that authority. So these are all the powers of board of directors, and they can exercise these powers by conducting board meeting and by passing board resolution. Now the point is, there is a separate concept called as resolution by circulation. What is meant by resolution by circulation? So without conducting board meeting, you can pass resolution. So how to pass resolution without conducting meeting? I will forward the agenda to all the directors electronically or through post. Now all the directors will give their reply through post or electronic mode. Now I will collect all the replies and I will check whether resolution is passed or not. So in this case, conducting meeting is not required. This kind of resolution will be called as resolution by circulation. So board of directors can exercise these powers. That is borrowing money, investing money and making LSD transactions. So these powers can be exercised by resolution by circulation also. Then what about remaining? They must conduct board meeting. What about these three things? They can conduct either board meeting, or without board meeting also they can pass resolution called as resolution by circulation. Next one. Can they delegate the powers to any other person? Yes. Delegation of office, entire office is not allowed, but delegation of some of the powers is allowed. So the powers can be delegated to whom? Committees. Say for example, recommending auditor, it is the power of board of directors, but it can be delegated to audit committee. Recommending directors and some key persons, it is the power of board of directors, but it can be transferred to nomination and remuneration committee. So like that they can create committees and they can transfer some of their powers. Next one, it can be transferred to MD. It can be transferred to manager or principal officer of the company. In case if there is any branch, principal officer of that branch. So the powers can be delegated to these people, but not entire position. Only few powers can be transferred to these people. Next one. So in this question we discussed about powers. So individual director, can he exercise any powers? No. But if he is executive director, yes. Board of directors collectively, yes. Then what powers? All these powers will be covered. Then how they can exercise the power? By conducting board meeting and by passing board resolution. But in case of borrowing funds, investing funds, giving loans or guarantees or securities, then you can pass the resolution by circulation also without conducting board meeting. Next one. Power delegation, is it possible? Yes. Entire office delegation is not possible, but power delegation is possible. Next one. Restrictions on powers of board of directors. So here there are 4 points. In those 4 points, board of directors alone can't make decision. In those 4 points, shareholders need to agree. That means SR is required. So I am going to discuss about 4 points. In those 4 points, board of directors can't make decisions. What is required here? Shareholders approval is required. What kind of resolution shareholders need to pass here? Special resolution. Then what are those cases? First one, company is having undertaking and company want to sell this undertaking, or it want to give this undertaking under lease. Now what is required means SR is required. Or now company is going to sell or lease not whole of the undertaking, it want to give lease or sale only substantial portion of undertaking, then also SR is required. Now the main point is what is meant by undertaking and what is meant by substantial portion of undertaking. Undertaking means it is a business unit. In all the business units, it is one of the business unit, and this business unit need to contribute at least 20% of profits. So out of total profits of the company, if this unit contributes at least 20% of the profit, this unit will be called as undertaking. Or in this business unit, the total investment is more than 20% of the net worth of the company. So out of total company's net worth, more than 20% of the net worth was invested in business unit. Now also this business unit will become undertaking. So what is meant by undertaking here? It's the business unit which will contribute at least 20% of total profits, or which requires an investment which exceeds 20% of the total net worth. That business unit will be called as undertaking. Then what is meant by substantial portion of undertaking? So in this entire undertaking, if you want to sell or lease 20% of undertaking, then it will be called as substantial undertaking. Now the point is, if the company want to sell or lease any undertaking either as whole or as substantial portion, then what is required? SR is required. Board of directors alone can't make the decision in this matter. Next one. Now the company made merger or amalgamation. Now they got some compensation. So in the form of purchase consideration. Now where to invest this purchase consideration? There are 2 options. One is trust securities, other one is other securities. If you want to invest in trust securities, then board resolution will be sufficient. If you want to invest in any other security, then SR is required. So what is the point here? I got compensation under merger or amalgamation. If I want to invest this money in any trust securities, SR is not required. If I want to invest this money in other than trust securities, then SR is required. Next, C point. Now total debt exceeds total capital, then SR is required. So what is meant by total debt? Total debt means existing debt plus proposed debt minus temporary loans. So I need to take the existing debts after excluding temporary loans, and I need to add proposed debt. If that amount exceeds total capital means paid up capital plus free reserves plus security premium account. So if my total debt exceeds total capital, then SR is required. Sir, what happens if my total debt is up to total capital? Then BR will be sufficient. Say for example, my existing debt is 20 crores. Among these 20 crores, so temporary loan is 5 crores. Now I want to raise another 20 crores. My entire paid up capital plus free reserves plus security premium is 30 crores. Now say what kind of resolution is required here? So now 20 after excluding 5 it will be 15. 15 plus proposed debt 20, total 35. Now 35 exceeds 30. So what is required? SR is required. What happens if the total debt is only 30? Not required. If it is less than 30, not required. If it is more than 30, required. So this concept is already there in CMA intro also. Next one. Last one. So now director is given with a loan. So company gave a loan to the director. There is no problem in it. But if company want to remit the amount which is given to the director, or company want to give extra time for the director to repay the loan. So one is remission of amount which is given to the director. Other one is giving extra time to repay the loan. In both these cases, the company want to do some favor to the director. So that's why here board resolution is not sufficient. What is required? Special resolution is required. That's it. So this is extra point. You can strike it off. So now in which cases SR is required? So there is undertaking. The company want to sell or lease entire undertaking or substantial portion of undertaking. Entire undertaking means it is more than 50%. Entire undertaking means more than 50%. Substantial portion of undertaking means at least 20%. If company want to sell or lease either entire undertaking or substantially whole portion of entire undertaking, then it need to get the permission of shareholders through SR. Second one. Now company got some money because of amalgamation or merger. If it want to invest that money in security other than trust security, SR is required. Third one. If total debt, that means existing debt as well as proposed debt, if it exceeds total capital, SR is required. And last one. Now company gave loan to the director. Company want to remit that loan, or it want to provide some extra time to the director. In both these cases, SR is required. Now first point is having exception. So what is that exception? Say for example, if it is done in ordinary course of business, that is sale or lease of undertaking, either whole or substantial. So if it is in the ordinary course of business, then no need to take SR. Next one. Now without permission of shareholders, company made sale or lease of the undertaking, either whole or substantial portion. But other party got the title in good faith. When other party is innocent, then this transaction is not invalid. This transaction will become valid. Reason? Because other party is innocent party. So Nemo.quad non-habit concept. So in case of sale, if seller does not have any ownership, buyer will not get ownership. But if buyer is innocent person, even though seller does not have ownership, buyer will get ownership. So that point is covered here. These are the two exceptions which are given for point number 1. Next one. Compensation for loss of office. So how much compensation to pay? So first of all, I appointed a director for 5 years. After 4 years, I removed the director. So before the expiry of term, I removed the director. So not because of any misconduct. So I removed the director for normal reason only. Now company is required to pay compensation to such director. Then what is the compensation amount? First one. Now we need to calculate the salary here. How to calculate the salary? So term into salary per year. So if I multiply the term with salary per year, I will get the total salary. That total salary will be the maximum limit of compensation. Then what term I need to take? I need to take balance term or 3 years, whichever is shorter. So in this case, balance term is 1 year or 3 years, whichever is lower. That means I need to take 1 year. Next one, how much salary per annum I need to take? I need to take the average of last 3 years or last appointed years. Say for example, if he is appointed only for 1 year, only 1 year got completed, only 2 years got completed, I need to take the average of 1 year or 2 years. That's it. If it's more than 3 years, I need to take only the average of last 3 years. So 3 years or appointed period, whichever is lower, I need to take the average per annum salary. Now I need to multiply the term with per annum salary. So I will get some amount. Thus that will be the maximum compensation that need to be paid to the director for loss of office. Next one. Now there are certain cases where a director is not allowed to get compensation. So what are those cases? First one, director himself resigns from the company. Then he is not allowed to take compensation. But here we need to classify the resignation case into two cases. One is resignation because of reconstruction of the company. Resignation because of any other reason, that is other than reconstruction. So if it is reconstruction case, if a director resigns because of that amalgamation or merger decision, now company need to offer the director position once again. If director refuses to take the new position, then company is not liable to pay any compensation. In case of any other situation, if any director resigns from his position, company is not liable to pay any compensation. That means, what is the difference between these 2 points? First of all, what is the similarity? In both cases, director is resigned. What is the dissimilarity? Here this is because of reconstruction of the company. Here it is because of any other reason. So in this case, compensation is not paid to the director. But in this case, compensation is not paid to the director only if he is offered as a new director in the reconstituted company. Next one. Now, director vacated the office because of disqualification, because of non-attending board meetings for 12 consecutive months. So because of his own conduct, he vacated the office. Now, is company liable to give any compensation? No. Next one. Now, company is closed. And the main reason behind the closure of the company is the director only. So, what about the obligation of the company? Is it required to pay any compensation? No. Now, the director did any fraud or breach of trust, or he acted in negligent manner, or he did some mismanagement. That means there is a guilty on part of the director. That's why he is not entitled to any compensation from the company. And last one, any other reason where there is no default of the company, company is not liable to pay compensation. In all these cases, company is not liable to pay any compensation. In the remaining cases, company need to pay compensation. Then how to calculate compensation, maximum compensation? Tenure into salary per annum. So how to take tenure? 3 years or balance period, whichever is lower. How to take average? For last 3 years, if it is less than 3 years, then that less than 3 years term, we need to take that average. We need to multiply the term into average so that we will get an amount which is a maximum compensation which is payable to the director. Next one. There are some special cases. Even though there is no default on the director, director is not entitled to get compensation. So what are those cases? Now director went out of the company. Now within 12 months of his vacation, company got closed. Not for his reason, not for any other, it is for any other reason. Now company will make winding up. What is meant by winding up? It will sell the assets so that it will release some money. It will clear the liabilities. After clearing liabilities, it will pay the amount of shareholders. If the amount is not sufficient to pay the amount of shareholders, then company is not required to pay any compensation to the directors. So here there is no default on part of the director. But here the money is not sufficient to discharge all the amounts. So after clearing liabilities, they need to clear the shareholder amount. But the amount is not sufficient to clear the shareholder amount. When it is not sufficient to clear the shareholder amount, how the company is going to clear your amount? So in that case, you are not entitled to get any compensation from the company. But this rule is applicable only is when company is dissolved within 12 months from the date of removal or resignation or any other vacancy from the director position. Next one. Waiver of recovery of compensation. Say for example, the company paid wrong compensation. They paid excess compensation. What company can do now? It can recover that money. It can recover that money. Next one. Now, director got remuneration based on net profit. Because based on net profit only, they will be paid with remuneration. Now, in order to get more remuneration, he overstated the net profits so that he will get more remuneration. Later, it was found that the financials are overstated in order to give more remuneration to the directors. Now the entire financials got restated. Now the net profit got reduced. That means the remuneration which is payable to directors is also reduced. So for example, previously he took rupees 1 lakh, but because of this restated financials, he is eligible to take only 60,000. That is, what about extra 40,000 which is already paid to him? It can be recovered from that person. Next one. Related party transactions. What is meant by related party transaction? Very simple, the transaction which is made by related parties like subsidiaries, associates, joint ventures, directors relative. So these people are called as related parties. If company made any transaction with related party, it will be called as related party transaction. Next one. In case of related party transaction, there may be some unique transactions, there may be some repetitive transactions. So what is meant by unique transaction? What is meant by repetitive transaction? Unique transaction. So there is no similarity between transactions. Repetitive transactions. Almost all transactions are similar in nature. So for unique transactions, approval of audit committee is required. For each transaction, approval of audit committee is required. For repetitive transaction, approval of audit committee is required for all the transactions. That means if I did 10 unique transactions, I need to get the approval of audit committee for 10 times. If I did 10 repetitive transactions, I can take single approval from the audit committee. That single approval will be called as omnibus approval. So it is nothing but a single approval which is given by the audit committee for repetitive transactions. Next one. Then what is the validity of this approval? This will be valid for maximum 1 year. That means audit committee may fix it as 6 months also, 7 months also, 9 months also, but not exceeding 1 year. So the validity of approval is maximum 1 year. Next one. Then what about the permission of shareholders? Is it required? Permission of shareholders. So it will be required if the paid up capital is more than 10 crores. If company's paid up capital is more than 10 crores, along with audit committee approval, shareholders approval is also required by passing ordinary resolution. That means whose approval is required for related party transaction? So for normal companies, only audit committee. For companies with a paid up capital of 10 crores, audit committee approval plus shareholders approval in the form of ordinary resolution. Okay, for unique transaction, for each transaction approval is required. For repetitive transactions, omnibus approval will be sufficient. Next one. What is the validity of omnibus approval? Maximum 1 year. It may be less than 1 year also, but maximum 1 year. Next one. And this omnibus approval is not applicable in case of selling undertakings. So in previous question, we already discussed about selling or leasing of undertakings. So for selling or leasing of undertakings, omnibus is not eligible. It is not applicable. So if you want to sell your undertaking or if you want to lease your undertaking to your related party, then you need to take separate permission. Omnibus approval is not eligible. Next one. Now let's check some points before giving this omnibus approval. First one. What criteria audit committee will set in order to provide omnibus approval? So it will fix maximum value of all the transactions. Say for example, if it fix maximum value of all the transaction together is 1 crore. That means The single approval will be sufficient for all repetitive transactions up to their value does not exceed 1 crore. But once their value exceeds 1 crore, again separate approval is required. That means they can put a maximum limit on overall transactions, and they can put maximum limit for each transaction also. So for example, they set rupees 1 lakh as limit for each transaction. So for the transactions which are in repetitive nature and up to 1 lakh limit, omnibus approval will be sufficient. If it is more than 1 lakh, then separate approval is required. Next one, they can ask for disclosures. If company want to make related party transaction and it want to take omnibus approval, that is single approval for repetitive transaction, it need to give certain details to the audit committee. So what kind of details the company need to provide for the approval purpose? It will be decided by audit committee. Next one, if audit committee want to check those transactions, repetitive transaction, it can fix some intervals also, like 3 months, 4 months, 5 months, like that. It can put some frequency, and in that frequency they will verify the repetitive transactions if they want. Next one, they can put some prohibited transactions also which are not subject to omnibus approval. So for this transaction, whether it is repetitive or not, whether it is having low amount or not, you must take the permission, separate permission. So here omnibus approval is not applicable. Like that they can put restrictions also. Now say, what is the eligibility criteria? Eligibility criteria may be maximum value of all the transactions, maximum value of single transaction, disclosures to be made to the audit committee for getting approval, and periodical reviews, and transactions which are not subject to omnibus approval. So this is the eligibility criteria. So here there is no defined eligibility criteria. It will be decided by audit committee. The criteria will be decided by audit committee. So while deciding criteria, audit committee need to examine the following factors. What are those factors? Repetitive nature. Next one, justification for the need of omnibus approval. Next one, what about the content of approval copy? So name of the related party, nature of the transaction and duration of the transaction, and maximum amount of the transaction that can be entered with the related party. In case if there is any inflation, how to calculate the inflation, how to adjust the inflation. All these things will be provided in omnibus approval copy. Next one, sir, what happens if there is no need of related party transaction, or the details which want to be provided by the company to the audit committee are not available for getting approval? So when these things are not available, then also omnibus approval is possible, but with a maximum transaction limit of 1 crore. And this is valid for maximum 1 financial year. That's it. Now what is the conclusion of this question? So related party transaction means transaction which is made with related party. Whose approval is required? Normal case, audit committee. In case of companies having paid up capital of 10 crores, shareholders approval in the form of OR is also required. So if the transactions are unique in nature, separate approval. If the transactions are repetitive in nature, omnibus approval, single approval. And what is the validity of the approval? Maximum 1 year. So for that purpose, who will decide the criteria? Audit committee, based on certain factors, by giving certain contents in the omnibus approval. Now what happens if this criteria is not met? Then also omnibus approval is possible, but now maximum transaction limit will be 1 crore. Next one, interested director. So who is interested director? Say for example, the company want to make a contract with a partnership firm. Now one of the directors is a partner in that partnership firm, so he will be called as interested director. The company want to make a contract with an association of persons. Now our director is one of the person in that association, so our director will be called as interested director. Now our company is going to make a contract with another company, another body corporate. In that body corporate, our director is also acting like director or promoter or manager, or he is having more than 2% of shares. Then our director will be called as interested director. So when director of a company will be called as interested director? When company want to make a contract with a partnership firm, any association or any body corporate. Now in that partnership firm, our director is partner, interested director. Our director is person in association of person, interested director. Our director is either director or promoter or manager or CEO in other company, or he is having more than 2% of shares in other company, then also our director is called as interested director. Okay. Now, in case of interested director, so while making the decision regarding this contract in the board meeting, he must not participate in that meeting, and he shall not exercise any voting, and he need to disclose this fact even before the start of meeting. That means now company is going to make a contract with these people. Now our director is associated with these people. Initially, before the commencement of meeting itself, he need to communicate that fact to the company, and he shall not participate in the meeting. He shall not vote at the meeting, and he cannot be counted for the purpose of quorum also. So what about the quorum requirement in case of board meetings? 1/3 of total directors or 2, whichever is higher. But while counting those limits, you need to exclude interested directors. Okay. Now the point is, sir, what happens if out of total directors, at least 2/3 directors are interested directors? If all those people are not required to participate in meeting, then all those people will not be counted for the purpose of quorum. Then how many people need to be there in company to constitute a valid quorum? 2. That's it. That means if the interested directors are less than 2/3, then what about the quorum requirement? 1/3 or 2, whichever is higher. If interested directors are at least 2/3, then what about the quorum requirement? 2 directors. Those 2 directors must be uninterested directors. So next chapter, it is about board meetings. So first of all, frequency of board meetings. So what is meant by frequency of board meetings? How many board meetings a company is required to conduct in a year? First of all, first board meeting need to be conducted within 30 days of incorporation. So what is the purpose of conducting first board meeting, that too within 30 days? For the purpose of appointing auditor. So auditor will be appointed by board of directors within 30 days of incorporation. If they fail, shareholders will appoint the auditor. So first, after incorporation within 30 days, the board of directors need to conduct one board meeting, and thereafter they need to maintain at least 4 board meetings per year. So here there is no clarity whether such year is financial year or calendar year. So some companies will follow it as financial year. Some companies will follow it as calendar year. So there is no clarity from MCA. So in exam, just write the year, not as calendar year, not as financial year. Then what about the gap between 2 board meetings? It is maximum gap, not minimum gap. It is maximum gap 120 days. That means if I conducted board meeting today, I need to conduct another board meeting in next 120 days. Next one. Then there are 3 special companies. One is 1-person company, other one is small company, other one is dormant company. In case of 1-person company, there are 2 categories. 1-person company with only 1 director, 1-person company with more than 1 director. So total how many categories are there? 4 categories. First one, 1-person company with only 1 director. Second one, 1-person company with more than 1 director. Third one, small company. Fourth one, dormant company. If 1-person company is having only 1 director, then it is not required to conduct board meeting at all, because board meeting means meeting of directors. If there is only 1 director, so how he will conduct meeting? So that's why the meeting provisions are not applicable for the OPC having only 1 director. What about OPC having more than 1 director? Board meeting provision is applicable. What about small company? Applicable. What about dormant company? Applicable. But they need to conduct at least 1 board meeting for each half of the calendar year. So here it is clearly mentioned as calendar year. So for each half of the calendar year, that is from January 1st to December 31st, it is entire calendar year. Half of the calendar year means June. That means from January 1st till June ending, they need to conduct 1 board meeting. From July 1st to till December ending, they need to conduct another board meeting. Now, gap. So here it is not maximum gap, here it is minimum gap. The minimum gap is 90 days. That means if I conducted a board meeting today, I need to wait for 90 days to conduct another board meeting. So now say what is the provision for normal companies, for special companies. For normal companies, 4 times per year. For special companies, 1 time per calendar year, but half of the calendar year. That means for whole calendar year, it will be 2 times. Next one. In case of normal companies, the gap will be maximum gap, 120 days. So within 120 days, they need to conduct board meeting. In case of special companies, there will be minimum gap of 90 days. After 90 days, they can conduct another board meeting. Next one. Then what about the committee meeting? In case of committee meeting, they need to meet according to the directions issued by the board of directors. If board of directors said to meet 3 times a year, they need to meet for 3 times. They said to meet for 5 times, they need to meet 5 times. So they need to follow the instructions given by the board of directors. If any law or any authority like SEBI so gave any instruction, then they need to obey such instruction. That means how many number of committee meetings must be conducted in a year? It all depends upon the directions given by the board of directors or any law or any authority. Next one. What about the meeting of independent directors? So they must meet at least once in every calendar year. So this is for independent director. Now what is the overall conclusion for this question? Board meetings, committee meetings, meeting of independent director. Board meetings. So what is the rule? Normal companies, special companies, except OPC with 1 director. Okay, in case of normal companies, 4 times per year. Maximum gap 120 days. In case of special companies, 1 time for each of the half of the calendar year, and minimum gap 90 days. Next, what about committee meetings? The number will be dependent upon board of directors directions, any directions given by law or any authority. And what about the meeting of independent directors? They must meet at least once in a calendar year. So calendar year is clearly prescribed in all cases except one case. What is that case? 4 times per year. So in this case, so it is not given that it is calendar year or financial year. Next one. Then how to participate in the board meeting? So you can participate in the board meeting either physically or through electronic mode. Physically means you need to attend the board meeting. Mari, electronically. So in case of electronic meeting, you need to attend either through video conferencing or through any other audio video means. Now the point is, there are certain cases where the director must attend the meeting physically, not through video conference, not through any other audio video means. In certain cases, physical presence is mandatory. Except in those cases, in remaining cases, they can participate either physically or through electronic mode. But in those certain cases, only physical presence is mandatory. Then what are those cases? First one, approval of financial statements. I already said the procedure. First, company will prepare financials. Later, board of directors will give approval. Later, auditor will conduct audit and he will issue audit report. Later, board of directors will conduct meeting and they will issue board report. Later, AGM will be conducted and all the documents, that is financials, audit report, board report, will be placed before shareholders. And thereafter, company will file financials as well as annual returns with the ROC. Now the point is, for the approval of financials before the audit, board of directors need to meet. They need to meet physically. So audio video means, video conference means not allowed. Next one, for issuing board report, board of directors need to conduct meeting. So for that meeting, all the people need to attend physically. So audio video means, video conference means not allowed. Next one, now company want to issue securities to the public. When company want to issue securities to the public, the company is required to issue prospectus. So before issue of prospectus, it need to be approved by directors. Now directors need to conduct a board meeting, and how to participate in that meeting? Physically. That is point C. Next one. And now board of directors want to decide about amalgamation, merger, demerger, acquisition, takeover. So these are nothing but external reconstructions. So if any decision about amalgamation, merger, demerger, acquisition, takeover is need to be made by the board of directors, then in that board meeting, the board of directors must present physically. Next one. Now this is about audit committee meeting. This is not about board of directors meeting. This is about audit committee meetings. So audit committee may review the financial statements of the company, including consolidated financial statements. And for such purpose, they need to meet physically. Now say, how to attend board meetings or committee meetings? Whether it is board meeting or committee meeting, you can attend either physically or through video conference or audio video means. But if it is related to certain matters, you must attend physically. What are those certain matters? Approval of financials, issue of board report, approval of prospectus, approval of external reconstruction. Physical presence is mandatory. In case of audit committee, to review the financials, physical presence is mandatory. Next one. Then, how to conduct board meeting? First one. First of all, there must be a person to send the notice. And there must be other person to receive the notice. And we need to provide some content in the notice. So let's discuss about each and every point. First one, to whom the notice must be sent? The notice must be sent to all directors because the notice is related to board meeting. When it is related to board meeting, who need to participate in that meeting? Directors. That's why you need to give notice of board meeting to all the directors. Next one, who need to give the notice of meeting to all the directors? If company is having CS, CS. If company does not have CS, any director. If no one is prescribed like that, then any other authorized person. So these people can send a notice to all the directors. Now, how many prior days notice is required? 7 days prior notice is required. In case of general meeting, that is shareholders meeting, 21 prior days notice is required. But in case of board meeting, 7 days prior notice will be sufficient. Okay, 7 days prior notice should be given to all directors. Is it allowed for shorter notice? Yes. But for that purpose, there is a requirement. What that requirement? In that board meeting, there must be at least one independent director. Then only it is valid. So, in case of board meeting, the notice must be given by these people to all the directors at least 7 days before the date of meeting. But if they want to give some shorter notice, that is allowed. But in that meeting, there must be at least one independent director. Sir, what happens when independent director is not present at the meeting? So first you need to conduct the meeting and you need to prepare the resolution and pass that resolution to all the directors including independent director, and now independent director need to ratify that resolution. That is subsequent approval. Then only your meeting will be valid. Next one. Then how to give the notice to the directors? If any prescribed mode is given by the director, in that prescribed mode, you need to forward the notice to the director. If nothing is prescribed, you can give either through post or through electronic mode. Next one. Then what about the content of the notice? So it must specify the serial number. So first board meeting, second board meeting, third board meeting, fourth board meeting, 10th, 11th, 30th board meeting, like that. You need to provide the number of board meetings. And you need to provide the day of the meeting. You need to provide the date of the meeting. You need to provide the timing of the meeting. You need to provide the address of the meeting. And you need to provide a point, that is, if any director want to participate through audio video means, they need to communicate to us before the conduct of meeting. Like that, they need to give a disclaimer also. So what about the content of the notice? Serial number of the board meeting, date, time, and address for physical presence, and they need to say about option which is available to the directors to participate through audio video means. Now if any director want to participate through audio video means, what he need to do? He need to communicate his intention to the CS or person authorized by board of directors. So is it necessary to give this kind of intention for every meeting? Yes. But if the director want to give a single declaration for all the meetings, he need to give at the beginning of calendar year about his intention. until that intention is revoked, he will be allowed to participate in audio video mode only. Next one. And on which time you need to conduct meeting. So for AGM, there will be lots of restrictions regarding place of AGM. It need to be conducted at registry office or any place where the registry office is situated. Then what about board meeting? No such restriction. In case of AGM, so it must commence during business hours. But in case of board meeting, such kind of requirement is not there. In case of AGM, it must be conducted on any day except national holiday. In case of board meeting, same rule is applicable. It can be conducted on any day except on national holiday. So there is no restriction regarding time and place, but there is a restriction regarding day. So on which day you can conduct a board meeting? On any day except national holiday. Now what are the points that are covered in this question? First one, who need to send the notice? Second one, to whom the notice must be sent? Third one, how many prior days notice is required? Fourth one, is shorter notice allowed? Next, fifth one, content of the notice. Next one, minimum quorum. So what is the minimum quorum in case of board meeting? So in case of normal company, 1/3 of total directors or 2, whichever is higher. In case of chartable company, that is section 8 company, instead of 1/3 you need to take 25%. So 25% means 1/4. And instead of 2 you need to take 8. Instead of higher you need to take lower. Now say, what is the quorum for normal company? Total directors, out of total directors, at least 1/3 directors or 2, whichever is higher. In case of section 8 company, 1/4 directors, that is 25% of total directors, or 8, whichever is lower. Now what happens if interested directors are greater than or equal to 2/3 of total directors? They are not allowed to participate. They are not allowed to vote. They are not allowed to be counted for the purpose of quorum. Now the quorum rule will be changed. Now what is the updated quorum rule? Minimum 2 directors who are not interested. So that will become the quorum. Normally what is the quorum? 1/3 or 2, whichever is higher. But if the independent directors are more in the company, interested directors are more in the company, then minimum 2 will be sufficient. Next one. Then what about committee meetings? And what about fractions? In case of fractions, we need to round it off to next number. That means nearest number is allowed only in case of rotational directors who are liable for retirement at AGM. So at the time of taking 1/3, we need to take nearest number. In remaining all cases, we need to take next number. Next one. And what about committee meetings? What about committee meetings? In case of committee meetings, all the members of the committee need to present. That means in case of board meeting, all directors are not required to present at the board meeting. But in case of committee meeting, all members of the committee need to present at the meeting. But if board of directors or articles or any law so set a different rule, then they are allowed to follow the different rule. Otherwise, all the members of the committee need to present to create a quorum. Now the next biggest question is, if the quorum is met, if quorum rule is met, they can continue with the meeting and they can pass the resolution. What happens if quorum is not met? They need to adjourn. But for 2 things, no need of any adjournment. So what are those 2 things? Say for example, there are total 10 directors in the company. So what about the quorum rule? 1/3 of 10, which means 3.33, we need to take it as 4 or 2, whichever is higher, that means 4. But now only 3 directors are present at the meeting. Now what to do? So for 2 things, they can continue the meeting. For balance things, they need to adjourn the meeting for the requirement of quorum. Then what are those 2 things? In order to add 1 extra person to meet the quorum, that extra person will be called as additional director. So they can appoint additional director in order to meet quorum requirements. But the validity of the term of additional director will be up to next AGM only. We already discussed about that concept in previous chapter. Next one, they can call for general meeting. So for calling general meeting, even though the quorum is not met, they can continue with the meeting to call for general meeting. So for these two things, for adding extra directors to meet quorum requirements or to call for general meeting of shareholders, for these two things, no need to postpone the board meeting. You can conduct the board meeting even though quorum rule is not met. But in remaining cases, you must postpone the board meeting to meet the quorum requirements. Next one. Sir, what happens if directors are not present in that adjourned meeting also? Then they can continue with the meeting without postponing more. What happens if a director is absent for all the board meetings throughout the calendar year? He will be disqualified. Next one. Resolution by circulation. So what is meant by resolution by circulation? So generally, board of directors will decide any matter by passing board resolution. Then how to pass board resolution? Either by conducting board meeting or without conducting board meeting. So without conducting board meeting, if they pass any resolution, that resolution will be called as resolution by circulation. Now what is the procedure they need to follow? They need to prepare the agenda. They need to forward the agenda to all the directors. A 7 days time period will be allowed to all the directors to give their reply. Now directors within those 7 days, they will provide the reply. Now I need to count the votes. If in favor votes are more than against votes, then board resolution is said to be passed. So this is how the process will happen. Now the point is, if out of total directors, 1/3 directors are demanding to pass board resolution only by conducting board meeting. That means those people don't want to pass board resolution through resolution by circulation. They want to pass board resolution only through board meeting. Now, if these many number of people are demanding for board meeting, then definitely company need to conduct board meeting. That means company is allowed to pass resolution through circulation. But if 1/3 of total number of directors are demanding for board meeting, then company must conduct board meeting. There is no other option. Next one. Minutes. So what is meant by minutes? So it is the record of what has happened at the meeting. So in the meeting, so what are the discussions made? What are the resolutions passed? All these things will be recorded in a separate register called as minutes book. For general meeting, there will be a separate register. For board meeting, there will be a separate register. That means for every meeting, the company need to maintain a separate register. Then what is the time limit to fill the details in minutes book? Within 30 days of completion of meeting, the company need to fill the details of the meeting in the minutes book. So the time limit will be 30 days of conclusion of meeting. Next one. So matters to be included. So which kind of matters to be included in board meeting? So first one, the discussions that are made in the meeting and the resolutions that are passed in the meeting. So for example, if you appointed a managing director, the same need to be included in the minutes book. If you appointed some KMP, the same need to be so included in minutes book. So every appointment made at the meeting, which is nothing but every resolution passed at the meeting, need to be included in minutes book. And what is the time limit? 30 days. Now the point is, if it is board meeting, you need to disclose extra particulars. What are those extra particulars? Number of directors present. Number of directors present. Number of directors absent. And the names of the directors who are present at the meeting and the names of directors who are absent for the meeting. And in case of resolution, so names of the persons who supported the resolution, names of the persons who opposed the resolution. That means we need to provide the complete particulars. But this rule is not applicable in case of general meeting. Because in case of general meeting, the shareholders will be in lakhs and crores. So it is not possible to record each and every person name. But in case of board meeting, the max number is 15. Sometimes 16, 17 by passing SR. That's it. So it is very easy to record the names who are present at the meeting, who are absent, and who assented for the resolution, who dissented for the resolution. In simple words, the minutes book shall contain fair and correct summary of proceedings. So what is happened in the meeting, that should be recorded in the minutes book. Now the point is, every meeting will have a chairperson who will preside the meeting affairs. Now that chairperson will have a right. If you want to remove any point which is happened at the meeting, he can remove that point based on 3 grounds. First ground is if it is against to the interest of the company. That means if that point is included in the minutes book, it will definitely going to damage the image of the company. Then he can remove that point. Next one. If this is against to the interest of any member or director, then that point can be excluded. If it is irrelevant, immaterial, unnecessary, then also he can exclude that point. So which points can be excluded by the chairman of the meeting from the minutes book? Which is against to the company, which is against to the participants, and which is unimportant. All these 3 things can be ignored by the chairperson while preparing minutes book. Next one. So this minutes book will be kept at registered office of the company. Next one. Is it possible to inspect the minutes book? Yes. But when to approach the company in order to inspect the minutes book? During business hours. So are we liable to pay any charge for inspecting the minutes book? No. For getting copy or extract, I need to pay the money. But for inspecting minutes book, no need to pay any money. Then who is allowed to inspection? Members. So can company restrict the inspection time period? Yes. It can restrict up to minimum 2 hours. And for copy or extract, so company will provide you copy or extract within 7 days. That means member, he want to inspect the minutes book. Is it possible? Yes, without any cost. So he want to take the copy or extract of minutes book. Is it possible? Yes, but by paying money. So in case of inspection request, you are allowed to inspection immediately. In case of copy request, you will be provided with a copy within 7 days of your request. Next one. So this point is already completed. Next, audit committee. So what is meant by audit committee? The committee which is created by board of directors and the power to recommend auditor. So it is generally available with the board of directors. The power to review the audit work, it will be reserved in the hands of board of directors. Now these powers will be transferred to whom? Audit committee. Then which companies are required to create audit committee? That too mandatorily. First one, all listed companies. Irrespective of paid up capital, irrespective of turnover, irrespective of loans, borrowings, deposits, debentures. So irrespective of anything, all listed companies are required to form audit committee. Next one, what about unlisted public companies? In case of unlisted public companies, we need to check either paid up capital or turnover or loans plus borrowings plus debentures plus deposits. So in case of turnover, what is the limit? Minimum 10 crores. Paid up capital 10 crores. Turnover minimum 100 crores. What about loans, borrowings, debentures, deposits? Minimum 50 crores. If any one of these conditions got satisfied by any unlisted public company, then those unlisted public companies are also required to create audit committee. What about balance unlisted public companies? Not required. What about private companies? Not required. Next one. Then what about the composition of audit committee? So audit committee must contain minimum 3 directors. So among board of directors, there will be some directors. At least 3 directors must be allotted to audit committee. So audit committee must contain at least 3 directors. Out of all directors, majority directors, that is more than 50% directors must be independent directors. Next one. And the composition of audit committee shall be disclosed in board report. So after audit report, board of directors will issue a report called as board report. In that board report, they need to give the details of members of the audit committee. So who is the member of the audit committee? He need to provide such details. Next one. What is the responsibility of audit committee? So these are all the responsibilities. This is point F. This is G, H, I, J. And this is point number 5. Okay. What are the responsibilities of audit committee? First one. Who will recommend the appointment, remuneration, terms of auditor? Audit committee only. But this is applicable only in case of non-government companies. In case of government company, such kind of recommendation will be made by C and AG. Comptroller and Auditor General of India. Next one, who will review and monitor auditors' independence, auditors' performance and effectiveness of audit? Audit Committee. Next one, who will examine the financial statements and audit report? Audit Committee. Actually Board of Directors, but when Audit Committee is created, that responsibility will be given to Audit Committee. Next one, who will give approval for related party transactions? Audit Committee only. Either separate approval or omnibus approval. Next one, who will provide intercorporate loans and investments? Company. Say for example, one company gave loan to another company, or one company invested in another company. So this is called as intercorporate loan. This is called as intercorporate investment. Then who need to review these intercorporate loans and investments? Audit Committee. Next one, and valuation of undertakings and assets. So who need to evaluate the value of undertakings and assets? It is registered valuer. Now who need to review the work of registered valuer? Audit Committee. Next one, who need to evaluate the internal controls and risk management systems? Audit Committee. And if company raises any money by way of capital, who need to check their end usage? Audit Committee. So whether it is utilizing for the said purpose or not. So who will review that point? Audit Committee. So these are all the responsibilities of Audit Committee. Finally, while investigating these matters, if Audit Committee want to take the professional advice of some outsider, they can take the advice, but at the cost of company, not at the cost of Audit Committee. Now say what about Audit Committee? Which companies are required to create Audit Committee? All listed companies. In case of unlisted public companies, they need to satisfy any of the three conditions. What are those three conditions? Minimum paid up capital 10 crores, minimum turnover 100 crores, minimum loans, deposits, debentures, deposits 50 crores. Next one, what about the composition? So at least 3 members must be directors of the company. Out of all directors, majority directors must be independent director, and the composition of this committee need to be disclosed in board report. Next one, and what about the responsibilities of Audit Committee? They will recommend, not appoint. Appointing authority is shareholder only. They will recommend the appointment, remuneration, terms of auditor, but this is not applicable in case of government companies. And who will review auditors' independence, performance and effectiveness of audit? Audit Committee. Who will examine financial statements and audit report? Audit Committee. Who will give approvals for related party transactions including omnibus approval? Audit Committee. Who will scrutinize intercorporate loans and investments? Audit Committee. Valuation? Audit Committee. Internal financial controls evaluation? Audit Committee. And monitoring the end use of funds? Audit Committee. Next one, visual mechanism. So what is meant by visual mechanism? So say for example, here there is employee or director, and this employee or director knows about some wrong motives in the company. So some people are doing some wrong actions. Now these people are aware about that information. Now what these people need to do? They need to communicate that matter to higher authority. Then who is the higher authority here? In case if Audit Committee is created, the chairperson of the Audit Committee. In case if Audit Committee is not created, then any director authorized by Board of Director. So this will become higher authority. So if any employee or director knows about any information which is against to the company, then they need to pass such information directly to the chairperson of Audit Committee. In case Audit Committee is not available, directly to the director who is authorized by the Board of Director. Now these people will handle the complaints. Now the point is, now what is the duty of company here? Company need to give awareness to the all employees and directors regarding the availability of this facility. Because without knowing about this facility, how they are going to report these matters to the highest authority? So first they need to know about this facility. That means the company need to advertise about this facility to the employees as well as directors. Now if there is any wrong information, then employer or director will communicate that information to the highest authority. Now there are two employees. There is a dispute between these two employees. This employee made a complaint to Audit Committee chairperson or any director who is authorized by board against this employee, even though there is no mistake on part of this employee, just to take revenge. Now these people need to take strict action against this kind of employees who are filing petty cases for personal interest, not for the interest of the company. So those people need to be punished by that higher authorities. Now the point is, this entire process will be called as visual mechanism process, and which companies are required to follow this visual mechanism process. For every listed company, it is mandatory. For every unlisted company, for every private company also, first time the private company got included here. So for every unlisted company as well as private company, if it is accepting deposits from the public, even 1 rupee also, that company is required to follow visual mechanism approach. If they borrowed funds from banks or financial institutions, which is more than 50 crores, then these companies are required to adopt visual mechanism process. Now say, what is meant by visual mechanism process? It is a facility which is available to whom? Employees and directors to report to higher authority. Higher authority means if audit committee is available, chairperson of audit committee. If audit committee is not available, any director authorized by board of directors. Okay, what they need to report? About the negative things which are happening in the company. Now the point is, the company need to advertise about this visual mechanism process to the every employee and director for effective communication. Next one, and these higher authorities need to punish those people for filing petty cases for their personal interest. And which companies are required to follow this mechanism? Every listed company, mandatory. In case of every other company, whether it is unlisted public company or private company, it is mandatory if it accepts any amount from the public as deposits, or if it is having borrowings from banks or public financial institutions exceeding 50 crores. Next one, compositions. First one, composition of directors. So board of directors must contain both executive directors and non-executive directors. So no company shall have all directors as executive directors, all directors as non-executive directors. There must be optimum combination between executive directors and non-executive directors. Next one. Then what about number of independent director concept? This is as per SEBI regulations, not as per Companies Act. As per Companies Act, we already completed that point. In case of listed company, at least 1/3 of total directors need to be independent. In case of unlisted company, which satisfy any of the condition, at least 2 directors need to be independent. This is as per Companies Act. But as per SEBI, the rule is different. As per SEBI, what is the rule? If the chairman of the board of directors is a non-executive chairman, then 1/3 of total directors need to be independent directors. If the chairman of the board of directors is executive chairman means who will participate in day-to-day affairs of the company, then at least half of the directors must be independent directors. So as per Companies Act, there are only 2 limits, 1/3 or at least 2. But as per SEBI regulations, 2. If the chairman is executive, then at least half of the directors need to be independent. If chairman is non-executive, at least 1/3 of the directors need to be independent. So what about fractions? It will be rounded off to next number. Next one, committees of board of directors. So some committees are given here. Audit committee, role is recommending auditor. NRC, role is recommending directors and key people. Next one, shareholders relationship committee, addressing the issues of shareholders and other stakeholders. Risk management committee, so addressing various risks that a company can face in future. So these are the committees which are formed by board of directors, and these committees will carry some of the functions of the board of directors. Now we are going to discuss about the composition. So you may get a practical question here, so please listen it carefully. In case of audit committee, there must be at least 3 directors. In case of NRC, there must be at least 3 directors. In case of SRC, board of directors will decide. In case of risk management committee, majority from board of directors. If the number of members of risk management committee is 10, then 6 persons must be directors. If number of members of risk management committee is 12, then 7 members are directors. So out of total members of that committee, majority members must be directors. Now say, in case of audit committee, minimum 3 directors. NRC, minimum 3 directors. SRC, board of directors will decide. In case of RMC, majority shall be board of directors. Now, out of these directors, majority directors must be independent. Next one, in case of NRC. So, all shall be non-executive director, not majority. All shall be non-executive directors and at least 50% shall be independent. Majority is different from 50%. 50% means just 50%. Majority means more than 50%. So here two conditions are applicable. First condition is at least 50% shall be independent directors and all shall be non-executive directors. So here there are no further conditions. So this is about membership. But every committee will have chairperson. Then what about the chairperson? In case of audit committee, only independent director is allowed to become the chairperson, head of the committee. In case of NRC, only independent director. In case of SRC, non-executive director. In case of RMC, any director. Now see what is the requirement. First one, composition. Composition of members. Audit committee, minimum 3 directors. NRC, minimum 3 directors. SRC, decided by board. Risk management committee, majority shall be directors. Further conditions are applicable in case of audit committee 1. In case of NRC 2. In case of SRC and RMC, no further condition. In case of audit committee, what is the extra condition? Out of all directors, majority directors must be independent. In case of NRC, out of all directors, all shall be non-executive directors and at least 50% shall be independent directors. In case of SRC, RMC, no further conditions are there. Then who can become chairperson? For audit committee, independent director. For NRC, independent director. In case of SRC, non-executive director. In case of RMC, any member of the board. Member of the board means director, any director. So by this we completed about board meetings also. So total we completed minimum 15 marks, not 15 marks, minimum 15 marks. You may get up to 28 marks also. But let's follow prudence concept. So we will get at least 15 marks out of these 2 chapters. Now let's try to fill another 15 marks, which is about basic concepts of the company. So now we are going to cover 4 chapters. What are those 4 chapters? Company formation and conversion, investments, dividends, accounts and audit. So all these 4 chapters will contribute minimum 15 marks. First one, very simple concepts. Actually these concepts are already there in your CMA intro also. And already you people learn these concepts in main class also. Another point in main class lo. Okay. First one, definition of company. What is the definition of company? Company means a company which is incorporated under Companies Act 2013 or previous company law. Previous company law means Companies Act 1956, Companies Act 1913 and so on. Next one, what are the features of company? So company will have separate legal existence. Company will have perpetual succession. In case of company, shares can be transferred easily. In case of members of the company, the liability is generally limited. Company can have a separate property. Company can have a common seal. So they may ask any of these features for 2 or 3 marks. You can write the content on your own. So this is covered in CA Foundation, CA Inter, CMA Inter, even in CMA Final also. And this is 5th time. Okay, I will explain those points. First one, what is meant by separate legal entity? Company need to be treated as a separate person. Company is different from its members. Company is different from its promoters. Company is different from its directors. That means if company is having any asset, that asset belongs to company only. If company is having any debt, the debt need to be repaid by company only. So for the assets of the company, no person will have rights except company. For the liabilities of the company, no person will have obligation to pay that liability except company. Next one, perpetual succession. So you can run company for any number of years. It may be 100 years, 200 years, 300 years, 400 years and so on. So how is it possible in case of company? Because in case of company, there are 2 separate features called as transfer and transmission. What is meant by transfer and what is meant by transmission? So I'm the shareholder. If I sell my shares to somebody else, it will be called as transfer. If anything is happened to me and my shares got transferred to my legal representatives, it will be called as transmission. That means to run the company, my availability is not mandatory. If I sold my shares to somebody else, that somebody else will continue the company. If anything is happened to me, then my legal heads will continue the company. That means there will be some people to continue the company. That's why a company can be operated for any number of years. Next one. This is called as perpetual succession. Sir, what happens if all the members are died together? No problem to the company. Their legal heads will carry the company. Sir, what happens if there is no legal heads also? Then company need to be closed. Because in order to operate the company, there must be some people. Next one. And what about the liability of company? Liability of company is always unlimited. It need to clear all its liability by using its asset. Then what about the liability of members in the company? Depends upon the type of the company. If they are members of limited company, their liability is limited. If they are the members of the unlimited company, their liability is unlimited. But limited companies are more, unlimited companies are very less in number. Next one, common seal. If company want to sign on any document, it can use official stamp called as common seal. But it is not mandatory to use common seal. Instead of common seal, two directors can sign on the document. Next one. So, which point is pending? Separate property. Yes, artificial person. So company is an artificial person. So just like us, it can own a property. It can sell the property. It can buy the property. It can do anything on its own name, just like a natural person. So these are all the features of the company. Next one, types of companies on the basis of number of members. OPC, private company, public company. In case of OPC, 1 member. In case of private company, 2 to 200. In case of public company, 7 to no limit. Now, while calculating 2 to 200 limit, we need to exclude those members who got shares because of their employment. Sir, what happens if those people left the company now? Even then also we need to ignore those people. So whether they are continuing in the company, whether they are not continuing in the company, this is irrelevant. What is relevant? How they got the shares. Is it because of employment or not? If any person got the shares because of employment, that person shall be excluded while counting 200 limit. And what about joint shareholders? They will be counted as single member. So on this concept, you can get a practical question. So how to calculate 200 limit? On this, you can get a practical question. So what are the two rules we need to remember while calculating 200 limit? All shareholders who got shares because of employment, whether they are current employees or ex-employees, need to be excluded. All joint shareholders need to be counted as single member. Now the point is definition. What is the definition of OPC? Very simple. Company with only 1 member is called as OPC. And what about the definition of private company? So it must have minimum paid up share capital as may be prescribed. In its articles, it must contain 3 clauses. What are those 3 clauses? Restriction, limitation, prohibition. Restriction means company can do it, but subject to conditions. Prohibition means company cannot do it. Limitation means it is minimum limit, maximum limit. Okay, restriction on what? Transfer, that is sale of shares, not any other kind of security like bonds, debentures. The restriction will be there on transfer of shares only, but not transmission of shares. It is transfer of shares only, but not transfer of debentures or transfer of some other kind of security. So there must be restriction on transfer of shares. Then what about prohibition? Prohibition on public invitation of securities. Public invitation means initial public offering, further public offering, that is IPO, FPO. Now company want to issue its securities to the public. Then being a private company, it is prohibited from doing so. Then what a private company can do here? Private company can go for private placement. That means if company want to give shares, it can give shares to private people or to entire public. If they offer shares to private people, it will be called as private placement. If they offer shares to public, it will be called as public offer, public placement. Now, after getting shares, these shares can be transferred to some other person either because of transfer or because of transmission. Now the point is, private company can make private issue of securities, but it cannot make public issue of securities. The shareholders of private company can make transmission, but they cannot make transfer. But for making transfer, they need to satisfy various conditions. Various condition means, so before transferring shares to others, I need to take the consent of board of directors. For transferring shares to others, I need to go to the board of directors in order to fix the price. For offering shares, I need to first offer the shares to the board of directors. Like that, there will be various restrictions in case of private company. But in case of public company, there will be no such restrictions. Now say, what are the definition of OPC? It is a company where there is only one person as a member. What about the private company? It must have minimum paid up capital as may be prescribed, and its articles must contain restriction on transfer of share, prohibition on public issue of securities, and limitation on maximum number of members. Next one. Then what about the definition of public company? Any company which is not a private company is called as public company. Even these companies must have minimum paid up share capital as may be prescribed. But as of now, nothing is prescribed. That means you can start private company, public company, OPC with any amount of capital. Next one. Even a private company can also be called as public company when it is a subsidiary of public company. Next one. One person company. So one person company is not a separate class of company. It will fall under private company definition only. So actually there are two types of companies only, that is private company and public company. So one person company will fall under private company itself. So this is all about classification of companies on the basis of number of members. Next one, features of OPC. So in case of OPC, how many members will be there? 1. In case of OPC, there is a concept of nominee. If anything is happened to that member, then who will replace that position? Nominee. Then in order to become member or nominee, they need to satisfy certain conditions. What are those conditions? Natural person allowed, artificial person not allowed. Next one, major allowed, minor not allowed, minors not allowed. Next one, Indian citizen allowed, foreign citizen not allowed. Next one, resident allowed, non-resident allowed. So who are allowed? Natural person, major, Indian citizen, whether resident or not. Only these people are eligible to become member of OPC or nominee of OPC. So member of OPC means he will run the company as of now. Nominee of OPC means he will run the company if anything is happened to the main member. Next one. At a time, in how many OPC I can act like member? Only one. At a time, in how many OPC I can act like nominee? Only one. So can I act like member in one OPC, nominee in another OPC? Yes. Because number of membership, 1. Number of nominee cases, 1. So allowed. Next one. Conversion of OPC. Is it possible to convert OPC into a normal company? So OPC to private company. Yes. OPC to public company. Yes. OPC to Section 8 company. No. So all conversions are allowed, but OPC to Section 8 company not allowed. And which kind of business activity can OPC carry? It can carry any activity, but it can't carry charitable activities. It can't carry non-banking financial activities. It can't carry investment activity. So charitable activities means doing something without expecting any profit. Non-banking financial activities means taking deposits, giving loans. Next one, investment activity means purchasing the securities of other entity. All these things are not allowed in case of OPC. That means OPC can't buy the shares of another company, but a normal company can buy the shares of another company, and that normal company can become holding company also. But OPC is not allowed to buy the shares of any other company. Next one, then what is the punishment for default? Very simple, 10,000 plus 1,000 per day. So base penalty is 10,000. If you made any delay, for each day of delay, 1,000 rupees will be added. So that's why the total fine amount will be 10,000 plus 1,000 per every day of delay. Next one, types of companies on the basis of control. Say for example, A Limited, B Limited, two companies are there. A Limited along with its existing subsidiaries. We need to take existing subsidiaries of A Limited also. A Limited along with existing subsidiaries, if it is having more than 50% of total voting power in B Limited, then A Limited status will be holding company, B Limited status will be subsidiary company. Or if A Limited along with its existing subsidiaries, so it is having a power to appoint or remove majority directors of B Limited, then A Limited will be called as holding company, B Limited will be called as subsidiary. So when such kind of relation will be created? When one company along with its existing subsidiaries is holding more than 50% of total voting power in another company, or it is having power to appoint or remove majority directors of another company. In any of this situation, the company having control will be called as holding and the other company will be called as subsidiary. Then what about associate company? So same, A Limited, B Limited. But here I need to take only A Limited. But in previous case, A Limited along with its existing subsidiaries. But in this case, only A Limited. If A Limited is having significant influence in B Limited, then B Limited is called as associate company and A Limited is called as, nothing is given in the act about the name. So only B Limited name is given, that is associate company. But in previous case, B Limited is subsidiary, A Limited is holding. So two names are given. But in this case, only one name is given in the act, that is associate company. So B Limited will be called as associate to A Limited. But what about the name of A Limited? There is no specific name. You can call A Limited as investing company. Next one. Or there is one more route. If B Limited is the joint venture to A Limited, then B Limited is the associate company. That means Hero Honda is the joint venture project of Hero and Honda. That means Hero Honda company is associate to Hero company. Hero Honda company is associate to Honda company. That is second way. And what is the first way? If one company is having significant influence for second company, then second company is called as associate. Then what is meant by having significant influence? Having at least 20% of total voting power or having participation right in business decisions with the help of some agreement. Without having shares also, you can participate in the decision making process. But this will be possible with the help of agreement. So for example, I gave huge loan to the company and I made a stipulation, that is condition. Even I am also allowed to participate in the board meetings to make decisions. Now, without any shares, I can participate in the decision making. This is possible because of agreement. So, if there is at least 20% of the total voting power, or if there is any participation right in business decisions, then the company is said to have significant influence in another company. Now that another company will become associate. Next one, small company. So in order to call it a small company, first of all, it must be a private company. Other than public company means private company. And what about paid up share capital? It shall not exceed 4 crores. What about turnover? It shall not exceed 40 crores. So private company with maximum paid up share capital of 4 crores with maximum turnover of 40 crores. All the three conditions need to be satisfied. All the conditions need to be satisfied. Then only that company can get small company status. Next one, exceptions. Holding company, subsidiary company. Even though all the three conditions are satisfied, they cannot get small company status. Section 8 company. Even though all the three conditions are satisfied, they cannot get small company status. Any statutory company. Statutory company means the companies which are required to follow an act other than company law. Say for example, banking companies. They need to follow Banking Regulation Act. Insurance companies. They need to follow Insurance Act and IRD Act. Electricity companies. They need to follow Electricity Act other than Companies Act. So that's why these companies are called as statutory companies. So for statutory companies, for Section 8 companies, for holding companies, for subsidiary companies, even though three conditions are satisfied, they cannot get small company status. Other than these companies, if they satisfy those three conditions, they can get small company status. Then what about Section 8 company? So Section 8 company is the company which is created for the purpose of carrying charitable objects. Next one. Then what happens if Section 8 company got any profit? It must use that profit for its objects, not for the payment of dividend. That means Section 8 company is prohibited from making payment of dividend. Next one. What about the requirement of minimum paid up share capital? Not applicable. But in case of OPC, it must have prescribed minimum paid up capital. Private company, prescribed minimum paid up capital. Public company, prescribed minimum paid up capital. But in case of Section 8 company, having minimum paid up capital is not at all required because they can operate by using donations. So that's why having capital is not mandatory here. Next one. So it can have all the benefits just like a limited company. Next one. Is it possible to update MOA and AOA? Yes. For normal companies, special resolution is required. For Section 8 companies, along with special resolution, CG approval is also required. So CG approval is required only in case of Section 8 company. For normal company, SR is sufficient. So here what is required? SR plus CG approval is required. Next one. Is it possible to convert Section 8 company into other company? Yes. Section 8 to private company? Yes. Section 8 to public company? Yes. Section 8 to OPC? No. So OPC to Section 8 not possible. Section 8 to OPC is also not possible. Next one. Now, to create a normal company, you need to make an application to the ROC by using a form called a Spice Plus. But in case of Section 8 company, before applying to ROC using Spice Plus, you need to get license from the central government, which is called as NPL, which stands for Not for Profit License. That means to create Section 8 company, first they need to make an application to CG to get NPL. Thereafter, they need to file Spice Plus. But in case of normal company, they can directly file Spice Plus. Next one. In case of normal company, if it is a private company, they must use private limited in its name. If it is a public company, they must use limited. If it is OPC, they must use OPC private limited. But what happens if it is Section 8 company? No need to use any of these words. Instead of this, they can use more suitable words like club, chamber of commerce, etc. Next one. So what happens if the conditions of the license are violated? What happens if provisions of Section 8 are violated? What happens if affairs of the company is conducted fraudulently or against to the objects or against to the public? That means the company did wrong things here. When company did wrong things, CG will revoke the license which is given to that company. Now the license will be revoked. Once the license is revoked, the immediate consequence is it must be converted into a normal company. And what about the final consequence? Either winding up or amalgamation. Winding up means complete closure. Amalgamation means giving your business to some other entity. Okay. Next one. Who can become member in Section 8 company? In case of OPC, who can become member? Only natural person. Artificial person not allowed. In case of private company, natural, artificial. In case of public company, natural, artificial. In case of Section 8 company, natural, artificial, even Section 8 company also. Sorry, even partnership also. But actually partnership is neither natural person nor artificial person. But even though it is neither natural or artificial person, it is allowed to become member in Section 8 company. But in case of normal company, partnership form is not allowed to become member. Only partners are allowed to become member. But if it is a Section 8 company, even partnership firm can directly become member. Next one. NRC, SRC. Just now we discussed about the composition of NRC and SRC. So creating those committees is not required in case of Section 8 company. Next one. Minimum number of directors. Maximum number of directors. 1 to 15, 2 to 15, 3 to 15. These rules are not applicable to Section 8 company if there is no filing default. And having number of directors, at least 1/3 directors should be independent. At least 2 directors should be independent. In case of executive chairman, how many directors need to be independent according to SEBI regulations? Executive 1/3, non-executive half. So, but in case if it is Section 8 company, these rules are not at all applicable. And for giving notice to general meeting, how many prior days notice is required? 21. But in case of Section 8 company, 14 days notice will be sufficient. Next, punishment for contravention. For company, 10 lakhs to 1 crore fine. For directors and officers in default, who committed default, 25,000 to 25 lakhs fine. But if any person involved in any fraud, that person will be liable under section 447. Basically, this section is meant to punish those people who got involved in fraud. Then what about the incorporation process of company? Very simple. So the company need to forward certain documents to ROC. Based on such documents, ROC will issue certificate of incorporation. Then what documents need to be forwarded to ROC to get certificate of incorporation? First one, you need to prepare MOA and AOA. And who need to sign on MOA? All the subscribers. Who need to sign on AOA? All the subscribers. Who are subscribers? After incorporation, they will take shares and they will become shareholders, and thereafter they will become members, nothing but future members of the company. So all the subscribers need to sign on MOA and AOA. And that signed MOA and AOA need to be forwarded to ROC, first document. Second document, declaration by professional. So what kind of declaration he need to give? He need to say all the provisions with respect to incorporation of company are complied. nothing is violated. Like that, he need to give a compliance declaration. On the declaration, who need to sign? That professional. So who is that professional? Either CA in practice or CMA in practice or CS in practice or advocate. So that person need to sign on the declaration. Along with this person, one more person is required from the company to sign. That one more person is nothing but MSD. So not Mahendra Singh Dhoni. It is manager, secretary, director. So either manager or secretary or director, any one person from the company need to sign on the declaration. Now say what is the declaration? Everything is complied. Nothing is violated. Who need to sign on it? One professional, one person from the company. Who is that one person from the company? Either manager or secretary or director. Next one more declaration. Now this declaration need to be signed by subscribers who will become future members and first directors who will act like directors till the first AGM. Okay, what kind of declaration they need to give? So during last 5 years, we had not convicted under any offense relating to promotion, formation, management of any company. We had not committed any fraud during last 5 years. Like that, they need to give the declaration. And for the company which is going to be incorporated now, for this company, we provided the information which is complete as well as true. Next one. And you need to provide address for communication. Next one, you need to provide the particulars of subscribers, for particulars of first directors. So particulars means basic particulars only. But in case of directors, along with basic particulars, you need to provide extra particulars. So first one, DIN. Second one, particulars of interest in other entities. Third one, consent letter. So if you provided all these documents to the ROC, now ROC will verify the genuineness of all the documents. If he is satisfied, if those documents are genuine, then he will issue a certificate called as Certificate of Incorporation. That certificate will contain a unique number called as CIN, which stands for Corporate Identity Number. And the documents which is forwarded to ROC, all these documents need to be preserved by the company. So where to preserve? At register office. How many years they need to preserve? Till the dissolution of the company, they need to preserve those documents, either in physical form or in electronic form. Next one, Memorandum of Association and Articles of Association. So memorandum will contain only few clauses, whereas balance clauses will be there in articles. That means MOA will discuss about only few aspects. Remaining aspects will be discussed in AOA. Then what are the aspects that are discussed in MOA? Name clause must contain the name of the company. If it is OPC, the name must end with OPC Private Limited. If it is private company, the name must end with Private Limited. If it is public company, the name must end with Limited. If it is Section 8 company, these things are not applicable. If it is government company, whether it is private or public, it must end with limited only. Next one, register office clause. We need to provide the name of the state where the register office is situated. No need to provide the complete address. Just provide the name of the state, it will be sufficient. Object clause. So it will contain two things, main objects, incidental objects. So main objects means, say for example, I created a company to construct the houses and to sell that house. Now the main object is acquiring land, constructing building, selling the building. These three things are main activities. Then what about incidental activities? Purchasing raw material, hiring labor, and appointing some buying agents and selling agents. All these things are incidental activities. Now object clause must contain both main activities as well as incidental activities. Now the name of the company must reflect the objects of the company. That is very important. The name of the company must reflect the objects of the company. Say for example, Reliance Jio. Reliance Jio Infocom Limited. Infocom means information and communication. So this is the name of our Reliance Jio Sims company. So it is reflecting objects of the business. That means if there is any change of objects, the name must also be updated within 6 months. Liability clause. Here we need to provide the liability of members. Is it limited or unlimited? Capital clause. Here we need to provide the maximum capital that a company can hold. Next one, articles of association. So rest of the points will be covered in articles of association. Now in articles of association, there are two kinds of provisions, normal provisions and trenched provisions. Generally for updating MOA and AOA, what is required? Special resolution is required. In case of Section 8 company, what is required? Special resolution and CG approval is required. So For updating articles also SR is required. So normal provisions can be updated with the help of SR. But what about entrenched provisions? These are special provisions. These provisions can be updated by passing a resolution which is higher than special resolution. So you can convert normal provision into entrenchment provision. But to convert normal provision into entrenchment provision, you need to take the consent of shareholders. If it is private company, 100% shareholders need to agree. If it is public company, at least 75% people need to agree in order to convert normal provision into entrenched provision. Because if it is normal provision, it can be easily updated by passing SR. But if it is entrenched provision, it can be updated only after passing something more than SR. So this is about AOA. Next one, and how to prepare MOA and AOA. Very simple. For that purpose, I need to open schedule number 1. So for MOA, there are 5 tables. For AOA, there are 5 tables. So which table I need to follow? For this purpose, I need to classify the companies. First one, company limited by shares. Second one, guarantee company without shares. Next one, guarantee company with shares. Next one, unlimited company without shares. Next one, unlimited company with shares. Now for MOA, which table I need to follow? A, B, C, D, E. That's it. For AOA, F, we need to reverse GH. H, G. Next, IJ, we need to reverse IJ. J, I. So these are the tables which need to be followed by these companies for the preparation of MOA and AOA. Next one, doctrines. Doctrine of ultra-virus. What is meant by doctrine of ultra-virus? If company did any activity beyond the powers of MOA, beyond the powers of AOA, it is called as ultra-virus. And for such ultra-virus acts, company is not liable. Then who are liable? The persons who made such transaction by using company name. Those people are personally liable but not company. Next one, doctrine of constructive notice and doctrine of indoor management. This is applicable to outsiders. When outsiders want to deal with the company, they must know about public information about the company. They are not required to know about internal information of the company. If they fail to know about public information and they made the contract blindly, then they can't make the company liable by showing those people as innocent. That means every outsider must know about public information of the company. Example, MOA and AOA. Next one, what about indoor management? Every outsider is not required to know about internal matter of the company. So that means if anything wrong happens, even though it is ultra-virus transaction, by showing his innocence, outsider can make the company liable. So that is indoor management. So what ultra-virus is saying, if it is beyond the powers of MOA and AOA, it is void. What constructive notice is saying, outsiders must know about public information about the company. Next one, what about indoor management? They are saying outsiders are not required to know about internal matters. Now the point is, yes, they are not required to know about internal matters because it is not open for public inspection. But if they know about internal information, so they know about the wrong that was happened in the company, but still they made the contract. So can they make company liable in this given situation? No. So this is exception, which is nothing but called as knowledge of irregularity. Or they are having enough resources to know the internal information. Even though they are having enough resources to know about the fact, they fail to do so because of some negligence. Now they can't utilize indoor management. Next one. Now outsiders relied on a forged document. Now they can't make the company liable for it because a forged document can never be valid. In any situation, a forged document cannot become valid. So these are the exceptions for doctrine of indoor management. And last question, conversion. Is it possible to convert companies? Yes. Okay. The first conversion is about private company to public company. So how to convert private company to public company? Just remove the 3 clauses, restriction, limitation, prohibition clauses in articles of association. Then private company will become public company. Then how to convert public company into private company? Just add those points. Then public company will not become private company because CG's approval is also required. So for this conversion, removal will be sufficient. For this conversion, adding those 3 points and approval of CG both are required. Next one. Now, in order to convert private to public, public to private, you need to update MOA, AOA. You need to file an application with ROC. And what about the previous dates? Nothing will be changed. So previous date will remain same. Then what about conversion of partnership firm or LLP firm into company? Is it possible to convert partnership firm or LLP firm into company? Yes. Then what kind of requirements they need to follow? So first of all, they need to take the approval of all the partners. They need to make advertisement in newspapers. And they need to take no objection certificate from ROC where that LLP is registered, or ROF where such partnership firm is registered in case of partnership firm. Next one, procedure. First they need to decide the name. Next one, they need to authorize one person to handle all these matters related to conversion. Next, they need to obtain DSC and DIN. DSC for what? For signing SPICE plus form. So in order to sign SPICE plus form, you need to have digital signature. So the person who want to sign SPICE plus form need to get DSC. And what about DIN? The person who want to become first directors must get DIN. Now, which form we need to file? For incorporation of company, we will file a form called as SPICE plus. For conversion into company, we need to file URC1. Next one. And what documents we need to attach with URC1? So first one, the details of the partners of LLP or partnership firm, which want to be converted into private company. Next one. And those people will get shares now. So how many people are getting shares, and how many people are getting shares for cash, and how many people are getting shares for other than cash, that is for kind. Next one, numbering of shares. Next one, if any partner is proposed as first director, then DIN, passport number, address, and particulars of interest in other business entities. Even consent letter is also required. Next one, in case of partnership firm, if partnership firm want to be converted into private company, then it need to provide partnership deed. So what happens if partnership deed is updated? So at later point of time, then you need to provide subsequent deeds also. If the partnership firm is a registered partnership firm, you need to provide certificate of registration also, because partnership firm registration is not mandatory. If it is registered, provide the certificate. If it is not registered, ignore this point. But providing partnership deed is mandatory. Next one, and you need to get no objection certificate from secured creditors also. But what about unsecured creditors? No need to require, not required to get any NOC. But from secured creditors, we need to get NOC. And you can strike off this point. This point is omitted because of some amendment. So point is okay, but this was omitted by Act itself. So what is the procedure to convert LLP firm or partnership firm into private limited company? They need to approve the name. They need to get DSC. They need to get DIN. They need to file URC1. Along with URC1, they need to attach all these documents. That's it. So what is our next chapter? Investment and loans. So first one, investment layers. So what is meant by investment layer? Say for example, A Limited is investing in B Limited, and B Limited invested in C Limited. C Limited invested in D Limited. So A Limited directly invested in B Limited, but it indirectly invested in C Limited as well as D Limited also. So the investment by A Limited in B Limited is direct, whereas in C Limited and D Limited is indirect. Now the point is, this is first layer of subsidiary. This is second layer of subsidiary. And this is third layer of subsidiary. Now the point is, how many layers of subsidiaries a company can have? Maximum 2 layers. That means A Limited can have a subsidiary, that is B Limited, which is first layer of subsidiary, and a subsidiary C Limited, which is second layer of subsidiary. But A Limited can't have D Limited as subsidiary. So this is called as layers concept. Now the point is, if A Limited invested in B Limited, C Limited, D Limited. So now B Limited, C Limited, D Limited are called as first layer of subsidiaries. Why this time B, C, D are called as first layer of subsidiaries? Because it is direct investment. So in case of direct investment, it will be called as first layer. Now B invested in 3 companies, X, Y, Z. Now X, Y, Z will be called as second layer. Now X Limited invested in 4 companies, P, Q, R, S. Now P, Q, R, S are called as third layer of subsidiary which is not allowed. So maximum permissible limit is 2 layers. In one layer, there may be n number of subsidiaries. There is no problem. But maximum number of layers must be either 1 or 2. That's it. Next one. Now this rule is having exceptions. So what are those exceptions? Now A Limited is going to purchase B Limited. Actually A Limited got incorporated in India. B Limited got incorporated outside India. So A Limited is Indian company. B Limited is foreign company. Now how many layers A Limited can have as subsidiaries? Maximum 2 layers. Then what about B Limited? Our law is not applicable for B Limited because that company got incorporated outside India. Now, according to the law of that country, this company can have maximum 5 layers of subsidiaries. Now, our A Limited is going to acquire B Limited. Now, in total, the number of layers will become 2 plus 5, 7 layers. Is this allowed? Answer is yes, this is allowed. Normally, how many number of layers are permitted? 2 layers. But if you are going to purchase an entity which is incorporated outside India, having more than 2 layers of subsidiary according to their country laws, then this point will be covered under exception. Next one, second one, exception number 2. Now A Limited is having 2 layers of subsidiary. So first layer B Limited and second layer C Limited. Now government or court or law insisting A Limited to have one more layer of subsidiary. That's why A Limited purchased the stake in D Limited through indirect holding. Now this will create third layer of subsidiary. Now is it allowed or not allowed? Answer is allowed. Why it is allowed? Because the company added third layer of subsidiary just to comply with laws, rules and regulations. If any law, any rule, any regulation says you to have more than 2 layers of subsidiaries, then you must have more than 2 layers of subsidiaries. So this is second exception. Now say what is the conclusion for point number 1? In India, every company must have maximum 2 layers of subsidiaries. I'm not talking about number of subsidiaries. I'm talking about layers of subsidiaries. Next one, what is the exception? If our company is going to acquire other entity which is situated outside India and that entity is having more than 2 layers according to their country laws, then it is allowed. What is the second exception? Now our company acquiring another layer of subsidiary in order to comply with any law, rule or regulation, then also it is allowed. Next one, LSZA transactions. What is meant by LSZA transactions? Say for example, company want to give a loan to a person. This is L transaction. Loan transaction. So it is not about loan taken. It is about loan given. So loan given to a person. Next one. Now this person is taking loan from some other person. Now what company is doing? Company is providing its property as security. So here the loan is provided by some other person to some other person. But who is providing security here? Company is providing security. So this is yes transaction. Now one person is taking loan from another person, and for this loan transaction company is acting like a guarantor. That means company gave guarantee here. This is G transaction. Now this company want to purchase the shares of another company. So this is yes transaction. That is acquisition of securities, or you can call it as A transaction. Now say how many transactions are there here? 4 transactions. What are those 4 transactions? L, S, G, A. L stands for loan given by company to others. Next one, S stands for security offered to any person under any loan contract. G stands for guarantee given by the company to any person under any loan transaction. A stands for acquisition of securities of other company. Now the point is, can a company make all these transactions? Answer is yes. If it is within the limit, then board of directors permission will be sufficient. That is, board resolution will be sufficient. If it is beyond the limit, then board resolution along with that special resolution is also required. So a company can make L transaction. That means a company can give loan. A company can give security. A company can give guarantee. A company can acquire securities of other company. But if the value is within that limit, then what is required? Board resolution is required. If the value is beyond the limit, then what is required? SR is required. Now the point is, what is the limit here? So for calculating limit, we need to take paid up share capital, free resource, security premium account. We need to add paid up capital, free resource, security premium account, and we need to take 60% of the total amount. That is one amount. Other amount is, we need to take free resource, security premium account. That means in previous case, we took paid up capital, free resource, security premium. But in second amount, we are taking only free resource and security premium, but not paid up capital. So in case of all the three amounts, we need to take 60%. In case of only two amounts, we need to take 100%. Now among these two amounts, we need to select whichever is higher. That will be the limit. Say for example, paid up share capital is 100 crores. Free resource are 200 crores. Security premium 300 crores. Now what is the limit now? 100 plus 200 plus 300, total amount 600. So 60% of 600 is 360, one amount. Next one, 200 plus 300 only, 500. 100% of 500 is 500. Now in between 500 and 360, which amount is higher? 500. So the limit will be 500. If company want to give a loan, or it want to give a security or guarantee, or it want to buy the securities of any other entity, then if the existing LSG transactions value and the proposed LSG transactions value, so combined value, if it exceeds 500 crores, then what is required? SR is required. What happens if the LSGA transaction value does not exceed 500 crores? Then board resolution will be sufficient. Now the point is, how many directors need to agree? Generally, majority directors need to agree in order to pass board resolution. But in this case, all the directors who are present at the meeting need to agree. That means in board resolution also we require unanimous consent. Next one. Now this company has taken a loan from PFI. PFI means Public Financial Institution. Now the company has taken loan from PFI. Now there is a default in repayment of loan. So by making default in repayment of loan which was taken from PFI, can I make payment to any other person in the name of loan or security or guarantee or purchase of securities? No. So that's why in order to make LSGA transactions, prior approval is required. Whose approval is required? PFI prior approval is required. But one more important point, if I am taking the LSGA transaction beyond the limit, then PFI permission is mandatory whether there is any default in loan or not. In simple, we can make a chart like this. First one, which transactions I need to cover here? L, S, G, A. Next one, the existing LSGA transaction value and the proposed LSGA transaction value. If it is more than the limit, then what will happen? If the existing LSGA transaction value and the proposed LSGA transaction value, if it is less than or equal to the limit, then what will happen? First one, in this case, permission is required. Whose permission? Board of Directors permission. All directors need to agree. Next one, special resolution in general meeting. Next one, PFI approval in case of any loan, whether there is default or not. You need to take the permission of PFI when it exceeds the limit. Now it is within the limit only. Whose permission is required? Board resolution with the consent of all directors. Okay. Yes sir. Not required. Completely not required. And what about approval of PFI? In case of default of repayment of loan, then only PFI approval is required. Otherwise PFI approval is not required. So only BR will be sufficient with the consent of all directors. So SR completely not required. PFI approval required only in case of default. In case of no default, not required. But what about if the value exceeds the limit? BR mandatory, SR mandatory, PFI mandatory. All three approvals are mandatory. Next one. Then in case of loan transaction, so how much rate of interest the company need to charge? So the company need to charge minimum rate of interest that is being paid on government bonds. So in case of government bonds, if government is paying at least 10% per annum rate of interest, then for the loans which are given by the company need to collect at least 10%. But rate of interest will differ from one bond to another bond depending upon the tenure. Say for example, 1 year bond will carry one rate of interest and 2 years bond will carry some other rate of interest. Now what to do here? Now, so there are some bonds like 1 year bond, 3 year bond, 5 year bond, 10 year bond. Now we need to compare with the loan tenure. If the 1 year bond rate of interest is 10, 3 years bond rate of interest is 12, 5 years bond rate of interest is 14, 10 years bond rate of interest is 16. Now, if my loan tenure, that is the loan which is given by the company to others, the tenure of that loan is 1 year, the minimum rate of interest is 10. If the tenure of the loan is 5 years, the minimum rate of interest that is being charged by the company is 14. That means we need to compare our rate of interest with rate of interest that is being offered by the government on government bonds. For this purpose, in order to make comparison, we need to compare tenure first. Next one, deposits. So a company can take deposits from members as well as public. In case if company took any deposit from any member or public and company fails to repay either entire deposit amount or fails to pay either interest amount, then that company is not allowed to make LSDA transactions. Then when to make LSDA transactions in case of default in deposits? Only after clearing such a default, they need to make LSDA transactions. That means in case of deposits, if interest is outstanding or if repayment is outstanding, then LSDA transactions are prohibited. If this outstanding interest is paid, if this outstanding due amount is paid, then the company can make LSDA transactions now. Next one, register. Company need to maintain a separate register showing the particulars of L transactions, S transactions, G transactions and A transactions. Next one, inspection. So this register must be kept at registered office. Member can go and ask for inspection. Member can take copies. For inspection, free of charge. For copies, they need to pay the money. For inspection, they will allow you immediately during business hours. For copies, you need to provide at least 7 days time to the company to provide copies. Next one. Now, all these LSDA provisions are not applicable for certain companies. Then which are those companies? In case of LSD transactions. So here only LSD transactions got covered. What about A? A transaction got covered under B point. So LSD transaction means giving loan, offering your property as security, giving guarantee. So these are the ordinary course of business for banks, for insurance companies, for housing finance companies, and for industrial establishments which are providing loans to infrastructure companies. So for all these 4 companies, providing loans, providing securities, providing guarantees are ordinary course of business. So as their ordinary course of business, above aforesaid provisions regarding LSDA transactions are not applicable. Next one. Now it is about A, acquisition of securities in other company. Now if it is investment company, the ordinary course of business is buying securities of other company only. Next one. If it is any company under rights issue, or if it is NBFC, non-banking financial company, whose principal business is acquisition of securities. So for this company is also making investment is ordinary course of business only. That's why acquisition related provisions are not applicable. Finally, punishment for default. For company, what will be the punishment? 25,000 to 25 lakhs. For officer in default, imprisonment up to 2 years, fine from 25,000 to 1 lakh. Now say what is the total conclusion for this question? First one, number of investment layers, maximum 2. Exception, while acquiring outside entities who are having more than 2 layers of subsidiaries according to their country laws. Second one, to comply with our laws, our rules, our regulations. If we acquired another layer of subsidiary, then it is okay, fine. Next one. Second point is completely about LSGA transaction. That is loan given by the company, guarantee given by the company, security given by the company, and finally acquisition of securities of other company. Okay. If existing LSGA transaction value plus proposed LSGA transaction value, if it is within the limit, Whose approval is required? Board of directors approval is required. Unanimous consent is required. What about SR? Not required. What about PFI approval? In case if there is any default, required. In case if there is no default, not required. What happens if this entire value exceeds the limit? Board of directors resolution, that is unanimous consent is required. SR is required. PFI approval is also required, whether default is there or not. Next one. Then how to calculate the limit? We need to take two amounts. In those two amounts, we need to take higher amount. Then what are those two amounts? 60% of paid up capital free resource security premium, or 100% of free resource security premium. Next one. In case of default in deposit repayment or payment in interest of deposits, then LSA transactions not allowed. Once they are cleared, LSA transactions are allowed. And what about rate of interest? It should match with government rate of interest based on tenure. Next one, separate registry is required to be maintained, and it is available for inspection, available for taking copies. And this rule is not applicable to LSZ. Transaction rules are not applicable to banks, insurance, housing finance, and other finance companies. A transaction provisions are not applicable to investment companies, NBFC companies whose principal business is acquiring securities and rights issue. Next one. Now the point is, if I bought any property, I will hold that property on my name. Similarly, if company bought any property, company need to hold that property on the name of company itself. But is it possible to have the property on the name of any other person? Generally, answer is no. But this rule is having exceptions. What are those exceptions? Say for example, AB Limited is holding 100% of shares in A Limited. So 100% of shares in A Limited means now A Limited will become wholly owned subsidiary company. Now say, how is it possible to have only one member in a public company? A Limited is a public company. So it is a public company. So minimum number of members are 7. But how many members are there here? Only 1. Is it possible to have one member in public company? No. Minimum 7 members are required. So what to do here? Now AB Limited will hold, say for example, total number of shares of A Limited are 10,000. Now AB Limited will hold 99,994 shares. And what about balance 6 shares? On behalf of A Limited, so 6 different people will hold each share. So total number of people will now become AB Limited 1, 6 other people 6, total 7. Now minimum requirement is complied. But in this case, AB Limited is holding 99,994 shares directly and remaining 6 shares indirectly. That means whether directly or indirectly, it is virtually holding 1 lakh shares. Now in this case, A Limited will become wholly owned subsidiary. Now the point is, these 6 shares belongs to AB Limited. But who are holding these 6 shares? Some other person. So now the investment made by the company is held on the name of some other person. Is this allowed or not allowed? Yes, allowed, because this is made in order to fulfill the minimum number of members requirement in the company. Next one. This is exception number 1. So there are 4 more exceptions. First one. Now company deposited its investment with a bank. What is the purpose of depositing the investment with the bank? To collect dividend and interest. In case if it is equity share or preference share, the bank will collect dividend on behalf of company. In case if it is any bond or debenture, the bank will collect interest on behalf of the company. That means the bank will act like collecting agent for the investments of the company. Now, for the purpose of collecting income, bank transfer the investment made by it onto the name of the bank. Is this allowed or not allowed? Allowed. Exception. Next one. Now, company deposited the securities. Why? To facilitate transfer. So now company want to sell its investment. So that's why it transferred the investment to the bank. And here the bank is selling agent. So in this case also, the investment of the company can be held by any other person like bank. Next, third case. Again, company is depositing securities. Now company is depositing securities in order to get a loan. That means it is offering its securities as investment. So then also it is allowed. So in first 3 points, what is the common thing? Company made investment. That investment belongs to company. But company is transferring the investment to the bank. Now investment is held on the name of the bank. And what is the purpose of giving that investment to the bank? First one, to collect income. Second one, to facilitate transfer. Third one, for getting loans. Next one and last one, in case of depository bank. Say for example, shares. So shares are of two types, physical shares, demat shares. So in case of physical shares, company will directly allot the shares to the shareholders. In case of demat shares, company will allot shares to the depository bank, not to the shareholders. Depository bank means NSDL, CDSL. So these companies are called as depository banks in India. So demat account will be created by these banks only, but it will be operated by the shareholders with the help of stockbrokers. But basically who create this deposit account, demat account, it will be created by depository banks, that is NSDL, CDSL. Now company will allot the shares to the depository bank. Now depository bank will transfer the shares to the shareholders. That means in case of physical shares, the shares will be registered on the name of shareholders directly. In case of demat shares, the shares will be registered on the name of depository bank. Now I am the company. I want to buy the demat shares of another company. Now another company will allot the shares on the name of depository bank. But whose security it was? My security, my investment. But who is having that security on their name? Depository bank. Is this allowed? Answer is yes, this is allowed. Okay. Now what is the conclusion of this question? If company is having any investment or property, it must be on the name of company only. But what are the exceptions? So first one, in order to make the other company as wholly owned subsidiary company, it can practically own 9,994 shares out of 10,000 shares, and remaining 6 shares can be given to 6 other people in order to comply with minimum 7 members requirement. So now those 6 people are holding the investment of the company on their name. Now company investment is on the name of some other person. Is this allowed? Yes. Now company deposited the securities with the bank. Now it was named on the bank, but it belongs to company. But why company deposited like that? To collect income, to facilitate transfer, to get loan. In all these 3 cases it is allowed. And last one. Now when any company or any person buy any shares of other company which is in demat form, the shares will be registered on the name of depository bank, and later on depository bank will give some portion to us. Now in this case, my investment was held on the name of depository bank. Is this allowed? Answer is yes. Now for this purpose also the company need to maintain a separate register specifying the properties belongs to company but held on the name of some other person. And is it available for inspection? Yes. Not only for members, even for debenture holders also it is available for inspection. And what about the cost? Inspection always free of charge. But when to inspect? During business hours. If company want to restrict this business hours, that is inspection time, it can reduce to 2 hours per day. Next one, deposits. Okay. For this purpose, we need to classify the companies first. So companies are classified into 2 categories: private company, public company. Again, public companies are classified into 2 categories: ineligible public company and eligible public company. Now the point is, who can take deposit? Company can take deposit. From whom deposit can be taken? If it is private company, the deposits can be taken only from the members of private company. Only members. Sir, my company is public company. If your company is public company and moreover it is ineligible public company, then your company can take deposits only from members. Sir, my company is eligible public company. Then you can take deposits from either members or public. That means which companies are allowed to take deposits from public? Just like a bank, eligible public companies. So what about other companies? They can take deposits from only from its members, that is shareholders, not from outsiders. Now the point is, when a public company will be treated as eligible, when it is ineligible. So if public company is having minimum net worth of 100 crores or minimum turnover of 500 crores, if any one of the point got satisfied, then that public company will be called as eligible public company. And eligible public companies are allowed to take deposits from public also. Next, now the point is how much amount they can take as deposit. So for that purpose, we need to take paid up capital plus free resource plus security premium account. So we need to calculate the aggregate of paid up capital, free resource and security premium account. Now a private company can take up to 100% of paid up capital plus free resource plus security premium account. They can take 100%. That means if the entire amount amounts to 100 crores, then how much a private company can take as deposits from its members? 100 crores. Then in case of ineligible public company, it can take maximum 35% only. That means they can take deposits from their members maximum 35 crores. Next one. Now if it is eligible public company, they are allowed to take deposits from both members as well as public. Now in case of members, the limit is maximum 10%. In case of public, the limit is maximum 25%. In total, it is 35%. But don't say in total, because they are separate limit. If you say in total, then company can take entire 35% from members, which is not allowed. Company can take entire 35% from the public, which is not allowed. Because from members, how much percentage is allowed? Maximum 10. From public, how much percentage is allowed? Maximum 25. So they are separate limits, not combined limits. Now say private company, from whom they can take deposits? Only from members. How much amount? 100%. In case of ineligible public company, from whom they can take deposits? Only from members. How much percentage? Maximum 35%. In case of eligible public company, they can take deposits from members. How much percentage? 10. In case of from public, maximum 25. Now this 100%, 35%, 10%, 25% need to be calculated on paid up capital plus free resource plus security premium account. Next one. Then what about the tenure of the deposit? The minimum tenure will be 6 months. Maximum tenure will be 36 months. So is it allowed to have a deposit exceeding 36 months term? No. Is it possible to have a deposit less than 6 months term? Yes. So there is an exception. What is that exception? If it is short term purpose and you took only up to 10% of paid up capital plus free resource plus security premium account and you fixed a minimum 3 months as repayment period, then less than 6 months is also allowed. Now say what about the term of the deposit? Generally minimum 6 months, maximum 36 months. So it is not possible to go beyond 36 months, but it is possible to go below 6 months. Okay, for that purpose, you are required to follow 3 conditions. What are those 3 conditions? You need to raise deposit for short term purpose. Next one, how much amount? Maximum 10%. Okay, and what should be the minimum term now? Minimum 3 months. If these 3 conditions are satisfied, even less than 6 months is also allowed. But in no case, it shall not exceed 36 months. Next one. So minimum 6 months, maximum 36 months. So less than 6 months is also possible, but amount should be up to 10% and minimum term shall be 3 months. And limit on deposits, ineligible public company 35%, eligible public company from members 10, other than members, that is public 25. Then what about joint depositors? Joint depositors means more than one person is holding deposit. Now those people are combinedly called as joint depositors. So how many joint depositors a company can have? So joint depositors not exceeding 3. Not exceeding 3 means 2 or 3. That's it. So if there is only one depositor, he is not called as joint depositor. If there is 2 depositors, then they are called as joint depositors. 3 joint depositors. 4 joint depositors only, but they are not allowed because maximum number shall be 3. Then what about interest and brokerage? how much interest the company need to pay for the deposit. And for the person, that is agent, who brought the deposits from the public or members, how much brokerage company need to pay them. So this will be decided by RBI. So generally RBI will decide the interest rate and brokerage for banking companies, non-banking financial companies. Now you need to follow the interest rate and brokerage rate which is given for non-banking financial companies. Next one, is it possible to alter the terms and conditions of the depositors? If it is creating any disadvantage to them, not possible. Otherwise, possible. That means the company is altering the terms. Now depositors are getting benefit. Allowed. The company is altering the terms and depositors are not getting any profit, any loss. It is also allowed. If company is altering the terms and depositors are getting loss, this time this is not allowed, because any alteration which results in disadvantage to the depositors is not allowed. Next one. And what about eligible company? Minimum net worth 100 crores, minimum turnover 500 crores, required to satisfy only one condition but not both the conditions. And what kind of resolution is required? Same. In morning section, we discussed about 4 matters where board of directors powers can be restricted. That is sale or lease of undertaking or substantially whole part of undertaking. And what is the second one? So because of merger and amalgamation, you got some compensation and you invested that compensation in other securities other than trust securities. What is the third one? Total debt exceeds total capital. Then SR is required. Otherwise, BR will be sufficient. What is fourth one? You gave a loan to the director. Company gave the loan to the director. Now company want to remit that loan, or company want to extend time limit for the director to repay the loan. So SR is required. All the 4 cases require SR. In these all 4 cases, the third case deals about debt. If total debt, that is existing debt as well as proposed debt, if it exceeds total capital, then what is required? SR is required. Otherwise, what will be sufficient? BR will be sufficient. Next one. And maintaining the list of deposits. So you need to maintain the details of depositor. So name of the depositor, address of the depositor, permanent account number of the depositor. Next one. If anything is happened to depositor, now you need to pay the money to his legal representatives. But what happens if depositor gave any person name as nominee while applying for deposit? Now if anything is happened to the depositor, you need to pay that money to the nominee. Next one. If minor is depositor, you must take the particulars of guardian. And you need to provide the details of deposit certificate. Nothing but when you opened a deposit account with company, within 21 days they will give a certificate called as deposit certificate or deposit receipt. This is just like share certificate. If I got shares, company will give me share certificate. If I got debentures, company will give me debenture certificate. If I open any deposit account with the bank, bank will give deposit receipt. Similarly, if I open any deposit account with the company, company will give me deposit receipt or deposit certificate. So the particulars of that certificate will be provided here. Next one. And date of giving deposit, amount of deposit, rate of deposit, due date for repayment of interest, duration of deposit, and date of repayment of each deposit. And in case secured deposits, in case of secured deposit, what properties are offered by the company as security. All these particulars need to be maintained in a separate register called as register for deposits. And all these details need to be entered in 7 days. So one transaction is happened, within 7 days you need to enter these details in the register. And this register need to be maintained for 8 years. And whose authorization is required for making entries in the register? Director, secretary, or any person authorized by board. Next one. If you accept deposit without following Companies Act, companies rules, as well as notifications issued by MCA, then it will attract penalties and prosecution. Now, there is a procedure regarding accepting deposits. Okay, first one. If you want to take deposits either from members or from public, first of all, you need to invite them. You need to attract them. For attracting members or public to make deposits, you need to prepare a circular. So circular is nothing but a kind of advertisement that a company will make to its members or public to attract deposits. Now, what about the content of this circular? The circular must contain the latest financial position of the company. So how many assets are there? How many liabilities are there? Whether company is capable of clearing its liabilities by using its assets. All these particulars need to be stated in the circular, which is nothing but about financial position. Next one. The company need to get a credit rating from approved credit rating agency. So based on this credit rating, people will decide whether to invest in this company or not by way of deposits. In case of existing deposits, the company need to disclose how many number of depositors are there in the company and what is the amount outstanding as a deposit in the company. Now it need to provide such other details which are prescribed. Now say, what about the content of the circular and what is the purpose of issue of circular? To advertise, to attract members or public to make deposits. So what about the content of circular? It must contain financial position, credit rating, and it must contain the details about existing deposits, that is number of depositors, amount outstanding towards depositors. Next one. After preparing circular, file that circular with the ROC. The very first copy should be given to ROC. Now within 30 days after filing, so you need to publish that circular to the members or public as the case may be. Next one. Now, during next year, you are required to pay a deposit of 100 crores. So maturing deposits in the next year is 100 crores. Now what you need to do? In the current year itself, that too by the end of first month itself, that is April month, you are required to create deposit repayment reserve. So for that purpose, you need to take 20% of the outstanding amount. That means, so now what is the next financial year? 2025-26. So 2026-27. So during 2026-27, the company is required to pay rupees 100 crores as deposits. Now during 2025-26, that too during first month itself, that is April 2025 itself, by the end of April 2025, out of 100 crores, at least 20%, that is 20 crore, need to be deposited in a separate account called as deposit repayment reserve. In case of debenture redemption reserve, it will be 10%. And in case debenture redemption investment, it will be 15%. But for this reserve, it will be 20%. For deposits, the limit will be 20%. And for what purpose this reserve can be utilized? This reserve is created in order to repay the deposits. That means this reserve must be utilized only for that purpose, not for any other purpose. Next one. And one more important point. If company is having existing deposits, so company can allow for fresh deposits only when there is no defaulting in the existing deposits. That means the company already took 100 crores as deposit. Now company may default in repaying interest, in repaying entire loan. Now company is not allowed to make any fresh deposit. So who will assure this point? CA will assure this point. Now the company's auditor is required to give a certificate regarding this. Next one. Sir, what happens if there is any outstanding amount? You need to clear that outstanding amount and you need to wait for 5 years. Then only you are eligible to issue fresh deposits. That means if there is no default, CA need to give a certificate, there is no default. If there is default, CA need to give a certificate, this default was cleared and 5 years time is also expired. Like this, he need to give a certificate. Next one. So deposits may be either secured or unsecured. Secured means company provides any property as security. Unsecured means company fails to provide property as security. So if it is secure deposit, you can mention it as secure deposit or just deposits. But if it is unsecured deposit, you must mention as unsecured deposit in all the documents. So if it is secured, you can mention it as secured or you can keep silent. But if it is unsecured, mentioning as unsecured deposit is mandatory. In every document, every notice, you need to mention the deposits as unsecured deposits. And finally, what happens if company fails to repay the interest or principal amount? Then the depositor can go to the tribunal. Tribunal can pass appropriate orders. If tribunal asks the company to repay the entire amount immediately, the company need to repay the entire amount immediately. So by this we completed second chapter. Next, chapter number 3, which is about payment of dividend. So here we are going to cover two categories of dividends: final dividend, interim dividend. What is meant by final dividend and what is meant by interim dividend? The dividend which is declared at AGM is called as final dividend. The dividend which is declared in between AGM, one AGM, another AGM, in between two AGMs you declare dividend, then it will be called as interim dividend. Then who is declaring authority in case of final dividend? Actually, final dividend will be recommended by the board of directors and approved by the shareholders. Then what about interim dividend? It will be recommended as well as approved by the board of directors only. Shareholders, so they will not be involved in case of interim dividend. Now the point is, I want to pay final dividend. What will be the source? I want to pay interim dividend. What will be the source? So in case of final dividend, the source will be current year profits. If current year profits are not sufficient, in current year if there is any loss, then I can utilize previous year profits, nothing but called as reserves, or I can utilize both. Now in few cases, central government will offer you guaranteed dividend. Say for example, central government asks you to establish a company in a remote area, and you said this will not be feasible for me, and government said I will give guaranteed dividend to your shareholders, and you started the company now. Now every year government will give the dividend. So this is nothing but called as government fund. Now what will be the source for final dividend? Current year profits. If they are not sufficient or if they are not available, previous year profits, or both. In case of government guaranteed companies, government will provide the dividend amount. Then what about the sources of interim dividend? Sources of interim dividend. So current financial year profits. Now in case of interim dividend, the point is 2023-24 financial year. It is just completed on March 31st, 2024. Now we are in 2024-25 financial year. Now AGM of this company for this financial year need to be held by September 30, 2024. Now on August 1st, the company declared a dividend. So this is declared not at AGM time. It is declared at some other time. So that's why this dividend is called as interim dividend. Now for the purpose of this interim dividend, I can take the profits of 23-24 financial year, or I can take the profits of 24-25 financial year also, but up to last quarter only. So for August 1st, what is the last quarter? June quarter. April, May, June. So I can use the profits of June quarter. So this is second source. Second source. And third source, previous year profits, nothing but reserves. That's it. And what about government guarantee? So government will guarantee for final dividend, not for interim dividend. Now say, so when final dividend will be declared? At AGM. Who will declare final dividend? Board of directors plus shareholders. When interim dividend will be declared? At any time other than AGM. Who will declare interim dividend? Only board of directors. Next one. And what about the sources of final dividend? Current year profits, previous year profits, both CG funds or SG funds. Then what about interim dividend? So previous year for which the dividend relates, and current year up to last quarter, and previous reserves and surplus. That's it. Next one. Once the dividend is declared, it will become a liability for the company. Next one. Okay, now company want to utilize the resource. So can it utilize the resource? Yes, subject to certain conditions. Say for example, company want to declare 10 crores as dividend, but in the current year, the available profit is only 5 crores. Now what this company need to do? it need to utilize the current year profit of 5 crores and it need to take the balance 5 crores from reserves. That means the company is going to utilize reserves now. Now company can utilize the reserves subject to some conditions. Next one, current year there is a loss of 3 crores. Now company decided to declare 10 crores dividend. Is it possible? Yes, possible. But what about the source? This 10 crores will be paid from reserves. So in current year, if there is inadequate profit, in current year if there is any loss, then for payment of dividend you can utilize the previous year profits, nothing but called as reserves. But to utilize reserves, certain conditions need to be satisfied. What are those conditions? First one, what is the maximum rate of dividend? So this is for final dividend. So what I'm saying here is applicable for final dividend. So what about the maximum rate of dividend? For that purpose, I need to take the average rate of dividend for last 3 years. Say for example, during last 3 years, company declared 10%, 12%, 14% dividend. Now say what is the average rate of dividend? 12%. So what is the maximum rate of dividend? 12% only. So while I'm utilizing reserves and surplus, I can declare dividend maximum up to 12% only, not exceeding 12%. Sir, what happens if I declared dividend for 2 years only in the last 3 years? I need to take the average of those 2 years. What happens if I declare only 1 year during last 3 years? I need to take that 1 year dividend. That's it. So what is the maximum rate of dividend if I want to utilize reserves? Last 3 years average rate. Next one, how much amount I can withdraw from reserves? So for this purpose, I need to take paid up share capital plus free reserves. So don't take security premium account, take paid up share capital and free reserves. So in this amount, I need to take 1/10, that means 10%. So if paid up share capital is 50 crores, free reserves are 50 crores, total 100 crores. So total 100 crores, in that 100 crores, 1/10, that is 10% means 10 crores. So maximum amount that can be withdrawn from reserves is 10 crores. Now this 10 crores must be utilized to set off the current year losses, because in first case there is no loss, so third condition is not applicable. But in second case there is 3 crores loss. So now that 10 crores must be utilized for the payment of 3 crore loss, and balance 7 crore can be paid as dividend. So these are the conditions that need to be satisfied. So if in current year, if there are adequate profit, then no need to fulfill any of these conditions. If profits are adequate to pay the dividend, no need to satisfy all these conditions. If profits are inadequate, 3 conditions need to be satisfied. What are those 3 conditions? Maximum rate of dividend condition, maximum amount that can be withdrawn from reserves condition, and last one, balance after withdrawal condition. One more condition is there, balance after withdrawal condition. It need to satisfy 3 conditions. Next one, sir, what happens if there is any loss in the current year? Then 4 conditions, 3 conditions, and one more condition is the balance which is withdrawn from the reserves need to be utilized first in order to set off the losses. Okay, then what is the maximum rate of dividend condition? We need to take the average of last 3 years. What about maximum amount of withdrawal? We need to take 10% of paid up share capital plus free reserves. And where to utilize the withdrawn amount first? For current year losses, if any. And what should be the balance of reserves after withdrawal? It must be at least 15% of paid up share capital. That's it. So here we need to take only paid up share capital, free reserves, security premium not allowed. Only paid up share capital, and this time this is not 10%, this is 15%. Next one, these conditions are not applicable for government company where the entire capital is held by government. Next one, then what about interim dividend? In case of interim dividend, if you want to utilize the reserves, then you are required to satisfy only one condition, that is first condition, maximum rate of dividend. That's it. Now say final dividend means declared at AGM. Interim dividend at any time other than AGM. Declaring authority, board of directors plus shareholders. Interim dividend, only board of directors. Next one, sources, current year profit, previous year profit, both CG funds, SG funds. In case of interim dividend, so financial year, related financial year profits or current year profits till last quarter or reserves. Next one, if I want to utilize reserves, in addition to current year profits or instead of current year losses, then I need to satisfy 3 or 4 conditions in case of final dividend, 1 condition in case of interim dividend. So 3 conditions when there is inadequate profit, 4 conditions when there is any loss. Next one, in case of interim dividend, only 1 condition, that is rate of dividend condition. Next one. Now what happens if company fails to distribute the dividend? So once dividend is declared, within 5 days it need to deposit the entire dividend amount in a separate bank account. So once dividend is declared, within 5 days what company need to do? It need to deposit entire dividend amount in separate bank account. So after declaration, within 30 days, the company need to pay the dividend to all shareholders. So 5 days, 30 days. Both the time limits need to be counted from date of declaration of dividend. So from the date of declaration of dividend, all the amount which is payable as dividend need to be kept in separate bank account. And within 30 days of date of declaration of dividend, I need to give that money to the shareholders. What happens if I fail to give that money to the shareholders? Then the director who is in default will be imprisoned for 2 years. And company is required to pay simple interest of 18% per annum. Exceptions. Now in these exceptional cases, director is not liable for imprisonment. Company is not liable to pay any interest. Then what are the exceptions where company will be saved from the consequences? First one, dividend is not paid because of legal reason. So company is ready to pay the dividend, but because of some statutory compulsion, some legal compulsion, company stops to pay the dividend. Now in this case, there is no default on part of company, so company is not liable for any consequence. Next one. Now shareholder gave some instructions to the company with respect to how to make payment. Company tried to follow that instruction, but company failed. And such failure is intimated to, informed to respect to shareholder. Now there is no default on part of company, so company is not liable for any consequence. Next one. Now one of the shareholder got expired. Now legal heirs are having some dispute regarding claiming of dividend amount. Now to which person company need to pay the money? There is no clarity. That's why the company is holding the money even though 30 days time is expired. So in this case also company is not liable for any consequence. Next one. Now shareholders need to pay some money to the company. Company need to give it to the shareholder. Now without giving that money, company adjusted the dividend amount with the amount receivable from the shareholder. Then company is not liable for any consequence. Finally, any other reason where there is no company's fault. So in that situation also company is not liable for consequence. So what is the conclusion for this question? Within 30 days, if company fails to give the dividend, company is liable to pay simple interest at the rate of 18% per annum, and defaulting directors will be imprisoned for 2 years. But these rules are not applicable in 5 cases. What are those 5 cases? Company failed, but because of legal reasons. Company failed because company fails to satisfy the instructions given by the shareholder, but the same is informed to the shareholder. If it is not informed, company will be liable for consequences. Next one. Now company failed because of dispute with respect to ownership. Next one, company failed because it adjusted the amount with the amount receivable from the respective shareholder. Company is failed, but it is not company's fault. In all these cases, company is not liable for any consequence. Next one, how to treat unpaid dividend. So first, date of declaration. From the date of declaration, within 5 days, what company need to do? It need to deposit the entire amount in scheduled bank account. So within 30 days of date of declaration of dividend, the company need to pay the dividend to the shareholders. What happens if company fails to pay the dividend to the shareholders? What happens if shareholder fails to claim the amount from the company? In case of unpaid dividend, in case of unclaimed dividend, after the expiry of 30 days, within 7 days, company need to transfer that money to a separate account called as unpaid dividend account. So all unpaid dividends, all unclaimed dividends will be transferred to separate bank account within how many days? 7 days. And this 7 days time limit will be counted from the expiry of 30 days. Now the amount will be in the unpaid dividend account. For how many years? It will be there in unpaid dividend account for 7 years. If any person, that is shareholder, if that person want to claim this money, he need to make an application to the company, and company will give that money to that respective shareholder. But once 7 years time is expired, any amount which is left in unpaid dividend account along with shares will be transferred to IEPF, Investors Education Protection Fund. If the original shareholder, if he want to claim the money, now he need to make the application to IEPF authority but not to the company. That means when the amount is lying in unpaid dividend account, that person can make application to the company. If the amount is transferred to IEPF, he need to make application to the IEPF authority. So these are the time limits which you need to remember. So first one, 5 days. Within 5 days of date of declaration, company need to deposit the entire amount in bank account. Within 30 days of date of declaration, company need to pay the dividend. Any unpaid dividend, unclaimed dividend need to be transferred within 7 days to the unpaid dividend account, and it will remain in unpaid dividend account for how many years? 7 years. After the expiry of 7 years, it will be transferred to IEPF. Next one, punishment for default. So in case of company, 1 lakh plus 500 per day, maximum 10 lakhs. In case of officer in default, 25,000 plus 100 per day, so maximum amount is 2 lakhs. So these are the penalties for company as well as officer in default. So by this we completed dividend chapter. So next one, accounts and audit. So this is most important chapter. So in this chapter, first we are going to discuss about books of accounts, books and papers, financial statements. So books of accounts means what? Cash book. Cash book will contain cash receipts, cash payments. So cash book will be covered under books of accounts. Next one, purchases and sales of goods and services. Purchase book, sale book will be covered under books of accounts. Assets and liabilities related books will be covered under books of accounts. And cost records which you are required to maintain as cost records. So those records are also called as books of accounts. Now books of accounts includes 4 things. What are those 4 things? Receipts and payments, purchases and sales. Next one, assets and liabilities. Next one, cost records. Then what about books and papers? Books and paper means a vast term. It includes books of accounts also. Books of accounts, deeds, nothing but written agreements, vouchers, writing, document, minutes book, registers, all will be called as books and papers. Next one, what is meant by financial statement? Financial statements means balance sheet, profit and loss account, cash flow statement, statement of changes in equity, and notes forming part of financials. So all these 5 will be called as financial statements. Now the point is, in case of one person company, in case of small company, in case of dormant company, financial includes all the above points except cash flow statement. That means for other companies, P&L account, balance sheet, cash flow statement, notes to account, changes in equity. But for OPC, small company, dormant company, all 5 will come except one, that is cash flow statement. Next one, what is meant by financial year? Say for example, so financial year will start from April and it will end by March. So I am taking April to December and January to March. So April to December will cover how many months? 9 months. And January to March, 3 months. So entire financial year will be 12 months. That is April to March. Now, if company is created during April to December period, then the financial year for that company will end by next 31st March. If the company is created during last 3 months of the financial year, that is during January to March, then the financial year will end not by 31st March of that year, it will end by next year 31st March. Say for example, we are in 2024-25 financial year. In this financial year, if company is created in between April 24 to December 24, so financial year will end by March 31st, 25. That's it. If the company is created during January 25 to March 25, that is last 3 months of the financial year, then its financial year, first financial year will end by 31st March of 26. So this is the definition of financial year. And in case of financial year, it will start from April to and it will end by March. But if my company is having a foreign subsidiary, my company is having foreign joint venture, foreign associate company, and that company is required to follow different financial year in order to comply with their rules and regulations. Now I can request central government to follow different financial year for my entity also, which is there in India. If CG agrees for it, I can follow different financial year. Next one. Now main concept. Okay, next one. So now the point is, for every financial year, every company shall prepare and preserve at register office following documents. Which documents? They need to prepare and preserve books of accounts. They need to prepare and preserve books and papers. They need to prepare and preserve financial statements. Books of accounts means 4 things: receipts and payments, purchases and sales, assets and liabilities, cost records. Books and papers means each and every thing like minutes book, registers, vouchers, all the things will be called as books and papers. Financial statements means 5. But for OPC, small company, dormant company, it is 4. It excludes cash flow statement. Now, every financial year, for every financial year, every company shall prepare these 3 things, these 3 documents, and they need to preserve those 3 documents at registered office. And now, these 3 documents must reflect true and fair view. And these 3 documents are related to main office as well as branch office. Next one. And all these 3 things need to be prepared in such a way that they need to explain each and every transaction in detail. In simple words, while making journal entries, you need to provide explanation. Next one. And which basis we need to follow? Is it cash basis or accrual basis? Only accrual basis. Cash basis not allowed. Is it single entry system, double entry system? Only double entry system. Single entry system is not allowed. Single entry system is only one credit. That's it. Double entry system means for every credit, there will be debit. Next one. Cash basis means you will account for only when cash is received or cash is paid. Accrual basis means on due date, you will make due entry. On payment or receipt date, you will make another entry. So, among cash basis and accrual basis, you are required to follow accrual. Among single entry and double entry, you are required to follow double entry. And every transaction need to be explained in detail. Next one, where to maintain. Now it is about only books of accounts as well as papers, not about financial statements. Only 2 things got covered now. So what are those 2 things? Books of accounts and books and papers. So where to keep these books of accounts and papers? First one, here we need to classify the office into 2 categories: main office, branch office. Branch office into 2 categories: Indian branch office, foreign branch office. Now the point is, in case of main office books, they need to be kept at registered office or some other place as decided by the board of directors. Yes, some other place is also allowed, but who need to decide that place? Board of directors. Then what about branches? So in case of Indian branch office, the books can be kept at branch office itself. In case of foreign branch office, the books of accounts can be kept at branch office itself. But these branch office are required to send summarized periodical statement to the main office, that is register office. Then what about the frequency of such statements? In case of foreign branch offices, according to law, it is quarterly basis. In case of Indian branch office, so nothing is prescribed by law. So they can follow either monthly basis or quarterly basis or half yearly basis also. So this is how books need to be preserved. Now say books as well as books and papers. Where to preserve? If it is related to main office, at register office or some other place as decided by board. If it is related to branch, at branch office itself. But that branch need to send periodical summarized returns to the main office. In case of foreign branch office, quarterly is the prescribed periodicity. In case of Indian branch office, it will be decided by board of directors. Next one. Then, is it possible to inspect books of accounts? Yes, but this right is only applicable to director. Shareholders or debenture holders or some other person is not allowed to inspect the books of accounts. They can see financial statements, but they can't ask for books of account. They can't ask for ledgers, cash book, sales statement. They can only ask for financial statements. Now, who is having right to inspect books of accounts? Only director. So in case of main office, the books of accounts and other books and papers can be inspected by director. In case of branch office, he can inspect the summarized returns which are forwarded by those branch officers. What happens if he requires some extra information? He will ask the respective branch to provide that information. Within 15 days, the respective branch need to provide the extra information which is required by the director. Now, only director is having this authority. Only director can exercise this authority. That means the director cannot assign this work to any other person. So director himself need to go for inspection. Okay. Now the question is, the director of holding company want to inspect the books of accounts of holding company. Is it allowed? Yes. The director of holding company want to inspect the books of accounts of subsidiary company. Is it allowed? Yes. But for this purpose, consent of all the directors of holding company is required. With the consent of all the directors, any director from the holding company can inspect the books of accounts of subsidiary. For inspecting own company's books of accounts, there is no restriction. For inspecting subsidiary company books of accounts, board of directors permission is required. That too unanimous permission is required. Next one. Period of maintenance. So the company need to maintain the books at register office or some other place as decided by board. In case of branch books, those books can be maintained at branch itself. Now, what about the period of maintenance? Each and every book of account need to be preserved for at least 8 years. But if central government orders you to maintain for 10 years, you need to maintain for 10 years. If central government orders you to maintain books of accounts for 16 years, you need to maintain for 16 years. If there is no such order from central government, maximum period is 8 years. And who is responsible for non-maintenance? Managing director, whole-time director who is in charge of finance, CFO, and person authorized by board. So any of these 4 persons are responsible for maintenance of books of accounts and papers. Then what is the non-compliance consequence? They are required to pay fine varying from 50,000 to 5 lakhs. Next one. Provisions regarding financial statements of the company. So first of all, what a company will do every year. So after the completion of year, company will prepare financial statements. Step number 1. Second one, board of directors will approve financial statements. Step number 2. Third step, audit of financial statements, and auditor will give audit report. Fourth step, board of directors will give board report. And next step, AGM will be conducted, and in that AGM, audited financials, audit report, board report will be provided to the shareholders. Now shareholders need to approve the financials. Once they are approved, they need to be filed with ROC in the name of financial statements, and thereafter annual returns. So this is the every year process that need to be followed by the company. Now the point is, what happens if company is required to prepare consolidated financial statements? Then along with standalone financial statements, they need to prepare consolidated financial statements. And approval for standalone financials as well as consolidated financials is required. Audit for standalone as well as consolidated is required. But board report will be given only for standalone financial statement but not for consolidated financial statements. So except board report, remaining things will be done for both standalone as well as consolidated. Next one, in AGM, shareholders are provided with standalone financials, consolidated financials, and highlights of the financials of subsidiaries, a separate statement. So all these things will be provided to shareholders of AGM along with board report and audit report. Now shareholders will decide and they will approve the financials. Later, financial statements along with consolidated financial statement need to be filed with ROC. And what about annual return? As usual. That means in case if company is required to prepare CFS, then SFS will be replaced by SFS plus CFS. But this is not applicable in case of board report and annual return. In the remaining cases, you need to take SFS as well as CFS. Now the point is, which companies are required to make consolidation? Which companies are required to make consolidation? Every company which is having subsidiary or every company which is having associate company, they need to prepare consolidated financial statements. Actually in law, you can see a point. A company having subsidiaries need to prepare CFS. Then what about associate? So below the definition, an explanation is also provided. For the purpose of this section, subsidiary includes associate also. Which means if a company is having subsidiary, if a company is having associate, then that company need to prepare CFS along with SFS. But certain company can get exemption here. Which company can get exemption? Say for example, A Limited is the holding company, B Limited is the first layer of subsidiary, C Limited is the second layer of subsidiary. Up to 2 layers, no problem at all. Now the point is, A Limited, they need to prepare SFS, CFS. SFS means standalone financials of A Limited. CFS means consolidated financials of A Limited, B Limited, C Limited. Then what about B Limited? B Limited is required to prepare SFS as well as CFS. So SFS of B Limited, CFS of B Limited and C Limited, that's it. Then what about C Limited? Only SFS. CFS is not applicable. Why? For A Limited there are 2 subsidiaries. For B Limited only 1 subsidiary is there. For C Limited there is no subsidiary at all. So that's why for A Limited, B Limited consolidation is applicable. For C Limited consolidation is not applicable as it does not have any subsidiary or associate. Now I can give exemptions to either A Limited or B Limited from following consolidation provisions. Okay, which kind of company is eligible for that category means B Limited. That means I need to give exemption for the subsidiary company, not to the holding company. That is condition number 1. Second condition, the members of this subsidiary shall not object for non-preparation of consolidated financial statements. That means every member need to agree for not to prepare consolidation. Next one, this company must be unlisted company and ultimate holding company, that is A Limited, need to prepare consolidation. If all the 4 conditions got satisfied, then B Limited will be exempted. So actually, who are required to prepare CFS here? Both A Limited as well as B Limited. But A Limited will not have any exemption, but B Limited will have exemption. So when B Limited can claim exemption? When it is a subsidiary. Yes, it is a subsidiary. When ultimate holding is preparing CFS. Yes, A Limited is preparing CFS. When members of B Limited doesn't make any objection for it. Yes, no one is making objection. And B Limited is unlisted company. Yes, B Limited is unlisted company. All the 4 conditions got satisfied. Now B Limited is exempted from preparing CFS. Next one. Then what about preparation of CFS? It shall be in accordance with Schedule 3 formats only. What about audit of CFS? It shall be in accordance with normal audit provisions only. That means every provision which is applicable to SFS shall apply mutatis mutandis to CFS also. Next one, accounting standards. Every company, while preparing either SFS or CFS, must follow applicable accounting standards. If India is applicable, they need to follow India AS. If India is not applicable, they need to follow normal AS. Now the point is it possible to deviate from the standards? Yes. If you are claiming that your presentation is more accurate than the presentation which is given by the standard, then you can deviate from the standard in order to give a better presentation of financials. But in such a situation, you need to make a disclosure. What kind of disclosure? So what is the deviation? What is the reason for the deviation? And what is the increase or decrease in profit or increase or decrease in loss because of such deviation? So I need to give three particulars: deviation, reason for deviation, effect of deviation. Next one, periodical financial results. Generally, all listed companies are required to provide periodical results on every quarterly basis. For every quarter, every listed company will announce results, financial results. But what about unlisted public companies? So as of now, nothing is applicable for unlisted public companies regarding this. But in future, CG may prescribe some class of unlisted companies to prepare periodical financial statements. So for example, if CG said unlisted companies to prepare half-yearly statements, then after the completion of half year, what company need to do? Company need to prepare financial statements for that half year. Board of directors need to approve such financial statements. Auditor need to audit them and he need to issue audit report. Now this is not called as audit report. This will be called as limited review report. Why it is not called as audit report? Because in order to call it as audit report, he need to audit each and every particular. But the particulars which is given to the auditor as of now is, they are related only to the half year. So that's why he need to give limited review report, not audit report. So after doing all these things, they need to file the financials with the ROC. So just like every year concept, so every company is required to follow the concept for quarterly basis or for half yearly basis. For listed companies, quarterly is mandatory according to SEBI regulations. For unlisted companies, as of now nothing is mentioned, but in future if CG mentions as half yearly, they need to follow half yearly basis. If CG said to follow quarterly, they need to follow quarterly basis. Next one, very important question, corporate social responsibility. So in this concept, you may get a practical question. So corporate social responsibility, for which companies it is applicable? It is applicable to every company. It is applicable to every company whose net worth is minimum 500 crores or whose turnover is minimum 1000 crores or whose net profit is minimum 5 crores. That means the company is not required to satisfy all the conditions. If company satisfy only one condition also, the company is required to follow CSR provisions. Now, such companies need to create CSR committee. They need to create CSR committee. Then what about the members of CSR committee? So the members of CSR committee will be at least 3 directors. So in CSR committee, how many directors must be there? Minimum 3 directors must act like members. So out of these 3 directors, at least 1 independent director shall be present. Next one, sir, there is a private company. In case of private company or in case of one person company, there is a chance to have only 2 directors. Then how is it possible to have 3 directors in CSR? So that's why any company which are having only 2 directors, they are required to appoint 2 directors in the CSR committee. For them, 3 directors rule is not applicable. That means in case of public company, 3 directors rule is applicable. In case of private company, having more than 2 directors, 3 director rule is applicable. Having only 2 directors, 3 directors rule is not applicable. And what about OPC? For OPC, it is not applicable if number of directors are below 3. Next one. Now, this is the constitution of CSR committee. So if any company satisfies any of these conditions, then it need to constitute CSR committee. This committee need to create CSR plan, and this CSR plan need to be recommended to board of directors. Now board of directors will finalize the CSR plan. Now CSR committee will implement the CSR plan. Now the main point is how much amount need to be contributed for CSR plan. For this purpose, I need to take the average of last 3 years net profit. In that average net profit, I need to take 2%. That much of amount need to be spent for CSR purpose. Next one. Now, for the purpose of calculating net worth, what is the formula? Net worth means paid up capital plus reserves and surplus minus accumulated losses, deferred expenditure, miscellaneous expenditure, which will be shown on asset side. That means which is not yet written off completely. So we need to take paid up capital, we need to add reserves and surplus, and we need to remove accumulated losses, deferred expenditure, and miscellaneous expenditure, which is shown on asset side. Now while taking reserves and surplus, I need to exclude revaluation reserve. So it shall not be taken into account while taking reserves and surplus. So this is how I need to calculate the net worth. Then how to calculate net profit? To calculate the net profit, I need to take entire net profit of the company and I need to exclude two things. First one, Indian company, it is having branches in India as well as outside India. In India, the profit is 100 crores. Outside India, the profit is 200 crores. Total profit is 300 crores. Now, what is the net profit? 300 crores. Now, on which net profit I need to make CSR contribution? Only 100 crores. Why not 200 crores? Because it was not generated in India. That means any profit which got generated outside India shall not form part of net profit for the purpose of CSR. Next one. Now, there is an Indian company. It got income in two ways. One as dividend from another Indian company. One is business income. So, dividend income is 10 crores. Business income is 90 crores. Total income is 100 crores. Now, the point is, this Indian company need to spend some amount to the CSR. How much amount? It depends upon the net profit. Which net profit I need to take here? Is it 100 or 90? 90. But what about 10? The 10 is not required to be added. But this is subject to a condition. What is that condition? Now, this is receiving dividend from another Indian company which already spent for CSR. That means A Limited is the company. It got dividend from B Limited. Now, B Limited, before giving dividend to A Limited, it already spent some amount to the CSR. So after deducting CSR expenditure, the dividend is transferred to Indian company. That means the dividend which was received by the Indian company is already subject to CSR. Again, utilizing that money for CSR is not required. So that's why I need to ignore 10 crores. I need to spend 90 crores. Out of 90 crores only, I need to spend for CSR. And last point, what happens if I fail to spend money for CSR activity within the end of financial year? Now I need to check, is it related to any ongoing project or not? If it is related to ongoing project, within 30 days from the end of financial year, I need to separate that amount to a schedule bank and I need to spend that money for the ongoing project up to a period of 3 years. Next one, what happens if that amount is not related to any ongoing project? Then I failed completely. Here also, after 3 years, what happens if there is any amount left in the schedule bank account? The company was failed. Whenever the company was failed, the company need to transfer that money to schedule number 7 funds. So there are certain funds which are given in schedule number 7. So the amount need to be transferred to such funds. Within how many months means 6 months. So now what is the rule? If the amount is spent within the end of financial year, then it is okay. If company fails to spend the money within the end of financial year, then we need to check whether it is related to ongoing project or not. If it is related to ongoing project, the amount need to be kept in separate bank account within 30 days and company can utilize that money for a period of 3 years. If it is not related to any ongoing project, that means company failed completely. So company need to transfer the entire amount which it need to spend as CSR to schedule 7 funds. But in case of ongoing project also, after 3 years, if the amount is still left in the account, then that amount need to be transferred to schedule 7 funds. And there is one more point with respect to applicability. Once you got covered under CSR, you are required to follow CSR for every year. But previously the provision is, if you got covered under CSR, you are required to follow CSR for every year. But if you fail to satisfy any of the 3 conditions for 3 consecutive years, then from the 4th year onwards, you are not required to follow CSR. but this is old provision. But this is updated now. Once you got covered under CSR, whether you are satisfying those limits or not, it is irrelevant. You need to follow CSR forever. Next one. Right of member to ask for copy of audited financial statements. So this is also very important question. So you may get a theory question directly. So we already discussed about the procedure. What is the procedure that need to be followed by every company? First, they need to prepare financials. Later, they need to get approval from the board of directors. Later, it need to be submitted to the audit for audit report. Later, board of directors need to give board report. Later, financials, audit report, board report shall be given to the shareholders. Now, shareholders are having a right to claim all these documents. Okay. So, who is having right to claim all this document? Members of the company, trustee for the debenture holders, any other entitled person. These people are having right. So what is that right? They can ask for audited financial statements, which includes both standalone as well as consolidated. Next one, they can ask for audit report. They can ask for any other legally required documents, nothing but board report. That means they can ask for three things. What are those three things? Financials, standalone, consolidated. Audit report for standalone, consolidated. Board report, it will be for only standalone. So they can ask for these three documents. Now, when to give these three documents to the shareholders? So first of all, the company need to give notice to the shareholders for AGM. How many prior days before the notice must be given to the shareholders? At least 21 days prior. So at that time, company will give a notice called as general notice proposing its own agenda. So now, along with this general notice, the company need to attach audited financial statements, audit report and board report. Next one. Then what about short notice? Is it allowed? Yes, even short notice is also allowed, but consent of the members is required. So at least 95% of the voting power having members need to give their consent in order to agreeing for shorter notice. If they agreed for shorter notice, then company can proceed with shorter notice even less than 21 days. Next one. Now there is a special provision with respect to listed companies. So what is that special provision? In case of listed company, they can forward general notice to the shareholders, but while sending general notice, so without sending audited financials, audit report, board report, they can simply send a statement which will contain the main points of these documents. So why listed company is doing like this? Because listed company need to forward the notice to so many number of people. It may be in lakhs or crores. So it is not practically feasible for the listed company to forward all the documents to the each and every shareholder. So that's why it will send general notice. Along with general notice, it will send another statement which will contain the important points of audited financial statements, important points of audit report, important point of board report. Now, based on this statement, if any shareholder asks for the complete information, now that listed company is required to provide such complete information to the respective shareholder, not to all shareholders. So whoever asks for the full information, company need to provide the information to those people. But this is only applicable in case of listed company. In case of other companies, it is mandatory for them to forward complete details. In case of listed company, they can provide a summary statement and they can provide complete particulars for the shareholders who asked for it. Next one. Then manner of circulation. So how to circulate? So you can give notice along with these things to the shareholders in any manner, whatever you like. But in case of listed companies, in case of unlisted companies whose net worth exceed 1 crore, turnover exceed 10 crore, both conditions need to be satisfied. So for these two categories of companies, they need to follow the procedure what is given here. What about other companies? They can follow any procedure they want. But in these two cases, they need to follow the procedure which is given here. So in case of demat shares, definitely all these things need to be forwarded to registered email ID. In case of non-demat shares, nothing but physical shares, You need to ask the member. So what you need to ask the member? How can I send the notice? Is it through electronic mode or through physical mode? If other party, that is member, agrees for electronic mode, then you can forward through electronic mode. If he agreed for physical mode, or if he fails to agree for any mode, then you need to forward the documents in physical mode. Next one. And what about other cases? Physically. So this is how company need to send the general notice along with these documents. Next one. In case of listed company, they are required to show certain documents in the website also. So this is also applicable to listed company. So what documents need to be placed at website? First one, it need to place consolidated financial statements including SFS. So holding company, subsidiary company. For holding company, they need to place standalone financial statements along with consolidated financial statements. But for subsidiary companies, what documents they need to provide? Standalone financial statements which are audited. That's it. That means they are required to give all the details, all the standalone financials in the entire group and consolidated financials of the entire group. Both the financials need to be placed at website. Now the point is, what happens if that subsidiary is situated outside India? And at outside India, the company is not required for audit. Then you are supposed to upload unaudited financial statements of the foreign subsidiary. Because according to the rules of that country, audit is not mandatory. That's why you can upload unaudited financial statements of the subsidiary. Next one. So what happens if the foreign subsidiary is following their country rules, and according to that country rules, they are not required to prepare SFS. They are required to prepare CFS. Then you can directly take the CFS of subsidiary company instead of SFS. So you can just follow the laws of that country also. Simple. Next one. What happens if these documents are not in English language? Along with this thing, you need to add translation also. All these points are covered here. So now say what is the conclusion of this question? In case of normal companies, at least 21 days before, the company need to forward general notice along with audited financials. So standalone financials of holding company, standalone financials of subsidiaries is not required. It is required in case of website, but forwarding to members it is not required. So for that purpose, SFS of holding will be sufficient. And CFS, audit report, board report, need to be forwarded to debenture holders as well as members or any other person who is entitled to get the notice. Next one. Then what about the time period? At least 21 days before the meeting. What about shorter notice? Allowed, but 95% voting power holding members need to agree. Next one. In case of listed company, instead of sending all those documents, they can simply send a summary statement. But whenever a shareholder asks for full information, the company must provide full information. Next, in case of listed company, in case of unlisted public company having net worth exceeding 1 crore, turnover exceeding 10 crore. So what about the mode of communication? In case of demat shares, electronically. In case of physical shares and members gave written consent for delivering the financial statements through email, then electronically. In all other cases, physically. Next one. And in case of website, this is also applicable only to listed companies. So in website, they need to place standalone of own company, standalones of subsidiaries which are already audited. But if the subsidiary is a foreign subsidiary, and if it is not required to prepare audited financials, then you can upload unaudited. If it is not required to prepare SFS, they are required to prepare CFS, you can upload CFS. If it is not in English language, you can attach translated copy. Next one. Then, so what is the next step? Now in AGM, the financials will be approved, and after approval, they need to be filed with ROC. But in case of OPC, AGM is not required. Why AGM is not required in case of OPC? Because only there is one person as a member. With only one person, how can he conduct AGM? So AGM is not required. So financials must be forwarded within 180 days of end of financial year. That's it. But what about other cases? In case of other cases, after AGM is held, within 30 days of conclusion of AGM, the company need to file financial statements with the ROC. For OPC, 180 days from the end of financial year because AGM is not applicable. For other companies, AGM is applicable after completion of AGM. Within 30 days, you need to forward the financials to ROC. Now let's discuss about various provisions. So when AGM is held, strike off not. When AGM is held, there are two possibilities. Shareholders may adopt financials. Shareholders may fail to adopt financials. What happens if shareholders adopted financials? After the conclusion of AGM, within 30 days, forward adopted financial statements by the shareholders to the ROC. Completed. Sir, what happens when financial statements are not adopted? When financial statements are not adopted, so after the completion of that AGM, within 30 days, give unadopted financial statements to the ROC. Next one. And you need to conduct adjourned AGM. And in that adjourned AGM, you need to take the approval of shareholder. Once approval was given by the shareholders, from that AGM date onwards, within 30 days, you need to file adopted financial statements. That means if the financials are adopted at first AGM itself, then within 30 days of conclusion of AGM, forward the adopted financials to ROC. Now, in first AGM, financials are not adopted. In second AGM, financials are adopted. Now, what to do? Within 30 days of conclusion of first AGM, you need to file unadopted financial statements with the ROC. So, after the second meeting, that is within 30 days of second meeting, you need to file adopted financial statement. That means you are required to file 2 times. So, first time unadopted, second time adopted. Now, the point is, what happens if AGM was not held? If AGM is held, the possibilities will be shareholders may adopt the financials, shareholders may not adopt the financials. If they adopt the financial in first meeting itself, one time communication will be sufficient. If they fail to adopt in the first meeting, then 2 times communication is required. For first meeting, you need to file unadopted financials, and for the last meeting where financials are approved, you need to file approved financials. What happens if AGM is not held? If AGM is not held, then also you are required to forward all the financials to the ROC within 30 days. But now this 30 days will be counted from due date of AGM. And you need to communicate the reason also why you failed to conduct AGM within the due date. So this is the requirement in case when AGM is not held. Next one. In case of companies having foreign subsidiaries, they are required to give some extra information to the ROC. What is that extra information? So in previous question we discussed about listed companies. Listed companies are required to display certain information in their website. What is that information? Standalone financials of that company. Standalone financials which are audited of the subsidiaries. And entire consolidated financial statements. So same rule is applicable here also. So what happens when audit is not mandatory for foreign subsidiary? Give unaudited financials. What happens when subsidiary is required to prepare consolidated rather than standalone? Upload consolidated. What happens when foreign subsidiaries books are not in English language? Provide certified translation copy. Next one. So penalty you can refer on your own. So by this we completed about accounts of the company. Next one, audit of the companies. So time limit for first auditor and time limit for subsequent auditors. So you already know about it. For first auditors, what is the time limit? For non-government companies, board of directors need to appoint first auditors within 30 days of incorporation. If board of director fails, members by conducting extraordinary general meeting need to appoint the first auditor within next 90 days. That means the first chance will be given to the directors. If they fail, the second chance will be given to the members. So for directors, the time limit is 30 days from incorporation. For members, the time limit is next to 90 days, total 120 days. Then what about the term of first auditor? He will stay in the company till the end of first AGM. That's it. Next one. But what about government companies? So C and AG will appoint the first auditor within 60 days of incorporation. If C and AG fails, board of directors within next 30 days. If board of directors fails, members at AGM within next 60 days. And what about the tenure? Till first AGM. So first auditor term will expire by the end of first AGM. That's it. He will not continue for 5 years. His tenure will end by first AGM. Whether he is appointed by board of directors or members. whether it is government company case or non-government company case, the maximum tenure is up to end of first AGM. Next one. Then what about appointment of subsequent auditors? So subsequent auditors will be appointed in case of non-government companies by members at AGM. What is the time limit? There is no specific time limit. During AGM only they will appoint the subsequent auditor. And what about the term of auditor? He will remain in that company till the end of 6th AGM. That means 5 years. And thereafter, another 5 years. Thereafter, another 5 years. Thereafter, another 5 years. So, auditor can continue in that company for n number of 5 years. What about rotation concept? It is applicable only to few companies, not to all companies. For small companies, for private companies. So what kind of requirement is there? So you can appoint auditor for 5 years and auditor is reappointed for another 5 years and thereafter another 5 years, and it is a continuous process. No need of any cooling period. So cooling period is applicable only in case of few companies. Okay, I will discuss those companies later. So as of now, the term of auditor is 5 years and he is eligible for reappointment for n number of times. Next one. What about government companies? In case of government companies, auditor will be appointed by C&AG. That's it. No further power delegation. And what about the time limit? 180 days from the end of financial year. And what about the term? Only till next AGM. That means in case of government companies, the term will be up to 1 year. But in case of non-government company, the term will be 5 years. So after expiry of 1 year or 5 years, as the case may be, that auditor is eligible for reappointment for n number of times. But in case of government company, he need to be reappointed by C&AG. In case of non-government company, he need to be reappointed by the members. Next one. Filling up of casual vacancy. What is meant by casual vacancy? Now, auditor discontinued from his office before the expiry of his term. Then it is called as casual vacancy. Now, if it is caused because of resignation, who need to fill casual vacancy? Board of directors within 30 days of vacancy. Later, it need to be approved by shareholders within next 3 months. What happens if casual vacancy is created for any other reason, not because of resignation? For any other reason, casual vacancy was created. Then, only board of directors will be involved. Subsequent approval of shareholders is not required. Then what about the time limit? 30 days of vacancy. Then what about the term of that auditor? So he will stay up to next AGM. Not for the balanced term. He will stay up to next AGM only. Say for example, auditor was appointed for 5 years. After 1 year, you removed the auditor. So before the expiry of term, auditor was removed. So casual vacancy was created. Now if you appoint any other auditor in the place of this auditor, he will continue up to next AGM only, not for balance 4 years. So this is very important point, key point. Next one. But in case of government company, it may be any reason, resignation or any other reason. Who need to fill casual vacancy? C&AG within 30 days. If C&AG fails, board of directors within next 30 days. And what about the term of auditor? Same. Till the end of next AGM, not balanced tenure. Only till the end of next AGM. Next one. Now, in case of government company, 1 year term is expired. In case of non-government company, 5 years term is expired. Now you need to reappoint the auditor. Then only he will be eligible to act like auditor. So what happens if he is disqualified? He cannot be reappointed as auditor. What happens if he gave any written consent showing his unwillingness to continue as auditor? He cannot be appointed. Next one. What happens when a special resolution is passed for not to appoint that person as auditor? He cannot be appointed. What happens if resolution is passed to appoint some other person in his place? He cannot be appointed. That means if he is not disqualified. Next one. If he doesn't show his unwillingness to act as auditor. If some other person is not appointed. If shareholders does not resolve for not to appoint this person as auditor. That means all these 4 things are positive signs. If nothing is happened like this, then the retiring auditor is deemed to be reappointed. Next one. Then what about audit committee recommendation? So wherever the company is required to constitute audit committee, then instead of board of directors, who need to make recommendation? Audit committee need to make the recommendation. That means the point of board of directors will be replaced by audit committee plus board of directors, because recommendation will be made by audit committee to the board of directors. Board of directors will forward the recommendation to the shareholders. So that's why all board of directors related points need to be replaced by audit committee plus board of directors. But when company is not required to create audit committee, then only board of directors will continue. If company is required to constitute audit committee, then board of directors point will be replaced by first audit committee, later on board of directors. So how this will happen? Let's see this question. So first of all, Mr. A. So there is audit committee for the company. So audit committee want to appoint Mr. A as auditor for the company. So it will recommend the appointment to the board of directors. Board of directors will recommend the same to the shareholders. Now the point is, audit committee made a recommendation to appoint Mr. A as auditor, but board of directors refuses for it. Now board of directors will ask audit committee to review the decision once. Now audit committee review the decision. If it is satisfied with board of directors, the problem will be solved. If it is not satisfied with the board of directors version, again they will make the recommendation once again. No, we are not agreeing with your version. We are recommending Mr. A as auditor. This is final. Like that they will say to the board of directors. Now what board of directors will do? If board of directors are agreed with audit committee recommendation, then it is fine. Problem will be solved. If he is also not agreeing with the same, then the proposal of audit committee, the proposal of board of directors, both will be forwarded to shareholders, and ultimately who will decide the matter? Shareholders will decide the matter. This is when audit committee is there in the company. What happens if audit committee is not there in the company? All these things will be taken care by board of directors. Directly he will recommend the auditor to the shareholders. If audit committee is available, audit committee plus board of director. If audit committee is not available, board of directors alone will make recommendation of auditor to the shareholders. Next one. Conditions preceding appointment. So here also written consent is required from Mr. A, who is the proposed auditor, and he need to give a certificate also. What is that certificate? I fulfilled all the requirements for the appointment of auditor position. Like that he need to give a certificate also. Next one. And he need to provide criteria under section 141. So what is the criteria under section 141? So he is not disqualified and he is accepting audit within the limit only. So like this he need to give particulars in certificate also. Next one. And some other particulars he need to say he is eligible for appointment and he is not disqualified for appointment. Under which act? Companies Act, CA Act, and rules and regulations made under Companies Act and CA Act. Next one. The proposed appointment is within the term provided under the act, that is 1 year in case of government company, 5 years in case of non-government company. Next one. It is within the limits, because auditor is not supposed to accept n number of audits. There will be some limits, just like directorship positions. So he need to accept within that limit only. And he need to say about pending proceedings against that auditor. If any disciplinary proceedings are pending against the auditor, he need to clearly communicate about those details to the company. So all these things are required to be communicated by the auditor to the company. Later company will decide whether to appoint this person as auditor or not. Once if company decided to appoint this person, he will be appointed. Within 15 days, the appointment particulars need to be communicated to the respective auditor as well as ROC by using a form called as ADT 1. And in exam, in MCQs, you may be asked with form numbers. So ADT 1, ADT 2, ADT 3, ADT 4, like that. So you need to remember form numbers. Next one. Rotation concept. So you already know about rotation concept. Who can be an auditor? Individual, firm. Firm is partnership firm, LLP firm. In case of individual, that individual must be CN practice. In case of firm, majority of the partners must be CN practice. Now the point is, in case of individual, for how many terms they can be reappointed? No, reappointment is not possible. Only one term appointment is possible. He need to wait for some cooling period. Thereafter he will be eligible for one more term. Again cooling period, one term, again cooling period. So this is called as rotation concept. In case of firm, so first they will be appointed for single term. Later they need to be reappointed for another term of 5 years. After that they need to wait for cooling period. So after expiry of cooling period, again 2 terms. Again cooling period. After expiry of cooling period, again 2 terms. So this is applicable for only few companies, not for all companies. Then which companies are required to follow like this? Listed companies, all. Unlisted public companies, when paid up capital is at least 10 crores. Private companies, when the paid up capital is at least 20 crores. Any company means it may be unlisted public company or private company whose public borrowings, banks and deposits is minimum 50 crores. So all these companies are required to follow rotation of auditor concept. Then what about other companies? All other companies can appoint auditor for 5 years. And he can be reappointed for n number of times without any cooling period. But in case of these companies, so cooling period concept is applicable for auditor. Then what about the cooling period? Cooling period is also 5 years. Next one. So question number 11, you can read on your own. Question number 12. So removal of auditor. Is it possible to remove the auditor? Yes. First you need to conduct board meeting and you need to pass board resolution to remove the auditor. Later apply it to the central government and take the approval of central government. After getting approval, conduct general meeting and pass special resolution. Thereafter you can remove the auditor. So for removing auditor, 3 approvals are required. Board of Directors approval, CG approval, shareholders approval. So first approval, Board of Directors. Second approval, CG approval. Last approval, shareholders approval. And in case of shareholders, what kind of resolution is required? Special resolution is required. If all the 3 conditions are satisfied, then you can remove your auditor. But you must provide a reasonable opportunity of being heard to the auditor. Next one. Resignation of auditor. Very simple. If auditor want to resign from the company, he need to communicate about his resignation to the company, ROC, C&AG. C&AG is applicable only in case of government companies. Next one. Eligibility. We already completed about eligibility. Qualifications. We already completed about qualifications. Disqualifications. So what are the disqualifications to act like auditor? First one. Body corporates are not eligible to become auditor. Only individual firms, that is proprietary firms, partnership firms, LLPs are allowed to become auditor. What about companies? No, companies are not allowed to become auditor. That means body corporates are not allowed to become auditor. Sir, LLP is also a body corporate. Yes, LLP is also a body corporate. That's why every body corporate except LLP cannot become auditor. Next one. Officer or employee of the company. Now there is a company ABC Limited. In this ABC Limited, so a CA is acting like officer, like CEO, CFO, CS like that, or he is acting like employee. So is the same person eligible to conduct audit of that company? No. So officer or employee of that company is not eligible to conduct audit. Next one. Not only officer and employee, any person who is a partner of this officer and employee, any person who is a relative of this officer or employee, even that person is also disqualified. Next one. Now we need to take any person or his relative or his partner. Person means main person. Say for example, Mr. A want to become auditor. Relative means relative of Mr. A. Partner means Mr. A is running a partnership firm. In that partnership firm, other partners are called as partner for Mr. A. So Mr. A or his relative or his partner, if they are having any financial interest in the company, then the main person, that is Mr. A, is not eligible to act like auditor. Then what are those financial interest cases? First one, holding securities. In which companies? Cash plus yes plus yes. Cash means main company, its associate, its subsidiary, its holding. Yes means subsidiary of its holding. Yes means subsidiary of its associate. Total how many companies? 6 companies. Now, if Mr. A or his relative or his partner is having any securities in main company or its associate or its subsidiary or its holding or the subsidiary of its holding or the subsidiary of its associate, then Mr. A is disqualified. But there is an exception to this rule. What is that exception? Relative can hold the securities, but Mr. A cannot hold the securities. Mr. A's partner cannot hold the securities, but Mr. A's relative can hold the securities. And the securities face value shall not exceed 1 lakh. So I am talking about face value, not about market value. The face value of the securities that are being held by the relative shall not exceed 1 lakh. Then Mr. A is eligible. That means Mr. A cannot hold securities. Mr. A's partner cannot hold securities. Mr. A's relative can hold securities up to a face value of 1 lakh. In this case, Mr. A is eligible. What happens if Mr. A holds security? Ineligible. What happens if Mr. A's partner is holding securities? Ineligible. What happens if Mr. A's relative is having securities with a face value more than 1 lakh? Ineligible. So at the time of appointment of auditor, relative is holding up to 1 lakh only. But after appointment, he purchases another 1 lakh because his relative is auditor in that company. Now say, what will happen now? Now auditor need to vacate the office. So that's why, in order to comply with the requirement, the auditor will be provided with 6 months time limit. Within the 6 months, he need to rectify the defect. 60 days. Within 60 days, the auditor need to rectify the defect. Next one, indebtedness. What is meant by indebtedness? Giving loan. So now the person has taken loan from these companies. Which companies? Same. Cash plus S companies. So from these companies, a person or his partner or his relative took loan. Now the main person is disqualified. But if the loan amount is up to 5 lakhs, then no disqualification. Now this exception is applicable not only for relative but also for the main person, but also for the partner. But in previous point, the exception is applicable only to the relative. But in the current point, the exception is applicable for relative, for main person, for partner. In previous case, the limit is up to 1 lakh face value, but in this case, the limit is up to 5 lakhs. Now, these companies provided guarantee or security to a person or his relative or partner, then that person is not eligible. But here also there is an exception. If the security value or guarantee value is up to 1 lakh, then no disqualification. So here exception covers all the 3 people. So in the entire transaction, so we discussed about 3 parameters. First parameter is securities. Second parameter is loans. Third parameter is offering securities or guarantees, nothing but LSD transactions. So in case of securities, only relative can hold up to 1 lakh face value. In case of indebtedness, nothing but loan, any person up to 5 lakhs. In case of guarantee or security, any person up to 1 lakh. So these are the exceptions. In remaining cases, those people are disqualified. And we need to check which company here? Cash plus S companies. Next one. Now, if the auditor or the firm is having some direct or indirect business relationship with same companies means cash plus S. If any person is having business relationship with cash plus S companies, then those person is not eligible to act like auditor. Next one. A person who is a relative of director or KMP is disqualified. A person who is in full-time employment elsewhere, that means there is a person who is a CA in practice but who is doing job with some other entity. So he is working there on full-time basis. Now the same person is not eligible to do audit for the company. Next one. Then what about the limit? The limit is 20. So a person can do audit for maximum 20 companies. But this 20 company limits excludes 1-person company, dormant company, private company with less than 100 crores paid up capital. That means a person can do audit for unlimited OPCs. A person can do audit for unlimited dormant companies. A person can do audit for unlimited private companies whose paid up share capital does not exceed 100 crores or does not equal to 100 crores. That means this 20 will be covered with those companies which are public companies, which are private companies whose paid up capital is 100 crores or more. Next one. If any person is convicted by court, so during last 10 years, that too because of fraud, that person is disqualified to act like auditor. Next one. If a person is providing section 144 services to main company or its holding or subsidiary, that is, we need to take cash and we need to eliminate associate company. If any person is providing section 144 services to C, S, H, that person is also disqualified. So these are all the disqualifications which are applicable for the appointment of auditor. Next one, how to report the frauds identified by the auditor. So first of all, auditor need to classify the frauds into two categories: big frauds, small frauds. Big frauds means minimum 1 crore amount. Small frauds means less than 1 crore. Big frauds are first reported to management, later reported to central government. Small frauds are reported to management. That's it. So here time limits are provided, so you can read the time limits on your own. But the main classification is big fraud, small fraud. Big frauds will be reported initially to management, subsequently to CG. Small frauds only to the management. And this rule is applicable for statutory auditor, branch auditor, even for cost auditor also. Even for cost audit also this requirement is applicable. And for reporting frauds to the central government, you need to utilize form called as AUDIT, which is important for MCQ point of view. So for cost auditor, for secretarial auditor, so these rules are applicable mutatis and mutandis. And punishment for non-compliance. So whether he is CA or CMA or CS, the punishment will be 1 lakh in case of unlisted company, 5 lakhs in case of listed company. And what about section 144 services? So these are the services which are covered under section 144. If auditor is providing any of these services to whom? To main company, to subsidiary company, to holding company, then that person is ineligible to act like auditor. So these are all called as section 144 services. Next one, these services cannot be provided either directly or indirectly. Directly means he himself will provide these services to the main company, subsidiary company, holding company. Indirectly means on behalf of this person, some other person or some other entity will provide such services to main company, subsidiary company, holding company. Whatever the case it may be. If any person provides either directly or indirectly section 144 services to any of these three companies, that person is ineligible to act like auditor for that main company. Next one, CARO, last question. So CARO requires additional requirements, additional disclosure requirements in audit report. So in this case, only applicability of CARO is important. So entire CARO report is not important. Only applicability is important. For which companies auditor need to report under CARO? So he need to report under CARO for all the companies, including foreign companies. But from this requirement, certain companies are excluded. Then for which companies CARO requirement is not applicable? Banks, insurance companies, section 8 companies, one person company, small company, and private companies which satisfies all the 4 conditions. Then what are the 4 conditions that need to be satisfied by the private companies to escape from CARO requirements? First one, it should not be a holding or subsidiary of public company. First condition. Second one, its paid up capital plus reserves shall be less than or equal to 1 crore. Its borrowings from banks and financial institutions less than or equal to 1 crore. Its total revenue including discontinued operations also. So basically you will have India's also for continuing operations and for discontinuing operations. So after combining the revenue from both discontinued as well as continued operations, it shall be less than or equal to 10 crores. If all the 4 conditions got satisfied for the private company, then that private company is not required to follow CARO requirements. That means if any one condition got failed, that private company is required to follow CARO requirements. But for remaining companies, conditions are not applicable. For banks, insurance companies, section 8 companies, OPC, small company, these conditions are not applicable. These conditions are only applicable in case of private company. And all the conditions need to be satisfied in order to escape from CARO requirements. So by this we completed another portion. So in total we completed for how many marks? 30 marks. So minimum 15 and again minimum 15, total 30. Next one. So after break I will continue with laws and regulations related to anti-money laundering. It will cover around 5 marks. And after that I will cover inspection, inquiry, investigation, compromise, arrangement, prevention of operational mismanagement. So these 3 chapters will contribute 10 marks. So total 45. So what is our next chapter? Prevention of Money Laundering Act. So first one, what is meant by money laundering? So what is meant by money laundering? Say for example, there is a person. So he got rupees 10 crores by doing some criminal activities. So this fund will be now called as illegal fund. Now he want to show this illegal fund as a legal fund. The process of converting illegal fund into legal fund is called as money laundering. So now how this person will show illegal money as legal money? So first of all, he will make placement of that money. Next, he will make layering. And finally, he will make integration. So by following these 3 steps, he will convert illegally acquired money into legal money. So what is meant by placement, what is meant by layering, and what is meant by integration? Placement means introducing the illegal funds into financial system. Next one, layering means making more number of repetitive transactions so that it will become difficult to trace source of the fund. Next one, integration, taking back the own funds out of the financial system. Now at the time of placing the amount in financial system, it is illegal fund. But at the time of integration, that is at the time of taking the money back from the financial system, it becomes legal money. So this entire process will be called as money laundering. So for example, so this person got how much money from illegal way? 10 crores. Now he appointed 10 binamis and he transferred rupees 1 crore each to each binami. Now these 10 people made different transactions, and finally they gave back that money to the person who committed the crime in order to achieve the 10 crores. So the process of giving money to these 10 people will be called as placement. And the process of transactions which are made by these 10 people in order to hide the source of that money is called as layering. Now the process of getting back the funds from those people will be called as integration. So at the time of giving the money to those 10 people, it is illegal money. But at the time of taking refund, it becomes legal money. So this entire process will be called as money laundering. Now the point is, so who will be punished under money laundering? So any person who made this kind of transaction, any person who is a party to this transaction, any person who assisted the person making this transaction, whether knowingly or unknowingly, that person will be liable for offense under money laundering. And the person who is supporting these illegal funds, so these people are supporting these illegal funds and showing this illegal fund as legal fund, even those people are also liable for offense under money laundering. Then what will be the period of imprisonment for those people? Generally it will be 3 to 7 years, but if it is related to any narcotic drugs, then it will be 3 to 10 years. So that will be the punishment. Now, how government will trace all these anti-money laundering activities? So how government will trace this? For this purpose, there are certain kind of people, certain kind of authorities. First one, the person making such transaction. Second one, reporting entities. Third one, Financial Intelligence Unit of India. Next, again, Financial Intelligence Unit of other countries. Next one, Enforcement Director, that is ED. Next one, Adjudicating Authority. Next one, Special Court. And finally, Tribunal for going for appeals. So these are the authorities which got involved in order to trace money laundering transactions. So first, this person will make money laundering transaction. So how government will know about it? How government is going to punish that person? So for that purpose, government needs some information about that person. Then how that information will be passed to government? First, reporting entity will be there. So who can be the reporting entity? Banks or financial institutions. So banks or financial institutions will act like reporting entity. So if there is any suspicious transactions, if there is any transaction which exceed the monetary limits prescribed by the authority, then all these transactions will be reported by the reporting entities to the Financial Intelligence Unit of India. Now, what happens if that information is there outside India? Then in similar manner, the Financial Intelligence Unit of that country will collect the information, and if it is related to Indian person, it will forward that information to Indian Financial Intelligence Unit. Now, Financial Intelligence Unit got the information. So they only got the information, that's it. Now they will process the information. They will try to analyze the information. And if there is any doubt, they will forward that information to Enforcement Directorate, who will conduct the investigation. Now, this Enforcement Directorate can make search and he can make seizure. So he can make search as well as seizure. Now it will be confirmed by adjudicating authority. That means the highest authority is adjudicating authority, and Enforcement Directorate will act under the directions of adjudicating authority. Later, the case will be forwarded to special court, which is specially designed in order to deal with money laundering activities. Now in this special court, they will decide whether this person committed offense or not. If it is proved that this person committed offense, then the property which is seized by Enforcement Directorate with the permission of adjudicating authority, that property will be confiscated now. So what is the difference between seizure and confiscated? In case of seizure, it will be detained for temporary period. In case of confiscation, completely that property will now belongs to government. That person will not have any right over such property. So now because of special court order, the property will be confiscated. Now if this person want to go for appeal, he can go to appeal with a tribunal. If tribunal also says you are the culprit, then the property will be completely transferred to the government. So this is how money laundering transactions will be monitored in India. So first one, this person will do some transactions, and if there is any suspicious transaction, if there is any prescribed transaction which need to be reported by the reporting entity will forward that information to Financial Intelligence Unit. They will analyze the situation. They will analyze each and every transaction, and they will make a recommendation to the Enforcement Directorate to conduct investigation. Now after investigation, Enforcement Directorate take the permission of adjudicating authority to seize the properties. Later they will go to special court. In special court, if this person won the case, the seizure will be removed and property will be given back. If this person lost the case, then the property will be confiscated. Now on this decision, the aggrieved party can go to appeal with a tribunal. So this is how money laundering transaction will be monitored. It will be prosecuted in India. Next. Now let's see the theory content. So what are the objectives of PMLA? The main objective is to prevent money laundering activities if they are not yet happened. If they are already happened, to control the money laundering activities and to confiscate and to seize the property which was obtained under money laundering, and to deal with any issue that is connected with money laundering. So total, how many objectives are there? 5 objectives. First one, prevention of money laundering. Second one, controlling money laundering. Third one, confiscation of property. Fourth one, seizure of property. Fifth one, all related matters. Then what about the process of money laundering? This is very important question. So this question will be asked as a theory question. So first one, placement. That means illegal funds will be introduced into financial system. Next one, layering. So here multiple transaction will happen so that they will try to hide the source of the illegal fund. And last one, integration. So after that illegal fund becomes legal fund, it will be taken back by the person who gave that fund, which is called as integration. Now by following these 3 steps, a person can show illegal property, illegal money as legal property or legal money. So this process will be called as money laundering. Next one. Then what is the punishment for money laundering? So 3 to 7 years imprisonment, and fine is unlimited. Unlimited fine is applicable. Then if it is related to narcotic drugs, so it is 3 to 10 years. Instead of 7 years, we need to take 10 years. And one more important point, in case of imprisonment, there will be 2 categories of imprisonments. Simple imprisonment, rigorous imprisonment. Simple imprisonment means you will be provided with all the facilities. That's it. Rigorous imprisonment means you will be provided with all the facilities. At the same time, you are required to work for the jail. So this is called as rigorous imprisonment. So here 3 to 7 years or 3 to 10 years, that imprisonment is rigorous imprisonment. Next one. And what about the property which got acquired under money laundering? It will be finally confiscated. Next one. So ED, Enforcement Director. So he is responsible for conducting investigation based on the information given by Financial Intelligence Unit of India. Courts, which are nothing but special courts. So these are the courts which are designated as special courts in order to deal with PMLA matters. Next one, agreements. So our authorities can make agreement with culprits. Why? Because they will ask some extra information in order to trace some other people also. If these culprits help the authority in order to trace other persons, then the punishment will be reduced in case of these culprits. So in that kind, they can make an agreement in order to know about more number of money laundering cases. Second one, our authorities can make agreement with foreign authorities also. Why? Because the persons who committed money laundering, so those people are not staying in India, they are staying in abroad. Now in order to get the information of those people, we need to get the help of authorities of foreign government. So that's why we will make a reciprocal agreement with foreign authorities. That means for the people who belong to foreign country, we will provide the information. For our people, they will provide the information. Like that, they will make reciprocal agreement. Next one, tribunals. And what is the purpose of tribunal? Say for example, FIU, India, passes an order. Next one, Enforcement Directorate passes an order. Adjudicating Authority passes an order. Special Court passes an order. Now you are aggrieved because of these orders. Now you can go for appeal. So where to go for appeal? Tribunal. Then Financial Intelligence Unit of India. So what is the role of Financial Intelligence Unit of India? They will receive the information from reporting entities, that is banks and financial institutions, and they will analyze the information and they will know whether such information requires further investigation or not. If it requires further investigation, they will hand over the case to Enforcement Directorate and Adjudicating Authority. So Adjudicating Authority is the higher authority for Enforcement Directorate. So in order to seize any property, so he need to take the permission of Adjudicating Authority. Next one. Then what about the obligations of reporting entity? Very simple. It need to maintain the data of its clients. Every bank, every financial institution must maintain the data about their clients. And they need to maintain the data about the transactions made by the client. And for how many years they need to maintain this data? For 5 years. Next one. Suspicious transaction report. So if reporting entity sees any suspicious transactions in any client bank account, immediately, so they need to send suspicious transaction report to FIU of India. This is mandatory. So who need to communicate? Reporting entity. To whom it need to be communicated? FIU. When we need to communicate this information? In case of suspicious transaction in client's account. Next one. Then there are some transactions, even though they are not in suspicious nature, the reporting entity need to report those matters to the FIU of India. So what are those transactions? Any cash transaction for more than 10 lakhs. Now what people will do? First he will send 2 lakhs, later 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 2 lakhs. Like this he will send more than 10 lakhs. So that's why they need to check all the series of transaction below 10 lakhs per month. So in the month, if it exceeds 10 lakhs, it also need to be reported to FIU. So this is single transaction more than 10 lakhs. This is multiple transaction in a month, not in a year. Multiple transactions in a month exceeding 10 lakhs. Total value exceeding 10 lakhs, but individual value which is less than 10 lakhs. But if it is aggregated, the total value exceeds 10 lakhs. Next one. Now some smart people want to deal in foreign currency instead of rupees. Because if it is more than 10 lakhs rupees, definitely reporting entity will forward that information to FIU of India. So that's why they decided to trade in foreign exchange. Now we need to check. So foreign exchange. Say for example, $1 is equal to 100 rupees. So for 10 lakh rupees, how many dollars are required? 10,000. Now, if in your account, if there is any transaction of more than $10,000, then those reporting entities will report that matter to the FIU of India. Next one. Now, you are using some counterfeit currency, that is fake currency or damaged currency. In that situation also, they will report that matter to FIU of India. Next one. In case of suspicious transaction also, they will communicate that information to FIU of India. That means when reporting entity will communicate the matter to FIU of India, when a single transaction exceeds 10 lakhs. When multiple transactions, series of transactions in a month, each transaction is having less than 10 lakhs, but in aggregate they are exceeding 10 lakhs. So then it will be reported. Now you are doing in foreign currency. You are trading in foreign currency, but that foreign currency is equivalent to more than 10 lakhs. Then also it will be reported. Next, you are dealing with counterfeit currency. It will be reported. The transaction seems to be suspicious. It will be reported. So all these things will be reported by reporting entity to the Financial Intelligence Unit of India, and thereafter Enforcement Director for investigation purpose. Next one. And one more important point, all banks and financial institutions are required to follow KYC norms strictly. So what is meant by KYC norms? Know your customer. So previously, banks and financial institutions are going to collect KYC documents like Aadhaar card, PAN card, like that. But what happens if I'm having the Aadhaar card and PAN card of some other person? So I can easily create a bank account on his name, and I can do money laundering in his bank account, so that he will be punished. I will be protected. So that's why. So completely this manual process got eliminated now. Now every bank as well as financial institution need to maintain digital KYC. So what is meant by digital KYC? Your Aadhaar card, PAN card, everything will be collected through electronic mode by using your fingerprint. That means without you, it is not possible to open any bank account. Without your fingerprint, it is not possible. Now, in this situation, your data will be protected. So now, every bank or financial institution need to follow digital KYC. And after doing digital KYC, the information of client need to be forwarded to a registry called as Central KYC Registry. So once that information is forwarded to Central KYC Registry, a unique number will be allotted to you. So whenever if you want to open a bank account or any account with any financial institution, just provide that unique number. No need to provide your Aadhaar card, PAN card once again. And this should be happened within 10 days of digital KYC. Next one. So Central KYC registry process, just now we completed about it. So by this we completed about PMLA. So very small chapter. So you can get 5 marks question from this chapter or around 5 marks. It may be 7 marks or it may be of 4 marks also. Next one. Next one. So till now we completed how many marks? 35 marks. Total we completed minimum 35 marks. Now we are going to complete another 10 marks so that it will become 45. So in balance 10 marks we are going to start with inspection, inquiry, investigation. So what is the full name of this chapter? ఇది మాత్రం చెప్తారు. Inspection, inquiry, investigation. Then say what is the meaning of inspection, inquiry, investigation. So what is the definition of inspection, inquiry, investigation? ఏమైంది? ఇప్పటివరకు అరిచారు కదా. So inspection means asking for documents. They will ask for documents and information. Then what about inquiry? Inquiry means asking questions. They will ask questions to get information from you directly without any document. What is meant by investigation? They will do everything to know about the fact. So that is the meaning of investigation. So first one inspection, second one inquiry, third one investigation. Now inspection on what? Inspection on company, inquiry on company, investigation on company. Then who can order for inspection? It can be ordered either by ROC or by CG. So ROC can ask for inspection, CG can ask for inspection. Who can ask for inquiry? Either ROC or CG. Then who can order for investigation? Only CG. ROC is not allowed. So ROC or CG is allowed to order for inspection. ROC or CG is allowed to order for inquiry. But only CG is allowed to order for investigation. That means ROC role is confined only to inspection and inquiry, whereas CG role extends to inspection, inquiry and investigation. Now what is the process of inspection, inquiry, investigation? First one. So first every company will file documents and information to the ROC. At the time of incorporation they will provide the documents. After incorporation if there is any change they will provide the documents. For every financial year they will forward both financial statements as well as annual returns. So they will provide each and every document to the ROC. So after forwarding documents to the ROC, if ROC requires any further information, he will ask for further information. So now ROC will ask for further information. Now what is the duty of that company from which ROC is expecting further information? It need to provide the information. What happens if this company fails to provide the information? ROC will order for inspection, the first step. What happens if this company give the information but that information is inadequate? Then ROC can order for inspection. What happens if company provides information which is adequate but that information is unsatisfactory to the ROC? Then ROC will order for inspection. So when ROC will order for inspection, when any information is asked by the ROC and company fails to provide such information, or company provides such information which is inadequate, or company provides complete information but ROC, so he is unsatisfied with that information. In all these three cases, what ROC will do? So he will order for inspection. And what is meant by inspection? Asking for further documents. Now ROC will ask further documents from the company. Now what the company need to do? It need to provide further documents or information to the ROC. What happens if company provides further documents to the ROC but ROC feels so it is unsatisfactory, I need to go for inquiry? Then he can go for inquiry. Now second step is inquiry. That means he will directly go to the company's office and he will question each and every officer and employee, and each and every officer and employee need to support the ROC. Now in this case ROC will go for inquiry. Based on inspection report he will go for inquiry, but based on some other reports also he can go for inquiry. So any person made a complaint against the company with the ROC. They are complaining that the company is being run in fraudulent manner. Then ROC can go for inquiry directly. Without inspection also he can go for inquiry. But when such kind of order will be passed by the ROC? When any person filed a case against company with the ROC. So what kind of complaint? They need to say that the company is being operated in fraudulent manner. Next one. Now if shareholders files a complaint against the company, what is the complaint? Sir, we have issues, we have grievances, but company is not solving those grievances. It is not solving our issues. Like that, if any shareholder made any complaint with the ROC against the company, then also ROC will order for inquiry. So now the complaint is from shareholders. Now say when ROC will go for inspection? When further information required by the ROC is not provided, when it is provided but it is inadequate, or when it is provided which is adequate but it is not satisfactory. In all these three cases he can go for inspection. When ROC will go for inquiry? So based on inspection report or based on the complaint received from any person regarding fraudulent manner of doing business and from shareholders regarding unsolved grievances. So in these cases ROC will go for inquiry. Now finally ROC will provide inquiry report to the CG and he will suggest to CG whether to conduct investigation or not. So why ROC is not going further? Because ROC role is confined only to inspection and inquiry. So he can't go beyond that. So beyond that only one person can go. Who is that person? Central government. So investigation can be carried out by central government only. Now investigation. So investigation. Investigation is of three types. Investigation into the affairs of the company. That means whether company's affairs are being conducted in good manner or fraudulent manner, it will be verified. Investigation into the ownership of the company to trace who is original owner of the company. So this is especially in case of binary transactions. Next one. Investigation by SFIO. So the abbreviation of SFIO is very important for MCQs. Serious Fraud Investigation office. Okay, now how many types of investigations are there? Investigation into affairs of the company, investigation into ownership of the company, investigation by SFIO. Next one. So when CG will go for investigating into affairs of the company? In 4 cases, CG will go for investigation into affairs of the company. So what are those 4 cases? First one, based on ROC report. So after completion of inquiry, ROC will give a report to the central government. If he suggested central government to go for investigation, then central government may go for investigation. Next one, based on the request of shareholders of the company. So shareholders of the company passed a special resolution and they decided to move to the central government in order to ask for investigation. So upon the request of shareholders, CG may order for investigation. Not mandatory, it is optional only. Next one, in the interest of public, that is in public interest also, CG can order for investigation of affairs of the company. But in these 3 cases, it is not mandatory for CG to order for investigation. It is optional. If CG want to go for investigation, it can. If CG don't want to go for investigation, it can keep silent. Next one. But there is one more case, NCLT. So if shareholders approached NCLT and shareholders requested NCLT, now NCLT passes an order against the CG to conduct investigation. Now it becomes mandatory for the CG to conduct investigation. Now say in how many cases CG will go for investigation? In 4 cases. One is request from ROC, request from shareholders, request from public, and finally request from NCLT. In case of first 3 cases, it is not mandatory for the CG to conduct investigation. But in last case, it is mandatory for the CG to conduct investigation. Next one. Now the point is, when NCLT will pass an order against CG to conduct investigation. So shareholders need to approach NCLT. Shareholders need to approach NCLT and they need to prove in the NCLT that so the company is being run by the directors in order to defraud shareholders or to defraud creditors or to defraud any other person. If it is proved like that, then NCLT can order the CG to conduct investigation. Next one. So now the directors are found guilty of fraud. Now shareholders are getting doubts about the affairs of the company, because so if board of directors are good, shareholders will feel comfortable with the company affairs. If board of directors are bad, then shareholders will concern about the affairs of the company. Now some of the directors are guilty of fraud. Now shareholders are worrying about affairs of the company. How affairs of company is being conducted by those bad directors. They want to know about it. So that's why they requested NCLT to conduct investigation. Now NCLT can order CG for conducting investigation. And there is one more situation. So shareholders are asking for information, either for inspection or for taking copy or extract, but company is not providing any information. In that situation also, shareholders can ask NCLT to conduct investigation. So when shareholders can approach NCLT, if board of directors are running company in a fraudulent manner, or if any board of directors is guilty of any fraud, or if board of directors are not responding to the request of shareholders. In any of these 3 cases, shareholders can approach NCLT and they can request NCLT to ask central government to conduct investigation. Now if NCLT is satisfied, then NCLT will order CG to conduct investigation. Now CG must conduct investigation. Now how many shareholders need to approach NCLT? So here we need to classify the companies into 2 categories. Companies with share capital, companies without share capital. In case of companies with share capital, 100 members need to approach, 100 shareholders need to approach NCLT, or members with 1/10 of total voting power. Members with 1/10 of total voting power. That means even if single member is holding at least 1/10 of total voting power, he can approach NCLT. So here holding of 1/10 total voting power is important. So either 100 members or members having 1/10 of total voting power need to approach NCLT, then only NCLT will consider the request. Then what happens if the company is not having share capital? Then 1/5 of total members. 1/5 of total members need to approach NCLT. That's it. If share capital is there for that company, 100 members or members with 1/10 total voting power can approach NCLT. If company is not having share capital, 1/5 of the total members. So here voting power is irrelevant. Out of total members, I need to take 1/5 of total members. They need to request the NCLT. Then only NCLT will ask CG to conduct investigation. Now it will become mandatory for CG to go for investigation. Now, investigation into ownership of the company. In this case, CG will conduct this kind of investigation only with the order of NCLT. That means if ROC requested, if shareholders requested, in the interest of public, so central government is not going to investigate into the ownership of the company. Central government is so not interested to know who is the correct owner, who is the original owner of this company. But if NCLT asks central government to find out the truth, then central government must conduct investigation into the ownership of the company. Then when NCLT will do like that, same upon the request of shareholders. So same number of shareholders need to request NCLT. So previously, what are the reasons for approaching NCLT? Business is carried in fraudulent manner. Directors are guilty of fraud, or directors are not listening to the requests of the shareholders. Now what will be the reasons? To know who is the owner of the company. So that means to know who is influencing the company. To know who is financially interested in the company. That is in company's success and company's loss. Who is financially interested? Who is getting profit? Who is getting loss? In order to know about that person. Who is influencing the company's policies? In order to know about that information. Who is beneficial owner? In order to know about that information. So shareholders can file an application with NCLT. Now NCLT will order CG to conduct investigation into ownership of company. Now it is mandatory for CG to follow NCLT's order. Finally, investigation by SFIO. It is very simple concept. If the fraud is very severe in nature, then CG will hand out the investigation responsibility to a special team called as SFIO, which stands for Serious Fraud Investigation Office. Okay, now normal investigation office cannot carry this case. All the pending cases about that company need to be transferred to SFIO, and they will prepare interim reports until investigation is completed. Once investigation got completed, they will prepare final report. So all interim reports till completion of the investigation. After completion of investigation, the final report will be provided to the central government. Now central government, based on the report given by SFIO, it will proceed to take action against the company. Sir, what about this cost of investigation? So initially the cost of investigation will be paid by CG only, but later it will be reimbursed by the company. So there may be a separate question about cost of investigation. So ultimately the cost of investigation need to be borne by company only, but initially by CG. Later it need to be reimbursed by the company. Next one. So once again I am repeating. So what is meant by inspection? Asking for extra information or documents. What is meant by inquiry? Asking questions. What is meant by investigation? Doing anything in order to find out the truth. So who is having power to order for inspection? ROC or CG. Inquiry, ROC or CG. Investigation, CG. When ROC will ask for inspection? When ROC asks for any information and company provides nothing. Company provides inadequate information. Company provides unsatisfactory information. In all these cases, ROC will order for inspection completed. CG is also having similar power. Next one. What about inquiry? Based on the report of inspection, ROC can go for inquiry. Or based upon the complaint by any person about the fraudulent manner of doing business. Based on the complaint by shareholders about the unissued grievances. In all these unsolved grievances. In all these cases, ROC will order for inquiry. Similar kind of power is there for CG also. Next one. In case of investigation. So what are the types of investigation? Investigation into affairs of the company to know the truth whether the affairs of the company are being carried fraudulently or not. And investigation into ownership of the company to trace out the correct owner, original owner, and investigation by SFIO. So when CG will order for investigation into affairs of the company based on the report of ROC, based on the request of shareholders by passing special resolution, public interest, or upon criminal order. When it will go for investigation into ownership of the company only upon the request of NCLT. When it will go for SFIO, if the fraud is severe in nature, then it will go for SFIO. Next one. Now the main point is when NCLT will order for investigation into affairs of the company upon the request of shareholders. When NCLT will order for investigation into ownership of the company, when at the request of shareholders, then how many persons need to request? In case if share capital is available, 100 members or 1/10 of voting power holding members. If company is not having share capital, 1/5 of total members need to request. Then for investigating into affairs of the company, what they need to request? Our business is conducted fraudulently. Our directors are not so good, they are guilty of fraud. Our directors are not listening to us. Like that, they need to raise the complaint. For investigating into ownership of the company, to trace who is financially interested in success and failure of the company, who is beneficial owner, who is materially influencing the policies of the company. In order to know about those people, they will ask the NCLT. So by this we completed inspection, inquiry, investigation. Next one. So let's go to last chapter, that is prevention, operation, mismanagement. Okay, first we will complete operation and mismanagement. So the chapter name is prevention of operation and mismanagement. So there are two concepts here. One is prevention of operation, other one is prevention of mismanagement. What is meant by operation? So in a company, because of the decisions made by the majority shareholders, minority shareholders need to obey it. Say for example, so I created a company. In that company, I am holding 80% shares. Balance shares are held by public, 20% shares. So now the point is, so for passing ordinary resolution, I can pass easily. For passing special resolution, I can pass easily. So no need to take the consent of balance shareholders. Now these balance shareholders will be called as minority shareholders. Now minority shareholders are those people will be ignored while taking decisions. Now majority shareholders are oppressing the interest of minority shareholders. See, if there is any situation like that, then this oppression need to be prevented. So how it will be prevented? It will be prevented by NCLT. So previously, in case of inspection, inquiry, investigation, the entire things will be done by either ROC or central government. But in case of operation and mismanagement, to prevent operation and mismanagement, so NCLT is given with the responsibility. So who will prevent the operation of majority shareholders or minority shareholders? NCLT. Now what is meant by mismanagement? Now I appointed 10 directors in order to run my company. Now those 10 directors failed to run the company in successful manner. Now this is called as mismanagement. Now this mismanagement need to be prevented. Then how to prevent this mismanagement? With the help of NCLT. Now the point is, who will go for NCLT? So who will approach NCLT? So NCLT can be approached by shareholders or NCLT can be approached by central government. So shareholders can approach NCLT to prevent operation and mismanagement. Central government can approach NCLT to prevent operation and mismanagement. Okay, when shareholders will approach NCLT for preventing operation and mismanagement? First one, operation case. Second one, mismanagement case. So operation. Now the company is going to be carried in such a way that it is affecting that shareholder. That shareholder means the person filing the case. Next one, other shareholders. Other shareholders means other than those shareholders who are filing the case, or entire company or entire public. So now the company is being carried in such a way that it is affecting the shareholder who is filing this case, or it is affecting other shareholders, or it is affecting entire company, or it is affecting entire public. Then shareholders can go for NCLT's case. Next one, mismanagement. What is meant by mismanagement? Now there is a change in management. There is a change in management. Now because of this change in management, so shareholders are affected, creditors are affected, debenture holders are affected. So all these people are affected because of change in management. That means the new management is not so good. That means there is mismanagement with the new management. So that's why shareholders can approach NCLT in order to prevent operation as well as mismanagement. Now say, who will approach NCLT? Shareholders. When they will approach NCLT? In case of operation, in case of mismanagement. So when it is called as operation, when that shareholder or other shareholder or company or public are affected because of the operation, then they can approach NCLT. When they can approach for mismanagement, because of the new management, if shareholders or creditors or debenture holders are affecting, then shareholders can approach NCLT. Then when CG will approach NCLT? So CG will approach NCLT if there is any fraudulent practice by the company director. So company is doing fraud. It is doing fraud against members, against creditors, against debenture holders. So when there is any fraudulent activities by the companies on those people, CG can directly make an appeal to NCLT. Next one, second one. Now the management who is carrying the business, so they are not following the sound business principles. So what is meant by sound business principles? Good principles. So they are promoting their business by doing some bad practices, by following some bad principles. Then CG can appeal to NCLT. Now management is affecting not only that company, they are affecting the entire industry. So for example, managers of Jio company, so increases the price from 200 rupees to 600 rupees. Now because of this, Airtel will increase the price, BSNL will increase the price. That means because of the mismanagement of one company, entire industry is affecting. In that situation also, CG can approach NCLT. So entire industry is being affected here. Next one and last one. Now if any director is guilty of any fraud, so if any director is guilty of any fraud, then also CG can approach NCLT. So all these cases are related to mismanagement. That means in case of operation, only shareholders need to go to NCLT. In case of mismanagement, either shareholder or central government can go to NCLT. Now the point is, how many shareholders need to approach NCLT? Okay, we already know about the reason. Then how many shareholders need to approach NCLT? So here also we need to check 2 points. Whether the company is having share capital or not. If company is having share capital, then what is the rule? 100 members or 1/10 of total members or 1/10 of total issued capital. So 100 members or members, total members, in total members 1/10 of total members, or members having 1/10 of total issued capital. Those people need to approach NCLT if company is having share capital. If company does not have share capital, 1/5 of total members need to approach NCLT. Next one. So by this we completed about operation and mismanagement case. So thereafter NCLT will take action, and the action which is taken by the NCLT is not so important for exams. Next one, class action suit. Last concept of this chapter is class action suit. So what is meant by class action suit? This means members can file a suit against the company. Next one, depositors. Depositors means the person who made deposit with the company. So depositors can file a complaint against the company. If single member filed a case against the company, it is not class action suit. If single depositor files a case against the company, it is not class action suit. In order to call it as class action suit, certain number of members, certain number of depositors need to go combinedly, jointly to the court in order to file the suit. So then it will be called as class action suit. Then how many members, how many depositors need to approach the court? So members, depositors. So in case of members, the rule is 100 members or 5% of total members or 5% of total voting power. If it is unlisted company, it will be just 2%. Next one. In case of members having share capital, this is the rule. In case of members without share capital, what is the rule? 5% of total members. That's it. They need to approach the court in order to file a class action suit. Then what about depositors? In case of depositors, whether the company is having share capital or not, it doesn't matter. The simple rule is 100 depositors or 5% of total depositors need to approach the court, then only it will be called as class action suit. So when nothing is set, that means whichever is lower, not whichever is higher. So by this we completed all the important concepts in prevention of operation and mismanagement. So only one chapter is pending now. Okay, let's see the theory content of the two chapters which got completed just now. First one, inspection, inquiry, investigation. So first, what company will do? Company will file information with the ROC. Now based on that information, what ROC will do? He will ask for some information, some explanation, some documents. Now, what happens if company fails to provide such information? What happens when company provides such information which is inadequate? What happens when company provides full information but which is unsatisfactory? So in all these cases, immediately ROC will ask for inspection. Inspection means again he will ask for further information, further explanation, further documents. Next one. And what about inquiry? When he will call for inquiry? Based on the inspection report, he will call for inquiry. So based on the inspection report, he will call for inquiry. Or if any person filed a case against the company, that company is being carried on fraudulent or unlawful purpose, then also he will order for inquiry without any inspection. When investor filed a case against the company that their grievances are not addressed by the company, then also ROC will order for inquiry. Next one. And inspection and inquiry can also be made by central government. Next one. And one more important point, while doing inspection or inquiry by ROC or by central government, the officers of the company, whether they are present employees and officers or past employees or officers, they need to support the ROC and CG. That means if ROC and CG ask for any information, past employees and officers, current employees and officers, all those people are liable to provide such information whichever asked by the CG or ROC under inspection or inquiry. Next one. Investigation. How many categories of investigations are there? Investigation into affairs of the company, investigation by SFIO, so investigation by CG into the ownership of company. Three types of investigations. So first one, investigation into affairs of the company. So when they will go for investigation into affairs of the company? So based on the report of ROC, based on the request of shareholders, that is special resolution, based on public interest. So CG may go for investigation. It is not mandatory. CG may go for investigation, but it will become mandatory for CG when any court or tribunal orders CG to conduct investigation, it will become mandatory. Now, when CG or NCLT will pass such kind of order against CG. So now, for that purpose, the application need to be made by how many shareholders? It is not 100. First, we need to check whether the company is having share capital or not. If company is having share capital, then 100 members or members having at least 1/10 of total voting power need to request NCLT. If company does not have share capital, then 1/5 of total members need to make request to the NCLT. And what may be the reason for conducting investigation into affairs of the company? So, the company is conducted to defraud creditors, members or any other person. That means the business is carried in fraudulent manner or unlawful manner. Next one. And the persons who are there in management, so they are guilty of fraud. And they are not providing information which is asked by the shareholders. In any of these three cases, these many number of shareholders need to approach NCLT, and NCLT may order CG to pass for investigation order. Now for CG it will become mandatory. Next one. Investigation into ownership of the company. So in this case also, shareholders need to approach NCLT. NCLT will pass order against CG, then CG will conduct investigation. But here what is the main objective? To know who is financially interested in success and failure of the entity. Next one. To know who is materially influencing the policies of the company. To know who is having beneficial ownership in the shares of the company. So what is meant by beneficial ownership? Say for example, Mr. X gave 10 lakhs to Mr. Y. Mr. Y invested 10 lakhs in the company, Reliance Industries Limited. Now the shares are listed on the name of Mr. Y. But who is taking benefits here means Mr. X. Here Mr. Y is called as registered owner. Mr. X is called as beneficial owner. So this person can easily trace it because this person name is provided in register of members. What about this person? So by investigation only we can found this kind of people. So that's why investigation is necessary. So what is the objective of investigation into ownership of the company? To know who is financially interested, to know who is materially influencing, to know who is having beneficial interest. Next one. So inspector powers. So you can read this question on your own. Next one. Inspection report. Yes, inspection report will be given to the central government and central government will take action based on such inspection report. But ultimately, the cost of investigation or inspection or inquiry need to be borne by company. Initially, it will be taken care by CG or ROC. Later, it need to be reimbursed by the company. Next one, compromises, arrangements and amalgamations. Okay, one more chapter is pending. Last chapter, that is prevention of operation mismanagement. Okay, what is meant by majority rule? So majority shareholders can easily pass or majority shareholders can easily pass yes sir. That means what about the decision of minority shareholders? It is very irrelevant. Now majority shareholders for their own benefit can oppress minority shareholders. Now in order to prevent such kind of oppression, shareholders, minority shareholders can approach tribunal. So here tribunal will solve the problem, not CG. Next one. So what is meant by prevention of oppression and prevention of mismanagement. Oppression means majority shareholders will try to oppress minority shareholders. So this need to be prevented. So for this purpose, who need to file the suit? Shareholders. With whom? NCLT. Prevention of mismanagement. Mismanagement means carrying the business in wrong manner. So who need to file the case here? Either shareholder or central government. With whom? NCLT. Then what about the right to apply for tribunal? So who can make application? Shareholders. So how many shareholders need to make application? If company is having share capital, 100 members, 1/10 of total members, or members having at least 1/10 of total issued share capital. Next one. If company does not have any share capital, 1/5 of total number of members need to approach NCLT. Next one. Then what may be the reason for them to go for NCLT? So it is against to him, or it is against to any other member, or it is against to the entire company, or it is against to the entire public. In that situation, that shareholder can approach NCLT. So this is oppression case. Then what about mismanagement case? Now there is a change in management. That means board of directors got changed. Manager got changed. Now in case of change of management, now because of the new management, if interest of members is affected, then shareholders can go for prevention of mismanagement with the tribunal. Next one. Even CG can also approach NCLT. When CG will approach NCLT? So directors are guilty of fraud. CG will go for prevention of mismanagement. Now business is not followed based on sound business principles. CG will approach NCLT. Now it is causing injury to the entire industry. CG will go for prevention of mismanagement. And business is carried to defraud creditors, members, or any other person. Then also CG will approach NCLT for prevention of mismanagement. And finally, class action. So what is meant by class action? So action by group of people. Here group of people means two categories of people will be covered. Who are those two categories of people? One is members, other one is depositors. So how many members need to approach? So 100 or 5% of total members or 5% of voting power. If company is having share capital. If company does not have share capital, 1/5 of total number of such people. In case of depositors, the limits are not given here. In case of depositors, what is the limit? 100 depositors or 1/5 of total depositors. So now the question is, why they are going for class action suit? So first one, now company is going to do some ultra virus activities. So that is, company want to do something beyond MOA. Company want to do something beyond AOA. Now if the act is already done, that act is invalid and company is not liable. But what happens if the act is not yet done? Then members or depositors can go for class action suit and they can stop company by bringing an injunction order, that is stay order. That means they will stop the company from doing ultra virus to MOA, from doing ultra virus to AOA. So first one, to stop the company from committing an act which is ultra virus to Articles of Association and Memorandum of Association. Next one, breach of any provision of the same. That means articles and memorandum contain some provisions. Now you need to follow those provisions. Now company is not following the provisions which are given in MOA, which are given in AOA. Now if it is not yet happened, if company is going to break the provisions of MOA and AOA, by class action suit they can stop company from doing so. Next one. So now a resolution was passed in order to alter memorandum and articles. But this resolution is passed by suppressing some material facts or by giving some false particulars. That means in order to update MOA and AOA, what is required? SR is required. For SR, you need to conduct general meeting. In general meeting, board of directors give false information. In general meeting, board of directors suppresses material information. Now because of this fact, shareholders does not know about the reality. So they passed a resolution to update MOA and AOA. Later shareholders know about this and they want to stop this resolution. Is it possible? Yes, possible. For that purpose, they need to go for class action suit. Next one. Now, based on this resolution, that is a resolution which alters MOA and AOA. Now, directors are going to act on behalf of the company. Now, in order to stop them, so these people can go for class action suit. Next one. Now, company is going to do some activities which are against to Companies Act or which are against to some other law. Then these members can stop the company from doing so by bringing class action suit. Next one. Now members passed a resolution, but company is not following that resolution. So now members can go for class action suit and make the company to follow the resolution which is passed by the members. Next one. So if members are suffering with any loss because of the actions taken by the directors, then members can go for class action suit and they can ask for compensation. Then who need to pay compensation? Company or directors. What about auditor? If he is also involved in the fraud, he is also required to compensate the members. And what about the experts or consultants or every other person who got involved in the fraud? Even those people are also responsible. So now see, when a class action suit can be initiated by members or depositors. First one, company is doing something which is against to MOA, AOA. They can stop the company. Company is not following MOA, AOA. They can stop the company. Next one, company passed a resolution by giving some false particulars or incomplete particulars and they updated MOA and AOA with the help of resolution from the shareholders. Now, shareholders can make this resolution as invalid. Shareholders can stop the directors from acting based on this resolution by using class action suit. Now company want to go beyond Companies Act or any other act, then shareholders can stop the company. Now shareholders pass a resolution but company is not following it. Now they can make the company to follow the resolution by going to class action suit. And they can ask for compensation from company, directors, auditors, advisors, experts, consultants who are involved in that fraudulent activity. Next one. So remaining points you can read on your own. So by this we completed how many marks? Okay, there is one more chapter which is left here. But before that chapter, I will try to give introduction to SEBI regulations. So this is also very important chapter. You will get around 7 to 10 marks. So I will complete only one part of SEBI regulations. Actually, there are three parts in SEBI regulations. First part is public issue of securities. Second part is prevention of insider trading. Third part is takeover. So in this class, I am going to complete one part which is about public issue of securities. So just listen the points. It will be sufficient. First one. So in question number 1, there are some points. These points will prevent the company from going to public issue of securities. So if company falls in any of these conditions, any of this situation, then company cannot go for public issue of securities. That means either for IPO or for FPO. First one. Now, issuer means company or companies promoters or companies directors or companies shareholders. If those people are debarred from assessing the stock market, then company cannot go for public issue of securities. So what is meant by debarred? Say for example, so while writing exam, you did some copying activities and squad so debarred you for 3 attempts. That means for 3 attempts you are not eligible for appear for exams. Similarly, if company or its promoters or its directors or its shareholders, if they got debarred by the SEBI from assessing the stock market, then that company is not allowed to go for public issue. So first reason is debarred. Next, second reason. Now, in order to go for public issue, the company need to list the securities in any recognized stock exchange, either in NSE or BSE or some other stock exchange. If company fails to get its securities listed in any recognized stock exchange, it is not allowed to go for public issue of securities. So without listing, it is not possible to go for public issue. Previously, we can take shares directly from the company. There is no problem. But in today's world, in order to take shares from the company, the only option is listing. We need to take the shares through stock exchange only. We need to participate either in the IPO or FPO through stock market only. So for that purpose, you need to list the securities which is being offered to the public in stock exchange. If that listing got failed, you are not eligible to go for public issue of securities. So what is the first reason? Debarred. What is the second reason? Failed to get its securities listed in any recognized stock exchange. Next one, dematerialization. Yes, in today's world, so if company want to issue any shares or securities to the public, then it should be issued in dematerialized format only. So physical shares or physical securities issued to the public is not allowed. If you want to issue physical shares or securities, you can make private placement. But for public placement, listing is mandatory. For public placement, physical shares not allowed. Only demat shares are allowed. So dematerialization is mandatory. Next one. Now, while going for dematerialization, you need to convert the existing holding of promoters into dematerialized form. One more requirement. So now let's see the conclusion of point number 3 and point number 6. Now there is a company. In this company, there are promoters, non-promoters. Promoters are having physical securities, non-promoters are having physical securities. Now company want to issue fresh securities. In which form they need to issue fresh securities? Only in demat form. Only in demat form. Physical form not allowed. Next one. So at the time of issue of fresh securities in demat form, the promoter's holding which is in physical form must be converted into demat form. What about the non-promoters? They are not required to convert the physical securities into demat form. That means total there are 3 securities here. 2 existing securities, 1 new security. So first one, new security should be in demat form. Existing security with promoters should be in demat form. Existing security with non-promoters, it may be in any form. So that is the final conclusion for point number 3 and point number 6. Next one. If company is having any partly paid up shares, the company need to take the money from partly paid shareholders. They cannot go for public issue now without making these partly paid shares as fully paid shares. Next one, making firm arrangements. What is meant by making firm arrangements? Say for example, a company is going to start a project with 100 crores. So what is the cost of the project? 100 crores. So in this 100 crores, at least 75 crores must be arranged by the company, either by itself or by taking some loans from the banks. Then they can take only maximum 25% from the public. That means if my requirement is 100 crores, I cannot raise 100 crores from the public. I need to make my own arrangement up to 75 crores. The balance amount can be raised from the public. So making own arrangements for this 75% will be called as firm arrangement. So this is mandatory. Next one. And for what purpose I need to utilize this 25% amount? Only for the said project. Can I utilize for any other purpose? No. Then what about administrative expenses? In order to carry that project, I need to incur some administrative expenses. Then what about the administrative expenses? Okay. For administrative expenses, you can spend some amount. So some amount means how much amount? Not exceeding 25%. That means here 25% means out of 100 crores, 25 crores. In 25 crores, 25% means 6.75 crores can be utilized for administrative expenses, but the balance amount must be utilized for the said project only. Next one. Now, if company or promoter or director is declared as willful defaulter, Willful defaulter means Vijay Mallya. Vijay Mallya means willful defaulter. Because he is having enough money to repay the loan, but he is not interested in paying the loan. He is asking for interest favor. So that's why SBI can classify Vijay Mallya as willful defaulter. If company or promoter or director is willful defaulter, then that company cannot go for public issue. So these are the 8 conditions. So if you got covered in any of these 8 conditions, then you are not allowed to go for public issue of securities. What is the first one? Company, promoters, directors, shareholders. If they are debarred from accessing stock markets, company is not allowed to make public offer. Similarly, if company, promoters, directors, if they are declared as willful defaulters, company is not eligible to go for public issue. So you can relate point number 1 and point number 8. Next one, point number 2. So in today's world, we need to issue securities to the public only in dematerialized form. That means we need to list our securities which are going to be issued to the public with any recognized stock exchange. If company fails to get the securities listed, then company is not allowed to make public offer. And you can link point number 3 and point number 6. So the fresh offer of securities must be in demat form. The existing holding of promoters need to be converted into demat form. But what about the existing holding of the non-promoters? It can be maintained in same form. And in case of partly paid shares, I need to cancel partly paid shares, and or I need to convert partly paid shares into fully paid shares. Then only I will be eligible to go for public issue of securities. And what about firm arrangements? If my requirement is 100 crores, I need to arrange 75% of the 100 crores, that is 75 crores. I can take only 25 crores from the public. Out of this 25 crores, I can utilize 25% for administrative expenses purpose. Next one, other conditions. Other conditions means now I want to participate in IPO. So what is the time limit that is provided to the public to participate in IPO? It will be minimum 3 days, maximum 10 days. So company may decide whether it is 3 days, 4 days, 5 days, 10 days, company will decide. Generally, every company will follow 3 or 4 days. But according to law, they can follow minimum 3 days, maximum 10 days. And what about minimum subscription requirement? If it is according to Companies Act, the amount stated in the prospectus as minimum subscription, that amount need to be collected. If it is as per SEBI regulations, 90% of the issue value. And what about minimum application money? According to Companies Act, 5% of the face value. According to SEBI regulations, 25% of the issue value. So we need to comply with both Companies Act as well as SEBI regulations. So in order to go further, the company must receive minimum subscription. In order to go further, the company must receive minimum application money also. So this is SEBI regulation concept. According to SEBI, minimum subscription is 90% of issue size and minimum application money is 25% of issue price. So is there any doubt in question number 1? Okay. Let's see question number 2. Now here we are going to cover some questions and some conditions. So in those conditions, if company fails to satisfy, then also company can go for public issue. If company satisfies all the conditions, then also company can go for public issue. But there is a slight difference. So I will explain the difference at later point of time. So first of all, I will say the conditions. First condition, it is about net tangible assets. What is meant by tangible asset? Okay, you already know about it. What about net tangible assets? In case of any depreciation, you need to deduct the depreciation also. Then the amount will become net tangible asset. Now, in each of the last 3 years, so it is not average. It is not average. We need to take each of the last 3 financial years. In each of the last 3 financial years, the company's net tangible assets shall be at least 3 crores. That means this is the 2024-25 financial year. So 3 financial years, last 3 financial years means 2023-24, 22-23, 21-22. Now in 23-24, the net tangible assets must be at least 3 crores. In 22-23, at least 3 crores. In 21-22, at least 3 crores. So I need to check each year individually. Don't take any average here. You need to check each and every year. So in each and every year, the minimum net tangible asset should be 3 crores. Next one. Now, out of all net tangible assets, if 50% of the net tangible assets is in monetary assets means which can be easily converted into cash. If at least 50% of the net tangible assets is in monetary assets form, then the company need to give a declaration. What the declaration? If you are having that much of monetary assets, why you are taking money from the public? Sir, I am having money, but that money will be utilized for firm arrangements because of my requirement, I need to make firm arrangement of 75%. For that 75% only I am holding that money. Like that you need to give a declaration. So what is the point number 1? Minimum net tangible assets in each of the last 3 financial years shall not fall below 3 crores. So out of net tangible assets, if 50% of net tangible assets is in the form of monetary assets, then I need to give a declaration. What kind of declaration? This amount is going to be utilized for making firm arrangements. Next one. So IPO will be of 2 categories. One is issuing of fresh shares, other one is issuing of existing shares. So if company created fresh shares and if company sold the fresh shares, then who will take the money? Company will take the money. Then what about the sale of existing shares? Promoters. So promoter will sell the bulk of their shares through IPO. Now who will get the money? Promoters will get the money. In case of fresh shares, who will get the money? Company. In case of existing shares, who will get the money? Selling shareholder, that is promoter. Now the point is, so this 50% of net tangible assets in monetary assets condition, this point is not applicable for sale of existing shares. This point is applicable only for sale of fresh shares. So sale of existing shares is otherwise known as OFS, offer for sale. So for offer for sale, so 50% criteria is not applicable. That is, minimum net tangible assets criteria is applicable. So in case of IPO of fresh shares, in case of IPO of existing shares, minimum net tangible assets criteria is applicable. But what about 50% monetary asset declaration? It is applicable in case of fresh shares. It is not applicable in case of existing shares. That is OFS. So this is all about point number 1. So point number 1 contains 3 points. What are those 3 points? Minimum net tangible assets of at least 3 crores in each of the last 3 financial years. Next one. If net tangible assets, 50% of net tangible assets is in monetary assets form, you need to give a declaration. This amount will be utilized for firm commitment. But this kind of declaration is not required in case of OFS. Next one. Now, I need to take average. Average pre-tax operating profit. What is meant by pre-tax operating profit? EBIT only. Earnings before interest and tax. Operating profit means EBIT. Next, pre-tax means before tax only. So it is EBIT. Earnings before interest as well as tax. Now, I need to take last 5 years data. So 1, 2, 3, 4, 5. I need to take last 5 years data. Among last 5 years, I need to select 3 years profits. And which profits I need to select? So we need to select most profitable year's profit. So for example, 1 year I got a profit of 15 crores. Next 20 crores. Lost 30 crores. Lost 10 crores. And profit 5 crores. So among last 5 years, what are the most profitable years? Top 3 most profitable years. 20, 15, 5. So what is the average of those 3 years profit? So 20 plus 15 plus 5 divided by 3. That is 40 divided by 3. Okay, it is around 13.33%. So 13.33 crores. Now the point is the minimum average EBIT for the 3 most profitable years. That to average, not each year. Now we need to take average of 3 profitable years, and that average shall be at least 15 crores. In this case, this is only 13.33 crores. That means the condition got failed. Next one. Now net worth. So in net worth case also, so I am required to take each year net worth, not average net worth. So for the last 3 years, for each of the last 3 financial years, my company shall have a minimum net worth of 1 crore. Next one, change of name. Why company will change the name? In case of change of objects, company will definitely change the name. Okay, that means if there is change in name of the company, that means there is change in objects of the company also. Now, out of total revenue, at least 50% of the revenue should come from new business. Then only it should be viable. So then only this condition will be fulfilled. So total, how many conditions? 4 conditions. First condition, to net tangible assets, at least 3 crores for each of the 3 preceding financial years. Immediately go to C point. Net worth, at least 1 crore for each of the 3 preceding financial years. In these 2 cases, don't take average. In one case, it is net tangible asset. In other case, it is net worth. In case of net tangible assets, minimum 3 crores. In case of net worth, minimum 1 crore. Next one. So what about EBIT? So for that purpose, I need to take last 5 years profits and losses. I need to take most profitable years. How many years? 3 years. I need to take the average of those 3 years. So that average shall not fall below 15 crores. That is third condition. Next one. If there is any change in name or object, now what will happen? Out of total revenue, at least 50% revenue should come from new business. So if these conditions are satisfied, you can go for IPO or FPO. If these conditions got failed, then also you can go for IPO or FPO. Then what is the difference? The difference is reservation. The difference is reservation. So here, whenever we want to go for IPO or FPO, we need to give reservations to 3 categories of people. One is retail individual investors. Second one is non-institutional investors. Third one is qualified institutional buyers. So who is retail individual investor? A small individual. Next one. What about NII, non-institutional investor? So he is an individual but high net worth individual. That means the small investor can invest up to 2 lakhs only in IPO or FPO, but the large investor can make investment more than 2 lakhs also. So this is the person having small net worth, small revenue. This is the person having high net worth, high revenue. So for these people, one reservation. For these people, other reservation need to be provided. Okay, but both are individuals only. But what happens if investor is an entity? Then it will be called as qualified institutional buyer. Okay, now there are 3 categories. So individuals, 2 categories. One is RII, other one is NII. And in case of institution, 1 category, that is qualified institutional buyers. Then what about the reservation? So first one, if you satisfy all the conditions that are mentioned in question number 2, I'm saying about question number 2 conditions. So if you satisfy all the conditions in question number 2, you can go for public issue, and at that time the reservation can be minimum is greater than or equal to 35% for retail individual investors. Minimum portion for non-institutional investors is 15%. That means both these people will take how much percentage? Minimum 50%. What about qualified institutional buyers? Balance. Balance means less than 50%, not equal to. Okay, you can take equal to also. Less than or equal to 50%. And out of this 50%, 5% should be given to mutual funds. So in this case, so the highest portion is given to the individuals, but not to the entities. Because if all the conditions mentioned in question number 2 are satisfied, then that company is less risky. When the company is less risky, the more portion can be given to the public instead of institutions. Now the point is, what happens if any of the condition got failed? If any of the condition got failed, then you must offer minimum 75% to qualified institutional buyers. So it is greater than or equal to 75%. Then what about balance? So for retail individuals, maximum 10%. Then for non-institutional investors, maximum 15%. So previously, what is the reservation of retail individual investor? When there is no risk, minimum 35. Minimum 35. But if there is any risk, maximum 10. In case of NII, non-institutional investors, if there is no risk, minimum 15. If there is risk, maximum 15. In case of qualified institutional buyers, if there is no risk, maximum 50 only. But if there is any risk, he need to be allotted with minimum 75%. That means if conditions are satisfied, it is not risky. If any condition got failed, it is risky. So in case of less risk cases, you need to follow this kind of reservation. In case of more risk cases, you need to follow this reservation. Next one. And there is one more concept called as pricing. So how securities will be priced in IPO or FPO? Companies are allowed to follow two approaches. One is fixed price method, other one is book built method. So what is meant by fixed price method? They will directly fix the price of the security. Okay, I am offering my securities for 100 rupees. Like that they will offer. But there is a risky in that step. What is that risk? If the demand is very less, say for example, public are expecting for only 20 rupees, but you are asking 100 rupees. So minimum subscription will not be met. So ultimately it is going to create loss for the company. Next one. So I fix 100 rupees, but public are expecting for 1000 rupees. Then also it is a loss for the company. Because when the opportunity is there to get 1000 rupees, company is able to get only 100 rupees. So it is a loss to the company. So in case of fixed price method, that is the risk to the company. If the demand and supply is not correctly estimated, then company is going to lose the money. So that's why alternatively, another pricing model is also introduced. What is that pricing model? Book built method. What is meant by book built method? In case of book built method, the securities are offered with a price range. So for example, they will say 80 to 120. Now, minimum amount is 80, maximum amount is 120. So public can subscribe for the securities in between 80 and 120 rupees. Now based on the demand levels of the subscribers, so they will freeze one price. Say for example, if they freeze 110 rupees, now what will happen? Any person who made a quote for less than 110, those application will be rejected. Any person who quoted exactly for 110, their application will be accepted, shares will be allotted. Any person who quoted more than 110, that is 120, so accepted and extra 10 rupees will be refunded. So this is most advantageous method called as book built method. Now the another point is, if the conditions mentioned in the question number 2 are satisfied, if all the conditions are satisfied, then company can go either for fixed price method or for book built method. If company fails to satisfy any of the conditions mentioned in the question number 2, then company must go for book built method only. They cannot go for fixed price method. Next one. Now, if company went for book built method, by satisfying all the conditions, the limits are like this. If company followed book built method without satisfying the conditions of question number 2, the company need to follow this category. Now what happens if company followed fixed price method? If company follow fixed price method, minimum 30% should be given to retail individual investors. And what about balance? It will be subscribed by NII. If there is any unsubscribed portion, it will be subscribed by qualified institutional buyers. That means RII can take 100%. Next one, if there is any unsubscribed portion, NII will take. Even though if there is any unsubscribed portion, QIB will take it. So this is in case of fixed price method. Now say, when all the conditions in the question number 2 are satisfied, what will happen? Company can go for fixed price method. Company can go for book built method. If it went for fixed price method, for RII, the minimum reservation will be 30%. Unsubscribed portion will be first given to NII. Thereafter, it will be given to qualified institutional buyers. If all conditions are satisfied, but company went for book built method. Now, what is the reservation? So, reservation is minimum 35% for RII, minimum 15 for NII, and balance 50 for QIB. Next one. Now company fails to satisfy those conditions. Now book build method is mandatory. Now company need to give at least 75% to QIB and maximum 10% to RII and 15% to NII. So you need to prepare a notes for this so that it will become very easy for you. Next one. So balance points 3, 4, 5, 6, 7. So now company want to issue equity shares. Company want to issue convertible debt instruments. What is meant by convertible debt instruments? At the time of due date, without repaying the capital, they will give shares. So then it will be called as convertible securities. Now, is it possible for a company to issue convertible debt instrument first without issuing equity shares in the public offer? Yes. There is no such requirement. So a company must give equity shares first. Thereafter only it can give convertible debt instruments. Like that, there is no rule at all. That means a company can issue convertible debt instruments even though it has not issued equity shares previously. That is the conclusion of point number 3. Next one, conclusion of point number 4. So what about minimum subscription in case of companies? That too as per SEBI regulations, 90% of issue value. At the same time, minimum number of allottees must be 1000. Allottee means the person to whom the shares will be allotted. That means the public only. So minimum number of people who applied for shares or other securities must be minimum 1000. If number of allottees are less than 1000, then what will happen? Then they can't proceed with public offer. They need to stop the public offer. So minimum number of allottees should be 1000. Next one. Now I already issued convertible securities without issuing equity shares. Now that convertible securities are due for conversion. So when they are due for conversion, I need to convert those securities into shares. At that time, I can't go for public issue of securities, public issue of shares, because already one thing is pending. I need to convert the existing securities into equity shares. Again, I can't go for equity shares. Next one. If the issue size is 100 crores, more than 100 crores, then a bank or PFI will be appointed in order to monitor the utilization of the funds. Say for example, I raise it 200 crores. Now SBI is appointed as monitoring agency. Now SBI will monitor the utilization of funds. So till 95% of the fund is utilized, my fund utilization will be monitored by the SBI, and SBI will provide quarterly report. So in this quarter, the company utilizes this much of amount for this purpose. Like this, it will provide utilization report. So this is applicable only in case of issue size having more than 100 crores. Next one. I need to get credit rating from credit rating agencies, just like deposits case. In deposits case also company obtain credit rating. So similarly here also company need to get credit rating. Next one. So differential pricing. So in case of RII, in case of employees, in case of existing shareholders, can you offer any discount? Yes, you can offer discount not exceeding 10%. Maximum 10% is allowed. So discount on shares is not allowed now. Discount on face value of shares is not allowed. But discount on market value, issue value is allowed if it is more than face value. So, for retail individual investors, for own employees, for own shareholders, company can offer the securities for 10% discount. So, this policy is called as differential pricing policy. Next one. Now, in case of book built issue, in order to raise the demand levels of the public, what I can do? I can bring some famous person into my company. Say for example, Rakesh Jhunjhunwala. He is a famous investor. If he invests his money in any company, then definitely public will go crazy. They will try to buy the shares of that company. Ultimately, the share price of the company will go up. Now, I want to make a public issue through book building. So I appointed Rakesh Jhunjhunwala as my anchor investor. Now initially he need to make the investment. Now this investment will attract so many people in order to make the investment so that the demand levels will be fulfilled. Now the point is, for how much price I need to offer the shares to my anchor investor? It should not be less than remaining category of people. That means for remaining category I am charging 100 rupees per share. From Rakesh Jhunjhunwala also I need to charge at least 100 rupees. That means I can't do any favor in favor of Rakesh Jhunjhunwala. I can't offer any discount to Rakesh Jhunjhunwala in order to attract public. That means discount can be given to whom? Retail individual investors, employees, shareholders. Discount cannot be provided to whom? Anchor investors. Next one. Then what about the face value of the share? So it depends upon issue value. If issue value is 500 or more, issue price is 500 or more, then what about the face value? Face value may vary from 1 to 10. If issue value is less than 500, then face value shall be 10 rupees. So that means if the issue price is up to 500, the guarantee face value is 10 rupees. If the issue value is equal to 500 or more than 500, then the face value may be either 1 rupee or 2 rupees or 3 rupees or up to 10 rupees. Next one, lock-in period. What is meant by lock-in period? So during lock-in period, those people are not allowed to sell the shares. Now the point is, in case of IPO, in case of FPO. So after promoters made any IPO or FPO, promoters can't exit from the company so easily. They need to maintain certain number of shares in the company for at least 3 years. This is called as lock-in period. So how many shares they need to hold? At least 20% of the shares need to be held for at least 3 years. In case of IPO or in case of FPO. Then what about the balance shares? In case of IPO, for selling balance shares, they need to wait for 1 year. But in case of FPO, that condition is not applicable. So there are two portions, minimum contribution and balance amount. Minimum contribution should be locked for 3 years. It is applicable both for IPO and FPO. Then what about the extra amount? Extra amount need to be locked for 1 year only in case of IPO. In case of FPO, no lock-in period for the extra contribution. So by this, we completed first 5 questions which are related to part 1, which is about public issue of securities. Now there are 2 parts in this chapter. What are those 2 parts? Prevention of insider trading and finally takeover code. So I will complete those 2 concepts in the next class. We started SEBI regulations. How many parts are there in SEBI regulations? 3 parts. What are those 3 parts? One is going for public issue, prevention of insider trading and takeover code. So first one, let's revise the topic which was completed in the last class. So question number 1 contains some points. If any point got attracted, the company cannot go for public issue of securities. So what are those conditions? First one, if company or its promoters or its director, if it is OFS, then selling shareholder. if any one of these person got debarred by the SEBI from assessing stock markets, then company cannot go for public offer. Next one. So in order to go for public offer, in order to issue securities to the public, those securities must be listed. So if listing is failed, then company cannot go for public offer. The securities that are being offered by the company must be in demat form. And what about the existing promoter holding? It must be converted into demat form. What about non-promoter holding? So it is their wish. Next one. What happens if there is any partly paid shares? Unless those shares are cancelled or those shares are made fully paid, company cannot go for public offer. Next one, firm arrangement. If the requirement of the company is 100 crores, so company need to arrange 75 crores on its own. So balance 25 crores can be taken from public. And in the 25 crore, how much percentage they can utilize for general purpose? 25%. Next one. What happens if company or promoter or director is declared as willful defaulter? Then also company cannot go for public offer. And what should be the offer period? Minimum 3 days, maximum 10 days. So during this offer period, people will buy the securities. Next one. What is the minimum subscription? 90% of the issue value. What about the minimum application money? 25% of the issue price. So all these conditions need to be satisfied. Next one, in question number 2. So we discussed about few conditions. If all these conditions are satisfied, company can opt for fixed price method or book building method. If company went for fixed price method, what will be the reservation? What will be the reservation? Minimum 30% should be given to RII. And what about remaining portion? It will be subscribed by NII. If there is any unsubscribed portion, it will be taken by QIB. That means the priority will be given only to RII. Next one. What happens if all the conditions are satisfied but company opted for book built method? Then RII need to get at least 35%. NII at least 15%. And what about qualified institutional buyers? Maximum 50%. Now, any of the condition got failed. Now there is only one option. What is that option? To follow book built method. In that situation, the risk is very high. As the risk is very high, so what about the portions now? Now this time RII will be given maximum 10%. NII will be given with maximum 15%. Minimum 75% should be given to qualified institutional buyers. Next one. And what is meant by lock-in period here? Not to sell the securities. And this is applicable to whom? Promoters. So after IPO, after FPO, promoters cannot sell those shares. Then what is the lock-in period for the promoters? So for 20% of the contribution, the lock-in period is 3 years, whether it is IPO or FPO. For balance shares, the lock-in period will be, in case of IPO 1 year, in case of FPO, no lock-in period. And what about the face value? If the issue value is less than 500, the face value of the share must be 10. If the issue value is 500 or more, then the face value may range from 1 to 10. So let's first complete about takeover code. So our next topic is about takeover. So here, who are the parties involved means, one is acquirer, other one is target company, and along with acquirer, persons acting in concert. So total 3 parties got involved here. One is acquirer, other one is persons acting in concert with acquirer, and last one is target company. Now, acquirer along with persons acting in concert will take over the target company. So here the target company must be a listed company. Why it need to be listed company? Because these are SEBI regulations. SEBI regulations are applicable only in case of listed companies. So that's why the target company must be listed company. Then who can be the acquirer? Acquirer can be either natural person or artificial person. So any person is allowed in order to buy the another entity, but the target company must be a listed company. Now acquirer, with the help of persons acting in concert, is buying the shares of target company. This is called as takeover. Next one. Now the point is, when acquirer or persons acting in concert or both, if they want to buy greater than or equal to 25% of total shares, that is total voting power in target company, then they are required to make open offer. So what is meant by open offer? Open offer means they need to buy the shares by making an open offer to the shareholders of the target company. Say for example, the target company is having 1 lakh shareholders. Now, before acquiring any stake in the target company, they need to ask these 1 lakh shareholders, if you want to sell those shares, please sell it to me. I will buy the shares. Like that, they need to make the offer to the existing shareholders of the target company. That kind of offer is called as open offer. What happens if it is less than 25%? If it is less than 25%, these people can buy the shares in stock market itself. No need to make any open offer. But if it is equal to 25% or if it is more than 25%, they need to directly make the offer to the existing shareholders. And existing shareholders will reply. So if they okay, then they will sell the shares to the acquirer or persons acting in concert. If they are not okay, then they will refuse the offer which is made by the acquirer and person acting in concert. So this is how open offer should be made. Next one. Now, already the company is having 25% of voting power. Now again acquirer and persons acting in concert want to buy further share. So which is more than 5% of total voting power. This time it is more than, not more than or equal to. So more than 5% of total voting power. This is subsequent acquisition. So already 25% is held by these people. Now they want to purchase another stake which is more than 5% of the total voting power. So in this case also they are required to make open offer. That means when open offer is required, first one, for the first time, if acquirer and person acting in concert want to buy at least 25% of total voting power in the target company, then they need to make open offer to the shareholders of target company. And what about the subsequent situations? So after acquiring 25%, if they want to purchase another stake in the same company, which is more than 5% of total voting power, they are required to make open offer. What happens if it is less than 5% or equal to 5%? So they can directly purchase from stock market. No need to make open offer to the existing shareholders of the target company. Now, they need to purchase up to 80% only. Why only 80%? In case of listed company, there is a condition. So at least 20% of the shares need to be held by public. 80% can be held by promoters or relatives of promoter or closely held people. But in case of listed company, minimum 20% portion should be given to the public. So that's why buying more than 80% is not allowed. So maximum 80% is permissible. So for the first time, if it is more than or equal to 25%, they need to make open offer. And for subsequent times, if it exceeds more than 5%, they need to make open offer. And they need to make open offer like this until they achieve 80% of total voting power. And thereafter, it is not possible for the acquirer or persons acting in concert to buy the shares in the company. If they want to buy the shares in the company, they need to unlist the company first. Because for listed companies, minimum 20% should be given to the public. Next one. So who are persons acting in concert? So for example, there is a person and this person is having a company. This person want to buy shares of target company with the help of this company. Now this person will be called as acquirer, and the person who is assisting the main person, acquirer, is called as persons acting in concert. Next one, types of takeovers. So takeovers are of different types. First one, friendly takeover. So what is meant by friendly takeover? Nothing but by taking the permission of the promoters. If any person take over the company, then it will be called as friendly takeover. hostile takeover. So without consulting the promoters or without consulting the board of directors, if any person bought the company, then it will be called as hostile takeover. So how friendly takeover and hostile takeover will take place? In case of friendly takeover, the persons who want to buy the company will approach directors and promoters first. They will make negotiations and they will finalize the terms and conditions. In case of hostile takeover, they will go to stock market and they will buy the shares without the approval of promoters or directors. Next one, vertical takeover, horizontal takeover, conglomerate takeover. So what is the difference between vertical, horizontal, conglomerate takeovers? Say for example, this is the supply chain. So supplier, raw material supplier. Next one, manufacturer. Next one, wholesaler. Next one, retail seller. So this is supply chain. Now, this is the main company. This company want to acquire supplier business. Vertical takeover. This company want to acquire wholesaler business. Again, vertical takeover. This company want to buy retail seller. Vertical. But what happens if this manufacturer want to buy the business of another manufacturer having same line of business? Then it will be called as horizontal. What happens if this company is buying another company which is completely not at all related to this company's business? Then it will be called as conglomerate takeover. Okay, just now we discussed about friendly takeover. That is, company voluntarily will sell the shares to the acquirer. Hostile takeover means, so here promoter's consent is not obtained, director's consent is not obtained. So through stock market, acquirer is acquiring the shares. Horizontal, vertical, it depends upon the business. Conglomerate, so in this case, the other entity is completely unrelated. Next one, disclosure norms under the takeover regulation. So first of all, disclosure. The disclosure is applicable to acquirer and persons acting in concert and promoters of target company. So disclosure is not applicable to target company. So I already discussed about the parties. Who are the parties involved here? First one, acquirer along with persons acting in concert. They will buy the stake of target company. In target company, there will be promoters. So now who are required to make disclosure and who are not required to make disclosure? Acquirer need to make disclosure, persons acting in concert need to make disclosure, and promoter need to make disclosure, but target company is not required to make any disclosure. That means disclosure requirements are applicable only for other people but not for the target company. Next one. So what they need to disclose? They need to disclose about acquisition and they need to disclose about disposal. What is meant by acquisition? Buying of stake. What is meant by disposal? Selling of stake. This acquisition includes taking property of other party by way of encumbrance. What is meant by encumbrance? Say for example, I gave my property as security to a bank and I took 10 lakhs loan. What happens if this 10 lakhs loan was not repaid by me? Now bank will take over my property. So in this takeover, it is possible because of encumbrance, that is charge. So because of money lending transaction, because I offered that property as security, now money lender will get a right over such property which is nothing but called as charge or encumbrance. By using that right, he will take over the property. Similarly, so company shares may be offered as security. Company shares may be offered as security and loan will be taken from the bank. What happens if loan is repaid? Shares will be released. What happens if loan is not repaid? Shares will be taken over by the banking company. So that taken over by the banking company will be called as acquisition and released by the banking company will be called as disposal. That means acquisition means buying the shares, okay, at the same time taking the shares on loan basis. Next one, disposal means selling the securities, okay, at the same time disposal means release of shares in case of encumbrance. So what is meant by event based disclosure? When this event happen, these people need to make disclosure. So what is the event? Acquisition, disposal. And who need to disclose? Acquirer, persons acting in concert, promoter. Who is not required to disclose? Target company. So they need to disclose about what? Acquisition, disposal. Acquisition means buying shares. Disposal means selling shares. Acquisition includes taking shares in the loan contract. Disposal includes releasing shares in the loan contract. Next one, continual disclosures. So now this is applicable to promoters. So promoters and non-promoters. So for every year, that means after the end of financial year, within 7 working days, they need to make disclosure. Okay, what kind of disclosure they need to make? First one, promoters need to say about his shareholding in the company, whether it is less or more, irrespective of the quantum of the shareholding. He need to disclose about the shareholding to the company as well as public. And what about non-promoters? In case of non-promoters, if number of shares are more than 25%, then only they are required to make disclosure. Otherwise, they are not required. That means this is continual disclosure. Every year, these people need to make disclosure about their shareholding in the company. Okay, who are required to disclose about their shareholding in the company? Promoters as well as non-promoters. In case of promoters, all promoters. In case of non-promoters, those persons who are having more than 25% of shares. Only those people are required to make disclosure. Next one, encumbrance disclosure. So just now we discussed about encumbrance disclosure. When bank has taken shares of other company under any loan contract, disclosure is required. When bank releases the securities of any company under loan contract, disclosure is required. So in all the cases, the disclosure should be made within 7 working days. And the disclosure shall be made to stock exchange where the target company is listed and the target company. So that means who need to make disclosure? Acquirer, persons acting in concert, promoter. And what about target company? No, because the target company will be receiving the disclosure from these people. So these people, these 3 people will make disclosure to the target company. These 3 people will make disclosure to the NSE or BSE or some other stock exchange where this target company is listed. And they disclose about what? First one, acquisition. Second one, disposal. And what about promoters and non-promoters shareholders? So this is a continual disclosure, not event-based disclosure. Every year they need to communicate about their shareholding. For promoters, it is applicable to all promoters. For non-promoters, it is applicable to those promoters having more than 25% of shares. Next one. So open offer process and compliance. So when open offer is required, if it is for the first time, more than or equal to 25% of voting rights. If it is subsequent time, that is after having 25%, if it is subsequent time, more than 5% until up to 80%. So that content is covered in question number 13. Next one. Is it possible to withdraw the open offer? So open offer is made by the acquirer and persons acting in concert. Now they want to withdraw the offer. Is it possible? Yes, but only in few cases. First one. Now, acquirer plus persons acting in concert made open offer to target company shareholders. Now, in order to fulfill that open offer, they need to satisfy certain approvals from the government, like approval from SEBI, approval from stock exchanges. These approvals are required. What happens if these people fail to get those approvals? They cannot proceed with the open offer. That means they need to withdraw the open offer. That means the open offer which is made by these people to the shareholders of target company is subject to statutory approvals. So if those approvals are granted, they can proceed with the open offer. If those approvals are refused, they cannot proceed with the open offer. They need to withdraw the open offer. Next one. Now the acquirer. So he's the natural person. So he made open offer. Okay. But before it is implemented, he got expired. Now they can withdraw the open offer. Next one. Because of conditions. Say for example, so these people made open offer to the shareholders of target company. And these people said, if shareholders try to buy at least 10%, then only we will continue with the open offer. Otherwise, we will cancel the open offer. Like this, they made a condition. Now, what will happen if shareholders of target company so agreed and that agreed percentage is 10%? Then they can proceed with the open offer. What happens if this condition is not fulfilled? Then they need to cancel the open offer. Next one. And any other situation where SEBI has given approval. So in all these 4 cases, open offer can be withdrawn. What are those cases? These people need to get statutory approvals to continue the open offer, but they fail. And these people got expired. Next one. These people made a condition regarding continuation of open offer, but that condition got failed. And for any other reason which was agreed by SEBI. Next one. And what is the process of open offer? So in case of open offer, first of all, acquirer plus persons acting in concert. So they need to make a public announcement. So we are going to buy these many number of shares in target company. Like this, they need to make public announcement. After making public announcement, they need to prepare a draft offer letter. They need to prepare draft offer letter. And they need to forward this draft offer letter to certain people. So among those certain people, one of the parties is SEBI. So SEBI will give its objections on draft offer letter. Now after considering the objections made by the SEBI, what this acquirer need to do? He need to publish the open letter, that is open offer letter. Now he need to give some time period to the shareholders of target company. During this time period, the shareholders of target company, if they want to sell the shares, they will exercise the option. So after the expiry of time period, you need to make payment to the shareholders who agreed to sell the shares. By making payment, your process will get completed. So what is the process here? First, acquirer and persons acting in concert, they need to prepare. First, they need to make public announcement about open offer. Later, they need to prepare offer letter. But that offer letter need to be forwarded to certain persons. Among those persons, one of the person is SEBI. Now SEBI will give objections. After considering objection, they need to finalize the offer letter. The finalized offer letter need to be forwarded to public. And thereafter, they need to give some time period to the public. So in the time period, if shareholder want to sell those shares, he will exercise his option. Now, after completion of the time period, so the persons who want to sell the shares, for them, the company need to pay purchase consideration. Now, what is the time limit for doing all these things? First one. So after making public announcement, within 5 days, you need to submit the draft letter of offer to the SEBI. So what is the time limit for it? 5 days. That is 5 working days. Next one. And along with SEBI, you need to forward that offer letter to target company as well as stock exchanges. So first one, public announcement. Okay. After that, within 5 working days, you need to prepare draft letter and you need to forward the draft letter to SEBI, stock exchanges, target company. So this is just draft letter. This is not yet finalized. Now SEBI will give objections. And what the time limit given to SEBI means 15 working days. So within 15 working days, SEBI need to give its objections. Okay, if SEBI gave its objections, then within 7 working days, so the letter must be published to the public. What happens if SEBI fails to give the reply within 15 days? Again, after the expiry of 15 days, within 7 working days, so it will be published to the public. Now, what you are giving to the public is the final offer letter. So after giving final offer letter, so you need to provide a time period for them in order to subscribe in order to sell their shares. Next one, what is the time limit? So from SEBI comments date, within 15 working days, you need to give a time period to those people in order to sell the shares. And this time period should be at least 10 working days. And this time period will be called as tendering period. Now if any shareholder want to sell his share, he will sell his share in this tendering period. So after completion of tendering period, so you need to make payment. So this is how open offer will work. Next one. Now, how to make payment? So payment can be made either in cash or it can be made by using listed equity shares of which company? Of acquirer, in case acquirer is a company. So acquirer company's listed equity shares or any person acting in concert. That means you can offer the listed equity shares of the acquirer, listed equity shares of the persons acting in concert. Next one, listed secured debt instruments. Listed plus secured debt instrument. So of the acquirer or persons acting in concert. Next one, convertible debt securities. So of the acquirer or person acting in concert or combination of above. That means the purchase consideration can be paid in the form of cash or in the form of securities. Securities means listed equity shares, listed secured debt instruments, convertible debt instruments. And these instruments may belong to acquirer or may belong to persons acting in concert. So by this way, you need to discharge the purchase consideration. Next one, escrow account. So escrow account means nothing but a security deposit. So you are making open offer and shareholders are offering their shares to you, and after that you are paying money. What happens if you fail to pay the money? So that's why you need to give the guarantee. So before going for open offer, you need to give the guarantee. Then how to give the guarantee? So deposit equivalent amount with a scheduled bank account. Say for example, you are going to buy the shares from the existing shareholders for a consideration of 20 crores. Now you need to deposit 20 crores in a separate bank account. So if you paid this 20 crores, the 20 crores which is deposited by you in the escrow account will be taken back. What happens if you fail to pay this 20 crore? This amount will be used for the payment of purchase consideration. Next one. Or you can give bank guarantee also. What is meant by bank guarantee? Bank guarantee means if you paid the purchase consideration, then it is okay. If you fail to pay the purchase consideration, then on behalf of you, bank will pay the money. So this is called as bank guarantee. Why bank will pay the money? Because you offered your securities to the bank. Now bank will give bank guarantee. So if you fail to fulfill the obligation, bank will fulfill the obligation. Later you need to repay that amount to the bank. So this is how bank guarantee will work. So even a bank guarantee is also sufficient. Or you can deposit frequently traded shares. So what is meant by frequently traded? Nothing but in last 12 months. If the traded turnover in the stock exchange is at least 10%, then those shares are called as frequently traded shares. So for example, the total number of shares of company is 1 lakh and these 1 lakh shares are listed in stock exchange. Now the traded turnover during last 12 months, if it is at least 10%, that is at least 10,000 shares are traded in the stock exchange during last 12 months, then these 1 lakh shares will be called as frequently traded shares. So you can give your frequently traded shares or freely transferable equity shares or freely transferable other securities to the escrow account, or you can give either bank guarantee and deposit of securities both. So why you are providing these monies? Just like a guarantee, because you need to pay either cash or you need to give equity shares, debt instruments or convertible debt securities. So what is the guarantee that you will give all these things to the selling shareholders? So that's why in order to provide guarantee, you need to deposit certain money with escrow account. So you can deposit either in cash or you can give bank guarantee or you can give your securities or you can give any of the above combination. Next one, obligations of target company, obligations of acquirer. So target company obligations. Acquirer and persons acting in concert. So they acquired target company. Now the target company board of directors will have certain obligations. What are those obligations? First, they need to run the business in ordinary course of business. So previously, before acquisition, how they are running the business? In the same manner, after acquisition also, they need to run the business. Next one. And they cannot fix any recorded date for corporate action. What is meant by corporate action? Declaration of dividend, share split, share consolidation, bonus issue, rights issue. All these things are called as corporate actions. For every corporate action, the company will announce a date called as record date. Because if company fixed a record date, the persons who are members as on that record date will get the benefits. Say for example, company is going to declare the dividend. Company fixes record date. April 1st as record date. Now the persons who are members on April 1st will be entitled to get dividend. Sir, what about remaining members who hold the shares for remaining 364 days? They are not entitled to get the dividend. So in order to get the dividend, no need to hold the shares for 365 days. So having shares only on one day is also sufficient, but that one day must be recorded date. So for corporate actions, company will announce record date. So once acquisition is made, so this target company cannot announce any record date for any corporate action. This is second duty. First one, second one, third one. And this target company need to provide the list of all its shareholders to the acquirer and persons acting in concert. Why the target company need to give the list of shareholders? Very simple. These people need to make open offer to the shareholders of target company. Without knowing about those details, how can they proceed? So that's why they need to obtain a list from the target company, list of its shareholders, and the target company need to provide that list. That is third obligation. And fourth obligation, is it possible to use material assets? That is, the target company want to sell material assets. Target company want to lease its material assets. So is it possible for the target company to do like that? Answer is no, because it is under acquisition. So when acquirer is acquiring your company, how can you sell your assets, that to material assets? Or how can you lease your material assets? So it is not possible. But in order to make it possible, you need to conduct post ballot voting and you need to get special resolution. So not through general meeting. You need to conduct post ballot voting. Through post ballot voting, you need to get special resolution. Then only you are allowed to sell or lease metal assets of the target company. So these are the four obligations of the target company. What is the first obligation? So before acquisition, how they are running the business. After acquisition, they need to run in the same manner. Second one, target company shall not announce any record date for any corporate action. Third one, they need to provide the list of its shareholders to the acquirer. And fourth one, target company shall not sell or dispose of its material assets without taking special resolution through post ballot voting. So four obligations are there for target company. Next one, obligations of acquirer. So acquirer along with persons acting in concert is buying the stake of target company. So just now we completed the obligations of target company. Now this is the time for obligations of acquirer. So what are the obligations of acquirer? So first of all, they need to pay money to the target company shareholders. Then for paying money, they need to make financial arrangements. And they need to follow the rules and regulations. So here they need to follow SEBI regulations for takeover. That means they're jointly and severally responsible. Who? Acquirer and persons acting in concert. So they are jointly and severally responsible for the fulfillment of obligations under takeover code regulations. Next one. And what about alienation of metal assets? Same. Now this acquirer want to sell or want to lease material assets of the target company. Is it allowed? No. For this purpose also, what is required? Special resolution in post ballot voting is required. So same point is applicable for both target company as well as acquirer. Next one. And one more important point. So during this open offer phase, these people need to buy the shares from the shareholders of the target company. So buying is allowed. During this offer period, they can't sell the shares because they made offer to buy the shares. When they are buying the shares, how they are supposed to sell the shares simultaneously? So simultaneous sale is not allowed. So these are the four obligations of the acquirer. So what are the four obligations of the target company? In case of target company, they need to continue the business as it is. Next one, shall not declare any corporate action record date. Next one, they need to provide list of shareholders. Last one, so sale or disposal of material assets without SR in post ballot is not possible. Next one, in case of acquirer, last condition is applicable as it is. What about other three conditions? They need to make arrangements to make payment. They are responsible for the compliance of applicable rules and regulations. Next one, during offer period, they need to buy the shares of selling shareholders, but they can't sell the shares. If they want to sell the shares after completion of entire acquisition, they can sell the shares. But during this acquisition process, they can't sell the shares simultaneously. Next one. So last part of this chapter, which is about insider trading. So first of all, who is insider? In order to know about who is insider, we need to know about the information of the company. Information of the company is of two types. Generally available information. Generally available information. And second one is unpublished price sensitive information. So what is meant by generally available information? It is a public information. That means this information is already known to the public. Say for example, financial results of a company for the last 2 years. It is generally available information. Anyone can view the information by going to the website of the company or by going to the website of MCA also. So it is generally available information. Then what about the financial results of upcoming years? Say for example, this is 2024-25 financial year. And we are in which quarter? So third quarter. Now second quarter results need to be published, but these results are not yet published. Now this information will be called as unpublished price sensitive information. So that means the information which is already available with the public will be called as generally available information. The information which is not readily available with the public will be called as unpublished information. And if that unpublished information, if known to the public, it will definitely affect the stock price in the stock market. Then such unpublished information will be called as unpublished price sensitive information. So this unpublished price sensitive information need to be maintained secretly. That means confidentiality is mandatory here. If it is disclosed to the outside world, definitely it may impact share value. Share value may go up or share value may go down. Say for example, from last 5 years a company is getting profits only. So company share price is also very high. Now for the current year company got losses. This information is not yet known to the public. This is known to the auditor of that company. Because before making public disclosure, auditor need to audit the financials of that company. So while doing audit, he came to know that the company suffered with huge losses. Now this information is not known to public. If it is known to the public, then definitely the share value may go down. So that's why this kind of information will be called as unpublished price sensitive information. Now in case of generally available information, there is no problem at all. But in case of unpublished price sensitive information, the person who is having that unpublished price sensitive information will be called as insider. And that insider can use that information for his personal benefit. Say for example, in this case, auditor can make short sale. What is meant by short sale? First he will sell the securities at low price, at high price. Later he will buy the security at low price. Because what is his expectation? Because of these losses, share price is going to fall. So when his expectation is falling of share prices, what he will do? He will sell at current rate, which is at high rate, and he will buy the security at low rate. So how is it possible to sell the security without having security? So for this purpose, you need to take the shares from any other person, nothing but called as stock lending. Say for example, this auditor will take the shares from a person who is an existing shareholder, and he will sell the shares now. And later at low price he will buy the shares and he will give back those shares to the shareholder. So this is how he will accrue the profit. Okay, now the point is, in this case, the auditor will be called as insider. Why he is called as insider? Because he is having the possession of unpublished price sensitive information. That's why auditor is called as insider. And the trading which is conducted by auditor will be called as insider trading. Now, in order to prevent this kind of insider tradings, SEBI came up with a regulations called as Prevention of Insider Trading Regulations. So, what is meant by generally available information? Which is available to the public. So, what about unpublished price sensitive information? Not available to the public. If it is available to the public, then it is going to materially affect the price of the shares. And what are the examples for unpublished price sensitive information? Financial results, dividends, change in capital structure, so merger, demerger like decisions, change in KMP. So all these things are unpublished price sensitive information. If it is known to public, then definitely it is going to affect share value. Next one. Then who is insider? Any person who is having the possession of unpublished price sensitive information will be called as insider. In our example, who is insider? Auditor. Why auditor is insider? Because he is having the possession of unpublished price sensitive information. But there is a concept called as connected person. Connected person means the person who is connected with the company. That person will be treated as deemed insider. He will be treated as deemed insider. That means whether he is having unpublished price sensitive information or not, we will treat that person as insider. So who is connected person now? So this definition is important. So connected person means during 6 months prior to insider trading. During 6 months prior. So what he is doing? He is associated with the company, either directly or indirectly. How he is associated with the company, either directly or indirectly? By making frequent communication with the officers. That means during last 6 months he is making some calls, messages to the officers of the company. That means he is a connected person. Next one. He is in contractual, fiduciary or employment relationship with the company. So now he is making contract with the company. Connected person. He is in fiduciary relation with the company. That means he is holding the assets of the company. On behalf of the company, he is holding the assets. So he is in fiduciary relationship. Next one, he is in employment relationship. He is one of the employee of the company. So in all these cases, they will be called as connected person. Next one, he is a director, officer, employee. So again, connected person. So he is holding any professional or business relationship with the company. Connected person. So who are called as connected persons? During last 6 months, if any person is associated with the company, how? Directly or indirectly? That is how? By making frequent communications with the officers, or by having contractual, fiduciary, employment, professional, business relationship, or having a designation of director or officer or employee. And that relation may be either temporary or permanent. And that relation will give access to unpublished price sensitive information. So whether he got unpublished price sensitive information or not, it is not mandatory. Whether he is having access to unpublished price sensitive information, it is mandatory. If he is having access to the unpublished price sensitive information, then he will be called as a connected person, and that connected person will be called as insider. So some of the examples are also given here, so you can refer on your own. So these are all the examples for the connected persons. Next one. Now the point is it possible for the company to give unpublished price sensitive information to anyone? Answer is no. A company is not allowed to give unpublished price sensitive information to the any other person. But what happens if he is auditor? Then definitely company need to provide the details to the auditor, because auditor need to audit the financials. So without providing details to the auditor, how he will audit the financials? So it is not possible. Next one, what happens if it is inspection, inquiry, investigation? Then they need to provide the information. Even though it is unpublished price sensitive information, they need to provide, because at the other end, who is asking for the information? ROC or central government. What happens if NCLT asks for the information? They need to provide. That means there are some legally permissible situations are there. In such legally permissible situations, the company must provide unpublished price sensitive information to those people. But at the time of providing those unpublished price sensitive information to those people, they need to maintain a code of fair disclosure and conduct. So in this code, they will instruct these people to maintain confidentiality. Okay, sir, because of statutory requirement, we are providing this unpublished price sensitive information to you. So please maintain confidentiality. Like this, they need to take promise from those people. Next one. Then, even in case of open offer also. So in case of takeover code, open offer is made by acquirer and persons acting in concert. So when any person is acquiring that much number of shares in the target company, then the target company must disclose unpublished price sensitive information to the person who is acquiring the stake, because they are buying greater than or equal to 25% of the voting power. That's why company need to give the information whatever they requires. Say for example, acquirer want to buy 50% stake in target company. Now, while buying 50%, definitely acquirer will ask for some unpublished price sensitive information. Now, target company need to provide that. But for providing such unpublished information, it must follow code of fair disclosure and conduct. Next one. Then, what happens if it is less than 25%? In case of if it is less than 25%, open offer is not applicable. When open offer is not applicable, it is not mandatory for the target company to provide the information about it to the acquirer. But if target company want to provide that information to the acquirer, then first of all, it need to make that private information as a public information. So what is meant by making public information as private information or private information as public information? So in this case, the company must disclose the unpublished price sensitive information to the general public. When it is disclosed to the general public, this private information will now become public information. That means now it will become generally available information. So after making that unpublished price sensitive information as generally available information, they can disclose that fact to the acquirer. So this is when acquirer is buying less than 25% stake. That means if the acquirer is buying small stake, you are not required to disclose unpublished price sensitive information. If you want to disclose unpublished price sensitive information, first you need to make that unpublished information as public information, and thereafter you need to disclose that matter to the acquirer. But if acquirer is going to purchase 25% or more than 25%, which attracts open offer, then you can communicate the unpublished price sensitive information in a secret manner. Next one. Trading plan. What is meant by trading plan? Say for example, insider. Actually, insider is not allowed to do insider trading. But insider, if you want to do insider trading, he need to follow trading plan obligation. What is meant by trading plan? Say for example, there is a company. In that company, one person is acting like insider and he want to buy the shares of that company, or he want to sell the shares of that company. So first of all, he need to communicate about his trading plan to the compliance officer. Now compliance officer will forward the trading plan to the stock exchanges as well as public. As after communicating to the stock exchanges and public, this insider need to wait for 6 months. After 6 months only they can execute trading plan. So what will happen if they wait for 6 months? If there is any unfair benefit, it will get nullified. So because of such longer intervals, if there is any unfair benefit to this insider because of the insider information, it will get nullified. So that's why first he need to prepare a trading plan, that is whether he is buying the shares or selling the shares, how many shares he is buying, how many shares he is selling, for how much price he is selling, for how much price he is buying. All these particulars need to be prepared like a plan. It need to be given to compliance officer, later stock exchanges and public, and after 6 months he need to execute the trading plan. Is it possible to modify the trading plan? No. Is it possible to cancel the trading plan? No. Once trading plan is issued to the public, he must execute the trading plan. So this is how insider need to trade. But what about others? So others can buy the shares or sell the shares at any time they want. But that is not possible in case of insider. If he want to do anything, he need to wait for 6 months. After 6 months only, he need to do that activity. And after 6 months, he need to honor the promise which was made in the plan. He can't deviate from plan. Next one. So disclosures by insiders. Whenever insider is making insider trading, he need to disclose. How he will disclose? By using trading plan. First he will make disclosure by using trading plan. Later he will wait for 6 months. After 6 months he will buy or sell the securities. Next one. Now this is about AMP, director, promoter. Same. Promoter, director and KMP. So what these people are required to do? So at the time of appointment of a person as a KMP, at the time of appointment of a person as a director, at the time of appointment of a person as a promoter. So at the time of appointment, within 7 days, they need to disclose about the shareholding in that company. That means, so I was appointed as promoter or director or KMP in Reliance Industries Limited. At that time, what is my shareholding in Reliance Industries Limited need to be disclosed. So this is initial disclosure. What is continual disclosure? Now, if in any quarter I made a turnover of more than 10 lakhs, then I need to disclose that matter. So I am the promoter, I am the director, I am the KMP, and I made more than 10 lakhs turnover in this quarter. Then after that I need to make a disclosure which is called as continual disclosures. So in this case, after appointment within 7 days I need to make disclosure. In this case, whenever I exceed 10 lakhs turnover in any quarter, within 2 days I need to make the disclosure. In both the cases, the disclosure requirement is applicable to 3 categories of people. Who are those 3 categories of people? Director, KMP, promoter. So at the time of appointment, they need to disclose the shareholding. And after appointment, if they made a turnover in excess of 10 lakhs in any quarter, this is quarterly limit, then also they are required to make disclosure. So first one is called as initial disclosure, second one is called as continual disclosure. For first one, time limit is 7 days from appointment. For second one, the time limit will be 2 days from such kind of transaction. Next one, connected persons. If company instructed its connected person to make disclosure about their shareholding, then connected person need to disclose the shareholding in that company. Say for example, company instructs its employees, directors, KMPs, all other people to disclose the shareholding in the company. Now they need to disclose the shareholding in the company. This is called as disclosure by connected persons. Next one. This is very important question. How prevention of insider trading will be regulated in listed companies? First one, here there will be certain officers, CEO, audit committee. Next one, board of directors. Next one, employees. Next one, intermediaries and fiduciaries. So these people got involved in the process of preventing insider trading. Then what is the role of each person? First one, the role of CEO is he need to check whether the internal controls for the compliance. So here it is not internal financial controls. Here they are internal compliance control. What is meant by internal compliance control? Whether company is following SEBI regulations or not. For that purpose, they need to put some internal controls. Those internal controls are called as internal compliance controls. So there are certain controls called as internal controls for compliance. Now CEO's role is he need to check whether such controls are adequate or not, whether such controls are operating effectively or not. So that is the role of CEO. Then what is the role of audit committee? Same role. Same role means he need to check the internal controls, whether they are adequate or not, whether they are effective or not. Then why 2 persons are allotted with same role? Because CEO will inquire at one. CEO will inquire multiple times, whereas audit committee will inquire for one time in a financial year. That means, so this is a routine task for the CEO and this is a review task for the audit committee. Next one. So now we completed about two persons. Who are those two persons? CEO, audit committee. So what is the role of CEO? To check whether internal controls are adequate and operating effectively or not. Audit committee also same role. Next one, board of directors. So whenever there is a leak of unpublished price sensitive information, then how board of directors need to respond? They need to conduct inquiry. And for that inquiry, they need to formulate some policies and procedures. That means board of director role will commence only in case of leakage of unpublished price sensitive information. If there is no leakage, then board of directors will have no role. If there is any leakage, board of directors role will commence. So they need to conduct inquiry. They need to prepare policies and procedures for the inquiry. Next one, while doing inquiry, all intermediaries and all fiduciaries who are associated with the board of directors, who are associated with the company, need to provide assistance. So point number 3 and point number 5 both are linked with each other. So in case of leakage of unpublished price sensitive information, who will start inquiry? Board of directors. Who need to support inquiry? Intermediaries and fiduciaries. Next one, what is the role of employees? So if employees knows about any information, they need to communicate that information to the higher authority, nothing but vigil mechanism, whistleblowing policy. So they need to follow whistleblowing policy. So this is how insider trading will be prevented in listed companies. So first one, we need to remember the names of the parties. Who are the parties involved here? CEO, audit committee, one set. CEO, audit committee, one set. Board of directors, intermediaries and fiduciary, one set. Employees. So what is the role of first set of people? That is CEO, audit committee. They need to check internal controls. They need to check whether they are adequate or not, whether they are operating effectively or not. And what about second set of people? Board of directors will conduct inquiry and intermediaries and fiduciaries need to support the inquiry. And what about employees? They need to give complaints about any possible leakage of unpublished price sensitive information to the higher authority by following a policy called as whistleblower policy. So by this we completed about SEBI regulations. So next one, insolvency and bankruptcy code. So next chapter name is insolvency and bankruptcy code. First of all, what is the applicability of insolvency and bankruptcy code? So in case of IBC, it is applicable for few entities and it is not applicable for few entities. And in case of applicability also, there are two processes. One is corporate insolvency resolution process. Second one is personal insolvency resolution process. So one is about corporate insolvency, in simple words. One is about corporate insolvency. Other one is about personal insolvency. So in case of corporate insolvency, which entities will be covered? First one, companies. Next one, LLPs. Next one, any body corporate. Next one, individual is also covered, but that individual is the guarantor for the above people. That means that individual gave guarantee to the company. That individual gave guarantee to the LLP. That individual gave guarantee to the body corporate. So that's why that individual will be called as corporate guarantor. So he will be called as corporate guarantor. Next one, personal insolvency case. So here, proprietary firms will be covered, partnership firms will be covered, individuals will also be covered other than guarantors. Because in case of guarantor, it will be covered under corporate insolvency. Now the point is, if company become insolvent, if LLP become insolvent, if body corporate become insolvent, if the person, individual who gave guarantee to the above entities become insolvent, then all these people will be prosecuted under corporate insolvency. So for this purpose, the adjudicating authority is NCLT, National Company Law Tribunal. Next one. What about proprietor firm? What about partnership firm? What about individual? If those people become insolvent, then it will be called as personal insolvency, and those insolvencies will be prosecuted in DRT, Debt Recovery Tribunal. Sir, I am not satisfied with NCLT, then I can go for appeal with NCLAT. I am not satisfied with DRT, then I can go for appeal DRAT, that is Debt Recovery Appellate Tribunal. Next one. Then IBC is not applicable for certain companies. Which companies? Companies which are providing financial services. So companies which are providing financial services means it may be banks, it may be mutual funds, insurance companies, and it may be asset reconstruction company. Asset reconstruction companies businesses, they will buy the bad debts of the bank and they will realize the money and they will get the profit. So that is the business model of asset reconstruction company. Even those companies are also called as companies providing financial services. Next one, collective investment scheme. Nothing but they will collect the investment from the various people. They will pool the money, and with the help of that money, they will invest that money in any other area like real estate, infrastructure, INVIT, REIT. You will get these concepts in income tax. So what they will do, they will pool the money from the public, and with that money, they will invest the money in any area. It may be real estate or infrastructure or some other area. So all these companies are called as financial service providers. So that's why IBC is not applicable to all financial service providers. Now say IBC is applicable to whom? Companies, LLPs, body corporates, individual guarantors. So proprietor, partnership firms, individuals. It is not applicable to whom? Companies which are providing financial services. So when these people become insolvent, it will be called as corporate insolvency. The procedure will be different. And if these people become insolvent, it will be called as personal insolvency and the procedure will be different. So the different procedure will be there in between corporate insolvency and personal insolvency. So all these people will be prosecuted in one manner and all these people will be prosecuted in another manner. And these people will be prosecuted by NCLT and these people will be prosecuted by DRT. And appeals can be made to NCLAT and DRAT. So in exams, corporate insolvency is important. So personal insolvency is not so important, but corporate insolvency is very important. So now we are going to cover corporate insolvency in this class. So before going to corporate insolvency provisions, we need to know about certain people. First one, debtor. Second one, creditor. Next one, insolvency professional. Insolvency professional. Next one, IBBI. Next one, adjudicating authority. Next one, insolvency professional agencies. Okay, let's see one by one. First one, debtor. Who is debtor? The person who owes the money to others is called as debtor. So as this is corporate insolvency case, the debtor is always the corporate entity. Corporate entity means company which needs to pay the money, LLP which needs to pay the money, body corporate which needs to pay the money. So this debtor is called as corporate debtor. So who is corporate debtor? The company which need to pay the money, or the LLP or body corporate which need to pay the money. Then who is creditor? The person to whom the company owes the money. That means the creditor is of two types: financial creditor, operational creditor. So who is financial creditor and who is operational creditor? Say for example, if it is financial debt, the creditor is called as financial creditor. If it is operational debt, the creditor will be called as operational creditor. So when a debt will be called as financial, when a debt will be called as operational. Say for example, I took a loan. So this is financial debt. Next one, I purchase the goods on credit basis. It is operational debt. So taking loans will come under financial debts. And buying goods on credit basis will be called as operational debts. So the person to whom the corporate debtor owes financial debt is called as financial creditor. If corporate debtor owes operational debt, then that person will be called as operational creditor. Next one, insolvency professional. So who can be the insolvency professional? CA, CMA and CS. So they must involve in practice, and that practice experience must be at least 10 years. And thereafter they are allowed to write an exam. If they qualified in that exam, they can act like insolvency professional. Now, insolvency professional agencies. So our institute, that is ICAI, ICMAI, ICSI. So there are three institutes which are called as insolvency professional agencies. These three institutes will conduct exams for the practicing members of those three institutes. But in order to eligible for exam, you need to have at least 10 years practice experience. Then only you are eligible to write those exams. So CA practicing people need to write the exams conducted by the ICAI, and CMA people need to write the exams conducted by the CMA institute. Similarly in case of CS institute. So these institutes are called as insolvency professional agencies. And the people who qualified in those exams will be called as insolvency professionals. And in this chapter we are going to discuss about three insolvency professionals. One is IRP, interim resolution professional. Second one is RP, resolution professional. Third one is liquidator. So what is the role of resolution professional and what is the role of liquidator? So first of all, if company fails to pay the debt, so don't go for liquidation. First of all, try to save the company first. So in order to save the company, so insolvency professional will enter into the game as a resolution professional. Next one, if it is worked out well, then there is no problem at all. No need to go for liquidation. What happens if the plan failed? Then the absolute consequence will be liquidation. In case of liquidation, in order to assist the company, again the insolvency professional need to enter into the game, but now as a liquidator. That means for saving the company, resolution professional. For liquidating the company, liquidator. Now, initially, IRP will be appointed. Interim resolution professional will be appointed. But thereafter, he will be replaced by final resolution professional. That means he is a temporary person and he will be the permanent person. Sir, can the same IRP become RP? Yes. Or you can appoint some other person in the place of IRP also. So the role of IRP is limited. So first initially court will appoint IRP. Later he will be replaced by another RP, or the same person will be continued as RP for the rest of the process. Next one, IBBA. So this is simply called as board also. So what is the role of IBBA? They will maintain the database of all insolvency professionals. Next one, adjudicating authority. So actually under this code, adjudicating authorities are two categories. One is DRT, other one is NCLT. So as we are discussing about corporate insolvency, here adjudicating authority means NCLT. In case of appeal, the adjudicating authority's order can be appealed to NCLAT, that is National Company Law Appellate Tribunal. Okay, now one more person is there, that is resolution applicant. So who is resolution applicant? So first of all, if company fails to pay the debt, the resolution professional will try to save the company. So how he will save the company? He will ask various investors to buy this company. Actually, this company is in losses. This company is unable to pay its debts. So that's why he will ask various investors to buy this company. Either for merger or for amalgamation, he will request various people. And if any person is interested in buying this company, that person will be called as resolution applicant. So now let's see the process. First one. Now company made default. So company made default in paying debt. That default may be either of financial debt or of operational debt. Now, who can file the case with NCLT? First one, financial creditor can file the case. Operational creditor can file the case. Next one, corporate debtor itself can file the case. Say for example, ABC Limited. So this is the company. This company owes certain money to the outsiders. Now this company fails to pay the money. That means there is a default. So whenever there is a default, now any person or even that company itself can go to NCLT and they can ask for corporate insolvency resolution process. Okay, now who can approach NCLT? Financial creditors, operational creditors, corporate debtor itself. Financial creditor means so the person to whom company owes financial debt. Operational creditor means the person to whom company owes operational debt. And corporate debtor means the main company who fails to pay the money. Next one. Now, when financial creditor approached NCLT, what kind of proofs he need to submit? When operational creditor approached NCLT, what he need to do? When corporate debtor approached NCLT, what he need to do? First one, if financial creditor approached NCLT, he need to propose IRP. That means IRP will be proposed by applicant, not by court. So appointed by court, okay. But who will propose IRP? Financial creditor and operational creditor and corporate debtor. So while filing an application for insolvency, so who can propose for IRP? Applicant. Applicant means financial creditor, operational creditor, corporate debtor. But for financial creditor, it is mandatory. For corporate debtor, it is mandatory. But for operational creditor, it is not mandatory. He may propose, may not propose IRP. So it is optional. Next one. Then, along with proposing IRP, they need to give the proofs for default also. Sir, company made default. Actually, company owes me this much of money, but company fails to pay this money. That means there is a default on part of the company. So for this purpose, you need to provide the proof. So in order to maintain proofs like this, there is one more concept called as information utility. So what is meant by information utility? It is nothing but a database which is maintained by the IBBA. So if any person gave any financial debt or operational debt to the company, then those people need to update the information in the information utility. That means if a person gave loan to the company, now he need to enter that information in the information utility. If company fails to pay the money, the same need to be recorded in the information utility. If company paid the money, the same need to be recorded in the information utility. That means each and every dealing with the company need to be recorded in information utility. It will act like a database and this will be maintained by IBBA. Now, whether company made default or not, how you will prove in the NCLT? By showing this information utility, that is database. So you need to provide the proof for default. But in case of operational creditor, you need to do something more. In case of corporate debtor, they need to show books of accounts for default proof. For operational creditor, the process will be different. So in case of operational creditor, first of all, operational creditor need to demand the payment and certain time period will be given to the company. If company fails to pay the money within the time period, or if amount is not yet disputed, then operational creditor can go to the NCLT. That means when operational creditor cannot go for NCLT for initiating corporate insolvency, first one, if 10 days time period is not given, he is not allowed. If 10 days time period is allowed, it is given to the company and company paid the money, he is not allowed to go to the NCLT. 10 days time period is given to the company, but company has quality related issues regarding supplied goods or services. So that's why it made a dispute regarding the payment. Then also this person cannot go for NCLT because it is the mistake of this person. So that's why he cannot go for NCLT for initiating corporate insolvency. Next one, what happens if within 10 days company fail to pay the money or fail to raise any dispute regarding quality? Then it is the company's default. Now operational creditor can go to the NCLT and he can ask for corporate insolvency. So he need to provide proofs for all these things. Now NCLT received the application. NCLT received the application. So after receiving the application, NCLT will be given with 14 days time. Within these 14 days, NCLT will either accept the application or reject the application. If there is any error, it will ask for resubmission also. So again, the time period which is available for resubmission will be 7 days. So again, these people need to file the application once again to the NCLT. Again, 14 days time will be given. Now at this time, now the options which are available with NCLT are only acceptance and rejection. That means it will ask for resubmission for only once. So what is the procedure now? Company made a default in paying the amount. Now any person can initiate corporate insolvency against the company. So who can initiate? Financial creditor, operational creditor, corporate debtor itself. Company can file a case against itself for corporate insolvency. So with whom the case need to be filed? NCLT. So who need to propose IRP? All need to propose IRP. But in case of operational creditor, proposing IRP is not mandatory. Next one. So along with proposing IRP, they need to provide default proof also. But in case of operational creditor, you need to provide 10 days time to the company. And within this 10 days, company need to make payment or it need to raise dispute. If nothing is made by the company, then only operational creditor can go to the court. And after approaching court, how many days is available with the court? 14 days. So for the first time, 3 options are available: acceptance, rejection, asking for resubmission. If it asks for resubmission, within 7 days we need to resubmit the application once again. Now again within 14 days, now there are only 2 options, that is acceptance or rejection. Now the point is, what happens if the application is accepted? Once application is accepted, now corporate insolvency resolution process will be initiated. In shortcut, it will be called as CARP, SIRP. So SIRP will be initiated. Now after initiating SIRP, NCLT will do 3 things. So first one, it will make public announcement. Second one, it will announce moratorium. Third one, it will appoint IRP. So now, which IRP, which person, which insolvency professional will be appointed as IRP? The insolvency professional who was proposed by financial creditor, who was proposed by operational creditor, who was proposed by corporate debtor. Sir, what happens if there is any disciplinary proceeding against that IRP? Then it will ask IBBA, that is Insolvency Bankruptcy Board of India. It will ask IBBA to send any other insolvency professional to act like IRP. That means if there is no disciplinary proceeding pending against the proposed candidate, then that person will be appointed as IRP by NCLT. So who will propose IRP? Applicant. Who will appoint IRP? NCLT. When IRP will be appointed? When there is no disciplinary action pending against IRP. What happens if there is any disciplinary action pending against IRP? It will ask IBBA to send other people. And one more important point. In these 2 cases, it is mandatory to propose IRP, but in this case, it is not mandatory to propose IRP. If operational creditor has not provided the IRP details, that means he has not proposed the IRP. Now how IRP will be appointed by the NCLT? It will ask IBBA to send a person. IBBA will send a person, insolvency professional. That insolvency professional will act like IRP. Next one. What is meant by moratorium? So moratorium means relaxation given to the company. Now if any person want to file a case against the company, it is not possible during moratorium period. So moratorium will give temporary relaxation from all cases. So new cases cannot be filed against the company. Existing cases cannot be continued against the company. So all the cases will be suspended for temporary period. So this kind of relaxation will be called as moratorium period. So now NCLT will announce moratorium. And NCLT will make public announcement also. That means it will communicate to the public that corporate insolvency resolution process is initiated against this company. So IRP is appointed, moratorium is imposed. Like this, NCLT will make public announcement. Next one. Okay, what is the next process? Now, IRP. So he will collect the details of all the creditors. He will collect the details of all the creditors. After collecting all the details of the creditors, he will prepare a team called as COC, Committee of Creditors. Then who will be there in this COC? Only financial creditors. What about operational creditors? They are not allowed. Only financial creditors can become members of COC. Next one. Now after forming COC within 7 days will conduct first meeting. In that first meeting, they will decide whether to continue the IRP as RP or to appoint some other person in the place of IRP as RP. So, what is the first resolution that need to be made by that COC committee? So, it need to decide whether to continue the IRP as RP or to appoint some other person as RP. It will decide that. So whatever it may be, it need to communicate to NCLT. If IRP is continued as RP, communication with NCLT will be sufficient. If some other person is appointed as RP, it must be communicated to NCLT and approval of IBBA is also required. Because whether such some other person is eligible or not, who need to decide? IBBA need to decide. That's why IBBA approval is required. What happens if IRP is continued as RP? Approval is not required, just communication is required, that too only for NCLT. If some other person is appointed as RP, then communication plus approval both are required. It must be communicated to NCLT. NCLT will communicate to IBBA and approval of IBBA is required in order to appoint some other person as RP. Now, RP got appointed. So what RP will do? Now he will prepare information memorandum, which will contain the entire information about the corporate debtor. Now he will prepare information memorandum and he will ask certain people to prepare a solution. Say for example, resolution applicant. So I already said, if company is going down, if company is not in a position to pay its debts, if company is in losses, we can ask some investors to invest in this company. Those investors are called as resolution applicant. So when these investors will invest in the company, when they know about the company. How they will know about the company? By using information memorandum. Who will prepare this information memorandum? Resolution professional. Now RP will prepare information memorandum. Based on information memorandum, resolution applicant will make a resolution plan. So once a resolution plan is made, like merger, amalgamation, acquisition of shares, whatever it may be, once a resolution plan is made, again RP need to conduct COC meeting. Now in this COC meeting, they need to approve the resolution plan which is proposed by resolution applicant. For approval, the consent of 66% of creditors is required. For approval, 66% creditors approval is required. Okay. Once this resolution plan is approved, it need to be forwarded to NCLT. If NCLT also agreed for the plan, then NCLT will order to implement the plan. Once plan is implemented, the company will be revived. That's it. Now the point is, what happens if COC failed to give any plan to the NCLT? What happens if COC give the plan to NCLT but NCLT rejects that plan? What happens if COC approves the plan and the plan is forwarded to NCLT, it is approved by the NCLT, but you fail to implement the plan? In all these cases, the immediate next consequence will be liquidation. Now company will go into liquidation. Next one. When company went for liquidation, what about the position of RP? He can continue as liquidator. Now his role will be changed. Now he will become liquidator. Or NCLT, if it want to change the existing person, they can appoint some other person as liquidator. That means the same person can be continued as liquidator or some other person can be appointed as liquidator. Now what this liquidator will do? So first of all, he will collect the money and he will pay the money. So he will collect the money, he will pay the money. So from where he will collect the money? First one, by selling assets. So for this purpose, he will prepare a estate called as liquidation estate. So he will prepare a estate called as liquidation estate. Now he collect all the money which is recoverable by the company, and that total amount will be called as liquidation estate. Now this liquidation estate will be used to pay the liabilities of company. And what is the priority of liabilities? First, liquidation cost need to be paid, first priority. Second priority, workers. So who are having outstanding dues of more than or equal to 24 months, those amounts need to be paid, and you need to pay money to secured creditors. So both these people will be given with equal priority, that in second category. Next, third category. In third category, you will make payment to employees who are having more than or equal to 12 months outstanding wages. And fourth priority will be given to unsecured people, and last priority will be given to government. So like this priority will be given, and all debts will be repaid. If it is not possible to repay all the debts, everyone will get some proportionate amount. Next one, after doing all these things, liquidator will give final report. After giving final report, the process will be completed. Now what is the entire process? Once again, first one, company need to commit a default. Default means non-payment of money. So when company fails to pay the money, who can file a case against the company? Company itself, or financial creditor, or operational creditor. So with whom these people need to file the case? NCLT. So while filing the case, they must propose IRP, but in case of operational creditor, it is not mandatory. And they need to provide default proof, but in case of operational creditor, he need to provide 10 days time. If company fail to pay the money, or if company fail to raise the dispute within the 10 days, then only these people can go to NCLT. And what is the time limit available to NCLT to dispose of the case? 14 days. And within 14 days, it will either accept the case or reject the case, or it will ask for resubmission. And if it asks for resubmission, it need to be resubmitted within 7 days. Again, within 14 days, they will accept or reject the case. Now CIRP process will be initiated if the case is accepted by the NCLT. And what is the time limit to complete this entire process? So it is 180 days. If COC with the permission of 66% creditors asked for the extension of time, then a maximum extension of 90 days will be given. Total it will become 270 days. But in few cases there will be some court appeals, court stay orders. So after considering those stay orders also, it shall not exceed 330 days. It shall not exceed 330 days. Maximum limit is 330 days. Next one. Now, in this case, after approving the plan, what NCLT will do? It will make public announcement. It will announce moratorium in order to give relaxation to the corporate debtor. It will appoint IRP. So in case if the proposed candidate is having disciplinary action proceedings, then it will ask IBBA to send another person. In case if operational creditor so has not proposed any person as IRP, then also it will ask IBBA to send a person. Next one. So now the appointed IRP will form COC, and COC will contain financial creditors only, but not operational creditors. And within 7 days of constitution, they will conduct first meeting and they will appoint RP. So while appointing RP, they can continue with the IRP or they can appoint some other person. If they want to continue with the IRP, communication to NCLT is required. If they want to appoint some other person, communication to NCLT, approval of IBBA, both are required. Next one. Now what this RP will do? He will prepare information memorandum. Based on this information memorandum, resolution applicant, that is investor, will prepare investment plan, that is resolution plan. This resolution plan need to be agreed by COC with 66% voting. Next one. Thereafter, the resolution plan need to be forwarded to NCLT and NCLT need to approve it. After approval of NCLT, the plan can be implemented. So by this, the process will get completed. But what happens if there is any negative point? Negative point means COC fails to accept any plan. COC accept the plan, but it was rejected by NCLT. both accepted the plan, but it was implementation failure, then also it will be a negative point. In all these negative points, what will happen? NCLT will order for liquidation. When NCLT order for liquidation, RP will continue as liquidator, or some other person can be appointed as liquidator. So he will collect the claims. From where he will collect the claims? From assets. Not only assets, from even contributories also they will collect the money. List A contributories, list B contributories in case of finding up. That is the persons who are holding partly paid shares. They need to contribute up to unpaid value of shares. In case of guarantee company, they need to contribute up to guaranteed value. In case of unlimited company, they need to contribute unlimited assets. So all these contributions need to be added to the assets, and this entire amount will be called as liquidation estate. Now this liquidation estate is used to pay the liabilities in this order. Next one. So by this the entire process got completed. Let's see the material now. First one, applicability. So for which companies, for which persons IBC is applicable, and for which persons IBC is not applicable? Companies, is it applicable or not? Yes, whether it is incorporated under Companies Act or whether it is incorporated under Special Act, it doesn't matter. IBC is applicable. For LLPs, yes. For body corporates, yes. For partnership firms, individuals, proprietary firms, yes. And for personal guarantors, yes. But we need to classify these people into two categories. One is company, LLP, body corporate, and corporate guarantor. Other one is individual, proprietary firm, partnership firm. So these cases will be covered under corporate insolvency, and these cases will be covered under personal insolvency. That's it. But in exam, you are not required to make that kind of classification. You are required to write all the points. Next one. What about the non-applicability of IBC? It is not applicable for the financial service provider. Examples: banks, financial institutions, insurance companies, asset reconstruction companies, mutual funds, and investment companies. Next one. Who are the authorities that got covered under IBC? IBBA. So what is the role of IBBA? They will maintain the data of insolvency professionals. Once they qualify the exams that are conducted by respective agencies, so those people will be enrolled in Insolvency and Bankruptcy Board of India board. So they will have the database of insolvency professionals. Next one. And it will maintain another database called as information utility. Next one. Who is the adjudicating authority? NCLT or DRT. So in case of corporate insolvency, NCLT, personal insolvency, DRT. And insolvency professional agencies: ICAI, ICMAI, ICSI. Next one. Insolvency professionals: CA, CMA, CS with 10 years practicing experience and qualified exam conducted by insolvency professional agencies, and finally they are registered with IBBI. Next one. And IP can act like IRP, IP can act like RP, IP can act like liquidator. Next one, information utility, nothing but database that is being maintained by IBBI. So when any person gave any loan to company, then that data need to be recorded in information utility. It will act like evidence in future. Next one, corporate debtor means company, LLP, body corporate which made payment default is called as corporate debtor. Financial creditor means corporate debtor to whom the financial debt is owed. Operational creditor to whom operational debt is owed. What is the difference between financial debt and operational debt? So this is loan transaction, this is credit purchase transaction. So in case of loan, when you take loan from any person, that any person will be called as financial creditor. If you buy goods on credit basis from any supplier, that supplier will be called as operational creditor, and the person who took all these things will be called as corporate debtor. Next one, resolution plan. So resolution plan will be given by whom? Resolution applicant. Given to whom? Resolution professional, that is RP. And it will be forwarded to whom? COC for their approval. After COC approval, it will be forwarded to whom? NCLT. And finally, if NCLT approves the plan, it will be implemented by the company. Next one, resolution professional. So IRP, RP. So initially, the person who is appointed as RP will be called as IRP. Later, he will be replaced by RP. Next one, resolution applicant. Nothing but the investor who came up with investment plan. That is resolution plan. Then who can initiate insolvency resolution process? Financial creditor, operational creditor, corporate debtor. Now, in following cases, initiating CIRP is not possible. What are those cases? First one, already one CIRP is initiated against the company. So during that time, another CIRP cannot be initiated against the same company. Already it is under liquidation process. Already it is under initiation process. Then no one can initiate another CIRP. So 2 points got covered. What are those 2 points? So already CIRP is initiated against the company, or already liquidation is initiated against the company. Once the company is under this process, now no one can initiate another CIRP against the same company. Next one. Now CIRP was initiated, but it got failed during the last 12 months. Now it need to wait for 12 months in order to go for another CIRP. Next one, CIRP was made and it was implemented successfully. Then also you need to wait for 12 months. That means if it is under CIRP process and the CIRP not possible. If recently CIRP process got completed and the CIRP process not possible, but you need to wait for how many months? 12 months. If in last 12 months, if there is any dispute regarding CIRP process, then also not possible. And finally, if the company is under liquidation, CIRP process not possible. In all these 4 cases, a fresh CIRP cannot be initiated against company. Next one. Then, who is not eligible to be a resolution applicant? Resolution applicant means investor who came up with resolution plan, that is investment plan. So some people are eligible, some people are not eligible. So who are eligible? Every person is eligible except the following persons. Then who are not eligible to be a resolution applicant, that is investor? If he is insolvent, not eligible. If he is willful defaulter of any loan, not eligible. So if he is having any NPA with the company, not eligible. If he is imprisoned for 2 years under IBC, 7 years under any other law, then also he is not eligible. So for IBC, only 2 years. For any other law, 7 years. So if any person is imprisoned for 2 years under IBC or 7 years under any law, that person cannot act like investor, that is resolution applicant. If he is disqualified to act like director disqualification, not eligible. Next one. If he made any fraudulent transactions, not eligible. If he is the guarantor, not eligible. So if he is having any of these disabilities in any other country, not in India, not eligible. And if any person is connected to these above people, not eligible. So all these people are not eligible to act like resolution applicant. That means these people cannot become resolution applicant. These people cannot give resolution plan. If any resolution plan is given by these people, the COC need to reject it. If COC fails to reject it, NCLT will reject the plan, because these people are not allowed to prepare resolution plan. Next one. So how financial creditor will initiate legal action? You can refer question number 6. Next one. How operational creditor will initiate CRP? You can refer question number 7. This process is already completed. They need to propose IRP. They need to provide the proofs for the default. In case of operational creditor, they need to provide 10 days time. All this concept got completed. Next one. For question number 8, CIRP initiation by corporate debtor itself. In all these cases, the common point is 14 days time is given to NCLT. NCLT will initially either accept it or reject it or ask for resubmission. But for second time, only 2 options: acceptance, rejection. Next one. What is the time limit? Time limit for completion of CIRP. It is also completed. And time extension. For time extension, 66% COC approval is required. So that is mandatory. And please remember, in most of the cases, COC approval is required with the help of 66% only. Only in case of secured creditors, it will be 75%. In majority of cases, it is 66 only. If there is any MCQ based on this, if you remember exact point, you can go with that exact point. Otherwise, go with 66%. Because in many cases, it is 66 only. Next one. What NCLT will do? It will announce moratorium. It will make public announcement. And it will appoint IRP also. It will do three things: moratorium, public announcement, IRP appointment. Now, what is the duty of IRP? He need to take out the management of the company, and he need to collect the claims of the creditors, and based on such claims, he need to form COC, Committee of Creditors. These are the duties of IRP. Now, what about COC? In COC, who can be the member? Only financial creditor. But for the meetings of COC, who can attend? Members of COC can attend, that is financial creditor. Operational creditor having at least 10% of total outstanding can also attend the meeting, but he is not entitled to vote. He can attend the meeting, but he is not entitled to vote. What about financial creditor? He can attend the meeting, he can vote at the meeting. And board of directors of the company can also attend the meeting. But these people are also not entitled to vote. So all these people can attend the meeting, but voting is available only to the financial creditors for the members of COC. Sir, what happens if two banks give consortium loan? Say for example, SBI and HDFC give 10 crore loan. So this is a consortium loan, not given by single bank. It is given by multiple banks. That's why it is called as consortium loan. Now what will happen in case if it is a consortium loan? Then SBI will have 60% share. HDFC will have 40% share in the consortium loan. Then both are allowed to participate in COC meetings. And both are allowed to vote also. But the voting will be based on this percentage. So based on 60-40 percentage, voting will be divided. Next one. What happens if a single person is having both financial debt as well as operational debt? He can become member of COC. But his voting will be restricted only to financial debt, but not to operational debt. In simple words, who can become member and who can attend meeting and who can vote at the meeting? Only financial creditor. Next one. Who can attend the meeting but can't vote? Operational creditor, that too very large operational creditor. Next one. Board of directors of company. In case if it is LLP, partners. Next one. Related party to the corporate debtor. This is also important question. Who are the related party to the corporate debtor? Directors in case if it is company, partners in case if it is LLP. Next one. So if this company, another company is having common director, if this LLP, another LLP is having common partner, and this is corporate debtor, and even these people can also become related parties. So my partner, my director is related party. If my partner or director is there in another company or another LLP, even that another company and LLP will become my related parties. Next one. KMP is a related party. In case if it is a private company, if the director holds more than 2% of share capital, then that private company can also become related party. Next one. Holding and subsidiary companies are related parties, and 20% voting rights means associate company. It is also called as related party. So company having more than 2 directors in common is a related party. So these are the names. You need to remember the names and you need to reproduce in the exams. Next one. Procedure for appointment of resolution professional. Yes, after creating COC, they need to conduct first meeting within 7 days. With 66% of voting, they need to appoint IRP as RP. Then communication to NCLT is required, or they can appoint some other person as RP. Then communication to NCLT is required. Confirmation from IBBA is also required. Next one. So these points are already covered. Preparation of information memorandum. Who will prepare the information memorandum? RP will prepare the information memorandum. It will contain the all particulars about the company. So what is the purpose of preparing this information memorandum? In order to show this information memorandum to resolution applicant. So that resolution applicant will prepare a resolution plan which need to be approved by COC and thereafter by NCLT. So for approval of resolution plan also, how much voting percentage is required? Same 66%. Next one, liquidation process. When liquidation process will start? If COC failed to provide the plan, or COC provides the plan but NCLT rejects it. If COC and NCLT both agreed the plan but company fails to implement it. In all these cases, NCLT will order for liquidation. Next one. Now, what about liquidator? Now, NCLT will continue with the RP also. RP as liquidator. Or NCLT will appoint some other person as liquidator. Now, this liquidator will take the charge over the company, and all officers and employees in that company need to support the liquidator. Next one. And what are the powers and duties of liquidator? Very simple. He will collect the money. He will pay the money. That is the main obligation. So, for collecting money, he will prepare a liquidation estate, and he will collect the money from selling of assets and from shareholders also. Next one, after making liquidation estate, he will use the liquidation estate in order to make payment. Then what about the payment priority? So this is liquidation estate. So liquidation estate includes these assets. Liquidation estate does not include these assets. You can refer on your own. Very easy concept only. So if the property belongs to company, then it will be added here. If the property does not belong to the company, then it need to be excluded from the liquidation estate. Next one. And how to distribute the liquidation of assets? So by using a priority order. What is the priority order? Liquidation cost, workman dues, and secured creditor dues. Next one, employees dues. Next one, unsecured, and final priority should be given to government. So by this we completed about IBC, and two more chapters are pending. One is corporate governance, other one is compromise arrangement, amalgamation. So if we completed both these chapters, then 60% descriptive questions got completed, and 20 marks descriptive objective questions are pending. In afternoon class, that too for first hour, I will try to complete all the objective questions which are given in MCQ booklet, because for these two chapters it will take at least 1.5 hours to 2 hours. So by 1 o'clock or before 1 o'clock I will finish these two chapters. So afternoon we are having a class that is 2:30 to 3:30. In that class I will try to explain all the MCQs which are given in MCQ booklet. I think there are around 117 MCQs. So if we prepare these 117 MCQs, then we can easily score either 30 out of 30 MCQs. In worst situation, we can score at least 20 out of 30 in case of MCQs. So that is the advantage. So in afternoon class, it will take exactly 1 hour time. In that 1 hour, I will complete all the MCQs which are given in MCQ book. So next chapter, corporate governance. So in this chapter, we are going to learn about 3 topics. First one, corporate governance. Second one, social responsibility. And third one, sustainable development. So first of all, we need to know about these 3 terms. First one, corporate governance. So what is meant by corporate governance? Say for example, there is a company and it has some goals to achieve. Now in order to achieve those goals, company can follow lawful approach, company can follow unlawful approach also, unethical approach also. Because for achieving desired results, for achieving goals, so company can go for ethical behavior or company can go for unethical behavior. If company goes for unethical behavior to achieve the goals, it will be called as management. If company goes for ethical behavior to achieve the goals, then it will be called as corporate governance. So what is meant by corporate governance? Corporate governance means achieving the desired goals, but by following ethical procedures. So here, achieving goals is not so important. Then what is important? The process of achieving goals is important. So they will try to make ethical procedure in order to achieve the goals. The process is very important for corporate governance. So in India, previously, the companies will be managed by the board of directors. So they will try to do anything, whatever they like, in order to achieve the desired goals. But now, because of SEBI regulations, every company need to follow corporate governance. That means corporate governance will help you to achieve your goals in ethical manner. So that is the meaning of corporate governance. Then what about social responsibility? So every company will try to work for profit. So profit means income for its shareholders, income for the company. At the same time, they need to think about society also. They need to do something to the society also. That kind of responsibility will be called as social responsibility. CSR is the best example. So every company need to contribute at least 2% of the average net profit, last 3 years net profit. So that amount should be spent for public purpose, which is called as CSR. So CSR is nothing but a social responsibility. And finally, sustainable development. What is meant by sustainable development? So using the resources of the present generation without compromising for the future generations. That means there are some resources. So now the present generation can utilize those resources. There is no problem at all. But they need to keep some reserve of such resources for future generation. So if they did like this, it will be called as sustainable development. That means corporate governance. Next one, social responsibility. And next one, sustainable development. All these topics got covered in this chapter. So corporate governance, it will focus on achieving results in ethical manner, and social responsibility, showing some concern towards the society, and sustainable development, so keeping the interest of future generations also. So these are the main objectives. Now let's see two different questions. One is about ethics versus corporate governance. Other one is about corporate governance versus management. Let's first see corporate governance versus management. So in case of management, what are the main objective? Objects and targets. That's it. In order to achieve such object and target, they will do anything, whether it is in unethical manner also, they will do that thing in order to achieve the desired object and target. But what about corporate governance? Corporate governance mainly focus on method of achieving the results. It will not focus on results. It will focus on method of achieving the results. Next one. Then at which level of management this management concept will be applied? It is applicable to all levels. All levels means top level, middle level, bottom level. So management can be practiced at top level management, middle level management, and bottom level management. Then what about corporate governance? It is only applicable to top level. Because who need to create a code of conduct? Who need to create ethical conduct? Top level management, and it need to be followed by the remaining people. So it will be created by the top level management. But in case of management, so it will be there at top level, middle level, bottom level. Next one. Then how a person can develop management skill? It depends upon the situation. So based on situation, a person will develop management skill. And what about corporate governance? We need to study SEBI regulations, and we need to have experience of implementing SEBI regulations. Then only we can know about corporate governance. Next one. That means corporate governance is a book concept, whereas management is based on situation. Next one. What about management? Organization can create their own rules. There is no problem. But in case of corporate governance, already there are rules by SEBI. We need to follow those rules. So regulations are important. SEBI regulations are important. Next one. In case of management, what is more important? Results rather than methodology. But in case of corporate governance, methodology rather than results. Now say, what are the differences between management and corporate governance? In management, the primary focus should be on objects and targets. In case of corporate governance, method of achieving those objects and targets. So management will be applied at which level? At all levels. But corporate governance, top level. And how to develop management skills? Based on situation. How to develop corporate governance skills? Based on study and experience. And in case of management, company will create its own rules. But in case of corporate governance, we need to follow the regulations which are given by SEBI. And which one is more important in management? Results rather than methodology of achieving results. In case of corporate governance, methodology of achieving results is more important than results. Next one. Differences between ethics and corporate governance. So ethics means doing something in good manner. Corporate governance means achieving results in ethical manner, that is good manner. Then what is the difference between ethics and corporate governance? Same. In case of ethics, values and principles will be considered as foundation. In case of corporate governance, method of governance, it all discuss about method of governance. Say for example, in case of employment, employee need to be ethical. In case of supplier, supplier need to be ethical. In case of distributor, distributor need to be ethical. So ethics is applicable in each and every place. But what about corporate governance? It is applicable only in case of top level management, that too only in case of governing the company. That's it. So it is a limited concept. Corporate governance is a limited concept, whereas ethics is the broader concept. Next one, where to apply ethics? At all levels. What about corporate governance? Only at top level. Next one, how to develop ethics? It will emerge naturally, just like management skills. But what about corporate governance? Study and experience is required. And what about regulations? Is there any regulations for ethics? No. But is there any regulations for corporate governance? Yes, called as SEBI regulations. Now say, what is the difference between management, corporate governance as well as ethics? Foundation, management. Objects and targets, corporate governance. Methodology of governance. And ethics, values and principles. Applicable at which level? Management, all levels. Corporate governance, top level. And ethics, all levels. Next, how to develop it? Management, situation. Corporate governance, study and experience. And what about ethics? Naturally. And regulations. No regulations in case of management. There are regulations in case of corporate governance. And there are no regulations in case of ethics. An extra difference in case of management and corporate governance is, here results are more important than methodology, and here methodology is more important than results. Next one, objectives of corporate governance. First objective, satisfaction of stakeholder. So what is meant by stakeholder? Who is the stakeholder? All the shareholders, debenture holders, bond holders, employees, bankers who gave loan to the company, government who is collecting taxes from the company. So every person who is related to the affairs of the company will be called as stakeholder. Now, the main objective of doing business by following corporate governance is to satisfy all the stakeholders. So how to satisfy all the stakeholders? You need to maintain a balanced interest among all the stakeholders. That means you need to respect shareholders. You need to respect debenture holders. You need to respect employees. You need to respect each and every person who is associated with the company. So you can't show superiority, inferiority in between stakeholders. For you, all stakeholders need to be same, at same level. If you satisfy all the stakeholders, then your company is going good in corporate governance. Next one, transparency. What is meant by transparency? Transparency means disclosing everything to the public. Confidentiality means hiding everything from the public. Then which thing we need to follow? For the matters which require public disclosure, transparency must be followed by the company. For the matters which need not be disclosed to the public, yes, company need to maintain confidentiality. So company need to follow transparency in case of disclosures which are required to be made to public. Next one, composition of board of directors. So board of directors must contain normal directors, independent directors. Then how many independent directors must be there in case of board of directors team? It all depends upon who is chairman. So I am saying about SEBI regulations, not about Companies Act. If it is Companies Act, for listed companies, 1/3. For unlisted companies which is satisfying any of the criteria, at least 2. But according to SEBI regulations, in case if chairman is executive chairman, if chairman is executive chairman, 1/3. If chairman is non-executive chairman, half. So like that we need to take. Next one, optimum use of resources. So whatever the resources the company is having, those resources must be utilized optimally. Optimally means without any wastage. So without any wastage, so every company need to utilize their resources, because it will benefit not only the company, it will benefit all the stakeholders. Next one, reduction of risk. So what is meant by reduction of risk? Say for example, if company is having any risk, it need to try to reduce the risk. So how a company will try to reduce the risk? Say for example, there is a risk of financial scam. So how a company will reduce that risk? By appointing internal auditor. By appointing internal auditor, the risk of committing financial scam may be reduced. So if there is any risk for the company must try to reduce the risk. Next one, developing trust. Yes, it need to develop trust between various stakeholders. If trust is built in various stakeholders, then company brand image will also be increased. So these are the objectives of corporate governance. What is the first objective? You need to satisfy all the stakeholders. Next one, and you need to maintain transparency wherever it is required. Next one, the board of directors must contain independent directors also according to SEBI regulations. Next one, if there is any resource for the company need to utilize such resource in optimal manner so as to benefit the company as well as stakeholders. And if there is any risk for the company must try to reduce that risk. And company need to develop trust among various stakeholders in order to increase its own value. Next one, what are the features of corporate governance? So transparency, which is already completed now. Next one, prudent and participative management. So what is meant by prudent and participative management? So first of all, the management should expect future risk for the company. That means management must be prudent. So after expecting future risk, they need to take proactive actions in order to reduce the risk or in order to mitigate the risk. So that kind of management must be there for the company in order to go for a good corporate governance practice. Next one, enhancing value of enterprise. How to enhance the value of enterprise? By creating trust among the various stakeholders. So just now we completed that point. So by creating trust among the stakeholders, because of the trust, the value of enterprise will increase. Accountability. What is meant by accountability? Taking responsibility. So management, so if they did any decision and company suffered with loss, then management need to take that responsibility. So no need to take the loss. They need to take the responsibility. So if they fail to take the responsibility, then it is not a good corporate governance practice. So in order to make it as a good corporate governance practice, every management should be accountable. They should take responsibility of running the company in a better manner. Next one, innovation. So what is meant by innovation? Creating new things is innovation, or providing new features to the existing things is also called as innovation. So company should be innovative. What happens if company is not innovative? Then company will fail to attract the customers. Ultimately, company will lose the business. Ultimately, stakeholders will suffer with loss. Next one. The directors need to maintain both professionalism as well as specialization. That means they need to have professional experience, professional qualification, and they need to have specialized knowledge also in order to run the company. And every stakeholder need to be recognized by the company. So they can't say only because of employees we came to this position. They can't say only because of our shareholders we came to this position. They need to respect each and every stakeholder. So what are the features of corporate governance? First one, transparency. What kind of management? Prudent and participative management. And how to enhance the value of the enterprise? By creating trust among the stakeholders. And management need to take responsibility. And management should think in innovative manner. And management need to maintain professionalism and specialization. And management need to recognize each and every stakeholder. Then what are the benefits of corporate governance? So if you followed corporate governance, then it will fetch you growth. That to stabilizer growth. What is meant by stabilizer growth? Say for example, today the profit is 1 rupee. Tomorrow 2. Day after tomorrow 3, 4, 5, 6 like that. That means, is there any growth in the company's performance? Yes. Is this growth is sustainable growth? Yes, it is a sustainable growth. It is a steady growth. What happens if company earns 1 rupee profit in today and 10 rupees profit tomorrow and 2 rupees profit in day after tomorrow and 30 rupees profit and 40 rupees loss. So this is not a growth. This is not a steady growth. And this kind of entity will definitely suffer with losses in future. So the growth should be steady, constant. So how it will be achieved? It will be achieved by following corporate governance. Next one. And the funds of the company must be utilized optimally. Yes, this point is also covered. Next one. Better management of resources, optimum utilization only. Better governance ensures long-term and steady growth. This point is covered in point number 1 itself. So, growth and stabilization. Next one. Establishing stakeholders' confidence, nothing but creating trust in stakeholders. And because of all these things, you will get some competitive advantage also. This is new point. So, what is meant by getting competitive advantage? Say, for example, there are two companies. One company is following corporate governance, another company is not following corporate governance. Now, both these companies are competitors to each other. Now, one company will get competitive advantage. How competitive advantage can be gained? By using lower prices, by offering innovative features, or by following corporate governance also you can achieve competitive advantage. Next one. And alliances is also very easy. Say for example, there are two companies, one company is following CG, other company is not following CG. If any other company want to make alliance like merger or joint venture like projects, then it will merge or create joint venture with which type of companies? The companies which are following corporate governance. So alliances are also will become easy. So these are all the advantages of corporate governance. So what is the first advantage? Growth will be there and it is stabilized growth. Next one, reputation of the company will enhance. Next one, funds of the company need to be utilized in a better manner and resources need to be managed in a better manner. Both points are almost all similar. So long-term and steady growth, which is related to point number 1 only, and establishing stakeholders' confidence and leveraging competitive advantage and making easy alliances. So these are all the advantages of corporate governance. Next one, corporate governance rating. So what is the purpose of corporate governance rating? That means every company need to provide certain number of points for the implementation of corporate governance. Now these points will decide the rating of the corporate governance that is being followed by that company. And what the purpose of getting rankings here? Very simple. If shareholder want to invest in your company, if he is very much concerned about corporate governance, then a better corporate governance rating will fetch you that investment. If that person is not interested about corporate governance, anyway he will make the investment, no problem at all. But the shareholders who want to invest in the company based on corporate governance, for them to attract their investment, corporate governance rating will be useful. Not only for the purpose of attracting investment, the corporate governance rating will be useful to compare one company with another company. So among both this company, which company is following corporate governance in more efficient manner? So in order to know about it, you need to check the rating of both the companies. The company with better rating is following corporate governance in effective manner. So that's why I will prefer that company. So in order to compare two companies also, this rating is useful. Next one. Corporate governance in family owned companies in India. So what is meant by family owned companies? Because once you completed your CMA and if you started practice, you will get certain companies like private companies, OPCs. And in those companies, the majority people will be family members only. Say for example, you created a partnership firm for your client. Partners will be two, husband, wife. Next one, you created a company, private company. There are only two members, husband, wife. Or if any person is added in that family, they are nothing but member of that private company. Say for example, son, daughter. So they will add into the members of private company. That means all the members of the private company, all the members of partnership firms will be family members only. In India, most of the businesses are like that only. Only few businesses are owned by some non-family members. But most of the businesses in India are owned by family members only. Now the point is family owned companies. So family owned companies means it is a private company where the shares are held only by family members. So is there anything wrong in it? No, there is nothing wrong in it. In India, so this kind of business are very large in number. Now let's see some of the points relating to family owned companies. First one. So who can act like full-time director? Family member. Who can act like other director? Family member. Who can act like senior management personnel? Family member. Who can act like CEO? Family member. CFO? Family member. Auditor? It is not possible. Okay. So all the top level management will be from family itself. Next one. So formation of coterie is common. What is meant by formation of coterie? Some disputes. Because if the people are non-family members, disputes are very less in number. If the people are members or family members, then disputes are quite common. Next one. And what about control and ownership? So control and ownership will be diluted by passing generations. What is the reason? Say for example, previously there are only 2 members in the company. That means each member will have 50% share. Now 2 more people were added to the company. 25%. Another 2 people added in the company. Now shareholding will be diluted. So by passing generations, what will happen? The shareholding will be diluted. What happens if these people are expired? Now the shareholding will increase. What happens if these people got expired? Again shareholding will be increased. That means the shareholding of each person is dependent upon number of family members. So because of birth, the shareholding will be decreased. Because of death, shareholding will be increased. Next one. And there is a high chances of conflict of interest. Why there is high chances of conflict of interest? Because it is their company. It is their company, their wish, they can do anything. Say for example, if me and my friend started a business, then definitely I am going to respect the views of my friend. My friend will respect the views of me. But what happens if the other person is my family member? I will not respect, because other person is my family member. So I will do whatever I like. So there is a conflict of interest in family owned businesses. And moreover, emotions and attachments are more in case of family owned business. Say for example, a person started a business, oil business. So it is a failed business. Now this person got expired, his son take over the business and he started another business and he is running that business successfully, but he is not going to close this oil business. Why? Because it is opened by his father. Even though it is not a successful entity, it is a failure entity, still he will run the company in order to make his father happy. So he is emotionally attached with that company. But what happens if there is no family relation here? If it is a loss making company, definitely he will close that company today itself. But it is attached emotionally. That's why he will not close the company even though it is financially not suitable. Next one. And in case of family owned companies, the decision making is very complex, because husband will say one thing, wife will say another thing, son will say one other thing. So there will be dispute among the family members regarding decision making. So definitely because of this thing, the decision making process will be in a delayed manner. That means in case of normal company, to take decisions, it will take 1 to 2 days time. But in case if it is family business, to take the decision, it will take 10 to 20 days or even more than 20 days also, because of continuous disputes. Next one. So in order to face this kind of situations, every family business will have a clear cut rules. So clear cut rule means, say for example, if the company need to take any decision, only I will take the decision. If it is related to sales, you can take the decision. If it is related to purchases, you can take the decision. Like this, they can create a clear cut rules before the formation of company, so that the disputes will be very minimal. Next one. And personal image of chairman, MD, directors is very important. So why their personal image is very important? Very simple. So we all people respect Ratan Tata. That's why we will respect all Tata products. So because of personal image of one person, we are respecting his companies also. So that's why personal image of chairman, personal image of managing director, personal image of director is also important. Next one. What about many hardcore professionals like you? So they definitely don't want to do business with these people. Why? Always there are quarrels between them. Decision making is, so it is a very delay process. So how a hardcore professional will work with this kind of entities? So definitely he will not work. Next one. And what happens if senior member got expired all of a sudden? Now a leadership crisis will begin. Now who will become leader? Who need to take over the company? Who need to take the charge? Now there is a dispute regarding this. So these are the issues in family owned business. So what are the issues? First one, who will be in the top level management? Family members. And disputes are very common. Next one, control and ownership. It will be increased because of death. It will be decreased because of birth. Next one, what about interest? Always there will be a chance of conflict of interest. And what about emotions or attachments? So very high in this kind of companies. And what about decision making process? Lots of delay will happen. So in order to avoid this, they can fix clear cut roles. And what about the personal image of chairman, MD, director? It is also very important for the success of entity. And what about hardcore professionals? They will avoid to work with this kind of companies. Next one, what about the death of senior member? It will create leadership crisis. Next one, continuation. So in few companies, not in all companies, in majority companies, the companies are owned by family members. Those companies are controlled by family members. But only in few companies, the company is owned by family members, but it is controlled by non-family members. So owners are family members. But what about top level management? So there are some different people who are not a family member. That means family will create the company. They will create the company, but they will not run the company. They will appoint some efficient people to run the company. Next one. So even family members can run the business today. Reason is they are acquiring professional courses from reputed institutes like CA Institute, CMA Institute, CS Institute. So when they got the knowledge of CA, CMA, CS, they can easily run the company. Next one. So promoters are encouraging professionals in the organization. Yes, if any person is allotted with any role in the top level management by the family members, then that person will be encouraged by the family members. That means conflict of interest will be very less. Why conflict of interest is very less? Because they want the business to be independent. So they want to do business in efficient manner. So that's why they are not involving the business. So that's why they are appointing some non-family members in the top level management. So that's why they are encouraging those people in order to run the business in successful manner. Next one. So here promoters are more focused on compliance. Why they are more focused on compliance? Because if anything is happened, if Companies Act or SEBI regulations got violated, huge penalties will be levied on the company. So that's why promoters will focus more on compliance. And if any regulatory authority like SEBI, RBI or Companies Act, ROC, if they imposed any fine on the company, definitely it is going to impact the share value in the stock market. Best example, Paytm. So RBI made some restrictions on Paytm. Because of such restrictions, what about the share value of the Paytm? Yes, it is reduced drastically. Next one. Role and leadership clarity is decided at board level. Yes, now there is clear-cut clarity because family members are not involved in this case. Outsiders are involved. So at the time of appointment only, they will decide who will act like CEO, who will act like CFO, who will act like professional. Next one. And owners will accept and honor the opinion of managers. So what is the meaning of this point? So owners can't implement their decisions directly. They will ask the opinion of the manager and they will respect the opinion of manager. And while taking decision, they will consider the opinion of manager. Next one. Then what about family, social and emotional issues? So if they want to satisfy those emotional or attachments, then they can form trust or foundation. which will do some chartable activities. Best example, previously, so father created oil company, son created another company. Oil company is a failure company, other company is a successful company, but still the son is running the company that is being created by the father. But in this case, without continuing that company, he will open a chartable company on the name of father, and he will do chartable activities with the help of that company. So by this we completed about corporate governance. Next one, social responsibility. So in case of social responsibility, we need to discuss about corporate social responsibility. That means the company need to do something for the society. So before doing something to the society, what they need to do? First, they need to identify the area where to implement the CSR project. So after determining the area, what they need to do? They need to identify the project. Say for example, a company got average net profits in last 3 years is 100 crores. Now out of 100 crores, they need to spend 2 crores for CSR project. Now they need to decide two aspects. One is where to spend this money. Other one is how to spend this money. So where to spend this money means the place where they need to spend the money. How to spend this money means they need to identify the project. So is it for education purpose? Is it for any other purpose? Like that, they need to identify the project. So after identifying the area, after identifying the project, they can spend the money in that identified area, that too in that identified project. Next one, collaborative projects. What is meant by collaborative projects? Say for example, a company want to construct a school in order to donate that school to the public for their welfare, which is nothing but CSR activity. Now, for the construction of school, it requires 5 crores. But company is having only 2 crores to spend for the construction of school. Now, what company can do? Company can collaborate with another company which is having same kind of CSR objective. So, if it collaborates with another company which is having same kind of similar objective, then this company will contribute 2 crores and this company will contribute 3 crores, and entire 5 crores will be contributed in total, and this amount will be utilized to construct school, which is nothing but CSR objective. So here CSR objective is carried not by single entity, it is carried by one entity in collaboration with another entity. So this is called as collaborative project. Okay, so this will be covered, this example will be covered in point number 1, collaboration with other companies. And you can collaborate with government also, but the government will not have enough funds to carry the CSR project. Then what is the advantage of collaborating with government? When you collaborate with government, triple P model can be implemented. What is meant by triple P model? Public private partnership. It is called as public private partnership. So if you collaborated with government, then by seeing government, certain entities will give you some amount as donation. Now my company is having only 2 crores. I want to collaborate with AP state government. Yes, I can collaborate with AP state government. If I collaborated with AP state government, then some organizations will give voluntary donations to your company, so that you will get entire 3 lakhs and the 3 crores. Total amount will become 5 crores, and you can use this 5 crores for the construction of school. So this is collaboration with government. So first one is collaboration with other companies. Second one is collaboration with governments. But in which model? Triple P model. Next one, collaboration with specialized agencies. Say for example, your company is having 5 crores money, but you don't have enough knowledge about construction of buildings. So what you can do now? You can give that money to a specialized agency, so which is already having enough experience in construction. Now these specialized agencies will construct a school building for you for this 5 crore rupees. Now this is also called as collaboration. But now this collaboration is made with whom? Specialized agencies. Then what are the examples for specialized agencies? Community based organizations like caste based community organizations. Next one, local bodies like panchayats or municipalities, voluntary agencies like NGOs, or institutions or academic organizations, or trust or missions self-help group, nothing but Dwakra groups, government, semi-government, autonomous organizations, Mahila Mandals. So all these are nothing but specialized implementing agencies. So now the company which want to spend some money for CSR need to collaborate with specialized implementing agencies in order to implement CSR project. So now say, what about question number 8? In order to spend for CSR, they will identify two things. First one, area where to spend the CSR. Second one, project, on which project they need to spend CSR. So after that, they will collaborate with others. So they will collaborate with other companies. They will collaborate with government under PPP model. They will collaborate with specialized agencies also. Or it can do CSR obligation on its own also without any collaboration. Next one, evaluation of project. So how to evaluate the project under CSR? First of all, before spending the expenditure, you need to evaluate the project. After spending the expenditure, you need to evaluate the project. So before spending the amount, how to evaluate the project? You need to conduct feasibility study, which is called as due diligence. So you need to conduct due diligence. You need to check feasibility, whether it is feasible or not. You need to check that aspect. That is called as evaluation of project before spending expenditure. Then what is meant by evaluation of project after spending expenditure? After spending expenditure, you need to evaluate the project, and that evaluation will be called as impact assessment. What is meant by impact assessment? Okay, you spent the money for CSR, fine. Then what about the result of that CSR activity? So what about the desired people? So what about the desired result? Whether they are achieved or not? All these things need to be assessed by the company. So this is nothing but evaluation of project after its implementation. So before implementation, you need to evaluate the project in order to check its feasibility. After implementation also, you need to check the process, because whether it is implemented successfully or not, you need to know about it. Next one, third party implementation. So what is meant by third party implementation? You can give the CSR obligation money to some other third party. They will spend the money on behalf of you. This is called as third party implementation. Okay, in case of third party implementation, what kind of evaluation we need to make? First, we need to make each and everything as a documentation. That means proper documentation must be maintained. Next one, I need to inspect the third party project site. I need to check the track record of the third party. I need to take the feedback of both beneficiaries as well as sponsors. That means, say for example, my company want to spend 2 crores for CSR. So there is a third party who will implement this project. Now I donated this 2 crores to this third party. Now this third party is already having track record. This third party is already having some sponsors like this company. And this sponsors amount is spent for some beneficiaries. Now I need to take the feedback from both sponsors as well as beneficiaries. Next one, I need to interview the person who is responsible for the implementation of a CSR project. So all these things need to be checked in case of third party implementation. Next one, what are the advantages and disadvantages of third party implementation? First one, if third party implements a project, they are having expertise knowledge. So that is the advantage. So they will have better supervision. Advantage. They can make unbiased decisions. Advantage. Single point coordination. Advantage. And we can make cost negotiations with them. Advantage. So all these things are advantages when we offer the project to the third party. Next one, what are the disadvantage? First one, supervision. Yes, we need to check frequently whether the third party is implementing the project successfully or not. We need to supervise it. So it is a disadvantage. Next one, lack of domain knowledge of the agency. Actually, this agency does not have the knowledge. This agency does not have the relevant experience, but still you give the money to the third party agency. Now supervision will be more. And one more important point, because of lack of expertise knowledge, so beneficiaries will not get intended benefit. Next one, what about section 80G benefit? It is not available. What is meant by section 80G benefit? Donation. That benefit is not available. And biased decisions are also possible. So previously, one of the advantages is unbiased decision and disadvantage is biased decision. What is the meaning of this point? Say for example, if you give the money to the third party, then you will not be involved in the decision making process of the third party. That means from you there will not be any biased decisions. It is advantage. But these people can make biased decisions. These people can benefit their own employees, own people. So here biased decisions is possible. So this will become disadvantage. Next one. And no proper accounting. What happens if this third party is not maintaining books of accounts properly? Then you can't supervise the work of the third party. That is also disadvantage. And some negative points and dominance of local area. What happens if this third party is having huge dominance in local area? Then everybody will try to support this third party only. Whether they are successfully implementing the project or not, everybody will try to protect this third party. Next one, lack of adequate monitoring by the company. So supervision is required on third party. What happens if company fails to supervise the third party? Third party can misutilize the funds. So these are all the disadvantages. Next one, impact assessment already completed. Last one, sustainable development. So what is meant by sustainable development? So using the resources by keeping some reserve for future generations. And what are the steps involved in sustainable development? So there are three approaches. One is economic approach, other one is environment approach, third one is social approach. In economic approach, we need to focus more on profit. In environment approach, we need to focus more on planet. In social approach, we need to focus more on people. So this is also called as triple P model. So the triple P model which is given here is different, and triple P model which we discuss here is different. So in case of government, triple P model means public private partnership. Here triple P model means profit, planet, people. So profit means economic approach, planet means environment approach, people means social approach. So while taking decisions, you need to think about your profit, you need to think about people who are associated with the company along with public, and you need to think about planet. And this is also known as triple bottom line approach or 3Ps approach. Next one, what are the need of sustainable management? So first of all, where to take sustainable management? We need to take sustainable management in businesses, we need to take sustainable management in communities, and we need to take sustainable management in natural resources and even in our personal lives also. So sustainable management is useful not only in business, it is also useful in community development, it is also useful in preservation of natural resources, it is also useful in to making our personal lives as a better lives. Next one, sustainability reporting. You can read this question on your own. Next one, last question, which is important question, NGRBC principles. So NGRBC means National Guidelines on Responsible Business Conduct. So according to NGRBC guidelines, every company is required to follow 9 principles. So in exam, you can be asked with any 1 or 2 principles, or you can be expected to write all the principles. First one, business should conduct and govern themselves with integrity. Integrity means utmost honesty. Ethical. Ethical means good governing practices. Transparent. Transparent means all public disclosures need to be made transparently. Accountable. Accountable means the management need to take responsibility. So this is applicable to every business entity. So every business entity need to maintain honesty. Every business entity need to work in ethical manner. Every business entity need to maintain transparency and accountability. That is principle number 1. Next one, principle number 2. Now this is also applicable to business entity. So business entity, while providing goods or services, they need to provide such kind of goods and services which are sustainable and safe. So they need to give safe goods and safe services. They need to provide sustainable goods and sustainable services. Next one, principle number 3. They need to respect and promote the well-being of all employees. That means they need to think about their employees, whether they are involved in non-value chain or they are involved in value chain. Value chain means it's the series of operation which will create some value to the company. Non-value chain means it is a series of operations which will not create any value to the company. If the employee is working in any operation, whether it is in value chain operation or non-value chain operation, all the employees need to be respected. All the employees need to be promoted. Next one. Not only employees, all the business entities need to support and respect stakeholders also. So employees need to be respected, stakeholders need to be respected. Next one. And human rights. So principle number 5, all business entities need to respect and promote human rights. So point number 3, respect and promote employees. Point number 4, respect and promote stakeholders. Point number 5, respect and promote human rights. And finally, respect and promote and protect environment. So they need to try everything to maintain proper environment. Next one. Now, while making any regulatory policy, say for example, government is creating some act, or government is creating some rules or regulations. So whenever government is creating some act or rules or regulations, so business entities will be offered with an option. What is that option? If they want to convey anything, they can convey it to the government, so that government will include those points in act, rules and regulations also. Now, being a senior person in the business entities, what you are supposed to do? So you need to provide a responsible and transparent suggestions. So responsible suggestions means you cannot give a suggestion that will benefit only you. You must provide a suggestion which is beneficial to all the business entities. And that suggestion need to be transparent. Next one. So you need to promote inclusive growth and equitable development. What is meant by inclusive growth and equitable development? So for example, I am business entity and I want to grow sustainably. Okay. Along with me, I need to add my competitors also, my other entities also, neighboring entities also. That means I need to grow not as a single entity. I need to grow as multiple entities, as a group. That means inclusive growth is required, not personal growth. So growth of entire community is required. Next one. And finally, I need to provide some value to the consumers. Consumers means customers. So I need to provide some value added services to the consumers. So these are the 9 principles of NGRBC. First one, every business entity need to maintain integrity. They need to be ethical, transparent and accountable. And they need to provide goods and services which are sustainable and safe. And they need to respect and promote employees, respect and promote stakeholders, and respect and promote human rights, and respect and protect environment. And finally, whenever an act or rule or regulatory regulations are being made by the government, they need to provide proper suggestions also. And they need to promote inclusive growth, not only personal growth, they need to offer growth to neighbors also. And finally, they need to provide value addition to the consumers. So based on these points, you can write the internal content on your own. And one more chapter is left. What is that chapter? Compromise, arrangement, amalgamation. First one, what is the name of this chapter? Compromise, arrangement, amalgamation. So what is meant by compromise? Compromise means there is a dispute between company and shareholders. Now these disputes need to be compromised, or there is a dispute in between company and creditors, and this dispute need to be resolved by making compromise. So compromise means it will arise only in case of dispute, and the dispute may happen in between company and shareholders or may happen in between company and creditors, and this dispute need to be solved, and that solving procedure will be called as compromise. Then what is meant by arrangement? In case of arrangement, there may be a dispute or not. So here shareholders will make some arrangements. Say for example, they will lose some value, creditors may lose some value. So this is called as arrangement. Say for example, internal reconstruction. So in case of internal reconstruction, what shareholders will do? Shareholders will give off certain paid up share capital, creditors will give off certain debt amount. So that kind of arrangement will be called as arrangement under this chapter. Next one, amalgamation. What is meant by amalgamation? Here amalgamation includes both merger and amalgamation. So for example, A Limited, B Limited merged with each other and they become AB Limited. This is called as merger. If A Limited acquired B Limited and continuing as A Limited, it is called as amalgamation. So it will be covered under amalgamation. So compromise means it is only applicable in case of disputes. Arrangement means it is applicable in case of disputes. Even though if there is no dispute, company can make arrangement. And finally, amalgamation means mergers and amalgamations. Now the point is, in case of compromise or arrangement, what they need to do? First, they need to prepare the plan. They need to prepare the plan of compromise or plan of arrangement. After preparing the plan, they need to file that plan with NCLT. Now NCLT will order for meeting. So whose meeting? Meeting of creditors or meeting of shareholders? Why meeting of creditors? Say for example, if there is any compromise between company and shareholders, then shareholders need to be conduct a meeting. And what about creditors dispute? In case of dispute between company and creditors, there must be a compromise arrangement between company and creditors. That means the creditors need to meet. Now the meeting will be ordered by the NCLT. So in that meeting, creditors or shareholders will decide the matter. They will approve the plan. So once the plan is approved by the meeting members, it need to be approved by the NCLT. After NCLT approval, the plan will be implemented. So this is how compromise or arrangement procedure will take off. First one, first they will prepare a plan for compromise or arrangement, and they will file the plan with NCLT. Later NCLT will order for the meeting of creditors or meeting of shareholders, as the case may be. Now that creditors or shareholders who are there in the meeting need to approve the plan, and plan need to be subsequently approved by NCLT. Finally it will be implemented in the company. Now the point is, in the entire situation, we need to focus more on the notice for the meeting, because to call for a meeting, a notice must be given to the members. Then what about the content of that notice? We need to know about it. That is the first one. Second one, once NCLT gave final order, so what about the content of the NCLT order? That is the second one. So now we need to focus on these 2 points. Next one, in case of amalgamation, the procedure will be same. In case of amalgamation, the procedure will be same. First they will prepare the plan of amalgamation. Later they will go to NCLT to get approval. Now NCLT will order for meeting of creditors or meeting of members. Now in that meeting they will approve the plan. Next one, later final approval need to be given by NCLT, and later it need to be implemented. So same process will be followed in the amalgamation procedure also. But what is the difference means, the content of notice in case of compromise or arrangement is different from content of notice in case of amalgamation. Next one, the content in the NCLT order in case of compromise or arrangement is different from the content of NCLT order in case of amalgamation. So only in these 2 cases the points are different. Remaining points are same. Okay, now let's see the detailed procedure. Okay, now there is a dispute between company and creditors, or there is a dispute between company and shareholders. Now, to solve this dispute, company prepared a plan for compromise and arrangement. So can they implement the plan directly? No. They can't implement the compromise or arrangement plan directly. What they need to do? They need to get the approval of NCLT. Now, what is the first step they need to do? They need to file an application with the NCLT. Application to NCLT. But after filing application to NCLT, so it won't accept the plan immediately. So it will ask the company to conduct the meeting of creditors. In case if the dispute is related to creditors, it will ask the company to conduct the meeting of shareholders if the dispute is related to shareholders. So now NCLT will ask to conduct meeting. It will ask to conduct meeting. Now the main point is, for this meeting we need to provide the notice. So this meeting must be subject to issue of notice. Then what about the content of that notice? That is covered in question number 1. We need to refer question number 1. Okay. First of all, let's try to complete this concept. So notice will be issued to the creditors or the shareholders as the case may be. And now they can raise objections. Who can raise objections? Creditors or shareholders. Okay, how many people need to raise objection? In case of shareholders, the persons having 10% shares. In case of creditors, the persons having 5% debt. They can make the objections. Next one, not only creditors and shareholders, even some regulatory authorities can make objections. Now, you will receive objections. After receiving objections from all the people, now you need to make necessary changes in the plan. And the updated plan need to be submitted in the meeting. Now in that meeting, it need to be approved. How many people need to agree in order to approve the plan? So if it is shareholders or if it is creditors, whoever it may be, so 2 conditions need to be satisfied. In number, more than 50% people need to agree. In value, at least 3/4 in value is required. That means in number we need to check. Say for example 10 members are there, so out of 10 at least 6 members need to agree, and in the hands of those 6 members at least 3/4 value must be there. That means these 6 members need to hold at least 3/4 shares. These 6 members need to hold at least 3/4 creditor value. So both conditions need to be satisfied. So after their approval, the plan will be again forwarded to NCLT. Now NCLT will give approval and NCLT will give order also. And this order need to be filed with ROC. Next one. Now the point is, if it is related to amalgamation, there will be an extra point. In case of amalgamation or merger, it is not a short-term point. It is a long-term point. That means it will take number of years, so many number of years to complete the process. That's why for every year we need to take a certificate from CA or CMA or CS about the completion stage. That means if amalgamation or merger takes 3 years, then for each of the 3 years, CA or CMA or CS need to give a certificate about the level of compliance. Okay, by first year 20% process got completed. In second year, balance 30% process got completed. In last year, enter 50% process is completed. Like that, they need to give a certificate to the government. But this point is only applicable in case of amalgamation merger. This is not applicable in case of compromise or arrangement. Now say what is the procedure? First one, when this will start? This will start with a dispute. Dispute between whom? Company and creditor or company and shareholder. Now to solve this dispute, they will prepare a plan for compromise and arrangement. And this plan will be forwarded to NCLT. NCLT will order for meeting. So company need to issue notice for the meeting. Now in that notice, there will be certain content which need to be discussed in the material. Next one. And who can give objections for this plan? Creditors, shareholders, regulatory authorities. For regulatory authorities, they can raise objections at any point of time. In case of shareholders, they can raise objections only if they are having at least 10% of shares. In case of creditors, they can make objections only if they are having at least 5% of total debt. So after making objections, the plan will be updated and the updated plan will be placed in the meeting. In that meeting, shareholders or creditors, If it is shareholders meeting, shareholders. If it is creditors meeting, creditor. They need to give approval. So here two kinds of approvals are required. One is in number, majority people need to agree. In value, those people need to have at least 3/4 in total value. So after approval, you need to forward the approved plan to NCLT. So NCLT will give an order, and this order need to be forwarded to ROC. By this, compromise arrangement will be completed. But in case of amalgamation or merger, as it is a lengthy process, for every year ending, CR, CMA or CS need to provide a certificate regarding level of completion. And what is the difference between compromise and arrangement and amalgamation and merger? The difference will be there in notice content, and the difference will be there in NCLT's order content. So in these two cases there will be difference. And one more difference is CMA CS certificate. It is not required in case of compromise arrangement, but it is required in case of amalgamation merger. So content of notice. So what about the content of notice? So first of all, we need to remember three important people, that is KMP, director, promoter. So these are the three important people in the entire content of the notice. So this notice is given to whom? Shareholders, creditors, regulatory authorities. Okay, what is the purpose of this notice? To invite them for the meeting and to invite them for giving objections also. Okay, then what about the content of this notice? First one. So in the proposed compromise or arrangement, so the plan which is proposed by the people, so is it going to benefit any of these people? You need to comment on it. So KMP, directors, promoter. So what about the benefit received by these people because of this proposed plan? And what is the benefit received by these people because of the proposed plan? You need to comment. Now, why I differentiated KMP directors and promoters with remaining people? Because in case of remaining people, if they are not getting any benefit, they are not required to say anything. But if these three people are not getting any benefit, they need to say, yes, we are not getting any benefit. That means a statement is required. So in case of these three people, if they got any benefit, they need to disclose it. So if they are not getting any benefit, then also they need to make disclosure. But what about remaining people? They are required to disclose only when they are getting benefit. When they are not getting benefit, disclosure is not required. Next one. Now, again, three important people. What are those three people? KMP, director, promoter. So in case of KMP, director, promoter, is there any investigation proceedings? So investigation, who can carry investigation? Only central government. Inspection, inquiry, investigation. Who can carry investigation? Only central government. What kind of investigation? Investigation into affairs of the company. Investigation into ownership of the company. Investigation by SFIO. So if there is any investigation proceeding against KMP, director, promoter, if yes, provide the details. Next one. In case of KMP, directors, promoter, you need to provide the shareholding pattern also during last 6 months. So during last 6 months, what is the shareholding of these three people? You need to provide that point. So with respect to KMP, directors, promoter, we completed 3 points. What are those 3 points? If they are having any benefit, they need to disclose. If they are not having any benefit, then also they are required to disclose. Next one. If there is any investigation proceeding pending against them, they need to disclose. And they need to disclose their shareholding during last 6 months. Next one. And you need to take no objection from various authorities for the proposed plan. Next one. Next, you need to prepare these documents, latest audited financial statements, in case CFS is applicable, including CFS, and order copy of tribunal, and copy of plan of compromise or arrangement, and the contracts or agreements which are material to the compromise or arrangement. So all these important documents need to be kept at registered office. If any person want to inspect these documents, company need to allow those persons. Say for example, if member want to inspect these documents, company must allow inspection. If creditor want to inspect these documents, company must allow those people to inspect the documents. Next one. So remaining points already completed. Now, contents of the order of tribunal. So we completed contents of the notice. Now the contents of the order of the tribunal. So if the compromise or arrangement is with respect to convertible preference shares, actually company need to pay dividend to the convertible preference shares in cash. So at the time of redemption, preference shareholders are repaid not by cash but by giving equity shares. But company failed to pay the dividend to the preference shareholders. Now there is a dispute between company and shareholders. Now in order to compromise this dispute, they prepared a plan. Now what tribunal will do? Tribunal will say, what about the position of dividend? Because preference shareholders, convertible preference shareholders are entitled to two things. One is dividend, one is repayment. In case of dividend, they need to get in cash. In case of repayment, they need to get in equity shares. Now there is a dispute. In this dispute, what is the compromise which was made by the preference shareholders? In case of repayment, there will be no change. They need to get equity shares only. But what about dividend? If it is not paid in cash, it need to be paid either in equity shares. So either cash or either equity shares. Anything is allowed. So what is the proposed scheme? It will be set by tribunal in its order. Okay, the dividend will be paid in cash, or the dividend will be paid in equity shares, or the dividend will be paid partly in cash, partly in equity shares. So they need to comment about the payment of dividend. But what about repayment? It will always remain constant. Next one. Now, if it is relating to variation of shareholder right, is it possible to reduce the shareholder right? Yes. So this concept is there in CMA Inter. So it is possible to reduce the rights of the shareholder. Now, there is a section called as section 48. Now NCLT need to give its opinion whether the company followed section 48 with respect to variation of shareholders' rights or not. Next one. And what about creditors? If the dispute with creditors, the NCLT need to ensure that whether creditors are protected or not. And what about dissenting shareholders? Dissenting shareholders means, okay, majority people agreed. People having 3/4 value of shares are agreed. What about the other shareholders? Other shareholders are called as dissenting shareholders. For dissenting shareholders, what company need to do? It need to provide exit offer. What is meant by exit offer? The promoters of that company need to buy the shares of those people, and those people will vacate the company. So that is called as exit offer. So is there any exit offer for the dissenting shareholders? All these things need to be commented by NCLT in its order. So this is the content of tribunal's order. Remaining points already discussed. Next one, merger or amalgamation. So there are three differences. First one, content of notice. Second one, content of order. Third one, CMA CS report. So CMA CS report completed. We need to check content of order, content of notice. Let's see content of notice first. Content of notice. So in case of amalgamation or merger, they need to say whether the proposed terms are adopted by the directors or not. They need to comment on it. Next one, because of proposed term, will there be any positive or negative impact on any class of shareholders, KMP, promoters and non-promoter shareholders? If yes, say that. And in case, if any property is being valued by registered valuer, so then report of registered valuer need to be attached. And you need to provide latest audited financial statements. But if you are going to amalgamation or merger after 6 months from the end of financial year, then you need to prepare supplementary financial statements also. That means in 2023-24 financial year, I prepared financials. Now I'm in 2024-25 financial year, and that too on October 1st. So on October 1st, I want to amalgamate my company. I want to merge my company. So can I provide previous financial statements? Yes, but already 6 months time is expired. So as 6 months time is expired, I need to provide extra document also. What is that extra document? Supplementary financial statements. Supplementary financial statements will contain the data from financial year starting to before October 1st. Next one, content of tribunal order. So tribunal order must contain the following contents. First one, transferee company and transferor company. Transferor company means, say for example, A Limited, B Limited merge with each other and they become AB Limited. So AB Limited will be called as transferor, A Limited transferee, B Limited transferee. A Limited bought B Limited and it become A Limited only. So here A Limited is called as transferor, transferee. Wait a minute. So in case of merger, what is the example? A Limited, B Limited merge with each other and they become AB Limited. Who is transferring the assets here? A Limited. Who is transferring the assets here? B Limited. Who is getting the assets here? AB Limited. So A Limited and B Limited will be called as transferor companies and AB Limited will be called as transferee company. Similarly, in case of amalgamation, A Limited is buying B Limited. So who is selling the assets? B Limited. That is, B Limited is transferor. Who is buying the assets? A Limited. So A Limited will be called as transferee company. Now the point is, who need to pay purchase consideration here? So transferor company will give its assets and liabilities to transferee company. So transferee company need to pay purchase consideration. It need to pay purchase consideration. And transfer company need to transfer assets and liabilities. Next one. Now, the tribunal order must contain about transfer of undertakings, properties, liabilities from transferor company to transferee company. So, which asset, which liability is going to be transferred from transferor company to transferee company? It need to be noted by tribunal. Next one. And what about purchase consideration? In what kind purchase consideration is being discharged by transferee company? It need to be noted by tribunal. So purchase consideration can be discharged either by cash or by giving shares or debentures or giving some other instruments also. So PC can be discharged in any way. Next one. And they need to comment on pending legal proceedings. So what about the legal proceedings which are pending against the transferor company? It will be transferred to transferee company. Next one. And what about the transferor company? It will be closed. It will be dissolved. And it will be merged with transferee company. Say for example, A Limited, B Limited, both are transferor companies. After merger, A Limited will be dissolved. B Limited will be dissolved. Next one. A Limited is buying B Limited. After amalgamation, B Limited will be dissolved. So now tribunal need to comment about dissolution. Next one. And in case of dissenting shareholders, so whether promoters are buying the shares of dissenting shareholders, if yes, what is the price offered to them, and within what time you are going to purchase the shares of dissenting shareholders, all these things will be provided here. Next one. In case of allotment of shares to non-residents, so especially the countries which are sharing land border with India, because at the time of COVID, so China is trying to buy many shares in our Indian company in order to get control over the Indian companies. So in order to avoid this kind of situations, government made some regulations in FEMA, that is Foreign Exchange Management Act. So what is that regulation? If any person who is from a country which is sharing land border with India, like Pakistan, China, Bangladesh, so if any person from those countries want to buy shares of Indian company, they need to take the prior approval of RBI. So now it need to be taken care by NCLT. And what about the position of employees? Employees of transfer company, it will get transferred to transferee company. So the tribunal order must address assets and liabilities which need to be transferred to transferee company, purchase consideration which need to be paid to transferor company, and the employees of transferor company, pending litigations of transferor company, position of transferor company, and the dissenting shareholders of transferor company. So NCLT need to address all these things. Next one. Merger or amalgamation in case of foreign companies. So is it allowed? So Indian company want to acquire foreign company. Is it allowed? Yes, allowed. But how to make purchase consideration payment? It can be made either by way of cash or by way of depository receipt. Depository receipt means ADR, GDR, IDR. So by using depository receipts, you can make payment. So by using cash, you can make payment, or you can make payment partly by using cash, partly by using depository receipts. And remaining provisions, they will apply mutatis mutandis. That means the normal companies which are required to follow the provisions regarding merger and amalgamation, the same provisions are applicable for amalgamation of foreign companies also. Next one. Is it possible for central government to order for amalgamation or merger? Yes. That means there are two companies, A Limited, B Limited. Both companies are not interested in merger. So both companies are not interested in merger. But CG passes an order against both the companies to do merger. Can CG passes such kind of order? Yes. But CG need to give such kind of orders only in the interest of public. So for public interest, CG can announce either amalgamation or merger between two companies, even though those two companies are not interested. But what about the shareholders? What about the creditors? The shareholders and creditors must be continued with the same rights. So before amalgamation and merger, what are the rights available to the shareholder and creditor? The same need to be continued even after merger or amalgamation. So what happens when rights got reduced? Then they are entitled to get compensation. Then who need to pay compensation? Central government need to pay compensation. If they are getting adequate compensation, there is no problem at all. What happens if they are getting only inadequate compensation, very small compensation? Then they can appeal to NCLT. Now NCLT will order the CG to pay adequate compensation. Next one more concept is pending, that is fast track merger or amalgamation. So what is meant by fast track merger or amalgamation? So without doing all these things, you can simply follow a simplified procedure in order to merge or amalgamate with another company. But this is applicable for only few companies. So which companies can go for fast track merger and amalgamation? First one small company with another small company. So one small company and another small company, they want to make merger or they want to make amalgamation. They can go for fast track merger or amalgamation. Next one startup company want to merge or amalgamate with another startup company. So they can go for fast track merger or amalgamation instead of following this entire procedure. Next one small company want to merge with startup company. So here also what is possible? Fast track merger and amalgamation is possible. Next one, holding company want to merge or amalgamate with wholly owned subsidiary, not normal subsidiary. So holding company want to merge or amalgamate with wholly owned subsidiary company. Then also they are allowed for fast track merger and amalgamation. That means in these combinations, fast track merger or amalgamation is possible. In remaining cases, they need to follow regular method. What is meant by regular method? They need to prepare the plan. They need to go to NCLT. NCLT will order for meeting. They need to send the notice for the meeting, and they need to conduct the meeting by taking objections, and in that meeting they need to take approval. Thereafter they need to forward the approval to the NCLT. So NCLT will give final approval, and CS, CMA, CS approvals are also required. So this is regular procedure, but instead of regular procedure they can opt for fast track procedure, but that is possible only in case of these combinations. Now what is the procedure in case of fast track merger or amalgamation? Very simple. Here also there will be two companies, transfer company, transferee company. So transfer company and transferee company will convey about their proposal to ROC as well as liquidator. Why liquidator? Because after amalgamation or after merger, any one of the condition is going to be dissolved. So that's why even liquidator is also required here. Liquidator means insolvency professional who is registered with IBBI. Okay, now transfer company and transferee company need to communicate about the proposal to the ROC as well as liquidator for getting objections if any. After doing that, transfer company need to conduct shareholders and creditors meeting. Transferee company need to conduct shareholders plus creditor meeting. Now in this meeting, shareholders and creditors need to give their consent. In case of shareholders, 95% of shareholders need to agree. In case of creditors, 9/10 in value having creditors need to agree for the proposal. If approval is given like this, then they will communicate this approval to three parties now. For those three parties means ROC, liquidator as well as CG. So why to ROC and liquidator? because initially they communicated to ROC liquidator. They already gave some objections. Based on that objection, they prepared the plan. Now that plan got approved by shareholders and creditors. Now again this plan need to be forwarded to these two people in order to check if there is any further objection is there or not. So if there is no further objection, then CG will close the matter. How CG will close the matter? It will order for merger or amalgamation. That's it. So what happens if there is objection still now? What happens if CG is not satisfied? Then CG will order these companies to go for regular method, not for fast track method. So this is how CG will settle the matter. So by this we completed compromise, arrangement and amalgamation also. So how many chapters completed till now? 60 marks, huh? So first of all, knowing about the questions is okay, but you need to read the questions and you need to write the questions in the exams. So then only you can achieve 60 marks. And moreover, so we are attempting for 60 marks in descriptive questions, but there is a chance to get around 30 to 40. If you write well, you will get 50. And along with descriptive questions, if you prepare well for MCQs also, you can easily get another 20 marks. That means qualifying in law subject is very easy, but getting more number of marks requires some preparation and some presentation in exam is also required. So first of all, you need to prepare well. You need to prepare all the questions which are given here without any choice, because we already made choice. We already excluded some questions. So don't do choice once again. Just follow all the questions given, which are given in this marathon material. So try to prepare each and every question. You are not required to reproduce as it is, but you are required to write at least relevant content. In your own words also there is no problem. So no need to reproduce it, but you must be able to write the points which are relevant to it. Then how much content to write? So if it is a 7 marks question, try to write on both sides of the paper. I'm saying on both sides of the paper. That means it may be with 10 points or 20 points or 30 points. It depends upon your presentation. So whatever presentation you can adopt, it's your wish, but you need to fill both sides of the paper for 7 marks question. For 3 or 4 marks question, try to fill one side of the paper. For 7 marks, both sides. For 3 or 4 marks, one side. Next one. And what about MCQs? In case of MCQs, you are not required to provide any reason, but you need to write the question number and option. Say for example, question number 1, option B. You need to write the content of option B. That's it. No need to write all the options. And the correct option is option B, like that. Just write the correct option, it will be sufficient. That means, say for example, a question is asked in exam. In that question, 4 options are given: A 100, B 200, C 300, D none of the above. Now the answer is none of the above. Now you need to write D, none of the above. And you are not required to provide any reason also. You are not required to reproduce all the options also. Just write the final answer, it will be sufficient. But just don't put just alphabet, that is A, B, C, D. Write entire content. If it is A 100. If it is B 200. If it is C 300. You need to write the entire option, because you are provided with 2 marks. So you can't just give just one single alphabet. So write entire answer and no need to provide reason. If you want to provide reason for all the questions. Because if you provide reason for some questions, then they will consider those questions as correct questions and they will provide you 2 marks. What happens other questions? In case of other questions, they will allot you only with 1 mark, because you had not provided any reason for them. So that's why don't create that kind of confusion among valuationers. So if you want to write reasons for all the questions. Otherwise, simply skip the reasons. So previously in new scheme for the first attempt, they asked reasons also. So you are required to write reasons like that. They gave disclaimer also. But from second attempt onwards, they are not giving such kind of disclaimer. So in that situation, we are not required to provide any reason. So that's why without any reason, you can provide your answer. Next one. In case of theory questions, you need to write all the theory questions in points wise with appropriate side headings. So how many points we need to write? It all depends upon you. But you need to fill at least 2 sides of the page in case if it is 7 marks, at least 1 side of the page in case if it is 3 or 4 marks. Okay. Which one? Page number? Or not? 5. NGRBC principles. So actually it is a theory content. So UNO, which is nothing but United Nations Organization. So they give certain principles of responsible investments. And these principles were supported by 3,500 signatories. That means they proposed the principles and 3,500 people supported those principles. Next one. So they want to integrate ESG factors. ESG factors means environment, social, governance. So environment means planet, social means people, governance means profit. So they want to integrate these ESG factors with investment decision making. That means if any person want to invest in any company, they will check all these factors. So after checking these factors, if he is satisfied, then only he will make investment. Otherwise, he will not make any investment. Next one. So most of the large companies in the world already following this kind of procedure. Next one. So here the main problem initially is rating. So previously the rating parameters is different for different companies. That means I cannot compare the rating of one company with the rating of another company because the parameters are different. But now the things got completely changed. Now every company is required to maintain uniform format and every reporting agency need to give rating based on uniform parameters. Now it is very easy to compare one company with another company and you can make investment decision also based on that rating. Next one. So previously ESG rating is not mandatory, but now it is mandatory. So previously ESG is completely optional. It is a philosophy and practice. If you want to follow it, you can follow. Otherwise it is not required. But now it becomes mandatory. Next one. So in 2015, SEBI has prescribed a formatting for reporting ESG parameters and this is mandatory for listed entities. Next one. Now this format got again updated in May 2021. Now it becomes BRSR. So it is business responsibility and sustainability report. Next one. Now they will check ESG factors and they will check NGRBC principles and they will compare these ESG factors with each principle of NGRBC. So whether we achieved ESG factors in principle number 1, whether we achieved ESG factors in principle number 2, whether we achieved ESG factors in principle number 3. So they will correlate with each and every principle and they will make reporting. And that report is called as BRSR, which stands for Business Responsibility and Sustainability Report. Next one. And every parameter is divided into 2 indicators: leadership indicator, essential indicator. Essential indicator means it must be followed by the company. Leadership indicator means it is voluntary, but it is following it because it want to stand as a leader for other companies. So that's why even though it is voluntary, they are following it. So all voluntary indicators need to be provided in this category. All mandatory things need to be provided in this category. And what is the purpose of the disclosure? So the purpose is very simple, in order to give more information to the stakeholder, so that stakeholder can take effective decision while investing his money in the company. And not only this point, so if you followed all these things, then you will show a sustainable growth to the other entities also. So what is meant by sustainable growth? You can continue your company for any n number of years, that too with steady growth. So that is the main advantage of this disclosure. So with effect from financial year 2022-23, the filing is mandatory for top 1000 listed entities. So top 1000 listed entities means based on market capitalization. See the MCQ bank. First one, how many minimum members are required to form a public limited company? In order to be a government company, 51% of shares need to be held by CG or SG, or jointly by CG or SG. That means any or all of the above. See in CMA MCQs, there is a trick. If any option is having all of the above, then go for all of the above. Okay. In case of listed companies, in case of limited companies, what is limited? Liability of members. Restriction in transfer of shares can be there in private company. In case of public company, shares are freely transferable. Foreign company is a company registered outside India but having place of business in India or having business conduct in India. That means either A or B. That is option D. Next one. Company which do not have any significant accounting transaction is called as dormant company. Life Insurance Corporation is, it is a statutory corporation, as well as it will be classified as public financial institution. So answer is B. Persons who sign the MOA are called subscribers. Certificate of incorporation is issued by ROC. Declaration by professional at the time of incorporation of company means declaration by CA, CMA, CS, advocate. So any of the above. Change of register office within city or town or village requires. So here there will be 4 cases. In the same city, if you want to shift from one locality to another locality, BR is sufficient. Next one, if you want to shift from one city to another city, then SR is required. If you want to shift from one state to another state, SR plus CG's approval is required. In case of Maharashtra, if you want to shift from Mumbai to Pune, so it is change of city and moreover change of ROC also. So in that special situation, SR plus CG's approval is required. So total 4 cases: within same city, within same state but different city but same ROC, within same state, different city, different ROC like Maharashtra, and finally change of state. So in case of within same city, BR, so one city to another city but same state, same ROC, SR. One city to another city but ROC will be changed, then it will be SR plus CG approval, and state to state SR plus CG. In this case within the city only, that's why what is required? Board resolution. Section 8 companies cannot. Yes, payment of dividend is prohibited. Next one, ABS Limited is registered in India with 100% shares being held by KYZ Limited, a company registered in UK having no business in India. ABS Limited is called as, in options they're asking about Indian company, foreign company, wholly owned subsidiary, does not come under the definition of foreign company. It is Indian company. ABC Limited, they are asking about ABC Limited, not about other company. They are asking about holding company. The holding company got incorporated in India, so that's why any company which is incorporated in India will be called as Indian company. Next one, does not come under definition of foreign company is also correct, but most appropriate answer is Indian company. So you can mark this question. So it is not called as foreign company. So B is wrong. It is holding company. It is not subsidiary company. C is wrong. But D, it does not come under the definition of foreign company. It is correct only. But accurate answer is Indian company. Next one. ABS Limited has 35% shares in XYZ Limited. The majority of directors of XYZ Limited are appointed and removed by ABS Limited. So XYZ Limited is subsidiary. A guarantee company is similar to LLP. Why it is similar to LLP? Because in case of LLP, the partner's liability is limited. In case of guarantee company also, members' liability is limited. To what extent it was limited? In case of LLP, so partner's liability is limited up to the agreed amount. In case of guarantee also, members' liability is limited up to agreed amount. So that's why the liability of guarantee company is very much similar to the liability of LLP. So answer is LLP. So now, once a company is converted into LLP, intimation to ROC has to be made within 15 days. Next one. Which chapter of Companies Act 2013 deals with foreign companies? It is chapter number 22. So mark this question. Because they will ask questions on chapter numbers, they will ask questions on section numbers, they will ask questions on form numbers. But it is not possible to remember each and every section number, form number and chapter number. So that's why let's try to remember those which are given in MCQ booklet. Next one. In case of secured debentures of public issue, the security must be created in favor of trustee. Very good, trustee. Fully convertible debenture is a debt instrument. Don't go for FR. Financial instruments chapter. So you need to answer this question as per law. So it is a debt instrument. Next one. What about register of deposit? Yes, it is mandatory. Then what about the content? According to rules of companies. That is option number C. Next one. A debenture trustee can be an entity registered with SEBI. So this is a tricky question. Mark this question. So debenture trustee must be an entity which is registered with SEBI. Loan in parallels to Companies Act means cash credit. So this is also a tricky question. Because generally loan means all the four options. But generally in case of Companies Act, loan means cash credit. So which is a tricky question, that's why I need to mark it. Next one. In case of deposits by the company, no brokerage can be given. Any amount of brokerage can be given. Rate of brokerage shall be as per RBI regulations. Rate of brokerage shall be as per SEBI regulations. Answer is RBI. So in case of deposits, how much interest rate need to be paid? How much brokerage need to be paid? It will be decided by RBI. So RBI will decide for banking companies as well as NBFCs. Now the companies which are going to accept deposits need to follow the rates which are prescribed for NBFC. Next one. Once declared in AGM, dividend cannot be revoked. Next one. IEPF stands for Investor Education and Protection Fund. Next one. Once declared, the amount of dividend shall be transferred to special dividend account within 5 days. A practicing CA may be appointed as auditor for the term of 5 years. But if it is a government company, 1 year. But when nothing is given, it is a non-government company only. Next one. Director responsibility statement is a part of board report. NFRA stands for National Financial Reporting Authority. A. A statutory auditor shall be practicing CA. Next one. In normal course, the board report is signed by chairman with the authority of board. If chairman is not authorized by the board, then some other people need to sign on the board report or financials. Next one. CAG stands for Comptroller and Auditor General. That is option B. Financial statements are to be filed with the register within 30 days of AGM. If it is annual returns, within 60 days of AGM. If it is OPC, AGM is not applicable. That's why within 180 days of end of financial year. Next one. In case of private company, internal auditor has to be appointed if the turnover is 200 crores or more. Next one. Auditor report is addressed to shareholder. In audit report, the first sentence is to the members of the so-and-so company. That means the addressee will be members, that is shareholders. Caro 2020 is effective from next year. Next year means 1/4/2021. Next one, first auditor is appointed by, in case of government company, C&AG. In case of normal company, board of directors. When nothing is given, it is a normal company, so it is board of directors. But don't go for C&AG. Next one, auditor can render the following additional service to the company where he is the auditor. Internal audit not allowed, accounting and bookkeeping not allowed, investment advisory services not allowed, because all of them are section 144 services. And answer is none of the above. Next one, additional director tenure is up to additional director. Next AGM, alternate director may be appointed when the additional is out of India for at least 3 months. A woman director has to be there is the company is listed company. So paid up capital 100 crores, turnover 300 crores. So turnover is given. So answer is either of the above. Next one, section 184 of Companies Act provide for. Actually, section 184 deals with interested directors concept. So that are directors who are interested in the transaction made by the company, those directors need to disclose about the interest to the company. And that person shall not participate in the meeting. That person shall not vote in the meeting. But here what options are given? Ordinary, board, special is given. So nothing is correct. So answer is none. A whole-time director is appointed for a term of 5 years. So managing director, whole-time director, manager will be appointed for 5 years. Are they eligible for reappointment? Yes. For how many times? For n number of times they are eligible for reappointment. But basically the tenure will be 5 years. Next one. If a person other than retiring director is proposed, a check of dash is to be deposited with the proposal. Say for example, I want to become a director in the company. So through special notice, I said I will become director of this company. So please prepare agenda like this. So then I need to deposit how much amount? 1 lakh. What happens if I won the election? Then amount will be refunded. What happens if I lose the election? Then also amount will be refunded if I got more than 25% of favorable votes. Next one. A director may be appointed by small shareholder. Small shareholder means shareholders who hold shares worth of face value of maximum 20,000. A company may remove a director with. So if he is appointed by war, by war. If he is appointed by SR, by SR. But nothing is given here. So we need to take war. Next one. Managing director's appointment is ratified in AGM through ordinary resolution. First of all, MD or WTD or manager will be appointed by board of directors. Later, the decision need to be ratified by shareholders by passing ordinary resolution. Next one. Section 203 provides for the appointment of. Mark this point. It is on section number. It is KMP. Next one. The eligibility and conditions of appointment of MD is mentioned in which schedule? Schedule number 5. So schedule number 1, MOA, 2, depreciation, 3, financial statements, 4, independent director, 5, MD, WTD, whole-time director, 6, infrastructure projects, 7, CSR projects. So answer is 5. Maximum remuneration to all managerial personnel is 11%. Independent directors are not entitled to get. They can get sitting fees for the meeting. They are allowed for reimbursement of expenses. They are allowed for commission on profit, but they are not allowed to take stock option, because by this option they will get shares and they will become related parties and they will lose their independence. Board of directors report need to be addressed to. If it is unlisted company, only 2 members. If it is a listed company, 2 members as well as SEBI. So in this case nothing is given. Let's check for 2 options, that is members and SEBI. Central government, stock exchange, members, ROC. Only member is given, so go for members. Next one. In another question, they asked for SEBI. Members point is not given. Only SEBI is given. Now we need to go with the option SEBI. Next one. The powers of board of directors may be restricted subject to. No need to look at the options, all of the above. So Companies Act, AOA, shareholders by passing resolution in general meeting. Again, mark this question. Related party transaction is provided in section number 188. Majority of audit committee members shall be. Actually, the question framing is wrong. So the directors in the audit committee, in those directors, majority directors shall be independent. Next one. Independent directors separately shall meet dash in a calendar year once. For board meeting, quorum as per the act, 1/3 of total number of directors or 2, whichever is higher. If dash number of directors require that resolution under circulation be placed in the board meeting for decision, it has to be complied with. So generally company can go for resolution by circulation. But what happens if 1/3 of the total directors ask to conduct board meeting only? They need to conduct board meeting only. So answer is 1/3. Minutes of board meeting shall be signed by chairman of the board. No, it is not the chairman of the company. Chairman of the board meeting. What happens if it is resolution by circulation? Because in case of resolution by circulation, there will be no meeting at all. Then it will be signed in next meeting. So the answer is B. Chairman of the present meeting if the meeting is conducted. If meeting is not conducted, that is if it is RBC, resolution by circulation, chairman of next meeting. Next one. Minutes of board meeting are to be preserved for permanently. Next one. Minutes are supposed to be kept at. Any register need to be kept at register office. SFIO stands for Serious Fraud Investigating Office. Next one. The decision to authorize buyback by board can be made by only board meeting. So I already said about how to make resolution. Board of directors can make resolution by conducting board meeting, or without conducting board meeting also they can pass the resolution. But board of directors can exercise all the powers by conducting board meeting only. But there are 4 powers which can be utilized by the board of directors without conducting board meeting. What are those 4 powers? Borrowing money, investing money, making LSD transactions. LSD transaction means loan by the company, security by the company, guarantee by the company. So for these powers, they can use resolution by circulation also. But the question is about buyback, which is not covered in those list. That means they need to conduct board meeting only. Only in board meeting. In case chairman is executive, at least how many directors need to be independent? So if it is executive, 1/2. Non-executive, 1/3. Majority of members of audit committee shall be, same question, independent directors. Again it is repeated, you need to strike it off. Next one. Board of directors are supposed to address their report to. Now SEBI is given. So go with SEBI. The provisions relating to investigation are provided in which chapter of the act? Mark this question. Chapter 14. So inspection, investigation, inquiry, all these provisions are given in chapter number 14. Next one. If a company want to punish an employee or officer of a company, it has to take permission of. So this is in case of investigation. In case of investigation, if any employee or officer supports the investigation person, then they need not be punished by the company. If company want to punish them, they need to take the prior approval of NCLT. Next one. The investigating officer has the power of inspection taking evidence as per. So all these powers are given as per civil code, which is nothing but civil procedures code. So civil procedure code will contain the provisions regarding how to handle a civil case. Criminal procedure code will contain the provisions regarding how to handle a criminal case. So this will come under civil procedure code. Next one. In case of merger, the transferor company will be dissolved. Next one. The auditors has to confirm in the scheme that, so in case of amalgamation or merger, or in case of compromise or arrangement, so what auditor need to confirm? He need to confirm accounting standards. That's it. No need to confirm Companies Act. On amalgamation, the following are transferred to the transferee company. Rights will be transferred, liabilities will be transferred. That means answer is both of the above. Next one. When a transfer company is listed company, And transferee company is an unlisted company. The transferee company will become, so listed company, unlisted company. Now unlisted company acquired listed company. Now what will happen to this unlisted company? Nothing will happen. But in future, if it listed its securities with any recognized stock exchange, then it will become listed company. So answer is C. It continues to be an unlisted company unless it is listed by complying with listing requirement. Next one, power of majority is subject to. So generally, any decision can be made with the help of majority rule, but this can be restricted by Companies Act, by case laws, common laws means case laws, or by memorandum of association, that means all of the above. Next one, any act done by the directors beyond authority is called as ultra virus. A case of oppression, application may be made on fraud on minority, ultra virus activity, so breach of duty. So all of the above. When it is all of the above, no need to see the options. Application has to be made for relief of oppression to NCLT. But I think in our MCQ booklet, the answer is given wrong, ROC. But we need to file the application to NCLT. So mark this question. In exam, just follow what is given in MCQ booklet. They will simply copy paste the question. So while copy pasting the question, answer will be same. If it is a mistake, the mistake will be carry forwarded and valuation will be done based on such answers. Next one, powers of tribunal is listed in section number. It is 242. Mark this question, section number. Next one, statutory auditor can also function as internal auditor, no. Financial advisor, no. Accounting solutions advisor, no. Tax auditor, yes. That means the same person can do both statutory audit as well as tax audit. Statutory audit under Companies Act, tax audit under Income Tax Act. Next one. Okay, next one. A CFO of a company has to be any person. Need not be a CA, need not be a CMA, need not be a MBA graduate. So answer is none of the above. Sitting fee of board meetings and board committee meetings may be same, may not be same. Both are same. So here it is mandatory, shall. So don't follow mandatory provisions. It is completely optional. So sitting fee in case of board meeting and sitting fee in case of committee meeting may be same, may not be same. So the correct answer is B. What about A and C? They are saying shall, which is mandatory. That's why they are wrong. Next one. Disclosure of interest by director. Don't see the options. All of the above. So at the time of appointment, he need to disclose about his interest. At every year, he need to disclose about his interest. And if there is any change in the interest, then also he need to disclose about it. That means all of the above. Next one. Quorum for a board meeting. 1/3 or 2, whichever is higher. In case of merger of A Limited with B Limited, A Limited is dissolved. Repeated question. Next one. Dividend distribution policy of a company is decided by board of directors. Policy will be decided by board of directors. Later it need to be approved by shareholders. So who need to decide means only board of directors. Companies shall not make investment through more than dash layer of investment companies. But answer given in MCQ booklet is 1. So mark this question. In exam, write it as 1. Next one. Rate of interest in deposit is guided by. This is already repeated. RBI. Strike it off. No eligible company shall accept or renew deposit from members up to. So actually, the question is wrong. Eligible company shall accept or renew deposit from its members up to 10%. In case if it is public, maximum 25%. 10. Interim dividend is decided by board of directors. Books of accounts can be inspected by only directors. Books can be inspected by only directors. Next one. Accounting standards will be prescribed by central government. Central government. So they will recommend it. But who will prescribe it? Central government will prescribe it. Recommendation will be made by ICAI. Next one. The board report is signed by chairman. Where is chairman? Answer is none of the above. Next one. Wait a minute. It is any director. So financials need to be signed by chairman. In case of board report, it can be signed by any director. Okay, next one. Zenith Limited is a company registered in USA and doing business in USA as per Indian law. This is not a foreign company. But when it established place of business in India, it will become a foreign company. So the answer is both 2 and 3. That is option D. Next one. A sectorial company is supposed to comply with both company law as well as sectoral laws. Articles of association can be altered by SR. In case of Section 8 company, CG approval is also required along with SR. Next one. Shifting of registered office from one state to another state. CG approval plus SR both are required. Option B. The following members of company shall have the right to apply under section 241 for operation, namely any of the above. So in case company is having share capital, so 100 members of company or 1/10 of total issued share capital holding members. In case company does not have share capital, 1/5 of total number of members. So all the 3 points are there. So that means any of the above. Next one. IBC was passed in which year? 2016. Yes. Next one. The code, that is IBC, is applicable to whom? All of the above. Next one. The code applies to whom? None of the above. Because bank, insurance companies, asset reconstruction companies, all are providing financial services. So that's why they will not be covered under IBC. An entity in favor of whom security interest is created is called secured creditor. Next one. And what is the time limit to complete CARP? 180 days. Next one. The RP, that is resolution professional, has to manage the company as losing concern, going concern, selling concern, profitable concern, going concern. Next one. Within how many days the first COC meeting should be held? 7 days. And they need to decide about RP. Next one. A resolution professional may be replaced with the voting rights of COC. So whenever this kind of question will come, remember 66%. Next one. The adjudicating authority in case of personal insolvency, DRT. Next one. During bankruptcy proceedings, bankrupt shall not be appointed for trustee. He shall not be appointed as a public servant in any election. So the answer is option A. Only option A. So mark this question, which is against to our fundamental principle. Next one. So CARP need to be completed within 180 days. If in the option 330 days is given, 330 is the maximum time limit. 180 is the normal time limit. So you are required to follow only 180 and 330. That's it. Extra 90 days. If they want to take extension, maximum 90 days. That's it. So they will not give 270. That is what I am saying. They will give either 180 or 330. Mainly they will give 180 only. Because in institute study material also it is printed as 360, which is wrong. Actually it is 330 only. That means they are going to give only one option, that is 180 days. Next one. IBC is not applicable on financial service providers. So with the introduction of IBC, the following laws has been repealed. Just follow our fundamental, that is all of the above. So Companies Act 2013 contains some provisions regarding insolvency. Companies Act 1956 contains some provisions. SSE Act contains some provisions. All these provisions are now deleted because a separate code is established for the purpose of insolvency called as Insolvency and Bankruptcy Code. Next one. The Insolvency and Bankruptcy Code has the power of dash in respect of issue of summons, discovery and production of books, inspection of books or registers, issue of commission for examination of witnesses. All these powers are powers of civil court. So answer is civil court. You will get these powers in DT also. Next one. The following institutions are insolvency professional agencies. All of them. But answer is Institute of Cost Accountants of India. Very biased question. So actually correct answer is all of them. But institute is following option A. Next one. The authority provided under IBBA to administer and regulate the law is IBBA only. Next one. Related party in relation to corporate debtor. All these people are related parties. So answer is all of the above. A person under IBC is all of the above. Just follow the person definition which is given in Income Tax Act. Next one. A person shall not be eligible to submit a resolution plan if such person or any other person acting jointly or in concert with such person. So all of the above. So these people are not eligible to provide resolution plan. That means these people are not eligible to become resolution applicant. So triple bottom line, 3 P's. Planet, people, profit. Option B. Next one. At which level corporate governance is more relevant? Top level. Next one. Which among the following would amount to undesirable practice by a senior executive of a company? So actually these 3 will be classified as undesirable practices, because using published information, it is good only, no problem. But using unpublished information of other entity, so it is not good. And luring the executives of other entity, it is also not good. But among these 3 options, which is better option is option C. So mark this question. Next one. Which out of the following would not amount to sustainable development activity? Paddy cultivation. Remaining 3 are sustainable development activities. Next one. Corporate governance practices are almost dashed by companies in India, regulated by SEBI regulations. The latest committee on corporate governance was Kotak Committee. So this is the latest one. Next one. The ideal implementing agency of CSR project should be Section 8 company, trust, society, any of the above. Next one. Economic approach to sustainability relates to economic, profit. Economic means profit. Next one. Corporate governance is more about fair method of managing the company. So mark this question, because they had given method of managing a company, fair method of managing a company. Which is better option? Fair method of managing a company is the better option. The items under schedule number 7, nothing but CSR related items. So how to interpret them? We need to interpret liberally. That means we can add some more CSR activities. Next one. CG practices should target to keep balance among. CG means not central government, corporate governance. So corporate governance practices should target to keep balance between all stakeholders, not shareholders. We need to take stakeholders. When a company evaluates an implementing agency, what is the first step? They need to examine the documents first. So this is first step. Every CSR activity is ultimately for beneficiary, that is public. Next one. The CSR fund earmarked for ongoing project need to be spent within how many years? 3 years. Next one. Clause 49A, which was the first major compliance of corporate governance by listed companies, was on the basis of recommendation of, it is Kumar Mangalam Birla. Next one. Corporate governance is close to ethical conduct of business. A foreign entity cannot become implementing agency. So implementing agency must be Indian entity. Next one. Some of the reasons for which companies cannot practice good governance may be any of the above. Next one. A company sponsors the expenditure of a primary school of physically disabled students having 200 students. 3 employees' children being physically disabled have also been admitted in the school. So can I call it as CSR activity? If it is for the exclusive benefit of employee or employee family members, it is not CSR. If it is for the benefit of entire public, whether or not including employees and employee family members, it will be called as CSR activity. So in this case, the school will qualify for CSR project. Option A. Which will not qualify as CSR expenditure? So giving donation to unrecognized charitable organization. So this is not CSR expenditure. Remaining are CSR expenditure. Next one. What are the advantages of direct implementation of CSR activity? All of the above. Advantages of third-party implementation of CSR projects. Very good. All of the above. CG ratings are done by, any rating will be given by rating agencies, credit rating agencies. Audit committee can interact with both statutory as well as internal auditor. See, the recommendation of the audit committee, so may not be accepted by board of directors, has to be accepted by board of directors. In case not accepted, board has to record the reasons. Recommendation need not go to board meetings. So first 3 options are correct, but among 3 options, third one is better option. Mark this question. Next one. Which of the following is the advantage of family business over non-family business? So they will have deep industry insights. Maximum number of days for keeping issue open, 3 to 10 days. That is 10 days. Minimum 3, maximum 10. At the time of IPO, the issuer has to have a compliance officer in order to check whether the company is following SEBI regulations or not. Next one. Which of the following do not require prospectus? Bonus issue. Because in case of IPO, in case of FPO, even in case of rights issue, in case of renunciation, public will participate in the issue. Whenever public is participating in the issue, definitely company need to issue prospectus. But in case of bonus shares, only existing shareholders will participate. So that's why prospectus is not required. And what about the minimum face value? 1 rupee. Minimum face value 1 rupee. Actually it is 1 to 10 and 10. So it all depends upon. Wait a minute. I'm saying about minimum face value. Minimum face value is 1 only. So 1 to 10 and 10. So when to follow 1 to 10? So more than or equal to 500 rupees. When to follow 10? Less than 500. But nothing is given here. So that's why among entire limit, what is the minimum? 1. So go with 1. Takeover means, what is meant by takeover? Acquirer will take over target company. So what is meant by takeover? Acquiring shares so that you will get control over the management. Next one. The purpose of the SEBI Act is to provide for the establishment of a board called Securities Exchange Board of India. The preamble to the Act provides for the establishment of a board too. All of the above. SEBI has 3 functions into one body. Legislative function, judicial function, executive function. Legislative means it can create law called as SEBI regulations. Judicial means it can punish the people who fails to follow the law. Next one, executive means it will implement the law. So legislative means law maker, judicial means law follower, and executive means law implementer. Yes, SEBI is doing all the 3 roles, but what is the question? Which is not the function of SEBI? Answer is official. Quasi-official is the answer. Next one. For appointment, reappointment, remuneration and removal of director in case of banking company, prior approval is required from RBI. Competition Act has replaced by MRTP Act. Next one. Turnover threshold for individual company operating in India in combination is, actually here various turnover limits are given. You need to refer the chart once. But here answer is 8,000. So this is from Competition Act. Which is not the objective of CCI. CCI means Competition Commission of India. So to promote startup is an objective. Promote and sustain competition, it is an objective. Protect the interests of consumers, it is not the objective. Because it is about competition, not about consumer protection. So that's why it is not objective. And prevent anti-competitive practices. Yes, it is an objective. Next one. Selling products or services below the cost is called as predatory pricing. So actually, who implemented predatory pricing? Reliance Jio. So it implemented predatory pricing, so that competition got eliminated. Next one. So again from Competition Act, which is about limit, the answer is 4 billion. Which of the following is not the type of unfair competition? So this is unfair competition, collusive price fixing. That means all entities together will fix the price. So it is unfair competition. Creating barriers to entry. That means now if anyone tries to come to the industry, you will restrict those people. So it is also unfair competition. Predatory pricing, it is also unfair competition. So among them, which one is not unfair competition? Tie-in purchase. What is meant by tie-in purchase? It may be just like offer, or it may be anything. So adding one product to another product. So if you want to sell the product individually, you can. But instead of selling the product individually, you are adding one more product. So this is called as tie-in purchase. So this is not unfair competition. Next one. What is not the objective of Competition Act? To prevent competition. So to prevent competition, is it correct? No, to protect competition is the correct one. But here they are asking not an objective. So this is not an objective. Next one. Unfair competition under Competition Act 2002 means adoption of practices. All of the above. Next one. Now, a large number of producers, sellers, distributors, traders, service providers formed an association in order to do unfair trade practices. Then such group will be called as cartel. Next one. Which of the following is not the benefit of CSR program? So you will get all these three things, but mutual trust, it is wrong option. So this is not a benefit of CSR program. Next one. Now, Competition Appellate Tribunal. I want to go against to the order which is given by the Competition Appellate Tribunal. So what is the time limit for it? 60 days. And where to go? Supreme Court. Next one. The chairperson and every other member shall hold the office for a term of 5 years. Next one. So in case of wrong combinations, the CCI can impose fine. How much fine? So 1% of total turnover or 1% of total assets, whichever is higher, that will be the punishment. Next one. The commission. Okay, all of the above. Next. So there is no time. We need to complete all the questions. Okay. If the commission does not, on the expiry of period of dash days from the date of notice given to the commission. Actually, whenever two companies want to merge with each other, they need to make an application to the CCA. And CCA need to look at the application within 210 days. If CCA fails to give reply within 210 days, then the approval is deemed to be given. So the time limit will be 210 days. Next one. What is meant by automatic route? Without any approval. That means without the approval of RBI, without the approval of central government. So this question is from FEMA. Next one. For investment in market securities, FII are to be registered with. So any security, market security related concept, we need to refer SEBI. DPIIT comes under industry and commerce. So they will give status of startup companies. So it will come under industry and commerce. Next one. Sale of shares from resident to non-resident. In case of transaction between resident and non-resident, if any person is creating asset in outside country or creating liability in outside country, then it will be called as capital account transaction. So this is a capital account transaction because for one person an asset is being created in another country. That's why it is called as capital account. And what about current account transaction? Anything other than capital account transaction is called as current account transaction. Next one. Foreign direct investment is prohibited in which sectors? All of the above. And what about LRS limit? All of the above. Actually, it is 2,50,000 US dollars. But the question is not about limit. It is about purpose. The purpose is all of the above. Next one. Eligible borrower can raise up to dash million US dollars through ECB, through automatic route, 750. So you need to by heart these numbers. Total maximum remittance under financial year under LRS scheme is Just now we discussed about it. 2,50,000 US dollars. The following remedies are prohibited. All of the above. Next one. Zenith Limited is a company registered in UK. It issues shares to the citizen of UK. Under Indian law, the shares are nothing. Because Indian is not involved there. India is not involved there. That's why it cannot be called as Indian security, foreign security. That means answer is none of the above. FEMA dash foreign currency transactions. So before FEMA, there is an act called as FERA. So FERA will prohibit the foreign exchange transactions, whereas FEMA, it will restrict the foreign exchange transaction. Answer is restrict. NPA stands for, very simple question, non-performance asset. Banking Regulation Act was enacted in 1949. Cash reserve ratio should be dash percentage of total time and demand liabilities. 4. SLR stands for statutory liquidity reserve. Banking companies cannot pay dividend unless following completely written off. All capital expenses need to be written off. So preliminary expenses is a capital expense, brokerage is a capital expense, commission is a capital expense. So the answer is all of the above. Asset reconstruction company ought to be registered with RBI. So asset reconstruction company will buy the bad debts of the bank. So it is related to bank. So that's why RBI approval is required. Next one. And what about the judicial authority in case of SARFAESI? So it is bank related. So we need to go with DRT, Debt Recovery Tribunal. So for SARFAESI Act, the adjudicating authority is DRT. Amalgamation of banking company requires dash percentage of voting of shareholders, 2/3. So from Banking Regulation Act, every banking company shall maintain liquid assets not less than dash percentage of total time and demand liabilities, 25. Every banking company incorporated in India shall prepare balance sheet and profit and loss account as on accounting year, that is financial year. Next one. According to Banking Regulation Act 1949, no banking company shall pay dividend on shares until all its capital expenses are completely written off. B. Minimum paid up capital for life insurance business. So remember a point, in case of insurance companies, minimum paid up capital is 100 crores. But in case of reinsurance, 200. So answer is 100. Banking Regulation Act was enacted in, repeated question. Officer appointed by central government is called as, in case of insurance act, officer appointed by the central government is called as controller of insurance. Next one. In case of insurance company, dash percentage of assets have to be remained invested in government securities, 25. Actuarial valuation. Who is actuary? He is the valuer who will value the liabilities. So actuarial valuation on life insurance business has to be done once in 1 year. Insurance policy made by insurer shall not be questioned after 3 years. That's why you need to open insurance policy now. After 3 years, you are eligible for each and every disease. But for first 3 years, you are not eligible for certain diseases. Next one. Insurance business is regulated by none of the above. IRDA was established in the year 1999. Next one. Minimum paid up capital again 100 crores. The chairman of IRDA shall hold the office for 5 years. Next one. The amount credited to Insurance Regulatory and Development Authority Fund shall consist of all of the above. IRDA shall within dash months after the close of each financial year submit to the central government a report giving true and full account of activities including activities for promotion and development of insurance business during the previous financial year, 9 months. Nothing but they need to give you about the advertisement regarding insurance business within 9 months from the end of financial year. Next one. The principle of dash ensures that insured does not profit by insuring with multiple insurers. Indemnity. Actually, insurance contract is indemnity contract. The policyholder will suffer loss. That loss will be indemnified by the insurance company. Next one. An actuary is expected to. He need to expect exact forecast of future liabilities of the policy. And he need to give actual report once in a financial year. The Insurance Laws Amendment Act was passed in the year 2015. Next one. Life insurance business will provide all the benefits. Next one, the amount of indemnity may be limited by certain conditions, which may be all of the above. But you need to read the questions once. In case of fire and motor accident insurance, the insurable interest has to be presented. Actually, so if I purchase a car now and I took insurance policy, I need to have insurable interest. If anything is happened to the car, if I want to claim the insurance claim, then also I need to have insurable interest. That means at the time of taking policy, I need to be the owner. At the time of claiming the policy also, I need to be the owner. That means at both times I need to be the owner. Next one, NSIC stands for National Small Industries Corporation. Next one, if a unit has investment in plant and equipment of 55 crores and turnover of 300 crores, it will be classified as none of the above. You need to refer the limits for micro, small and medium enterprises. Next one, and while calculating the value of assets, you need to ignore land, furnitures and fittings. So answer is both 1 and 2. Next one, while calculating the value of assets, so the value of the following will be excluded. So exports will be excluded. So actually for micro, small, medium enterprises classification, you need to refer value of assets and total turnover. You need to refer value of assets, that is plant and machinery investment, as well as turnover. In case of plant and machinery, you need to exclude land, furniture and fittings. In case of turnover, you need to exclude export turnover. Next one, certifying authority to get license to operate from. Nothing but I want to get DSC, digital signature. So for that purpose, I need to approach eMudra, Capricorn like agencies, and those agencies will get license from controller of certifying authority. Which among the following is not an offense under IT Act? This is an offense, this is an offense, this is an offense, this is authority name. So that's why this is correct answer. Next one, information technology, reasonable security practices and procedures and sensitive personal data or information rules was notified in the year of 2011. OSBA stands for Open Source Business Intelligence. The key benefits that businesses can get from BI application include the ability to all of the above. Decision of cyber appellate tribunal can be appealed to High Court. Next one, information, all of the above. Next one, which among the following is not a cyber crime? So tampering, hacking, so publishing obscene information, all these are cyber crimes. But sending threatening messages by email is not cyber crime. Next one, which of the following is not an cyber offense? Terrorism, warfare, piracy, data alteration, all are cyber offenses only, but they are asking about cyber offense to public. So terrorism is based on public, warfare is based on public, piracy is based on public, but what about data alteration? It is based on some individual persons, not about public. Next one, so accessing someone's computer without their authorization, trespassing, not hacking, it is trespassing. Next one, every reporting entity shall maintain record of all of the above. Actually we completed this question also. FIU stands for Financial Intelligence Unit. Next one, in part B of schedule, offences involved a value of rupees dash is mentioned, 1 crore. STR stands for Suspicious Transaction Report. Reporting authority shall send KYC data to central registry within how many days? 10 days. So introducing illegal funds into the financial system is called as placement. The cases under PMLA can be tried in special courts. Okay, successfully we completed 20 marks. So total 60 plus 20, 80.